thing is that let's dive into the core principle of effective and secure credit management. At the heart of it, at the heart of it, there is something called, prudent credit management. You can see at the heart of it, there is something called prudent credit management, something every banker and every financial professional should master, right? So this prudent credit management ensure that loan are given wisely, risk are minimized, bank remain financially strong. But what are the key pillars that support this? So the first thing is, adequate security. What it means, just like a safety net, this ensure that loan is backed by asset, reducing the risk of default. The stronger the security, the safer the loan. The second is called safety of fund. So what is safety of fund? So bank don't just lend money, they need to ensure that they get it back. So this principle protect the invested capital and ensure its safe return. The third reason is justifiable purpose. Justifiable, right? And there's another point which is called profitability potential. These are the some key prudent case. So you can see profitability potential. What is the meaning of profitability potential? See, at the end of the day, bank are businesses. Every loan should have high probability of generating financial return, ensuring sustainability. And then finally we have liquidity, which means, ever heard the phrase cash is king? Have you ever heard cash is king? Right. So bank must maintain liquidity to meet financial obligation, ensuring they don't run out of fund. So each of these principles, remember these are the five principles. They play a super important role. So let me summarize the principle in just one pick. So you can see adequate security, safety of fund, justifiable purpose, profitable potential, liquidity. So each of these principles plays a vital role in building a secure and profitable credit system. Ignore any one of this and the entire structure can collapse. Now here is a quick question for you. Which of these five principles do you think is the most important for bank? Drop your thought in the comment below. So I have given you the five principles. Now to the next slide, and the next slide, as you can see, is related to the legal framework for Indian entity. Whether you are an entrepreneur, a finance professional, or just someone curious about business law, this is something you must know. In India, different types of entity operate under different legal framework. Let's break them one by one. So the first one is none but individual, as you can see, individual, right? So they are governed by the Indian Contract Act 1872, which define the rules for forming a valid contract, right? The second we have is partnership firm. So partnership firm, you must know that these follow the Indian Partnership Act in 1932, right? So this law define how partners share profit, responsibility and liability in a business. So this is about the partnership firm. Then we have something called LLP. What is LLP? Limited liability partnership. So these follow Indian Partnership Act. They follow they follow the LLP Act 2008, right? So this structure offered the benefits of partnership but with limited liability. Then we have something called company, right? So for company, which kind of act they follow? They are regulated by the Companies Act 2013, right? They are regulated by the Companies Act 2013, and this law govern private and public company, ensuring transparency. And then you have, Hindu undivided family. So they are managed under Hindu Succession Act 1956, and this framework apply to family running a joint business, ensuring proper succession and management of asset. So each of these legal structure has its own rule, right? Each of this management structure has its own rule, right, and advantage, limitation, making it crucial to choose the right one for you. So tell me, which business structure do you think is the best for a startup? Please let me know in the comment section. Then let's look at some more, right? Besides, in addition to all these companies, individual, HUF, partnership firm, we have some more, right, for organization, as you can see. So friends, in this slide, we are diving into important topic, that is regulatory framework for organization in India. So whether you are a business owner, investor, finance enthusiast, understanding this framework is very essential for navigating the corporate world. First thing first, it's called statutory corporation. These are government created organization governed by specific acts, right? For example, RBI, LIC, SEBI, they plays a crucial role in economic stability. Then we have something called cooperative society. You must know they are regulated under the Cooperative Society Act 1912, Multi-State Cooperative Society Act 2002, or state specific law. And these organizations are formed to promote mutual benefit, especially in agriculture, banking, rural development. Then come trust and REIT. So what is REIT? Real Estate Investment Trust. So these are regulated by multiple trust act, including the Indian Trust Act, right? Including Indian Trust Act, Public Trust Act, Religious and Charitable Endowment Act, and the WAFC Act. And yeah, club and association, right? So club association, so basically these organizations follow registration legislation, right? So basically, club and association, if we talk about, so these organizations follow registration legislation to ensure compliance and accountability. So please tell me, which of these regulatory body do you think impact our daily life the most? So we have talked about some regulatory organization here: statutory, cooperative, trust and REIT, club and association, right? So friends, that's about the regulatory organization. Now let's switch our focus and let's come to the empowering economic growth through inclusive priority sector lending. So this is all about the priority sector lending. So let's focus our attention on this particular topic. So this is the we are unlocking the secret of inclusive economic growth. So banks are not just about business; they also play a crucial role in national building by lending to sector that drive economic progress. So which area benefit the most from PSL? The first area is agriculture. So you must know what are the things are included under PSL. The first is agriculture. So farmers are the backbone of our economy. PSL ensure that they get the financial support for farming activity, irrigation and agriculture development. Then we have MSME. MSME, this is called micro, small and medium enterprise. I think you know about it, right? So these business create jobs, boost innovation, strengthen local economy. So PSL provide them with much needed capital to grow and thrive. Then we have export credit. Okay, first of all, let's see the housing portion also. Here it is. Here you can see this is housing portion. So housing portion. So affordable housing is a key pillar of development. PSL help fund housing infrastructure, making home more accessible and affordable. Then we have education. Higher education should not be a privilege. PSL promote student loan financial assistance to ensure that education is within reach for all. And final thing is export credit. So that global trade is essential for economic progress. So PSL encourage export by providing credit to exporter. So without PSL, many critical sector will struggle for fund, slowing down development. So friends, I hope this makes sense to you. What are the sections which are included in the PSL? So friends, before moving forward, let me give you a detail about our crash course which I have just launched. So this is the crash course which I have launched from 15th March. And in this crash course, what I have done, I have prepared two separate folders. As you can see, one is the static folder and one is the daily updated folder. So this is daily updated folder, and in this folder you can see the schedule here, right? So schedule you can see from 15th March to 31st March EVM, then 1st April to 15th April AVFM. Similarly, the rest 3 subject. And you can see I have created a separate folder for AVM. Inside it, the first day target has been given. That I have just added the PDF, and then we will add the videos. Then we will add the quizzes. So on daily basis you will receive PDF, videos and quizzes. You just have to make sure that the content provided in this folder you have to do on daily basis. That's it. And the rest thing is taken care of by me. I guarantee you that the content which I provide you is sufficient to be covered in just one day by devoting just 1 hour to 2 hour of the time, because the video is just for 30 minutes to 40 minutes, right? And the rest time you have to devote toward practicing MCQs, practicing quizzes, which I will add in this particular folder. So if you want to get if you want to enroll in this particular course, you can get detail. It only costs rupees 700 after applying 30% discount, which is till today, right? So you can WhatsApp me on this particular number is provided on the screen, or in the description section you will see the link of the course. Friends, I guarantee you that if you are feeling short of the time, if you don't have much time to cover in the entire syllabus, then this course is very much beneficial for you. So now let's continue our discussion. Let's see the breakdown of PSL. So friends, let's see the breakdown of PSL, how it works. So let's get deeper into the PSL and how it supports various sectors. So first thing is agriculture financing. I hope it is visible to you. Agriculture finance. So farmer need financial backing at every stage. So PSL cover crop loan, medium term loan and post harvest activity, right? So including transportation with funding up to 2 crore. So remember this 2 crore for agriculture financing. Up to 2 crore funding is provided under PSL. Then we have something called warehouse receipt. Warehouse receipt. So see, storage plays a vital role in the agriculture supply chain. So advance against and you know what is NWR? NWR is called negotiable. NWR is called negotiable warehouse receipt, right? So advance against negotiable warehouse receipt qualify for PSL up to 75 lakh. Remember it. While for non-NWR backed loan go up to 50 lakh. For NWR 75 lakh, non under NWR 50 lakh. Now what about cooperative society? So farmer and a small producer rely on cooperative society for financial assistance. So PSL provide loan to help them purchase produce and sustain their livelihood. And then we have the next point, as you can see, is agriculture infrastructure. You can see here agriculture infrastructure. So friends, farmer producer company, that is called FPC. Sometimes we call it FPC. Farmer producer company engaged in farming, they can get loan up to 5 crore, right? While investment in agriculture infrastructure and food processing up to 100 crore. They remember these limits. Then for startups, so they can qualify for PSL. Remember it. A startup that contribute to economic growth can avail PSL loan up to 50 crore, right? So this is very important. And then you have the last thing, MSME. You know what is MSME? Micro small medium enterprise. So this is the backbone of our economy. So PSL extend loan to MSME engaged in manufacturing, services, retail, wholesale trading, right? And including KPI, Khadi and village industry, irrespective of the size and location. So by supporting this sector, PSL boost entrepreneurship, enhance financial inclusion and accelerate economic development. So please tell me, which sector do you think? So this is just a glimpse. Every content you will get in our crash course just like this, just like pictorial format. So at the end of suppose 5 days before the examination, you will just go through this PDF and everything will be in front of you. You can just revise it very quickly. This is the main motive of this crash course. Now, can you please tell me, which sector do you think benefit the most from PSL? I hope you can see. So I have given you the list of 6 sector, and can you tell me which sector is benefiting the most from PSL? Now let's switch our focus to the next PSL breakdown, as you can see in the slide. So friends, let's explore another crucial aspect of PSL, the different financial instrument and the segment it support. So you can think of PSL as the wheel of financial inclusion. So one thing, let me zoom a little bit so that the picture is visible to you clearly. Now, the first thing is called general credit card. We call it GCC. You know that MSME often face financial hurdle. To support their specific need, PSL includes credit card designed exclusively for MSME borrower. That is called GCC, general credit card. Then comes, the factoring transaction. As you can see here, right, factoring transaction is also included in the PSL. So as you can see on the left side, that MSME depends on timely payment. PSL cover factoring transaction, allowing business to manage their cash flow effectively. Then overdraft under Pradhan Mantri Jan Dhan Yojana. So financial inclusion start at the grassroots, right? So PSL provide overdraft facility to Pradhan Mantri Jan Dhan Yojana, right? So it starts at the grassroots, yeah, right. So PSL provide overdraft facility to the Pradhan Mantri Jan Dhan Yojana account holder, ensuring easy access to emergency fund. And then we have something called micro enterprise. So on the right you can see micro enterprise. So did you know that 7.5% of the total PSL is earmarked for micro enterprise? This ensures that a small business get the financial boost they need, right? That is, remember this limit, 7.5% of the total PSL is earmarked for micro enterprise. Then we have something called decentralized support system, the decentralized sector support. So a small scale industries and rural entrepreneur plays a vital role in the economic development. So PSL offer loan for decentralized industry support. And then finally we have MFI, that is called microfinance institution. So to empower a small business and self-employed individual, PSL facilitate funding through microfinance institution. So with this financial tool in place, PSL ensure that every sector from micro enterprise to rural industry get access to the fund they need to thrive. So please tell me, which PSL segment do you think make the biggest impact? Which PSL sector make the biggest impact? Now, then we have something called housing finance loan limit. Remember, in this particular diagram, we will understand how much housing finance loan is provided to the PSL. So let's decode another important category under priority sector, which is called housing finance. So home loan are a crucial part of financial inclusion, right? So as you can see here, metropolitan housing loan, right? The limit is 35 lakh. So remember, this data have been given in lakh, as you can see. So metropolitan, so loan for housing in metro city have a maximum cap of 35 lakh under PSL, right? So given the high cost of living, this help urban dwellers secure house finance. And now for metropolitan housing cost cap, so this is the cap, not so 35 lakh is the right. For housing project in metro area, the total cost cap is 45 lakh. It cannot exceed this under PSL, right? So if you are taking maximum 45 lakh loan under PSL, this is the cap they have put you, right? And then other reason housing loan, right? For non-metropolitan area, housing loan are capped at 25 lakh, up to 25 lakh, and maximum maximum it can go, right, is up to 30 lakh, right? So you can see for metropolitan 35, under 35 will be PSL, and maximum up to 45, right? And for other reasons 25 to 30. Then comes metropolitan repair cost. You know that for metropolitan repairing, if you are doing repairing works, so home loan repair in metro city also qualify for PSL loan with a limit of 10 lakh to help homeowner to maintain their property. And for other reason, a home repair loan, it is for 6 lakh, 6 lakh under, for non metro area the limit for home repair loan is 6 lakh. Then we have something called HFC. You know what is the meaning of HFC? This is called a house finance company. So housing finance company can avail refinancing loan. They can avail the refinancing loan, right, up to 20 lakh. This 20 lakh is under PSL, under the NHB guideline to extend affordable credit to home buyer. So I hope this makes sense, right? So what do you think? Is 35 lakh enough for metro housing? Drop your thought in the comment. Now let's see the breakdown of priority sector lending further. Education loan. So friends, up to 20 lakh education loan is under PSL. Remember this limit, 20 lakh, right? And for export credit, what about export credit? So export credit, Indian farmer and MSME are the backbone of our economy. Under PSL, export credit is provided to them. Then if we talk about the social infrastructure, then let's talk about the social infrastructure. So remember the limit. Remember the limit is 5 crore, right? Remember the limit is 5 crore per borrower. For social infrastructure, the limit is 5 crore per borrower. Imagine a world with better school, hospital, sanitation facility. So bank lend up to rupees 5 crore per borrower to fund essential infrastructure. Then we have renewable energy financing. So with the rise of sustainable energy, PSL also support non-conventional energy project like solar, wind, bioenergy, right? So that is the point. So I hope the sectors limit have been clear to you. Now let's switch our focus to some more sector. Like you can see, let me zoom a little bit here so that you can see large scale loan, right? So as the world shifts towards sustainable energy, financing plays a key role in making green project a reality. So first thing first, as you can see here, large scale loan. What does it mean? See, up to 30 crore. Remember, so up to 30 crore. Up to 30 crore, big project need big investment, right? Whether it is solar farm, wind park, hydro plant, bank offer loan up to 30 crore to support large scale renewable energy initiative. Then we have individual borrower loan. So want to install solar panel on your rooftop or set up a small biogas unit, you can get loan up to rupees 10 lakh for individual project. For a smaller loan, right? For a smaller loan, what happen? So a small group, communities or a startup can borrow up to rupees 1 lakh for renewable energy solution, making clean energy accessible for all. Why this is important? Because green energy means green future. So PSL make renewable energy more affordable. So I hope that makes sense to you, right? Let's look at the next classification, right? So now let's look at some more classification of this PSL. So friends, did you know that even a small loan can make a big difference in people's life, right? Under PSL, bank offer a small loan to help individual and community grow financially. As you can see, the first point is a small loan to individual. That if you need a loan but worried about income limit, so bank provide loan up to rupees 1 lakh, right? For individuals and their self-help group or JLG, joint liability group. Remember it, right? Now eligibility is that household income should be less than or equal to 1 lakh in rural area. Remember, your household income should be less than or equal to 1 lakh, or in non-rural area it should be less than or equal to 1.60 lakh. Then you will receive 1 lakh as a loan, right? So that is the point. And this thing is very important. For SHG and JLG loan, up to 2 lakh can be given. So if it's an individual, then 1 lakh can be given, provided his income should not be greater than 1 lakh and 1.6 lakh in non-rural area. But for SHG and JLG loan, right, a small group working for non-agriculture and non-MSME activity can borrow up to 2 lakh for house repair, for toilet construction or common group activity, right? So that is the point. Now for distressed individual, let's talk about the distressed individual. So for distressed individual struggling with debt from informal lender, bank can help by providing loan up to 1 lakh to repay non-institutional debt, lender, right? So because financial access empower rural household, women-led business, and a small community, so paving the way for economic growth and self-reliance. Now let's see the bigger picture here. So friends, in this particular slide, Did you know that different bank have a specific lending target under the PSL? So let's get started. So the first category you can see is a domestic commercial bank, excluding RRB and SFC. Total 40% target is there. How much? 40% target. So you can see, using this picture you can easily remember all the data. No need to go through those hectic tables. Now 40% target. This means these banks must allocate 40% of their ANBC, adjusted net bank credit, to priority sector like agriculture, MSME, housing, and more. Now let's come to the next part. Foreign bank with 20 plus branches. So their limit is 40%, right? So they follow 40% lending criteria. For foreign bank export credit. So out of this 40%, 32% must go toward export credit. Bank involved in export credit have slightly target at 32%, and remaining 8% should go to other sector. I hope this bifurcation is clear. Out of this entire, suppose this is entire 40%, so it says that it says that 32%. So this portion 32% should go to export credit, and remaining 8% to other sector. Now let's talk about the biggest priority sector contributor. As you can see this diagram, the biggest priority sector contributor is RRB and SFB, regional rural bank and a small finance bank, because they lead the way with a massive 75% target. And especially for this RRB and SFB, medium enterprise contribution should be 15%, right? Each of this sector gets 15%, social infrastructure 15%, right? And renewable energy 15%. So this bifurcation must be clear to you. Now let's switch our focus to our next chart. As you can see, this is micro enterprise. Okay, so this is minimum lending requirement. How much minimum lending is as per the PSL? So friends, ever wondered how banks decide whether to lend their money under the PSL? Well, there are specific target for different category. As you can see, the first term is agriculture lending. So bank must allocate at least 18% of their loan, ANBC, adjusted net bank credit, or COB, whichever is lower, right? They should allocate at least 18% to agriculture. So this ensures that farmer loan to farmer and agribusiness get the necessary financial support to grow, right? So this is about agriculture lending. Now then, after agriculture lending, we have something called SMF. You know what is the meaning of SMF? SMF stands for small and marginal farmer, right? Small and marginal farmer is called SMF. So there is also 10% target for SMF. As you can see, for SMF also 10% target, right? Out of the total agriculture lending, 10% must go through specifically to small and marginal farmer. Remember, out of this total agriculture, total 18%, 10% must go through a small and marginal farmer, right? So that is the point. So then we have micro enterprise. So remember, micro enterprise, the target is 7.5%, right? Except foreign bank with fewer than 20 branches. So this target is not for those foreign bank which have less than 20 branches. For rest everyone, this 7.5% target is there. Then we have weaker section, except RRB. So bank need to allocate 12% of their loan of their ANBC, adjusted net bank credit, to the weaker section. Like I will tell you about weaker section later in this particular chapter. And for RRB, the target is 15% to the weaker sector, right? For regional rural bank, the requirement is slightly higher at 15%, ensuring better financial support for rural development, right? So do you think that PSL targets will be increased for any category? So these are the target: agriculture 18%, SMF 10%, micro enterprise 7.5%, weaker section 12%, except RRB, and for RRB it is 15%. Right, now let's look at this for UCB, Urban Cooperative Bank. Let's look at the target. So friends, UCB is called Urban Cooperative Bank, and you can see March 2022, the target was 40%. So UCB were required to allocate 40% of their ANBC to the priority sector. Then 2023 March, 50%. By the next year, the target increased to 50%. Right. So as you can see, by the next year, the target increased to what? 15%, 50%. Right. And to support more sector in the need of financial inclusion. Then March 2024, the target increased to 75%. It was a significant jump, right? Then especially out of this, for micro enterprise 7.5%. So separate 7.5% of total lending must go to micro enterprise, and for weaker section as usual 12%, right? So this is for UCB, Urban Cooperative Bank. It increased in the phase manner, as you can see, maximum 75%. Now let's talk about the weaker section component. So I told you about weaker section. So as you can see here, some components of weaker section has been given. So what are the components? First component is a small and marginal farmer. So it may be asked, what is small and marginal farmer? So farmer with a small land holding eligible for loan with credit limit up to 1 lakh. Artisan, they are the part of the weaker section. Then cottage industry worker, government scheme beneficiary, a scheduled caste, a scheduled tribe, self-help group, distressed farmer, women beneficiary up to 1 lakh. So these are included in weaker section. Sometimes question is asked that which is not a part of weaker section. So you must know who are the part of weaker section, right? Please go through this particular diagram, this particular table. Everything will be crystal clear. Now let's switch our focus to MSME classification in India. Very, very important. So using this diagram, I will make you clear how MSME are classified in India. So friends, why does it matter? Because MSME are the backbone of our Indian economy, right? So first let's get started with the micro enterprise. So for micro enterprise, investment up to 1 crore and turnover up to 5 crore, right? So this is about investment and this is about the turnover, right? So up to 1 crore investment and multiply by 5. This is 5 crore. This comes under micro. This comes under micro. Okay, what about small enterprise? So investment up to 10 crore and multiply by 5 into 50 crore and turnover up to 50 crore. So these business are a step ahead, scaling operation, expanding their reach. So that's what scale small enterprise. And what about medium enterprise? Investment up to 50 crore. Investment up to 50 crore and turnover up to multiply by 5 to 50 crore. Right? Just you can remember it like this. So these are large scale business that significantly contribute to the economy. Right? So this classification is important because they help in getting subsidies, tax benefit, easier loan. That is why this classification is super important. So you must remember this limit. Just remember the top one and bottom one you can remember by just multiplying by 5. 1, 10, 50 and then 5, 50, 250. These are the limits, right? Investment and turnover. Based on this it has been classified. Now let's switch our focus to the comprehensive credit support review, right? So friends, in this particular slide, are you looking for financial support to grow your business? So India offers multiple credit schemes to help entrepreneurs, especially in MSME sector. So the first one you can see is called GCC. What is GCC? GCC means General Credit Card. I told you earlier about this also. So it is a biometric smart card designed for non-farm entrepreneurial activity. Right? Remember the keyword here, non-farm entrepreneurial activity. I hope that makes sense to you. Then we have CLSS. CLSS is Credit Linked Subsidy Scheme. It supports technology upgradation, right, for businesses, and it offers a 15% subsidy up to 15 lakh, right? Up to 50 lakh, 15% subsidy on machinery investment up to 1 crore, right? Remember this CLSS scheme provide you basically technological upgradation scheme it is, and 15% subsidy it provide you, capped at maximum it can go up to 15 lakh for investment up to 1 crore in advanced machinery. So this limit should be clear. Then we have composite loan. So it is a single window loan covering both working capital and term loan. That is why it's called composite loan. Then we have GCC I have already talked about. So it boosts credit for non-farmer entrepreneurial activity. Then we have something called collateral free loan. So loan without collateral for MSE. MSE is micro and small enterprise, right? Remember medium enterprise is not there, just micro and small enterprise. So loan without collateral for MSE, and it is available for business under PMEGP, Pradhan Mantri Employment Guarantee Program. So why this is important? Because easy financing for a startup and a small business. So you must remember what is CLSS, what are the limits under CLSS, what is GCC, what is composite loan. If you go through book, everything is written line wise. It is very difficult to separate out, to filter out the main content, and that is what I have done in this crash course for you. Right, now let's look at the RBI LEF. LEF is called Large Exposure Framework. This is a super important topic. So what is LEF all about? Let's understand. So friends, that have you ever wondered how bank manage big loan without increasing financial risk? Enter the RBI LEF. So it is a crucial system to safeguard the banking sector. So first thing is sector concentration. The first thing is sector concentration. You know what it means. Bank lend money to different sector. But what if too much is given to one sector? So higher concentration, you must note it down that if concentration is higher, it means risk is higher. If concentration is higher, risk will be higher, right? So this framework ensures that a balanced lending approach. Then we have second thing, counterparty risk. You know about it. That ever wondered what happened if a big borrower failed to repay? Bank assess the risk of lending to large entity, ensuring that they don't put all their egg in one basket. Then we have something called exposure limit. Yes, very, very important. Try to understand. A bank cannot lend too much to a single borrower. So if a bank exposure exceeds 10% of its tier 1 capital, it violates the RBI guidelines. So suppose tier 1 capital is 100 crore. What is the 10%? 10 crore. So bank exposure to a counterparty or connected group equal or exceed 10% of the guys. So that is the point. That is the limits which have been placed. We will discuss the limit in the upcoming slide. And what is tier 1 capital? The core capital that bank must maintain to stay financially strong. The higher the tier 1 capital, the better the bank ability to absorb shock and handle the risk. I think you know about it. Now let's look at the limits for non-NBFC bank, right? For non-NBFC bank, so have you ever thought how much can a bank lend to a single borrower? Well, RBI has a strict exposure limit to prevent financial risk. So first thing, as you can see, for single counterparty, for first point you can say single counterparty, so it is 20%. For non-NBFC, bank can lend up to 20%. It means that bank can lend up to 20% of their tier 1 capital to a single borrower. But wait, there is a flexibility. With board approval, it can be extendable by 5%. Remember, this is for non-NBFC. Non-NBFC means regular bank, right? And for group of connected counterparty, right, when multiple companies or entities are financially linked, they are considered a group of connected counterparty. And for them, the limit is 25%. So of their tier 1 capital. Remember, every percentage is of the tier 1 capital. Percentage of tier 1 capital. Remember it. So bank cannot lend more than 25% of their tier 1 capital to such connected group. So it reduces the risk of default affecting the entire banking system. So remember, these limits super important. Now let's look at for exposure limit for NBFC. Till now we were talking about non-NBFC bank, but what about NBFC? Have you ever wondered how much bank can legally lend to NBFC? That is called non-banking financial company. In this case also, RBI has set a strict exposure limit. So as you can see, for single NBFC, the exposure limit is how much? 25%. Sorry, so for single NBFC, 20% of the tier 1 capital, and for connected NBFC, group of NBFC, 25% of their tier 1 capital. So it prevents over dependence on NBFC for lending, right? That is the point. And it ensures that bank don't put all their egg in one basket. That is called LAF. Now let's talk about the RBI credit discipline. So friends, when it comes to lending, RBI has set a strict credit discipline to ensure financial stability. But what does it really mean? Let's break it down in the simple term. The first is called loan component. So RBI mandate that at least 60% of the working capital must for large borrower. So when I say large borrower, it means those borrower who have taken working capital of 150 crore and above. That is called large borrower. So RBI says that RBI mandate that at least 60% of the working capital for large borrower must be in the form of loan. So suppose a large borrower there who have taken 200 crore working capital. So at least 60% of that. What is 60% of 200 crore? It is 120 crore. It says that at least 120 crore must be in the form of loan, right? This ensures that borrower don't over rely on short-term borrowing. Borrower don't over rely on short-term borrowing. This is called loan component. Then comes cash credit facility. So bank allow borrowing beyond the loan threshold through cash credit. So this 120 crore, that is at least 60%, minimum 60% should be in the form of loan, and beyond this 120 crore, suppose 80 crore, this can be in the form of cash credit, right? So but wait, there are limit to avoid excessive borrowing. These are the limit to avoid. And you know what are excluded? Export credit and inland sale bill. These are not included in the working capital limit. Remember it. So two things, export credit and inland sales bill are not included in the working capital limit. And there is something called commercial paper investment. If a company raises fund via commercial paper, it counts toward the loan limit. You know, this prevents business from bypassing credit discipline. So why does this matter? Because it prevents over leveraging. It promotes responsible borrowing. It ensures financial system stability. Now, using this diagram, I will break down the MCLR component. So friends, have you ever wondered how banks decide loan interest rate? It all comes down to the marginal cost of lending rate, fund-based lending rate. So the benchmark rate for all the loan. So MCLR has 4 key components, just like 4 sections of an umbrella. So the first thing, as you can see, is called marginal cost of fund. What does it mean? See, this is the cost of borrowing for bank. Simple you can say this is the cost of borrowing for the bank. It includes interest paid on deposit and borrowing from RBI or other source. Second is the negative carry on CRR. So you know, bank must maintain a cash reserve ratio with RBI without earning interest. So this increases their overall cost, known as negative carry. Then we have operating cost. It covers all kinds of administration cost, operational expense of bank. However, service related costs are excluded, like you know, loan processing fee from MCLR calculation. and tenor premium. A uniform premium is added for long-term loan. The higher the loan tenure, the higher the risk. So obviously it's quite clear that if loan tenure increase, risk increase, right? This means premium increase. That is called tenor premium, right? So why is MCLR? This is all about MCLR. Why is MCLR important? Because it determines the loan interest rate. It ensures transparent pricing. The next thing is has the breakdown of MCLR publication requirement. So friends, have you ever noticed that loan interest rate change frequently? That's because bank update their MCLR at different interval. But how often? So MCLR has different tenor and each has its own publication timeline. So the first thing you can see is the overnight tenor. What does it mean? So this is shortest duration of MCLR used for ultra short term loan. Then 1 month tenor. Bank publish this every month. Then we have 3 month tenor. So updated quarterly. Then we have 6 month tenor, right? So it published twice a year. And then finally we have 1 year tenor. So you know that the most common MCLR benchmark is 1 year tenor for home loan and long term loan updated annually. So you must remember this tenor. Sometimes questions are asked based on this tenor. Now let's switch our focus to the pricing floating rate loan. Very important. Ever wondered how bank decide interest rate on loan that keeps changing? So welcome to the world of floating rate loan. In short, we call FRL. So friends, you know, there is a simple four-step process. Step number 1 is to identify the internal benchmark. So the bank first determine a benchmark rate. Think of it like the base rate from which your loan interest start. Then they add the spread component. So next, bank add a spread over the benchmark. This spread account for profit margin. You know, it account for profit margin, right? And it account for credit risk. Obviously credit risk is there. It account for other cost, and they ensure minimum rate. What it means that to protect the bank financial stability, the loan rate cannot go below the benchmark. This ensures minimum profitability, and then they state benchmark in the contract. So benchmark rate must be clearly mentioned in the loan contract, ensuring transparency, ensuring clarity for the borrower. I hope that makes sense to you. Now let's switch our focus to our next topic, which is none but stressed asset classification for term loan. Very important. So friends, have you ever wondered what happens if a loan repayment is delayed, especially term loan? So bank have a structured way to classify loan based on overdue date. So let's step into the world of stressed asset classification. So there is something called SMA, which is called a special mention account. As you can see, a special mention account. So before a loan becoming a non-performing asset, it goes through different stress level. So these are called SMA. So first of all, SMA 0. SMA 0 means what? That if the loan is overdue from 0 to 30 days, right? This is called SMA 0. It enters SMA 0. Then comes SMA 1. If it is overdue for, especially we are talking about term loan, right? If it is overdue for 31 to 60 days, it becomes SMA 1, right? This is a signal for bank to stay alert. Then we have SMA 2. SMA 2, overdue period is 61 to 90 days. It enters SMA 2. This is the, if dues are not paid, this is the most critical stage. If the dues are not paid, right, for 61 to 90 days, the loan entered SMA 2, a serious warning sign of potential default. And then we have NPA. So sorry, if the loan become unpaid beyond 90 days, it officially become NPA. This means the borrower has defaulted and the bank may start recovering procedure. So why does this matter? So this is all. So let me show you this entire classification in the form of peak. Friend, if you think that this video is helpful to you to understand the concept, please hit the like button, because it takes lots of effort to make such kind of slides for you for your better preparation. For the examination time, you just have to go through these important points and you will be able to remember all the fact, and this will specifically help you in your examination, right? So why does this matter? Because it helps bank identify problematic zone early. It gives borrower a chance to regularize payment before defaulting. Then we have something called breakdown of asset classification. Very important, right? So let's talk about it. So friends, every bank hold different type of financial asset, but not all assets are the same. Some generate income while other cause financial stress. So there is something called performing asset. So these are like healthy asset. These are like the healthy asset for that generate regular income. Then we have NPA, non-performing asset. So when an asset stops generating income, it becomes NPA. But wait, not all NPA are same. Let's look at the different types of NPA. For term loan, you must remember, for term loan, if the interest or principal remain overdue for more than 90 days, right, the loan turn NPA. For overdraft or cash credit account, right, if the account are deemed out of order, they are called out of order. Right? When they are called out of order, means there is no sufficient balance or transaction, they become NPA, right? Then we have for bills. When a bill remain unpaid for more than 90 days, it become NPA. For agriculture loan, it is a special case. If a loan is overdue for 2 crop season, it become NPA. So for agriculture loan, it depends on the short term crop or long term crop. For short term crop, it is just one season. For long term crop, it is 2 season. Sorry, for short term it is 2 season, for long term it is 1 season. What about the derivative transaction? So in this case, if there are unpaid receivable in the financial derivative deal, it become a problem for the bank. So this classification is super important. For every different kind of asset, we have different classification for NPA. Now let's look at the provisioning requirement. So this table I will tell you to remember using a trick, right? So this provisioning requirement is super important. Last year also one question was asked, one case study was asked. So let me give you a trick to remember this provisioning requirement. So you need not remember this table, just remember. So there are two kind of case. One is called normal provisioning, second is called accelerated provisioning. First of all, you must remember the normal provisioning. So what you will do, just write here secured and just write here unsecured. And in this side you write the type of asset you have, right? So a standard asset, I think you know about this standard asset, a standard asset, substandard asset, substandard asset, and inside it D1, D2, D3, right? So these are the different cases. So standard. So let's forget about the standard, because standard has very small provisioning. Let's get started with the substandard, right? So suppose substandard asset is there, right? Then we have D1, D2, D3, and finally we have loss, right? D1, D2, D3, and finally we have loss. So loss, loss has to, you have to give 100% provisioning for loss. So let's ignore loss also. Let's talk about D1, D2, D3 and substandard. That's it, right? So how will you remember it? How will you remember it easily? So first thing you do, you write here 100, right? You write here 100. So let me draw the table first. So I hope the table is clear to you, right? Let me use different color plane. So I'm using this color. So 100, 100, 100. What about D1 substandard? You know it. Okay, what about D1 substandard? I think it is also 100, right? For D1, unsecured portion, secured. For D1 unsecured, yes, it is 100. So these 300 you have to just write as usual. These 300. Now for substandard secured, it is 1525, right? What it is 1525, right? So you just write here. You just write here 1525, right? You just write here 15, you just write here 25. You add both of them, it will become how much? So you just put this 25 here and you add both of them, it will become 40. So this is how you should remember this table, right? For substandard secured, provisioning is 15%. For substandard unsecured, provisioning is 25%. For D1 secured, provisioning is 25%, right? Again I am repeating it so that it become very clear to you, right? So first of all, you have to draw this table, right? So this is substandard, this is D1, this is D2, this is D3, this is secured, this is unsecured, right? This is secured, this is unsecured, right? So first of all, you write 100, 100, 100, 100. I hope this is clear. 15, 25. Just put 25 here and just add these two. This will give you 40. So this way you can remember the table. No need to remember this particular table. I hope this makes sense to you, right? And for accelerated provisioning only, you need to remember the provisioning value, right? We will do a separate. I will provide you a separate video on how to do the calculation, right? Because every year one case study they are asking based on this. So I will provide you a separate video in our crash course. Today only I will provide you. So that is the point. So that's all for this particular topic. If you cover this much, that is more than enough for this particular topic. I hope that makes sense to you. And the last slide, you can see these are the maximum extent of guarantee coverage for different category. As you can see, for micro enterprise where credit facility is up to 50 lakh, 85% guarantee coverage is there, right? When the credit facility from 5 lakh to 50 lakh, 75%. For MSE located in northeast region, it is 80%. For women entrepreneur, 85%. For rest of these, you can see 85%, right? STSC, JDD, right? And other category of borrower, it is 75%. So these are the extent of guarantee cover, right? So this chart is also very important. Sometimes questions are asked based on it. So you must check up their financial health. Let's break it down into 5 essential components that form the backbone of financial statement. The first is called balance sheets. So friends, think of this as the financial snapshot of a company. It shows what a company or that is called asset, and it shows what a company on, right, that is called, so what a company on, sorry, what a company on, that is called asset, and what a company or, that is called, liability, right. So at a given point of time, it shows the assets and liability of a company, that's called balance sheet. The second kind of financial snapshot we have is called profit and loss account. So the ultimate performance tracker. This statement details revenue, right? It details expenses. It details your revenue. It details your expenses, right? Whether the business is making profit or whether it is making loss. The third statement we have is called cash flow statement. So it simply means money in, money out, right. So this statement track movement of cash, ensuring business have a smooth liquidity to run smoothly. The next statement we have is the statement of change in equity. So ever wondered how ownership equity shift? So friends, this statement explains how the owner stake in the business changes over time due to profit. It explains how ownership stake changes over the time due to profit, due to losses, or due to investment. So how the ownership equity changes over the time due to profit, losses, and investment. And the last we have is the explanatory note, means the fine print that matters. These notes offer additional context, additional detail, helping investor and stakeholder understand the number better. So each of these component is like a link in the chain, interconnected and crucial for financial decision making. Now I hope this 5 kind of components of financial statement is clear to you. Now the next thing we have to study is the role of financial statement. So friends, financial statement are more than just number. They impact key decision maker. So here we are talking about some key decision maker. Who are the key decision maker, right? So let's dive into their role. The first is lender. Lender is before granting loan, bank and financial institution analyze financial statement to assess the company financial health, right? So it based on company financial health. Second, is called creditor. So creditor is the supplier, creditor is the vendor. So whenever you see this word creditor, it simply means the supplier, it simply means the vendor, right? So they checks a company credit worthiness to decide whether to extend credit or demand upfront payment. The next is investor. Investor means investment is all about trust and potential. So whenever I say investment, it's about trust, it's about potential. So investor analyze financial report to determine if the business is worth funding. Then we have government body. So regulatory authority, they ensure financial compliance and transparency. So regulatory compliance means financial compliance and transparency. So they prevent fraud, they maintain economic stability. Then the next stakeholder we have is none but the rating agency. What is the role of rating agency? So friends, business rely on a strong credit rating. So every business rely on a strong credit rating, right, to attract funding, to maintain credibility in the financial market. Then we have customer. That stability always matter. So consumer prefer financially a strong company, ensuring trust and long-term reliability. Then we have employee. Job security and company culture are directly impacted by the firm financial standing. No one want to work for a company which is on a brink of collapse. And finally, analyst, experts. So expert interpret financial data to provide valuable insight, guiding business and investor forward a smarter strategy. So financial statements are like the backbone of a business transparency, backbone of the business trust. They help business grow, right, and they help investor invest and economy thrive. So that is the importance of this financial statement. Now let's look at the foundation of the financial statement preparation. So friends, have you ever wondered how financial statement maintain accuracy, consistency, reliability? So they are built on a strong accounting principle that guide business toward transparent financial reporting. The first principle is called accrual and matching. Imagine recognizing revenue only when cash is received. Only when cash is received, right? So imagine you are doing that. So that would not reflect the true picture, right? The accrual and matching principle ensure that revenue and expense are recorded accurately when they occur, not when cash is exchanged. So whenever revenue and expenses occur, they have to be recorded only then. That is called accrual and matching. The second principle is called prudence and conservatism. So accounting is not about being optimistic, it's about being realistic. So this word realistic, let me write it down. This word realistic plays a dominant role. right? So this principle ensure that business prepare for possible losses while not overstating gain, promoting cautious financial reporting. The next point we have is called a stable monetary unit and accounting period. So to compare financial performance, consistency is the key. So here is the keyword is consistency, right? So this principle ensure that financial statement use a stable currency and follow fixed reporting period, making analysis meaningful over the time. Then we have going concern and separate entity. So a business is assumed to operate indefinitely unless proven otherwise. Plus a company finance are separate from its owner, ensuring business continuity. So it ensures, it ensures business continuity, right, and independency in the financial record. Then we have consistency, cost, and finally money measurement. So financial reporting should follow uniform standards so that statements remain comparable across times and company. Costs should be recorded based on their actual value, avoiding misleading and inflation of asset. And then we have dual aspect, realization and full disclosure. So every financial transaction affect at least two account, right? One is called debit account and other is called credit account, right? Keeping balance intact. Moreover, full disclosure ensure that all relevant financial information is transparently reported, leaving no room for hidden surprises. So these are the accounting principles which are the backbone of financial statement and ensuring preparation, ensuring accuracy and transparency. So I hope it is clear. Now let's look at the breakdown of the financial structure. Ever wondered how a company financial structure is organized? Let's break it down into four key components, each playing a crucial role in the company financial health. The first is called shareholder fund. This is the backbone of company financial strength. Why? Because it includes share capital. It includes share capital, reserves, surplus, share warrant, all representing the owner stake in the business. All of these represent the owner stake in the business. The stronger the shareholder fund, the more financially stable the company is. Then the second part we have is the share application money. So before share are officially issued, investor deposit fund. What investor do? So investor deposit fund, right? So before the share are issued, before the share are officially issued, investor deposit fund, which are temporarily classified. So these funds are temporarily classified as share application money. This represent the commitment of potential shareholder before their ownership is finalized. Then we have something called non-current liability. So think of this as the company long-term financial obligation. It includes, non-current liability includes loans, it includes bonds, it includes other borrowing that the company must repay over several years. Managing them will ensure business sustainability. Then we have current liability, right? So these are the short-term obligation that a company need to settle within a year. So less than or equal to 1 year, right? From supplier payment to short-term loan, these liability must be managed efficiently to ensure smooth operation. So a well-balanced financial structure is essential for business success. Proper management of equity, security, liability ensure growth, stability, and investor confidence. So friends, this is how we are learning in our crash course. So basically I am providing you videos like this. After going through this video, which hardly take 20 to 30 minutes, you go to MCQ solving and quizzes solving. You devote maximum time there. You see your performance, whether you are able to get 60% marks or not. If not, you again read the topic, right? So this way you on daily basis you prepare and you basically become more confident. You check your strength, you make your strength, you convert your weakness into a strength, and this PDF will be available for download purpose. So at the time of revision, you can just go through the main points and you are able to revise. So if you want to be part of this crash course, just WhatsApp me on this particular number and I will make sure that each and every concept is clearly understood to you, right? So now let's continue our discussion and let's talk about further topic. So the breakdown of company asset. So friends, every business rely on asset to operate smoothly, to grow, but not all assets are the same. Let's break them down into two components. The first is called non-current asset, the second is called current asset. So these non-current assets are the long-term resource. So as the name suggests, they are basically long-term resource that company hold to generate revenue over the time. So you can think of some example like land, like building, right, or machinery, or patent, right, or investment that won't be converted into cash anytime soon. So these assets provide stability and help the business grow. Then we have the second type, which is called current asset. So these are the short-term resource. So if we talk about the current asset, these are the short-term resource, right? So that a company expect to convert to cash soon. So basically these are the short term resource that company expect to convert to cash. This can be converted into cash soon. Example include, cash, receivable. So let me give you some example of it. Cash, receivable, right? And there are some inventory. Inventory is also an example of current asset. Short term investment. So the higher the current asset, the better a company can manage its daily operation. So a strong balance between current and non-current asset ensure financial stability. Now let's look at the purpose of comprehensive financial analysis. This question was asked in the December examination. So friends, a company financial analysis health is like a puzzle, and banker analyze every piece carefully before making lending decision. The first thing they do is to assess the performance. What does it mean? So the first step is evaluating the growth, evaluating the profitability, right, and overall financial health of the company. A strong performance means, a lower risk for lender. So try to understand this point. So if performance is strong, it simply means that lower risk is lower, right? Then second thing we have is projecting the future earning. So banker forecast future financial outcome based on past trend, right? So this help predict future financial outcome based on past trend. Then the next thing is ensuring proper fund utilization. So it is crucial to monitoring how bank fund are being used. Are they failing growth or being mismanaged? Banker check this closely. Then evaluating the credit worthiness. So before approving a loan, bank gauge the company reliability and risk factor. So a strong financial track record simply means higher chance of approval. Then we have detecting the financial distress. Early warning sign of financial trouble can prevent future loan default. So banker identify risk before they escalate. And the final point we have is verifying the financial accuracy, as you can see. So it means that number don't lie, right? So number don't lie, or do they? Banker cross check financial statement to ensure they are accurate, they are reliable. A single mistake can change everything. So a thorough financial analysis ensures safer lending, better investment, and a stronger financial system. So now let's look at the next point. Let's look at the balance sheet, how it look like. So friends, have you ever wondered how banker analyze a company financial position before approving loan? It's all start with a balance sheet, which is like a financial mirror of a business. A balance sheet summarize, assets and liability, helping credit officer determine the company's solvency, liquidity, and financial stability. What does liability mean? Liability means, the source of fund, and asset means the use of fund. So it includes, liability includes, short-term liability, right, which includes working capital finance, or current liability, which is called OCL, other current liability, and it also includes long-term liability, right? Short-term liability is long-term liability, right? So this thing must be clear to you. It includes short-term liability, it includes long-term liability, and also net worth. So you can see tangible net worth. So tangible net worth means company owned fund, including paid up capital, including capital reserve. So let me write it down. Owned fund includes paid up capital, plus capital reserves is there, plus surpluses are there. So these things are included in the tangible net worth. Now asset side represent how the fund are used. So asset represent usage of fund, right? So it simply represent usage of fund. So basically there are some short term use. So fund can be used for short term, like current asset, total current asset, which we call TCA, which includes cash, which includes receivable, right, which includes inventory. So these are the total current asset. You must know it. Cash, receivable, inventory, these are the part of the current asset. Then there is something called net working capital, NWC. So please look at this balance sheet, and I will make you understand each and every part. So the first part of the asset you can see is the total current asset, which includes cash, inventory, and just now we have talked about receivable. The second part is called NWC, net working capital, means the buffer between current asset and current liability is called net working capital. So we can say it is current asset minus current liability. The buffer is called net working capital. And then we have some long term use. You see the long term use. So the short term use, it includes two parts. Short term use includes total current asset and NWC, and long term use it includes fixed asset. So it investment in the fixed asset, investment in the non-current asset, right, and so ensuring business growth. So in the liability side we have seen there is something called short-term source of the fund. So it includes working capital which you have availed, right, and other current liability, two part of the short-term source. And the long-term source we have two part, net worth, and we have total long-term liability, which is not a TL. So this is the proper bifurcation of this balance sheet.
I hope it is clear. Short term use, long term use. Question may be asked, which of the following is a part of short term use? So you must answer. Which of the following is a part of short term source? You must answer, right? So this chart should be clear. This table should be clear, right? So it helps determine whether a company is financially sound and can repay loan without a stress. A balanced structure of assets and liability ensures sustainable business part. Now, any imbalance may signal financial distress, triggering red flag for lender. Now, let's look at this slide. Ever wondered how business evaluate their financial health? The right financial analysis method can uncover insight that can drive smart decision making. Let's explore the top 3 methods used by financial experts. The first method they use is called fund flow analysis. Tracking where the money comes from, where it goes. This method help in assessing liquidity. It help in assessing liquidity, right, and ensure a business has enough fund to operate smoothly. So the maxim is that no liquidity, it means that if there is no liquidity, it means no growth. That's it. So it assesses the liquidity, right? It assesses the liquidity and ensure that a business has enough fund to operate smoothly. This is called fund flow analysis. The second kind of analysis we have, is called the trend analysis. So pattern don't lie. So here the point is, pattern don't lie. This method help identify the financial trend over time, allowing business to predict future performance and make data driven decision. So the key point here is data driven decision, right? A sharp decline means a time to act. And the third thing is called ratio analysis. Numbers tells a story. By comparing financial ratio, companies assess profitability, efficiency, stability. It's like a health checkup for a business. The right ratio means financial fitness. So these are the three methods which we use for financial analysis. Now let's look at financial analysis overview. So friends, have you ever wondered how business decode their financial health? Let's break it down into 3 essential methods that help in decision making. The first, is called the common size statement. So number means nothing without context, right? So number, it means nothing without context. Context is very important. So this method standardizes financial data, making it easier to compare company of different size. Want to spot trend? Start here. There's something called trend analysis. I told you early, right? Financial pattern tell a story. This method help track movement over the time. So basically it help track movement over a time, right? So it allows business to predict future performance, avoid surprise, a must have for smart decision making. And finally we have fund flow analysis. Where is the money going? This method traces the inflow and outflow of fund, ensuring liquidity, ensuring stability. A business without cash flow is like a car without fuel, right? Now let's look at the next slide. So this is the financial analysis overview. Just now we have talked about. Let's look at the next slide. So ratio analysis. How do we do the financial health assessment? Through ratio analysis. So first thing first, that ratio analysis is not just about number. It's about understanding the financial heartbeat of a company, right? It's about understanding the financial heartbeat of a company, right? So where does your business stand? So let's break it down into 4 key financial positions that every business falls. So first, a stable but unprofitable means what? It means a strong liquidity, right? A strong liquidity but low profitability. This means company is financially stable but not generating higher profit. So a business that plays it too safe might miss on big opportunity. Second is a strong financial position. High profitability, high stability. This is the dream scenario. A company with a strong profit and solid financial footing is set for long-term success and growth. Then we have financially strained, means low liquidity, low profitability. You see, low profitability, low liquidity, right? A business in this state struggle with both profit and stability. And finally we have profitability but risky. So high profitability, low stability. So big profit might seem great, but without financial stability, it's like walking on a tight rope. One wrong move and the business could face serious trouble. So balancing risk and reward is the key, right? Now let's look at some ratios. So I hope the ratio analysis concept is very clear to you. What is the importance? Now let's look at some liquidity ratio first of all. So ever wondered how financially secure a company really is? So this liquidity ratio, it holds the answer. They help us understand whether a business has enough short-term asset to cover its liability. So whether a business have enough short-term asset to cover liability, that is what it answer. So friends, let's see 2 key ratios. The first ratio is called NWC ratio, net working capital ratio. So it measures long-term support for current asset. It simply measures long-term support for current asset, right? So it shows the margin over liability to assess financial strength, and the formula is quite simple: net working capital upon total current asset multiplied by 100, right? So one thing I want to show you, that this NWC and this TCA, one thing you must note, you look at this balance sheet. You please look at this balance sheet. So you can see this NWC and both TCA, both are the part of short-term liability. You see it, short-term uses, right? So a higher NWC ratio means the company has a strong financial cushion to handle its obligation. So it means that, it simply means that its NWC is higher, because this ratio put NWC in the numerator and TCA in the denominator, right? So if this ratio NWC is higher, it simply means this ratio will be higher. It means company has more working capital available to maintain its short-term obligation, right? And if the ratio is lower, that means that could signal a trouble ahead. So I hope this ratio is clear to you, right? You just remember this diagram, and TCA, current asset, NWC upon TCA, right? Net working capital upon total current asset. This is how we calculate the NWC ratio. This is called a solvency ratio. The second kind of ratio, this is liquidity ratio. The second kind of liquidity ratio is we have current ratio. I think you are familiar with it. It is nothing but current asset upon current liability, right? It indicates short-term liquidity strength, right? Total current asset upon total current liability. So if current ratio is higher, it simply means company can easily pay off short-term debt. But too high, it means holding excess cash instead of investing. And you know, there is something called quick ratio. Quick ratio means quick asset upon current liability. And what is quick asset? Quick asset means current asset minus minus some inventory, which you cannot convert it into quickly into cash, right? So you subtract those inventory, that will give you quick asset. So current asset, quick asset, current ratio, quick ratio. So this is all a part of the liquidity ratio, right? And understanding liquidity is very crucial. Whether you are a business owner, investor, finance student, making this ratio help, mastering this ratio help in better financial decision. Now let's look at some important ratios, profitability ratios. So friends, ever wondered how profitable a business truly is? So profitability ratio help us uncover this by analyzing revenue, cost, efficiency. So in this particular table, you will see a different kinds of profitability ratio we have. So let's get started with the first ratio we have, that is called raw material consumption ratio. Ever wondered, so how you measure the impact of it measures the impact of raw material cost on total production expense. So the formula is quite simple. What is the value of raw material consumed? What is the cost of production multiplied by 100? Right. So if the cost of production is rupees 100 and raw material you have consumed is 120 rupees for rupees 120. So 120 upon 100 into 100, that will give you percentage. Then we have the next ratio, which we call PBT ratio, profit before tax ratio, right? So profit before tax. So it assesses profit before tax as a percentage of the net sale. So in denominator you will have net sale, in numerator you will have profit before tax. So a higher ratio means a strong earning before taxation. Then the next ratio we have is called PAT ratio. PAT means profit after tax. So it evaluates the profit after tax with respect to net sales, right? And then the next ratio we have EBITDA margin ratio. It gauges operating profit relative to the sales, right? So what it gauges, it gauges operating profit related to the sale. So EBITDA, what is EBITDA? Earning before interest, tax, depreciation and amortization, right? So it gauges your operating profit, operating performance. So if EBITDA is higher, it means better efficiency, better profitability. Then we have ROEC. What is ROEC? ROC means return on capital employed. So ROC simply means return on capital employed, right? So it measures how efficiently a company, right? It measures how efficiently a company uses its capital to generate earning. How efficiently a company uses its capital to generate earnings. So suppose this is the company, right? So friends, this is the capital. This is the capital. So how efficiently it is using a capital to generate earning? The formula is quite simple for ROCE. Earning is denoted by EBITDA, and capital is the total asset. Is the asset is the capital. So EBITDA upon total asset into 100. That is the formula for calculating ROCE. Return on capital employed means it is business is investing capital. How much earning it is generating? So earning is represented by this EBITDA. EBITDA you put in the numerator, you just write this EBITDA in the numerator, that represents your earning, and you just write the capital, which is the total asset which the company has, in the denominator, multiplied by 100. This will give you ROCE, return on capital employed. And then finally we have something called operating profit ratio. So it isolates core business profitability by excluding the non-operating expense. There are some non-operating expense. So it helps understand how will operation generate profit. So these profitability ratio are like an umbrella, right? They protect business from financial risk and guide them towards sustainable growth. So I hope this profitability ratio you will be able to remember. I have summarized all this thing in a single line, in a single page. If you think this was helpful, please hit the like button. Then we have the next kind of ratio, which we call leverage ratio. In the world of finance, understanding leverage ratio is very crucial to understand company financial health and risk level. So the first kind of leverage ratio is called total outstanding liability to tangible net worth. So how to remember it? So I again bring your attention to this balance sheet. So please see this balance sheet which I have shown you earlier. So I am talking about this balance sheet, right? Let me show you, just wait a minute. So this is what we are talking about. So friends, you see what we are talking about, TOL, total outstanding liability, right, to the tangible net worth. So where tangible net worth is there, you see this tangible, this is the net worth, and that too tangible net worth. And you know, total outstanding liability, right, total outstanding liability, so it includes all terms liability, all current liability, it is also included, current liability is also included, these two are also included. And you know, tangible net worth represent net worth minus intangible asset. So from this net worth you subtract the intangible asset, this will give you the tangible net worth, right? So this is called TOL upon TNW. If this ratio is lower, it means a strong financial position. It simply means a strong financial position, right? TOL upon TNW is lower, means outstanding liability is lower, it means a strong financial position. So this is a kind of, you know, this is a kind of a leverage ratio, right? This is a kind of leverage ratio, TOL upon TNW. Please remember this ratio, very very important, right? Then and what is TNW? I told you. The next kind of ratio we have DER, debt equity ratio. So it shows how much debt a company used to compare to equity. So if this ratio, so it is simply debt upon equity. So if this ratio is higher, it means, you know, riskier financial structure, and if this ratio is lower, it means more stability, lower risk. Now there is something called DSCR. DSCR is called debt service coverage ratio. This, you know, from DSCR there is a numerical question asked every year, very very important. So you know, the DSCR, there are two kind of DSCR, net DSCR and gross DSCR. If we talk about the net DSCR, it focuses on cash accrual. So you will see in the numerator what is written, cash accrual is written. What is the meaning of this cash accrual? So cash accrual means net profit, cash accrual means net profit plus non-cash expense like depreciation. You know, depreciation is a kind of non-cash expense. It is an expense but non-cash expense. So cash accrual means net profit plus non-cash expense, right? And in the denominator, this is put in the numerator. In the denominator we write total installment due. So cash accrual divided by total installment, this will give you the net DSCR. And if we talk about the gross DSCR, it evaluates the two repayment ability, including interest payment. Interest payment is also included. So it adds interest to both numerator as well as denominator. So you see, cash accrual plus interest payment upon total installment plus interest payment. So interest payment is added to the both, right? So for a more accurate picture, so it is essential for credit analysis and lending decision. So you must know how to calculate DSCR, right? A strong leverage ratio and a healthy DSCR ensure financial stability and a smart borrowing decision, right? So that is the role of DSCR. And you know, I hope it is clear, net DSCR and gross DSCR, and which gives you a better financial picture. I hope it is clear. Now let's talk about the so-called coverage ratio. So till now we have discussed liquidity ratio, we have covered what we called profitability ratio, we have covered leverage ratio, right? Now let's cover the coverage ratio. So when it comes to assessing a company ability to manage its debt, so the key point is managing debt. A company is able to manage its debt or not. When it comes to assess the company ability to manage its debt, two key coverage ratio comes into play. But which one is more crucial? Let's break it down. The first kind of ratio is what we call, you know, it is called Vanke's ratio. You know, it tells us, it determines long-term debt repayment estimate, long-term debt repayment time. It tells us how many years it will take to clear long-term debt using EBITDA. Means how many years will it take to clear whatever long-term debt we have taken, how many years it will take to cover the long-term debt using EBITDA. Means it simply tells you that yes, this much year it will take. So the formula is quite simple. It says that you just write this long-term debt, we are just talking about the debt, not talking about the equity. You just write the long-term debt in the numerator and you just write EBI TDA in the denominator, right? So it gives you the Vanquish ratio. This question was asked frequently. Now let me give you the implication of it. See, if the ratio is lower, suppose the Vanquish ratio is lower, so what does it mean? It means that faster debt clearance. Yes, it means that if this ratio is lower, it means it will take less time, right? And if this ratio is higher, it simply means debt burden is heavy, right? Heavy. The second kind of ratio we have is called interest coverage ratio. You know, it evaluates a company ability to pay interest on its borrowing. Yes, correct, try to understand. So interest on the borrowing, because the name itself suggests interest. So whenever you borrow money from bank, you have to pay interest. Similarly, a company has to pay interest. So how efficiently company is able to pay interest on the borrowing, it is measured by something we call ICR, interest coverage ratio. The formula is quite simple. We write EBI DTA in the numerator, and you must remember that in the case of Vanquish ratio, what we have written in the numerator? Long-term debt. But in this case, we are writing EBI TDA in the numerator, and we divide it by interest expense. We divide it by interest expense. How much interest we are paying, right? So if this ratio is higher, it means a strong financial health. Means that it can easily cover interest payment, right? And you know, if this ratio is lower, it means there is a chance of default. Means trouble in making interest payment, right? So the ratio can be higher, the ratio can be lower. Higher ratio means that in EBI TDA is higher for per unit interest expense, right? So means a strong financial health, we can easily cover interest payment, because you know everything depends on earning. Obviously, if our earning is higher, we can easily cover our interest expense. So that is why this interest coverage ratio should be higher, and this Vanquish ratio should be lower, right? Vanquish ratio formula is long-term debt upon EBI TDA, and interest coverage ratio formula is EBI TDA upon interest on all borrowing. So tell me, which ratio do you think is more important for financial stability? Is it Vanquish ratio or is it interest coverage ratio? Now let's talk about the next kind of ratio. We have fixed asset coverage ratio and security margin coverage ratio. When assessing a company financial security, so here the key point is, you know, financial security. This is the key point. So while assessing financial security, two coverage ratio comes into play. The first is called fixed asset coverage ratio, FACR. You know, it measures asset security for loan. It measures asset security for loan, right? So tells us how many times fixed asset can cover outstanding term loan, right? How many times fixed asset can cover outstanding term loan? The formula is quite simple. You just find the WDV, written down value of fixed asset, right, under charge. What is the written down value of the fixed asset? You know, there is something called written down value, right? And you divide it by the outstanding term loan. Obviously, on that fixed asset you have taken a loan. So whatever outstanding term loan is there, you divide it by them. So basically it tells you how many times fixed asset can cover outstanding term loan, right? So if this ratio is higher, it means a strong asset backing, means loans are well secured. That means the written down value of the fixed asset is larger to cover the outstanding term loan. And if this ratio is lower, it means risky. Yes, asset may not be enough to cover the debt, right? So that is called, obviously, try to understand. Security, whenever bank give loan, it takes some collateral as a security, and this is nothing but a fixed asset. Like for house loan, it takes mortgage of the house, which is a kind of fixed asset. You know it very well, right? So if this WDV is higher, it means this ratio is higher. It means we have sufficient asset to cover the outstanding term loan, right? So if there is a strong asset backing, it means loans are well secured. And if this ratio is lower, it means this is a risky situation. Means asset may not be enough to cover the debt. The second kind of ratio we have, you know, is called security market coverage ratio. You know what it is? It assesses the financial cushion available, right? And the formula is quite simple. You write down the WDV of fixed asset, you subtract the term loan. Let me write down the formula. This is very important. You write down the WDV of fixed asset, you subtract the term loan outstanding, and you divide it by WDV of fixed asset. So basically, sorry friends, basically we are comparing term loan outstanding with respect to WDV. So if this ratio is higher, it means more financial stability, means greater asset coverage ratio after debt. And if this ratio is lower, it means limited buffer, higher financial risk. So you know both the ratio, either we call it FACR or we call it security margin, because you know this word is margin. What is the meaning of margin? This way you can remember. See, there is something called WDV of written down value of fixed asset. And there is something called, so this is the security which we have taken, and there is something called outstanding term loan. Like for housing loan, whatever term loan is outstanding. So the difference is called margin, right? So if this margin is larger, it means this ratio will be larger, right? So that is why, so if this ratio is higher, it means we have more margin, more financially stable we have. The WDV of financial asset is more, right? And with the margin is lower, it means we are in a risky position, right? So I hope this makes sense to you. Now let's switch our focus to the next kind of ratio we have. There is something called raw material holding ratio. Try to understand it very clearly. So efficient inventory management is very crucial for business success. So let's break down raw material holding ratio and its key component. So the first component is called the day of stock coverage. Indicates how long the current stock will last. So obviously if longer coverage is there, if long coverage is there, it means smooth operation without supply issue. And if short coverage is there, it means risk of stock out. Then the second part aspect of it is called raw material average stock. It represents the average inventory held over the time. Average stock held over the time. It helps in tracking stock efficiency and minimizing the waste. So after analyzing both of these, the third part we have is the raw material consumed, right? So basically measure the total raw material used. So finally we have the ratio that is called material holding ratio, raw material holding ratio. So right, so it represents the average inventory held over the time. So in the numerator you will see the raw material average stock, in the denominator you will see how many raw material consumed in the period into 365. So right, so a fine balance between holding too much stock, right? If we hold too much stock, what will happen? Cost will be higher. And holding too little, so if we hold too little, production will get delays, right? So the balance between holding too much stock and holding too little is the key to the business efficiency. So optimizing this raw material holding ratio ensure cost control, steady production and efficient operation. You see the numerator. Numerator means how much stock we are holding, right? So if you are holding too much stock, our cost will be higher. And the numerator you will see raw material consumed in this period means this is called how much how much consumption is there. So this holding ratio is very important, right? This is called raw material holding ratio, RM holding ratio. The second kind of ratio we have is called SIP holding ratio and FG holding ratio. Let's understand these two. So which inventory ratio should you focus on for operational efficiency? So efficient inventory management is key to a smooth production and sales growth. There is something called SIP. What is the meaning of SIP? SIP simply means a stock in process holding ratio. It measures average time raw material stay in production before turning into fixed goods. And the formula is quite simple, that you write a stock in average stock, stock in process SIP average stock in the numerator, you write cost of production in the period in the denominator multiplied by 365. So it helps optimize production time management, it reduces bottleneck in the manufacturing process, and it ensures that a steady flow of good to meet the demand. Now there is something called finished good. FG means FG means finished good. So finished good holding ratio. It evaluates how long finished product remain in inventory before they are sold. So you write finished good average stock in the numerator, cost of sales of period in the denominator multiplied by 365. So it improves sale efficiency and inventory turnover. It helps avoid overstocking or stock out. It keeps cash flow healthy. So for a business, both ratios are very crucial. If this SIP holding ratio is higher, if this ratio is high, so it means slower production and there is a possible delay. And if this FG ratio is higher, it means slow moving stock, potential loss. So balancing both ensure efficient production and a faster sale, right? So we have discussed three kind of ratio here: efficient inventory management, raw material holding ratio, SIP holding ratio, and FG holding ratio. Now there is something called receivable holding ratio. Managing receivable efficiently is the key to managing cash flow and financially stable. What is the meaning of receivable? Suppose you have a company, right? Suppose you have a company, right? And you have given a product just on credit to someone. You have not received the amount yet, and that is called receivable, right? So how long do you stay unpaid? That is called receivable. How long your sale stay unpaid? So managing receivable efficiently is key to managing cash flow. So how do we measure it? There is something called receivable holding ratio, average sundry debtor. So it represents the average amount owed by the customer, how much average amount they are owing by the debtor. So high debtor means slower collection. So simple it is high debtor. So debtor increase, it means collection will be slower, and this will be cash crunch, risk will rise. There is something called gross sale. Gross sale means total revenue before deduction. You have not deducted anything. The total amount you have received, total sale you have received, called gross sale. Higher sale don't always means better cash flow if payment are not collected on time. So suppose your sales are higher, your gross sale is very high. So it does not mean that you have a better revenue, better cash flow if payment are not collected on time. And there is something called time frame. It indicates how many days sale remain unpaid. If there is a longer duration, it means there is a risk of bad debt and liquidity issue. Shorter duration, it means faster cash flow. So the formula for receivable holding ratio is quite simple. You must remember the formula. You write average sundry debtor, means average level of sundry debtor in the numerator, means average amount which is owed by the by the debtor, and you write the gross sale of the period, means how much sale you have in the denominator. You multiply it by 365 to convert it into, right, ratio. You multiply it by 365, right. Why we multiply it by 365? Because to find the gross sale per day, that is the point, right. So this tells us number of day. So basically after doing this, what you will receive number of day. This tells us number of days, right, it takes to collect payment from the customer. How much amount they have taken, you have written in the numerator, right. And how much is the sales, that is called gross sale of the period, right. So how many number of days, it tells you the number of days it will take, right. So it just give you number of days it will take to collect a payment from the customer, right. So that is called understanding receivable holding ratio. So a lower receivable holding ratio means faster collection and a healthier cash flow, means it takes lower number of days. And if the higher receivable ratio, it is time to improve credit policy and the follow up. So this is all about the receivable collection, right, receivable holding ratio. Then we have payable holding ratio and inventory turnover ratio. So friends, how long you hold on to supplier payment versus how fast you sell inventory. So on one side we have the payable holding ratio, means average level of sundry creditor. Now suppose you have taken something on credit and you have not paid yet, right. So this tells us how long we take to pay our supplier. So just we write the average level of supply creditor, sundry creditor, and you just write purchase during the period multiplied by 365. So if the longer credit period is there, it means greater for cash flow, but delayed payment may affect supplier relation. And if the shorter credit period is there, it ensures goodwill but can put pressure on working capital, right. On the other hand, we have inventory turnover ratio, which simply means that net sales divided by average turnover, average inventory during the same period. It indicates how quickly the inventory is sold, right. So we write net sales divided by average inventory, right. So if this ratio is higher inventory turnover, it simply means that your inventory move fast, right, reducing holding cost. Simply you can see, if average inventory increase, this ratio will decrease, and if average inventory decrease, its ratio will increase, right. So if this ratio is higher, it means your inventory is being sold in quickly. And if the low turnover, it means risk of unsold stock leading to cash being stuck in the inventory, right. Because this ratio will be lower only when inventory will be higher. That is why denominator we have inventory, right. So the key point is that delay payment smartly but not damage supplier trust. Move inventory efficiently to maintain a healthy cash flow. That is the point. So I hope every aspect is clear. So now that we have understood each and every ratio, please hit the like button if you have understood every part of it, because in the small amount of time I have covered major ratio. Now let's look at the limitation of ratio analysis. Very important. So ratios are widely used to assess financial health, but relying on them blindly can be misleading. There is something called time discrepancy. This is one of the major limitation. So first thing is that ratio often require average to give a true picture. Using a single data can be deceptive. There is something called fiscal period versus single day. What does it mean? So a company financial health fluctuate. So analyzing just one point in time may not reflect reality. Second limitation is a lack of context. So overlooking the cyclical variation. Business ups and downs are not always captured in ratio. A booming quarter does not mean long-term success. We ignore the seasonal trend. What does it mean? That retailer earn more during festive season. You know it very well. So ratio might not account for such kind of trend. So this is what this ratio analysis ignore. So two drawback we have already told: time discrepancy, lack of context. The third drawback is data manipulation. So there is something called inflating asset. Company may overstate asset value to appear stronger. Deflating liability. So lowering reported liability can artificially boost financial ratio, making business look risky. There is something called methodological flaws. So year-end sales spike. Some firms push sale at the year end just to improve their ratio. Does that really affect performance? No. Inherent ratio limitation. Ratio are just indicator, not absolute truth. They should always be analyzed alongside other financial data. So ratio help us analyze financial statement, but context is everything, right? Always look beyond the number to understand the real financial picture. So we have discussed every aspect of it, advantage, disadvantage. Now there is something called related party transaction. You know, money matters, but so do relationship. In business, financial transactions don't happen in isolation. They often involve related party. Who exactly are this related party? Let's break it down. The first point is control. You know, when one entity has full control or full authority to govern policy, it holds control over the other. Think of a parent company dictating operation of its subsidiary. Second is called joint control. Sometimes control is shared under an agreement. Imagine two companies jointly owning a venture. Neither can make decision alone. Third point is called significant influence. This means an entity has the power to participate in decision even without direct control. For example, suppose a company holding 20% plus stake, 20% plus stake in another can influence its policy. Fourth is called key management personnel. These are the strategic decision maker, like CEO, like CFO, like director, right? So their decision can save the company future. And there are some entities in the same group. So that business under common ownership or control fall here. A parent company and its subsidiary are the classic example. Then we have something called associate. What does the meaning of associate? That company that are not fully controlled but have significant influence are called associate. Joint venture. This is called collaborative entity with shared control, where two or more companies work together but retain their independence. And finally, we have post-employment benefit plan. Not all related party, are companies. Employee benefit plans set up for worker also fall in this category. Now let's look at some example of this related party. So identifying related party is very crucial, right, for transparency in financial transaction. Not all entity involved in business dealing qualify as related party. So you can see some example given here, right? So you can see customer, right? Customer and supplier, despite their regular interaction, remain independent unless influence or control is established, right? So customer or supplier is not considered a related party. Remember it. A second point, there is something called trade union, right? Trade union, or we call it utilities, public utilities, government agencies, finance provider, right? Finance provider. So these people, right, and even common director do not automatically fall into this category unless they exert control or they hold significant influence. Unless they exert control or hold significant influence, they are not a part called as related party. Similarly, joint venture, right? Similarly, joint venture are only considered related party if joint control exists. So understanding this distinction. So let's get started. So friends, think of working capital as a fuel that keeps your business engine running smoothly, and this fuel has three key ingredients. The first ingredient is called fixed asset. These are the essential tools like furniture, equipments, machine. They form the backbone of your business setup. Next we have the current asset. So these are your everyday lifeline. Like if you talk about the current asset, like raw materials or your finished goods, right? So raw material, finished goods, these are like current asset. So they keep your operation moving forward and help you meet the demand. And the third kind we have is called business operation. So this is where the magic happen. It's about how efficiently and how sustainably your business run day to day. That is called business operation. So three aspects we have talked: fixed asset, current asset, and business operation. So when these three work in harmony, your working capital become a powerhouse during a business success, driving a business success, right? So now I hope this be clear. The three component is clear: fixed asset, current asset, and business operation. Now friends, let's dive deeper into how working capital actually flow inside a business. So now let's deep dive into how this working capital cycle is called working capital cycle. So welcome to the working capital cycle. How this working capital actually flow inside a business. So imagine your business has a cycle, right? A continuous loop that keeps your operation active and thriving. So step number one, what you do? You purchase a raw material. This is the step number one. You purchase raw material. So it all begins here. With acquiring the raw material, you need to kickstart production. Step number two, you have to process the material, which means that we transform those raw material into finished goods, so ready to meet the customer demand. The third step is to selling the good. Then it's so time you sell those finished goods to your customer, and then you receive the payment. Okay, so let me show you the payment receiving. Here you can see payment, receive payment. So it means that once the goods are sold, the money flow back to your business as payment from your customer, and then you reinvest in material. So finally you reinvest that money to purchase even more raw material, restarting the cycle. And that is how the working capital cycle
fuel continuous growth, keeping your business in motion day after day. So I hope this is clear how what are the steps involved in the working capital cycle. Right, now let's move forward and let's discuss bank finance assessment process. So friends, now let's walk through a process that bank follow before financing a business, and this is called the bank finance assessment process. Let's understand it step by step. So it's like a checklist that bank tick off to make sure your business is financially healthy and ready for credit. First of all, they determine the turnover. You know what is the meaning of turnover? So bank analyze your business turnover based on past performance or industry benchmark. This set the stage for everything that follow. Then they assess the working capital. That they evaluate your total working capital, looking closely at things like inventory, looking closely at things like receivable. So they analyze your total working capital, including inventory, including your receivables. Then the next step they do is to estimate the inventory level. Bank estimate how much inventory your business need, factoring in supplier availability and the lead time. Right, so they factor in the lead time and supplier availability. They estimate the inventory requirement. So bank estimate how much inventory your business need. Then they evaluate the receivable. Right, so evaluating receivable means the bank assess how fast you collect money from your customer based on a standard market practice. That is called receivable. Inventory level, you know it very well. And they also estimate the other current asset, OCA. That finally they ensure that you have enough current asset beyond just inventory and receivable to support your financing need. So turnover, how much sales you have done. They assess your working capital, they assess your inventory level, they assess your receivable, and finally other current asset. So this step-by-step process help bank make a smarter lending decision while ensuring your business stay financially fit. Right. So I hope this is clear. Now let's discuss the next point: how to meet working capital requirement. So friends, that let's now explore a key question every business face, that how do we meet the working capital requirement. Think of a working capital like fuel. I told you earlier, right? You can think of this working capital like, you can think of this like a fuel for your business engine. It keep operation running smoothly, and here is how you can source that fuel. The first source can be your bank finance. You can approach bank for loan to fill any remaining gap in your working capital. If there is any remaining gap in the working capital, you can approach your bank for loan. That is called bank finance. So this is a common route, especially when internal fund falls short. Then bank finance is one source. The second source can be the supplier credit. You know what it means? That you can leverage supplier credit. By negotiating favorable credit term with supplier, you can improve liquidity without immediate cash outflow. That is called supplier credit. What you do, that you negotiate favorable credit term with the supplier. Right, you can improve liquidity without immediate cash outflow. Right, then we have current liability. This is another source of funding. So another option is to utilize the current liability. And what is the current liability? Like suppose you have some outstanding salary, right, or suppose you have some customer advance, you have taken advance from customer, right? So you can use this customer advance or outstanding salary to temporarily support your capital need. So supplier credit is one thing, current liability is another thing, and the third way is the on fund. And of course, don't forget your on reserve. Using retained earning, using surplus fund from the past balance sheet can strengthen your working capital position. So in short, a small combination of these options help business stay financially agile and ready to tackle day-to-day operation effectively. So friends, if the concept is clear, please hit the like button. This will motivate me to make more such content, because everything in this chapter is very much engaging, because it helps you retain the concept for a long time, because everything has been represented pictorially. Right, in book you will see it word line by line, and you have to underline what is important, what is not important. But in this case, I have filtered out every not important thing and just providing what is important from examination point of view. So please hit the like button. Now let's see the next point. Now let's discuss bank finance lending method. So friends, now let's dive into how bank decide the lending method for financing working capital. So there are three methods. Right, so let's discuss the three method. This is also called MPVF, maximum permissible bank finance. You will heard this word MPVF method. Maximum permissible bank finance. So there are three methods. So let's discuss each and every method. So the journey starts with choosing the right lending approach based on the business need and financial health. Right. So method one, which is basically gap based approach. So in the first method, bank expect the net working capital. Bank expect the net working capital to cover 25% of the working capital gap. See, suppose this is WCG. Suppose this is working capital gap. So bank expect that at least 25%, right? 25% of this WCG should be covered with the NWC, net working capital. right? So once this gap is identified, financing is provided accordingly, right? So here the main point is that, and net working capital is 25% of the working capital gap, right? Now you may ask me, what is working capital gap, what is WCG? So current asset minus current liability other than bank borrowing, right? This is called working capital gap. So basically this and you know, net working capital is current asset minus current liability. So basically you have to find the WCG, and at least 1/4 of that should be covered by the NWC. That is called method MPBF number 1. So net working capital should cover 1/4 of the, and the rest portion will be financed by the bank. So on the basis of this method we calculate the bank financing. I will provide you a separate video for the numerical portion. So first of all, understand the basic concept. Now the second method we have is the current asset approach. We have the current asset. In this case we calculate WCG, but in the second case we just look at the current asset. So what you do in method number 2 required that bank require 25% of the current asset to be funded by the enterprise itself. So you know, there is something called margin, right? There is something called margin, borrower margin, means something that borrower should provide. And method number 2 say that this margin should be 1/4 or 25% of the current asset. Means the business should finance 1/4 of the current asset itself, and the rest portion will be financed by the bank, right? So this is called bank require 25% of the total current asset to be funded by the enterprise. So this ensure that a minimum current ratio of 1:1.33 is maintained. You know what is the meaning of current ratio? Current ratio means current asset upon current liability. So this is 1.33. This is an ideal ratio. And method number 3 says that this focus on the core asset. So there is the key point here is core asset. So here bank mandate 100% funding of the core asset through NWC, which result in a higher current ratio and a strong liquidity position. So each method offer a unique balance of risk and liquidity, right? Helping both business make informed financial decision, right? So first method is all about WCG, second method deals with CA, current asset, and the third method deals with the core asset. So bank finance 100% of the 100% NWC for the core asset, net working capital for the core asset, right? So please remember these three methods. I will provide you a separate lecture in the crash course in which I will provide you the case studies based question based on it, right? Now let's see the understanding the cash budget method. So let's now break down the cash budget method, which is a very powerful tool for managing business liquidity. First of all, we have something called cash inflow. You know, this is the heartbeat of any business. It is the money flowing in from sales, service, and day-to-day operation. From sales, service, and operation, cash inflow. Then we have cash outflow. So here is where your money exits the door. Payment for raw material, salary, utility, other essential business expense. This is called cash outflow. Then we have, you know, short-term bank finance. When inflow does not meet this outflow, right, short-term loan steps in to bridge the cash shortfall, keeping the business running smoothly. So suppose that cash inflow like money received, so cash inflow is less and cash outflow is more. So obviously there is an imbalance, and this imbalance is supported by the short-term bank finance. Some finance is provided by the bank, right? So when inflow don't meet outflow, short-term bank loan steps in to bridge the cash shortfall, keeping the business running smoothly. And finally we have cash flow projection. So think of it as your financial crystal ball, forecasting your future cash flow position based on expected inflow, expected outflow. So based on your expected inflow and outflow, it projects your future projection. So mastering the cash budget method is all about balance, making sure your inflow and financing cover outflow while planning ahead for the road ahead. So this is how the cash budget method works. Now let's switch our attention to the next method we have, that is called Tandon committee method, right? That is called projected turnover method, also called Tandon committee method. So let's understand how it works. So friends, let's now dive into how working capital financing work for micro and small enterprise. Yes, micro and small enterprise using the projected turnover method. So first of all, you calculate your working capital, right? Working capital need. So this is where it all begins. Assessing how much capital is required to smoothly run the day-to-day business, right? You first find the working capital need. So under this approach, now comes the projected turnover method. Under this approach, we estimate your turnover. That means bank estimate the turnover for the coming year to determine your working capital requirement. That is what the bank do. So bank decide what will be the turnover, right? What will be the turnover of the business for the coming year? For the coming year, bank decide the turnover of the business, right, to determine your working capital requirement. And then the bank steps in, right? So bank finance up to 20%. Yes, bank can fund 20% of your projected turnover to meet your working capital need.
right? But the enterprise must also contribute 5%, right? So turnover, suppose it's 100 crore, so for that 20% will be financed by the bank, right? So projected turnover 20% financed by the bank and 5% is financed by the enterprise, right? Enterprise, that business has a skin in the game by committing a small portion from its own resource, and this is backed by RBI mandate for MSE. That a regulatory framework that ensures fairness and structure in lending. But here is the key question: is your working capital cycle longer than 3 months? This is the question to ask. If your working capital cycle is longer than 3 months, right? So if yes, then apply the holding norms. This means maintaining inventory or receivable for extended period will require stricter financial discipline, and if no, for shorter cycle, bank will ensure you have sufficient liquidity without tying up too much capital. So with the projected turnover method, MSE can secure the right balance of bank support and self contribution to power their growth, right? So I hope this is clear now. So you must understand this Tandon committee method or working projected turnover method, both means the same. Now let's look at this particular table. So friends, let's now break down the comparison of working capital assessment and credit limit between digital and non-digital business, right? So let's understand. So first let's look at the digital business. So when we assess working capital need for digital business, they are typically pegged at 37.5%, but when it comes to actual credit limit sanctioned by bank, this figure drops to 30%, right? So this is the credit limit sanctioned by the bank. Now shifting to non-digital business. So the assessment here is slightly lower at 31.25, right, percent, reflecting a more traditional business model. However, the credit limit allocated is ever more conservative, standing at just 25%. So both digital and non-digital enterprise see a clear gap between assessed working capital need and the credit actually sanctioned. You can see this is the working capital need assessed is this much and credit sanctioning is this much for digital. For non-digital, working capital assessed is this much and credit sanctioning is this much, right? So the key takeaway is that the digital business tend to receive a slightly better credit margin compared to non-digital business thanks to their faster cycle and their leaner operation. So this highlight how banks are cautious yet supportive, tailoring credit limit based on the business type and operational efficiency. So I hope this makes sense to you. Digital and non-digital business comparison we have just done, right? This question may be asked. Now let's move forward and let's see which working I told you the three finance method. The first method I told you remember, was the maximum permissible bank finance method. Second method I told you cash budget method. Third method I told you projected turnover method. Now which working capital finance method should be used? So which financial method is right for your business? Let's decode the three major method simply and clearly. So first method we have is called the cash budget method. So this method is perfectly fit for business with fluctuating operations. Remember this word. With fluctuating operations. So those business which have fluctuating operation, for them this cash budget method is the best. Think seasonal industry, like you can think of tourism, like you can think of agriculture, you can think of fashion retail, right? Fashion retail. So it focus on estimating future cash inflow, future cash outflow, making it ideal for business with uneven cash flow pattern. So those business which are having uneven cash flow pattern, right? Uneven cash flow pattern, for them this cash budget method work the best. Now let's look at the turnover method. For a small enterprise with limited financial record, this is the go-to method as per the RBI guideline, especially for MSME with credit need up to 5 crore. Remember that. MSME with credit limit up to 5 crore. Remember, bank assess their working capital based on projected turnover. It is simple, it is quick, and it is efficient, right? And the third method which we have just discussed is the holding method, right? So basically, that the holding method suits business with a stable operation. It is detailed, it is precise for regular production cycle, but may not be the best choice for seasonal industry. So choosing the right method can make or break your working capital management, always aligning with the business type, season, a small scale, or stability to ensure a smooth financing operation. So I hope that makes sense to you. Now let's look at the next point, working capital assessment process. So friends, let's break down the working capital assessment. If your business is seeking up to 2 crore, the bank will assess your working capital need based on just 20% of your projected turnover. So up to 2 crore, just I told you earlier, for a small business, we apply this projected turnover method, PTM, or something I call it, it is NAYAC committee. Tandon committee is different. It is NAYAC committee. So PTM, projected turnover method. So projected turnover method, 20% of your projected turnover. It's quick, straightforward method designed mainly for a small business. For 2 crore to 10 crore, if your requirement fall between 2 to 10 crore, bank will typically apply the cash budget method. So this means your working capital is assessed based on monthly cash flow need, perfect for business with varying cash cycle. And if it is 10 crore and above, right? So when you are talking about 10 crore or more, it get a bit more structured. Here business must comply with the loan system guideline involving detailed assessment and stricter norm to ensure financial discipline. So the bigger your funding need, the more comprehensive the assessment process become. So always be prepared with the right financial data. That is the point. So this is how the working capital financial assessment is done based on your turnover, right? Now let's look at the next point. So sales through bill of exchange, very very important. So friends, let's now explore how sales through bill of exchange actually work. So friends, first of all, first thing is that when goods are sold using a bill of exchange, the first question is the credit being provided to the buyer? The first question to ask is the credit being provided? Is the credit being provided to buyer? Right. So if no credit is provided, right, then what happen? If no credit is offered, we issue a demand bill, right? We issue a demand bill. What we do? We issue a demand bill, and the seller send it to the bank collection. Seller send it for bank collection or purchase, right? So demand bill is issued. If no credit is provided, demand bill is issued, and seller send it for bank collection or purchase. And once that is done, the bank provide an immediate credit to the seller, right? So bank provide immediate credit to the seller, giving the seller instant fund. Afterward, transport document are handed over to the buyer, and it is recorded as book debt. So remember, if there is no credit is provided, then it is recorded as demand bill. And demand bill, what happened? That the seller send this demand bill for bank collection or purchase. And once the bank collection and purchase is done, the bank provide an immediate credit to the seller, giving the seller instant fund. Afterward, transport document are handed over to the buyer, and it is recorded as the book debt. Remember it. And the second case, if it is but if the credit is provided, we issue a usance bill which the purchaser accept. So it is accepted by the purchaser, right? Usance bill accepted by the purchaser. If it is then recorded in the seller book as bill receivable. It is recorded in the seller book as bill receivable. Yes, this bill has to be received, ready for further action. To speed up cash flow, the seller might approach to the bank for bill discounting. An added benefit is that the transaction now enjoy legal protection under the Negotiable Instrument Act. So whether it is instant payment or credit term, bill of exchange streamline trade financing while reducing risk for both buyer and seller. So remember these two difference. I have drawn it the pictorial format so that you can remember the important point. And this PDF will surely help you for the last revision. So if you want to be the part of this crash course, feel free to WhatsApp me on this particular number. I will provide you the detail how to access the course. Now let's switch our focus to our next topic, which is understanding the bill finance. So friends, basically let's decode bill finance in the simplest and easiest ways possible. What is bill finance? It's all about how bank help business manage short-term funding by handling their bill. So first of all, the thing is called purchase. First of all, we have purchase where bank buy demand bill, right? Where bank buy demand bill directly from the seller, and the seller get instant cash. Next is the discount. This is where bank discount the usance bill. I told you when demand bill is there, when usance bill is there. So discounting is done for the usance bill. So these are the bill payable at a future date, but the seller get early fund from discounting. Then we have negotiation. So here bank negotiate letter of credit on the behalf of exporter, ensuring faster access to fund while reducing the risk. What about accounting? So that for the business, all these bill become the part of their current asset. So all these bill, usance bill, demand bill, they become part of their current asset, right? Basically cash inflow expected soon. And for bank, though these are marked at contingent liability, meaning bank are at risk only if the buyer default. So bill finance is a powerful tool that smooth cash flow for seller and ensure global trade happen smoothly. Now let's look at the TREDS, very very important point from examination point of view. So let's break down the magic of TREDS, which is the game changer for MSME. On December 3rd, 2014, 3rd December, RBI introduced TREDS, a digital platform designed to support MSME by solving one big pain point, that is delayed payment. What was the big pain for the MSME? The big pain was the delayed payment, and this was solved by RBI. How? The MSME submit receivable. What they do? That MSME upload their trade receivable, basically invoices, onto the TREDS platform, making them ready for action. Step number 3, corporate buyer accept receivable. So the next move, that corporate buyer verify and accept this receivable, confirming that the goods and service have been delivered, have been approved.
And the next step, financier discount receivable. So now the financier steps in, financier, they steps in, right? And the banks and financial institutions discount this receivable, turning pending payment into instant liquidity for MSME. And finally, MSME receive liquid fund, and finally MSME get their hand on the liquid fund, instantly improving their cash flow and powering their business growth. So TRDS makes sure MSME don't just survive but thrive, right? So if you want to know how this impact working capital, stick around and I will discuss it just now, that how this TRDS impact the working capital. Now let's look at screen based factoring system. So let's uncover the engine behind a screen based factoring system where every player has a crucial role. It all begins with MSME, right? A small and medium enterprise hustling to sell their goods or services and keep the economy buzzing. Then we have something called corporate buyer. I told you earlier also. So corporate buyer is stepping next. These are the big player purchasing goods and services from MSME, keeping the supply chain rolling. Then we have the bank. So bank provide vital financing support, offering credit and services to grease the wheel of business. Then we have NBFC factor. So this is called non-banking finance company, specialized in factoring, helping MSME get early payment against receivable. So NBFC factor help this MSME get early payment against their receivable. And then we have something called financial institutions, right? So basically financial institutions like bank, NBFC offer the money muscle, providing liquidity exactly when it is needed the most. And then we have digital transaction. Everything happen fast, smooth, thanks to the digital transaction. Invoices and bill get processed electronically. And then we have the collaboration with the technology provider. So tech partner ensure that platform is seamless and secure, right? So this is how it is done. And RBI collaboration is also there. So this is called factoring method. Step by step I told you. Now structure of bank guarantee in India. So let's break down the structure of bank guarantee in India, where every block fit perfect to safeguard trust. The first is the government directive. You see this government directive. So at the top we have the government directive setting a standardized format and laying the groundwork for mutual agreement between all parties involved. This ensures that there is no room for ambiguity. The third is the bank rule. See, this is the pivotal bank rule, where bank clearly mention who the beneficiary is and the exact purpose of the guarantee. This defines the core commitment in black and white. And finally we have the beneficiary requirement, means where the beneficiary verify the guarantee authenticity with the issuing bank, ensuring complete confidence and trust the transaction. And there you have it, a clear robust structure where every player know their part in ensuring secure credible bank guarantee in India, right? So this is how the bank guarantee, government directive, bank role, and beneficiary requirement, every stakeholder are there. Now let's look at the bank guarantee process for DGS&D contract, very very important. So let's walk through the step-by-step bank guarantee process for DGS&D contract. So first the bank steps in and issue a guarantee specifically for DGS&D contract. So this is the starting point, ensuring the contract is backed by a financial promise. Now the bank offer, bank provide officer detail for verification purpose. That this add a layer of accountability and transparency to the process. Then let me zoom a little bit. Then authenticity confirmation. So the beneficiary then verify the guarantee authenticity directly with the issuing bank. This step help ensure that there is no room for fraud, no room for error. Then we have initial validity. So the guarantee usually comes with an initial validity period, typically 6 months. So initial validity period is 6 months, right, beyond the actual delivery period. So this ensures that obligations are covered even after project completion. Then we have automatic extension. To further safeguard both parties, there is an automatic extension clause that kicks in, preventing complication from unexpected delays. And then we have tender condition. The guarantee also ties in with the tender condition, making sure that any extension requests are only processed with mutual consent. And finally, we have non-judicial stamp, right? So all documents are issued on non-judicial stamp paper, making them legally binding and enforceable. So this is how a DGS&D bank guarantee works behind the scene, systematic, secure, compliant at every step, right? So this is how it works. Now let's switch our attention to the component of bank guarantee in brokerage. So friends, let's break down the essential component of bank guarantee in the world of brokerage, a key mechanism behind secure and smooth financial transaction. First of all, security deposit. These deposits act like a substitute for cash or other asset when broker enter into transaction, keeping liquidity intact. Then we have margin requirement. We have a broker must meet a minimum financial threshold, typically a 50% margin, right? Typically a 50% margin is required, and at least 25% of this must be maintained in the cash. This ensures that brokers stay financially sound during their trades.
Then we have exchange regulation. So rules laid down by market platform like NCDEX, MCX, designed to maintain transparency and order in the market. Then we have applicant evaluation. Bank also carry out an applicant evaluation. This is where they assess the broker profile and a specific requirement before issuing a guarantee. And then we have something called safeguard. Safeguard are then put in place to protect the bank and the market from the potential financial risk, a vital step in the whole process. And finally, we have the exposure limit. So basically these are caps placed on how much financial risk a bank can take while supporting brokerage option. So these 6 components form the backbone of bank guarantee in the brokerage space, working together to maintain the trust, to maintain safety, to maintain efficiency in the financial market. Again, I am repeating: margin requirement, security deposit, exchange regulation, applicant evaluation, right, and safeguard and exposure limits. Remember this 6 part. Then we have letter of credit process. So friends, let's dive into the most trusted instrument in the international trade, the letter of credit. First of all, the journey starts with, the buyer approaches their bank to request a LC. This request kicks off the entire process by signaling the buyer commitment to pay. The bank issue the LC. There is an issuing bank, right, which issue the LC. So the bank then evaluate the buyer credential and issue the letter of credit. And this document acts like a formal guarantee that the seller will receive payment once the goods are delivered as agreed. Now seller receive LC. So the seller get notified of the issued LC. This gives the seller confidence to proceed. Seller supply the goods. Obviously there are some more bank like negotiating bank, advising bank, confirming bank, reimbursing bank. We will discuss in detail. We have already covered that in BFM. So just now I am giving you the brief knowledge, right? So the seller get notified of the issued LC. This gives the seller confidence to proceed, knowing that the bank backed assurance is now in place. Seller supply the good. With LC in hand, the seller ship the goods according to the contract. Every step here is monitored to meet the LC outline, to meet the term outline in the LC. Then bank guarantee the payment. So bank step into guarantee payment to the seller, providing all agreed conditions are met. Finally, once delivery is confirmed, the bank release payment to the seller and transaction is complete. And then tell me what happened. After the bank, issuing bank plays a very important role, right? After the bank pay to the seller, right, the same payment is collected from the issuer, from the issuer, right? The same payment is collected from the issuer, right, when the due date. So there are two kind of things: usance bill and demand bill. So if it is a usance kind of thing, then there is a due date. So before the due date, bank collect payment from whom? From the issuer, right? From the applicant, or we call it applicant also, both means the same. So issuer, or we can also call it the importer, right? So bank collect payment from the importer. This is how it is done. So friends, LC transaction, there is a separate chapter in your BFM book regarding this LC transaction. So this is how it is done. Now let's see the next part. Then determining the letter of credit limit. From this question is asked every year, and I will explain using simple example that how do you determine the letter of credit limit, how this limit is determined. So there is a step-by-step process. Let's get into detail of it. First of all, you calculate the EOQ. What is the meaning of EOQ? EOQ means economic order quantity, right? So first of all, you decide the EOQ, how much optimal order you have to make. Then you assess the lead time. So lead time, the time it takes to receive the goods is called the lead time. How much time it will take to receive the goods, this is called the lead time. And then after that, you evaluate the transit limit, means how much time it will take transportation duration. And then you determine the usance period, means the credit period for payment. And then you establish number and value. So let me give you an example to make it more clear. Suppose the lead time is 10 days. Let me write down. Suppose lead time is 10 days, right? And suppose transit is 20 days, right? And suppose usance period is 6 months, right? Usance period is given 6 months. Okay, so tell me the total time for which LC will remain outstanding will be how much? So it is nothing but 10 day plus 20 day plus 6 months. So this is nothing but for 7 months, LC will remain outstanding, right? So this is the LC outstanding time. And suppose the consumption of good is 6 crore per year. So consumption of, so how much good is consumed? Say 6 crore per year, and economic order quantity is 1 crore, means at one time we are ordering goods for 1 crore. So please tell me, in a year there are 12 months, right? And for every 2 month, for in every 2 month, one lot is getting consumed. So how many lot we have to be there? 6 lot will be there. So the frequency of LC opening is every 2 months. Why? Because consumption, you see the consumption, it is 6 crore per year. Means in 1 year 6 crore of the goods get consumed. 6 crore, worth 6 crore of the goods get consumed. And in every order we order for 1 crore of worth of goods. So in a year we have to order 6 times, and in a year, there are 12 months are there. So every 2 month we have to order 1 time. So frequency of ordering is 2 months. It means at any point of time, how many LC will be outstanding? So tell me, how many LC will be outstanding? You see, it takes 7 months. LC total outstanding LC will remain outstanding in 7 months, right? So at any given point of time, just divide this 7 by 2. So it almost 3.5. At any given point of time, rounding off, it will be 4, right? 4 crore. So at any given point of time, there will be 4 LC outstanding, and as the amount of each LC is 1 crore, right? Because amount EOQ is given 1 crore, means it in every order we are just ordering 1 crore. So just multiply number of LC outstanding with 1. This will give you the LC limit, right? This will give you the LC limit. So let me summarize the process. What you have to do, you have to add the lead time, you have to add the transit time, and then you have to add the Huygens period, right? Huygens period. So this will give you the total time. Suppose it is T, right? Then what you have to do, you have to see the consumption, right? What is the consumption of goods per year, right? So this consumption of goods, suppose it is C, right? So this consumption of goods, based on this you have to decide what is the frequency of opening LC, right? And you have to decide that how number of LC outstanding. You have to decide how many LC will remain outstanding at any given point of time. How to determine that a number of LC outstanding? So what you will do to decide that this T, right, to decide how many LC will outstanding at a given point of time. So this T you have to keep in the numerator, and you have to divide that T by the frequency of opening LC. So T divided by frequency of LC opening. So this will give you number of LC outstanding at a given point of time. How to get this frequency of LC opening? So you have to see the consumption, right? So what you do, you just divide 12 by the consumption, right? So this will give you the frequency of LC opening. So suppose consumption is 6 crore per year, and 12 months are there in a year, So a number of frequency of opening LC is every 2 months, right? So every 2 months, and economic order quantity is also, you have to see 1 crore, right? So 6 crore is total we are ordering. 1 crore is one time ordering. So number of order will be how much? 6 times. Number of order will be 6 times, right? So number of order divided by basically number of order, just write like this. So once you know the frequency, you just put in here get number of LC outstanding, and multiply the number of LC outstanding. Multiply the number of LC outstanding with what? Multiply the number of LC outstanding with EOQ, economic order quantity. This will give you the LC limit. So question will be asked you to calculate the LC limit. So this is the process. So let me again tell you what are the process. What you have to do. First of all, you calculate the T. From T you get number of LC outstanding, and you have to also calculate the frequency of LC. So frequency of LC, once you know, then you can get the number of LC outstanding, and once you know the number of LC outstanding, you can calculate the LC by multiplying it by EOQ, right? So don't remember the formula, rather go through the basics thing which I have just discussed now. So I hope this will help you understand the concept. Now let's switch our focus and let's see the factoring transaction. Factoring, how it works, how it happened in India. So friends, in this slide, factoring is a powerful tool for business to improve cash flow by selling their receivable to a factor, right? By selling their receivable, they sell their receivable to the factor, right? So it all started with the business receivable, the payment due from customer. Receivable means the payment which is due from the customer. So it all started with the business receivable. So business can sell the receivable as factor to a factor, unlocking immediate cash. Now comes a crucial decision: with or without recourse. Here you can see with recourse or without recourse. So with recourse means what? The business remain accountable, business remain liable if the customer does not pay. And without recourse means what? The factor bear the risk, which is ideal for business wanting complete risk transfer. So without recourse, factor bear the risk, and with recourse means the business become liable if customer don't pay, right? So suppose the bank is involved. Suppose the bank is involved, the next step is to determine the upfront payment, right? So what will be the upfront payment amount? So with recourse, who is liable? Business is liable. Without recourse, factor bear the risk. And now if the bank is involved, the next step is determining an upfront payment, means how much the business receive immediately. Upfront payment means how much the business will receive immediately. Then we have export factoring. For export factoring, a key player enter, which is the AD category 1 bank, right? So these banks facilitate non-recourse export factoring. Non-recourse export factoring. That means, what is the meaning of non-recourse? That factor bear the risk, right? Complete risk transfer. So these banks facilitate non-recourse export factoring, ensuring a smoother international trade transaction. But there is a checkpoint. Are all these conditions met? Are all these conditions met? If yes, then the process must move forward with coordination between bank and factor. And if not, then review. Finally, a report is filed in EDPMS, Export Data Processing System. So basically, factoring help business manage cash flow, reduce credit risk, and streamline the operation. This is how the factoring help. Now the next point we have forfeiting and rupee denominated trade credit process. So let's talk about the forfeiting. Using this diagram, you can understand it easily. If you want instant cash for your export receivable, then enter forfeiting. So this structured process help exporter receive upfront payment by selling their trade receivable. So they sell their trade receivable to receive an upfront payment. So first of all, exporter issue a bill. You see. So the exporter create a bill of exchange or promissory note, ensuring the buyer commit to payment at a later date. Then what happened? Then the financer discount the bill, which means that instead of waiting, the exporter sell this bill to financer at a discount, right? Getting immediate cash, no more cash flow worry. And then RBI guideline, RBI guideline, Exim Bank and the AD category 1 bank, RBI allow Exim Bank and AD category 1 bank, right, to handle forfeiting transaction, ensuring a smooth operation. Then AD category 1 bank is there. So AD category 1 bank approval, you can see it written here, AD category 1 bank approval. So what it means, that that bank oversees transaction, right, approving deals of up to $20 million per transaction, helping business scale big. And there is something called rupee denominated credit. What is the meaning of this rupee denominated credit? So Indian importer can raise fund in Indian rupees under a specific condition. This facility cover most export except gold. Most import except gold. Gold is not included, right? With credit period of 1 year for non-capital good and 5 years for capital good. There are two kind of goods: non-capital goods, capital good. For non-capital good, the credit period is 1 year, and for capital good, the credit period is 5 years. So Indian importer can raise fund in INR under a specific condition. This is called rupee denominated credit. So question is, why this important? Why this rupee denominated credit important? Because exporter get quick cash without waiting for buyer to pay, and eliminate credit risk and boost liquidity and business growth. So Indian importer gets this credit and exporter gets instant payment. Bank approved transaction up to $20 million per transaction. So that is the limit. Now let's look at the receivable, financing process involving receivable. So friends, business thrive on sales, but what if payment are delayed? That is where financing process involved receivable comes in. So there is step-by-step process. The first step, is the credit sale. So when a business sell on credit, receivable are created. The buyer get the goods now but pay later. Now receivable is recorded. So these receivable are documented in the book as asset, waiting to be collected. Remember always that receivable are recorded in the book as asset, that it is means waiting to be collected. Bank assessment. So bank assess the business financial health by evaluating its drawing power. That is called DP. DP means drawing power. Drawing power means how much credit it can get, how much credit the bank can get. That is called drawing power. After deducting the margin, yes, margin is always deducted while calculating the drawing power, means the borrower contribution. You just have to deduct that. That is called drawing power. Then to get immediate payment, a demand bill is issued. This is a formal request for the buyer to pay now. And the bank steps in, right, buying the demand bill and crediting the seller instantly. So this helps the business maintain cash flow, right? And then instead of immediate payment, a Ujaz bill is issued, allowing extended credit term for the buyer. And if the seller need a cash before the bill due date, then bank discount it, providing immediate finance while deducting interest. So converting receivable into immediate cash, this is the first benefit, reducing financial strain on business and keeping the economy moving smoothly. So these are the three benefits of the receivable. Now let's talk about understanding bill transaction in finance. So friends, ever wondered how business manage their bill in finance? So whether it is buying, selling or trading them as asset, let's break it down in the simple term. So friends, first of all, things is purchase of bill. So bank or financial institution buy demand bill from business. This means a business get immediate cash instead of waiting for payment from the customer. So this is one case, that immediate purchase, right? So this means the business get immediate cash instead of waiting for payment from the customer. So bank purchase the demand bill. Second thing, bank discount. So suppose what if the business has usance bill? So this work based when a business has usance bill, means a bill payable at a later date. In the case of usance bill, so suppose the business has a usance bill but need cash immediately, so the bank discount it, providing instant money after deducting interest. The third is called negotiation. So when international trade is involved, bill are often negotiated under letter of credit. So this ensures secure transaction between buyer and seller across border. And finally, we have asset treatment. So in the end, business record bill properly in their financial statement, ensuring transparency in cash flow and profitability. This is important because it ensures steady cash flow, it reduces payment risk, and it helps in managing working capital efficiently. When should a business be offered a working capital term loan? Well, it usually comes down to two key situations. The first is when enterprise face liquidity needs, right? In simple word, when they need a smooth cash flow to keep daily operation running smoothly, right? So that is the liquidity need. Liquidity need means when they need smooth cash flow, means the enterprise need smooth cash flow to keep daily operation running effortlessly. That is when a WCTL is ideal. Second, during financial struggle, right? When a business is finding it tough to manage its net working capital, this loan act like a financial cushion. So two condition I have told you that when should a business be offered a working capital term loan? The first is liquidity need. Whenever enterprise face liquidity need, that means when they need a smooth cash flow to keep daily operation running effortlessly, or when during financial struggle, which means when the business is finding it tough to manage its net working capital. So but that is not at all. Let's compare term loan and working capital loan, two critical tool in strategic financial planning. So in the next slide, we will see what is the difference between term loan and working capital loan. In the left side, you will see term loan. In the right side, you will see working capital loan. So friends, on one hand, term loan are your go for a structured repayment schedule, long-term financial planning, and acquiring fixed asset like machinery or property. So this is how term loan is provided, for which so you have a structured repayment schedule. It is basically for long-term planning, and here you acquire acquiring fixed asset like machinery or property. On the other hand, if we talk about the working capital loan, it brings on-demand repayment. It has short-term flexibility, and it has the power to sustain current asset like inventory or receivable. It has the power to sustain current asset like inventory or receivable. So these are called current asset, right? So these are working capital loan. So working capital loan, on demand repayment, short-term flexibility. It is for short-term, remember, and it has a power to sustain current asset like inventory or receivable. So the next time you advise a business, make sure you match the loan type to their specific need, be it long-term growth or short-term survival. If it is a long-term growth, term loan is basically needful, and if it is short-term growth, then working capital loan is basically. And there is a special kind of working capital loan which we call working capital term loan, which is called WCTL, and it is provided during liquidity needs, right? It is provided during liquidity needs, which means ensure enterprise liquidity for a smooth operation, and you should provide WCTL when enterprise struggle with net working capital, right? So these are the three kinds of loan which are provided: term loan, working capital loan, and working capital term loan. Now let's move forward and let's see understanding loan repayment structure. So friends, let's talk about something crucial in the world of lending, that is called loan repayment structure. So when structuring a loan, understanding how repayment will happen is the key. So let's break it down into simple terms. First of all, we have something called DSCR. What is DSCR? DSCR is called debt service coverage ratio. So friends, you know that this is the vital metric that tells us if a business can comfortably pay back a term loan. Think of it like financial health check. So you can think of it like, you know, financial health check, right? So DSCR, you know what is DSCR? Basically this is a metric that tells us if a business can comfortably pay back a term loan. If the business can comfortably pay back a term loan, its DSCR will be good, right? This is a very key metric. I will tell you the formula to calculate DSCR short a while. Just wait for a few minutes. I will tell you. For first of all, you should know that DSCR is like a financial health check, right? Then we have something called liquidity ratio. I think you are familiar with it. We have talked about it in unit number 19, right? So current ratio, quick ratio, these are the liquidity ratio. So basically this is perfect for evaluating working capital term loan. Working capital loan, basically for working capital loan, liquidity ratio plays a very important role, and DSCR plays a role for term loan, right? So it means can the business comfortably pay back a term loan. So for term loan assessment, DSCR is a very good metric, and for working capital loan, liquidity ratio is a very good metric. So the liquidity ratio help us know how easily a business can meet its short term obligation. Now moving to something familiar, that is called EMI based repayment. So this is the most common repayment style for salaried individual, fixed amount paid monthly. And for the agriculture sector, you know, for the agriculture sector there is something called crop cycle alignment. So this crop cycle alignment works for the agriculture sector, right? So this is called crop cycle alignment. So we are discussing different kind of structured repayment. So crop cycle alignment means what? Repayment sync with farming season. In this case, what happened? The repayment is synchronized with the farming season, right? So it is all about matching cash flow with nature's calendar. And then we have something called installment payment. So basically this is widely used by industrial enterprise, breaking the total loan into regular small payment. And then we have bullet repayment, which means, you know, this is a one shot lump sum payment at the end of the loan term, often used for short term financial need. So these are the different kinds of financial structure. So whether it is a business loan, personal loan, sector specific financing, picking the right repayment structure makes all the difference. So we have discussed all the kinds of repayment structure: bullet repayment, installment repayment, crop cycle alignment, EMI based repayment, liquidity ratio, debt service coverage ratio. These are the different kinds of repayment structure we have. Now let's move forward and let's see the next concept we have. Whenever a bank or lender looks at a project proposal for a term loan, whenever a bank or whenever a lender look at a project proposal for term loan, they don't just glance at the number, they go deep. Let's explore how professionals evaluate project proposal step by step. First of all, we start with the legal compliance. The first thing to note is the legal compliance. You know that with making sure that the proposal align with all the regulatory guideline and banking risk policy. So it means that your proposal, it should align with, you know, it should align with all the regulatory guidelines. So proposal should align with all the regulatory guideline and banking risk policy. So no shortcuts here. This is called legal compliance. Second is, you know, something called management capability, which means are the people running the show competent enough? Their experience and leadership skill matter. So when I talk about management capability, it means are the people running the show competent enough? That means their experience, their leadership skill matter. Then comes technical soundness, which means is the project technically feasible? Does it have the right foundation to stay tall? And finally we have market feasibility, which means it also plays a big role, which means will this project actually succeed in the market? Is there a demand of it? This is where the bank look at the business potential. But that is not all. Bank also assign the borrower credibility. Bank also assess the borrower credibility before lending a single rupee. Let's dive into that funnel. So let's talk about establishing borrower credibility. So first of all, we have character evaluation. Character evaluation means what, you know? Is the borrower trustworthy? Is the borrower reliable? Integrity is the key. So here the keyword, you know, is the integrity, right? Integrity is the key. Is the borrower trustworthy? Is he reliable? So integrity is the key. Then we have capacity assessment. Capacity assessment means what? Can the borrower actually repay the loan? That means is he able to repay the loan? Can the borrower actually repay the loan? Their financial health is reviewed. This is called capacity assessment. Then we have capital verification. Means what in their wallet? Do they have enough financial backing? do they have enough financial backing, that is called capital verification. Then we have collateral review, means what asset can they place to secure the loan. So review the asset that they can secure the loan. And finally we have condition analysis, means finally bank look at the loan terms and environment around it. Is this the right time? Are external factor favorable? So only when all these boxes are checked does a project move ahead. So character evaluation, capacity assessment, means can the borrower actually repay the loan. Capital verification means what is in their wallet. And collateral review, which means what asset can they place to secure the loan. Condition analysis. So that is how bank balance risk and reward, right? So I hope that makes sense to you, how to establish borrower credibility. So these are like, check mark. So once the bank is concerned about all this, once bank feel that yes, all this check box have been ticked, then only they give the loan, right? Now let's look at how to evaluate the project comprehensively. So friends, when it's come to evaluating a project thoroughly, bank don't just look at a single factor. They take a 360-degree approach. So what they take? They take a 360-degree approach. What is the meaning of this so-called 360-degree approach? See, so how do they evaluate a project comprehensively? Let's break it down. First, they do the environmental appraisal, which means this check how the project impact its surrounding. Is it eco-friendly? Is it following environmental regulation? It's all about balancing development with sustainability. Then we have, moving on, there is something called economic appraisal. What is the meaning of economic appraisal? That this look at the broader economic condition and check how resilient the industry is. It check the resilience of the industry, right? It check how resilient the industry is. Is the economy supportive of this venture? Will it survive market fluctuation? So this is called economic appraisal. Finally, we have technical appraisal. You know what is the meaning of technical appraisal? See, technical appraisal means where the nuts and bolts are examined. Does the project have the right technology, right infrastructure and the resources to make it work? Together, these four and market appraisal I think we have left. Yes, market appraisal is also there. So here bank analyze demand and supply dynamic. Right. In market appraisal, bank analyze the demand and supply dynamic. Is the market ready for the project? Will it be viable in the long run? So these are the different kind of appraisal. In what we do in environmental appraisal, it is eco-friendly. What we do in market appraisal is we analyze the demand and supply dynamic. What we do in economic appraisal, that it look at the broader economic condition and check how resilient the industry is. Is the economy supportive of this venture? Will it survive market fluctuation? And technical appraisal is all about the nut bolts. That is how together these four appraisal help bank make a smart informed lending decision, and that is how the big picture is created before any fund are disbursed. So these are the four methods. Now let's look at understanding break-even analysis. Very, very important. From this numerical is always asked. So let's simplify one of the most powerful tool in business, that is called break-even analysis. So what exactly help a business figure out when it start making real profit? Let's break it down step by step. The first thing we have is called fixed cost, right? The first thing is called the fixed cost. You know what it means? That these are the expenses that never change no matter how much you produce. So you can think of the rent, you can think of the salaries, right? You can think of the insurance, right? So this rent, this salary, this insurance, right, they stay constant whether you make 1 unit or you make 1000 unit. So whether you make 1 unit or whether you make 1000 unit, these factors like rent, salary and insurance, they stay constant. Then the second thing is we have is the variable cost. What is the meaning of variable cost? So these changes based on how much you produce. More production means more raw material and utilities. In short, costs that move with the production line are called variable cost. So first we have fixed cost, second we have variable cost, and third we have the total cost. Total cost is the simple math, add up all your fixed and variable cost and boom, you have your total cost. Now contribution. What is the meaning of contribution? Let's understand. What is the meaning of contribution? So this is where profit start peeking through. Contribution is your sales price minus the variable cost. Try to understand this picture. So suppose this is your entire sales. This is your entire sales, right? And sales, some part of the sales is contributed by the variable cost. So this portion is your VC, that is called variable cost, and the left amount is called contribution. Left amount is called contribution, and generally contribution is represented per unit. So sales per unit, variable cost per unit, so contribution per unit. So the formula for calculating contribution is nothing but sales per unit minus variable cost per unit. This will give you contribution per unit. Okay, is it okay? Is it clear now? Now then we know the contribution. So it tells you how much each unit contribute toward covering the fixed cost and generating profit. So inside the contribution you will see two part. One part is the fixed cost, another part is the profit, right? So these are the two part inside the contribution. So contribution tells you that how much each unit generate toward fixed cost and toward profit, right? Now what happened at the break even? This is the golden point, that this is the golden moment when your revenue perfectly match your cost. So at break even what happened, you know that revenue is equal to cost, and since revenue is equal to cost, it means profit will be equal to 0. So since profit is equal to 0, so this entire, so let us draw this figure again. So this entire, this one contribution will be just made up of fixed cost, right? It will be made of the fixed cost. So now how to derive the formula for break even point? It's quite simple. So let me do it for you here. How to derive the formula for, you did not remember anything, right? So it's quite simple. So we can say break even point means what? Number of units. It means basically number of units that you need to sold so that your profit will become 0 or loss will become 0, right? So in this case what we are saying, that our contribution is equal to fixed cost. So contribution per unit, which is noted by C, multiplied by N, which is noted by number of units, is equal to fixed cost. So we can write N is equal to FC upon C. So this is the formula for calculating the break even point. Means you write fixed cost in the numerator, you write contribution per unit in the denominator, and you will get fixed cost. Now you may ask me that how to get this contribution per unit. So to get contribution per unit, you have to apply this formula. You have to write sales per unit, you have to subtract the variable cost per unit from sales per unit, you will get contribution per unit, and then you will use this formula to calculate break even point. So let me again summarize the fact for you, right? First of all, sales per unit, let's denote by small s. So small s minus VC is equal to your contribution per unit, right? And so this way you get contribution per unit, and you write fixed cost in the numerator, you write contribution per unit in the denominator. This will give you N, and this small n is what we call number of units. This is called break even point. That means the number of units which you sold, so that your total profit is 0, your total loss is 0, or your revenue is equal to cost. So please remember this formula. This will help you calculate the numerical question based on the formula which is asked frequently, right? So this tool help business plan smartly and know exactly where they will cross into the profitability. Now let's move forward and let's discuss financial break-even hierarchy. So there are some more terminology here. So friends, let's level up your understanding of how business stay financially sound. So we are diving into the financial break-even hierarchy and risk calculation. So there is something called margin of safety. You may be asked to calculate the margin of safety. What is the margin of safety? So this is your cushion, right? You can call it, this is just like your cushion. You know what it means? It is the extra sale you make over your break-even point. So the extra sale you make over the break-even point is called margin of safety. So in simple term, how far are you from hitting zero profit? So the formula is actual utilization minus break-even point, right? So bigger the margin, the safer you are. Quite simple to understand. So margin formula is quite simple. Actual utilization, right? Actual utilization you write in the numerator and subtract that from BEP, break-even point. This will give you the margin, right? So margin of safety is equal to actual utilization minus break-even point. The second thing we have is called capacity utilization. You know what it means, capacity utilization? So are you using your factory, machine or team to their full potential? So this capacity utilization tells you how much of your production power is actually being used. That means production of the percentage of the production capacity used. That are you using your factory, machine or team to their full potential? So this is gauged by capacity utilization. So suppose someone asked you to calculate margin of safety. How will you calculate it? So you first of all see what is the break-even point. You see the number of units which we have to produce to get the break-even point, and basically this the sales we are talking about, and actual utilization and minus break-even point. This gives you, so access actual sale over break-even sale. This is the formula. So you calculate the actual sale, you get the break-even sale, and just subtract both of them, you will get the margin of safety. Similarly, capacity utilization is there. Now what about the break-even point? You know, the magic number where your revenue is equal to your cost. I told you earlier, the bad break-even point, what happened? That your revenue is equal to cost. So no gain, no loss, just even ground. And remember, this is found by adding your fixed cost to your contribution per unit. Sorry, dividing. dividing. So I told you early that you divide the fixed cost by contribution per unit. This will give you the break even point. And now the last point is contribution per unit. How to get the contribution per unit? Already I told you that you subtract revenue and variable cost. This will give you contribution per unit, right? So every time you sell one product, how much is left after covering variable cost? That is called contribution per unit. That is your contribution toward covering the big fixed bill. And fixed cost, these are your non-negotiable cost like rent and salary that stay steady no matter how much you produce. And here is where things get interesting. Let's talk about risk factor. So here is the risk categorization by percentage. This is very important. So suppose you have calculated the break even point. Now what does it tells us? So what does the percentage tells us? So depending on how far you are from your break even point, your risk change. So suppose it is 50%. So break even point is 50%. It means very healthy, means smooth sailing. You are financially stable and carrying low risk. If it is 65%, it means again low risk, right? You are doing fine with only minor financial concern. And suppose now it is 70%, right? So it means medium risk. 70% means medium risk, which means things are getting tighter, right? The time to be cautious. If it is break even point is 85%, it means red flag are waving, you are close to danger zone, high cautious needed. And if it is 100%, it simply means that you are at the critical point, extreme caution is a must to avoid financial trouble. So always aim to stay on the green side of the chart to keep your business safe, right, and growing. So I hope that makes every concept clear, right? So that is how we will do it. Now let's look at the next point, financial ratio sequence. This is very important thing which we are going to discuss now. So friends, let's navigate the financial roadmap step by step. Imagine you are about to take a journey to assess your business or project financial health, especially when dealing with loans and repayment. So here is your guide. First of all, you identify the break even point. First thing to do is to identify the break even point. Means this is your first checkpoint. Determine at what sales level your business neither make a profit or not a loss, just a stable ground. This is very crucial for financial stability. Then you determine the moratorium period. You know that think of this as a breathing space. It is a period before you actually start repaying your loan, right? Obviously some moratorium period is provided. It is a period before you start actually repaying your loan. Understanding the moratorium period gives you time to prepare the cash flow. Then you calculate the DSCR, debt service coverage ratio. Basically, here you assess your ability to service debt using your cash flow. So how much able you are to service your debt using your cash flow. This is assessed by DSCR, right? So the higher your DSCR, the safer you are in covering debt payment. The safely, because your cash flow is self-sufficient to cover the debt, and the higher the DSCR, the more safer you are in covering the debt payment. Then you calculate GDSCR. See, one thing is GSCR and you just add G before it, that means gross DSCR. So what it means that this step zooms out to evaluate the total debt servicing ability, covering all your loan obligation, not just a specific one. It is a broader view. And then you calculate net DSCR, which is called NDSCR. Now we go deeper, right? So calculate how well your net cash flow can cover loan installment and interest payment across the time. And let me tell you the formula to calculate the net DSCR. You write total cash accrual in the numerator. So you write total cash accrual in the numerator, and you add interest on all term loan. You add interest on all term loan. Interest has also to be added, and you divide that by, you divide that by so total cash accrual plus interest on term loan over the year, divide that by total term loan installment. Total installment you are paying plus interest on term loan. So interest is added on both the side. You see, interest is added here also, it is added here also. In the numerator we write cash accrual, in the denominator we write installment, right? So obviously if this portion is higher, means you are capable enough to pay your installment and interest using your cash accrual, right? So this portion is common, interest is common. So interest has been added on both the side. So interest on all the term loan over the year, and denominator also interest on all the term over the year. But in the numerator we have total cash accrual, in the denominator we have installment. So this ratio is called NDSCR, net debt service coverage ratio, right? So basically it calculates how well your net cash flow can cover loan installment. So this ratio is a key signal to lender about your repayment capacity. Yes. So they will see your total cash accrual and they will see your total installment you have to pay, and on the basis of this ratio they decide your repayment capability, and they calculate the average GDSCR. So lastly they average it out. By calculating the average GDSCR over the year, you smooth out the peaks and valley to see the bigger financial picture. So, but we are not done yet. Let's move to the biggest funnel. So, I hope this step is clear. How do they assess the lender capacity? Now, let's look at the next point, which is understanding IRR. You know what is IRR? So, let's break down how investors make a smart decision. First of all, you calculate the future cash flow. You calculate the future cash flow. Estimate what financial return you expect from this project or investment, what it will bring in the future. You calculate the net present value, NPV. So calculate the present value of all those future cash flows. So suppose you have invested. So let us try to understand what is happening here. Suppose you have invested 10,000 rupees in a project. Just suppose 1 lakh rupees, and suppose you are getting 10,000 over next 5 years. So these are the future cash flow which you are receiving, which you are expected to receive. Then you calculate their NPV. What is the net present value of these future cash flow in today's date? And you calculate it by discounting. You know the discounting factor is there, 1 upon 1 plus r whole to the power n. By using this discounting factor, you calculate their present value and you add all of them to get the net present value. Right, and then after calculating NPV, you identify the IRR. What is the meaning of IRR? IRR is called internal rate of return. This is called internal rate of return. So what is the definition of IRR? Means this is the golden number. Why it is called the golden number? Because the discount rate where NPV is equal to 0. So we equate the NPV to 0. First of all, you see the future cash flow. Then you calculate the NPV. You equate NPV to 0. The corresponding discount rate is called IRR. Right. So the higher the IRR, the more attractive the project is. And finally, the step number 4 is to assess the investor interest. Means finally gauge if the investors are on board. Their interest is often based on whether the IRR beats their expectation. So the next time, whenever you are analyzing financial or pitching an investment, follow this flow to make confident data-backed decision. Right. So what we do basically, what is the formula for calculating IRR? So this is the formula. You see, future cash inflow minus initial investment divided by 1 plus discount rate to the power time period. So let me write it down. Future cash flow minus initial investment, and you divide it by 1 plus r to the power time period. So this will give you IRR, right? So and there is a term which is called WACC, weighted average cost of capital. You can use this WACC at a discount rate. Now you may ask me, what is this weighted average cost of capital? So obviously I can tell you that this WACC is calculated by taking a weighting average. The capital structure, you have talked about the capital structure, either it can be debt or it can be equity. Right, so there is a different discussion, we will discuss it later. So this WACC, weighted average cost of capital, it can be used as a discount rate, and IRR is also called discounted cash flow rate of return, right, or simply rate of return. So these are the different name of IRR. You must note it down. So friends, then we have something called sensitivity analysis. So let's talk about the sensitivity analysis in the next slide. So here we are. So how to assess the financial viability and the security? How do you truly assess the financial viability and security of a loan proposal? So step number 1, you conduct the sensitivity analysis. There are 3 steps. We will discuss step by step. So start by stress testing your proposal. What you do? You stress test. I think you are familiar with this term, stress test. Basically, we evaluate how key financial metrics hold up under tough condition. So what we do, imagine running 4 separate what if scenario. We run 4 separate what if scenario. What if cost rise? What if sales drop? What if interest rate spike? And then we create a 5th scenario where all these adverse factors hit at once. So the 5th scenario we create when all these adverse factor, just now we have talked about the adverse factor, rising cost, rising interest rate, or interest rate spike, sales drop. So fifth case where we consider when all these adverse factor hit at once. This is the 5th case, hit at once, right? So basically, if the proposal still stands strong and the financial indicators stay healthy, we can confidently say yes, the project is viable. Right, I'm again repeating. How do you conduct sensitivity analysis? So we imagine running 4 separate what if scenario. What if cost rise? What if sales drop? What if interest rate spike? And then we create a fifth what if scenario. Then we create a 5th scenario where all these adverse factors hit at once. Means sales is also dropping, cost is also rising, and profit is also decreasing. So all the factors have been happening at the same time, and we check whether our project still stands strong. If it is staying strong, then it means our project is viable, right? This is called sensitivity analysis. The second thing we have is to assess the security margin. We look for the safety net for lender. This step ensures that in case of a borrower default, there is a solid fallback, be it asset, be it guarantee, so the lender can recover the loan smoothly. It's all about minimizing the risk. So whenever I say security margin, what it means, basically, in case suppose the borrower default, or suppose there is a solid fallback, right? So be it asset, be it guarantee, so the lender can recover the loan smoothly. That is the point. That is called security margin. And finally, we assess something called FACR. Now you may ask me, what is this FACR? FACR stands for fixed asset coverage ratio. So friends, lastly, this is a step number 3 way that we do. We check if there are enough fixed asset. What is the meaning of fixed asset? You know it very well. We check whether there are enough property. We check whether there are enough machinery, right? Or we check whether there are enough equipment, right, to fully cover the loan amount. A strong coverage ratio means the loan is well secured through tangible asset, right? So if you are evaluating a project or if you are evaluating a loan proposal, make sure to walk through these 3 pillars. They will help you balance risk, security and financial strength. So basically, this is all about risk, this is all about security, and this is about the financial strength, right? So the question was the question that how to assess the financial viability and security of a loan proposal. You have to conduct the sensitivity analysis, you can access the security margin, and you can evaluate the FACR, right? You must know it. Now let's look at the type of bank financing for infrastructure project. Very, very important thing. So this is the peculiarity of our crash course, that everything we provide in the form of this picture, right? And this picture help you retain this concept for a longer time. So friends, let's unlock another key concept, types of bank financing for infrastructure project. When it comes to funding infrastructure, bank provide a variety of financing options tailored to their specific needs. Let's break them down. First of all, we have something called working capital finance. I think you are familiar with it. So this type of finance takes care of your day-to-day operational need, right? Your operational need is taken care of, whether it is to manage cash flow or to meet short-term business goal, right? To manage cash flow or to meet short-term business goal, working capital finance is the go-to solution to keep the project running smoothly. Then we have the term loan. I think we know it very well, that these are the classic loan meant for long-term project. They fund big ticket items like capital expenditure. You might have heard of capex, right? Helping you build, expand or modernize infrastructure. Think of it as a financial fill for your long term. Next, we have something called project loan. What is the meaning of project loan? So these are tailor made for infrastructure development. Project loan address project specific needs, from highway to power plant. This loan category ensure the large scale infrastructure dreams become reality. Then we have something called bond debenture subscription. Bond bank also invest in debt security. So these are called debt security, right? Basically offering opportunity through bonds and debenture subscription. So these instruments provide alternative financing route while offering bank solid investment returns, right? Bank invest in this kind of instrument, debt security. Then we have final technique that's called takeout financing, and the question is frequently asked from it. This is the strategic partnership model. So in simple way, we can say that yes, it is a partnership model. It is a kind of partnership model, often seen in collaboration with institutions like IDFC. In partnership with IDFC, it helps bank offload long-term project risk by transferring them to a specialized financial institution after a certain period. So how does it help? Let me again explain. It helps bank offload long-term project risk. So risk offloading, which kind of risk offloading? So long-term project risk, right? So it helps bank offload the long-term project risk by transferring them to a specialized financial institution after a certain period. I will take in detail about this takeout financing because this question is frequently asked. So we have just summarized the type of bank financing for infrastructure project, right? These are the various kind which is possible. Now, so friends, so depending on the project nature, whether it is short term, long term, operational, developmental, banks have a financing solution for every stage. So if it is short term, go for working capital finance. If it is a long term, go for term finance. If it is a project type nature, then go for project loan. Or if it is partnership model, right, then go for this takeout financing. So these are the different steps available. Now let's discuss our next topic, that how to approach the infrastructure financing. So friends, how exactly do we approach infrastructure financing? There are 2 key pathways bank follow to make infrastructure project a reality. What are these 2 key pathways? The first is called inter-institutional guarantee. Inter-institutional guarantee. So what it does? What is the meaning of this inter-institutional guarantee? Do you know about it? Let me explain. So this enable bank to issue guarantee with at least 5% funded share, right? So what it means that bank issue guarantee. This is bank. So this bank is issuing guarantee with at least 5% funded share, right? Backed by thorough due diligence. Yes, due diligence is always there, right? So in simple term, bank can support project by offering guarantee when a specific funding and risk assessment criteria are met. So if due diligence is there, means condition are met, specific funding are met, then bank can give guarantee for the project. It is a smart way to reduce direct exposure while still supporting infrastructure development. Yes, bank is not directly exposed because it is giving a guarantee, but this is a way to support infrastructure development. And the second method, is called financing promoter security. So bank help promoter acquire share of the existing company, right? So this is a bank, right? And they are helping whom? They are helping the promoter. How they are helping the promoter? They are helping the promoter to acquire share of the existing company. To acquire share of existing company. Right. So but here is the catch, but under a strict RBI guideline. So the catch is that the borrower must have a significant skin in the game, their own stake, while the bank finance up to 50% of the acquisition cost. You can see bank finance capped at 50% of that. So this is the maximum that bank can finance, right? Remember it. So plus the loan must be secured against solid asset. Yes, security should be there against the solid asset. Plus obviously this ensures that promoter is fully invested, right? Promoter is fully invested literally and figuratively. So this is called financing promoter security. Again I am repeating what is happening here, that bank help promoter acquire share of the existing company. Suppose there is an existing company, so bank help promoter to acquire share of the company, right? But under a strict RBI guideline, the catch is that borrower must have a significant skin in the game and their own stake which should be at least 50%. So bank can maximum finance up to 50% of the acquisition cost, right? So let's shift gear and dive into the loan approval process. So how to approach infrastructure financing? Two ways are there, either through interinstitutional guarantee, but the minimum 5% funded share, right? That is the point. And second is financial promoter security, financing promoter security. So these are the two techniques to approach infrastructure financing. Remember these two techniques. Remember the limit 5% funded share for interinstitutional guarantee, or 50% limit, 50% finance they can provide for financing promoter security. Now let's look at the loan approval process. So friends, because financing is not just about handing over the fund, it's a step-by-step journey. So first of all, what the bank do? The bank do the risk assessment. You know what it means? A thorough evaluation of all potential risk involved in the project. Bank want to make sure that loan won't turn into a liability later. Yes, this they want to ensure that this loan should not turn into liability, right? Second is called margin maintenance. What it means? That bank ensure financial margin are maintained, acting as a buffer against unexpected challenges. Think of it as keeping a safety net in place. Then we have DER limitation. You know about it, debt equity ratio limitation. So bank check that the borrower DER does not exceed 3:1. Yes, very very important. Borrower DER should be less than or equal to, right, 3:1, right? Sorry, just wait a minute. Should be less than or equal to 3:1. Why? Because to ensure there is a healthy balance between borrowed fund and the promoter's own investment. Because when I say DER is 3:1, it means for every 1 unit of equity, the borrower has taken 3 times the debt. And if they are taking more debt, it means it may be possible that they can't repay their loan because they are more exposed to the debt borrowing. So that is why bank ensure that DER should not exceed 3:1. And there's something called tenor and compliance check. So the bank now verify that the project loan duration or tenor is within limit and fully compliant with the regulatory norm. No counter cutting is allowed. And finally, we have something called board approval. Finally, before the green light is given, the bank board must review and formally approve the loan. Only after this stamp of approval does financing move forward. So from a strategic funding option to a multi-layered approval process, bank ensure that infrastructure financing is secure, smart and sustainable. So this is how the loan approval process is done, right? The things which can taken care of. Now let's discuss takeout financing. I told you this is a very important financing method. Let's discuss step by step. So let's explore the step-by-step journey of takeout financing and liquidity support process. You see, this is the pictorial format, and everything can be made easily understand by this pictorial format. So friends, the step number 1 is that bank extend a long-term loan. Bank extend long-term loan. This is called LTL. What does it mean? See, this is the key mechanism, right, that help bank manage long-term infrastructure loan smoothly. It all starts when a bank provide a long-term loan to fund large infrastructure project like highway or power plant. this is where the foundation is laid, right? Then we have transfer of loan to financial institution. So soon after, these loan can be transferred to a specialized financial institution such as IDFC or SBI, right? So loan is transferred to the specialized, so you know there are some specialized financial institution like IDFC or SBI, so reducing the bank long-term exposure and freeing up fund for other project. So you know when the bank transfer the loan, obviously it will get the fund, so it will have more fund available to fund other projects, right? Then you know what happened, then this IDFC SBI develop model agreement, they develop something called model agreement. You know, institutions like IDFC or SBI work together to create a flexible financing model agreement. They create something called flexible financing model agreement that benefits both the bank and the borrower. Think of it like customizing the blueprint, right? Basically what they are doing, this model agreement is just like, you know, customizing the blueprint. That's it. Now after doing that, there is something called liquidity support from IDFC. What it means, this is step number 4. So IDFC steps in to offer liquidity support to bank, helping them manage their cash flow and maintain healthy operation while the project progress. So this is called liquidity support from IDFC, right? So IDFC steps in to provide liquidity support to whom? Bank, right? IDFC provide liquidity support to the bank, helping them manage their cash flow and maintain healthy operation while the project progress. And then the bank secure refinance commitment. The bank that secure a firm refinancing commitment from IDFC or similar institution, this ensure that once the initial loan mature, there are already a plan in place to refinance it. And IDFC agreed to refinance loan. At an agreed future date, IDFC formally agreed to refinance the loan. This is the key milestone that takes the burden of the original lender, right? And then what happened? Bank retain the credit risk. Yes, however, even after refinancing, the bank may continue to bear the credit risk of the loan. This means the bank remain responsible for assessing the and managing the borrower's repayment ability. Yes, responsibility does not shift. The bank still remain responsible for the credit risk. And finally, interest rate based on risk perception. Finally, the interest rate for the refinance loan is set based on IDFC risk perception. The higher the risk, the higher the rate, and vice versa. So, at which rate this IDFC will provide the return, it is based on the risk perception, right? So, the project ensures that bank can confidently fund large infrastructure project while managing their liquidity and risk exposure effectively. So, this is how this particular, you know, these are the steps. Again, I am repeating. First of all, bank extend long-term loan, transfer the loan to financial institution, IDFC SBI develop model agreement, IDFC provide the liquidity support to bank, bank secure refinance commitment, and IDFC agreed to refinance after a set period, and this is how it is done. Now let's look at the financing cost overrun in project. Very, very important. So friends, let's look at how we handle a financing cost overrun in project, a very real challenge in infrastructure financing. Especially, basically, we are talking about something called infrastructure financing, and you know that this kind of thing is very challenging in infrastructure financing. So step number 1 is to have a standby credit facility provided, you know, to safeguard against unexpected cost overrun. So this is a point, this is called cost overrun. So to safeguard against this cost overrun, you know, lender provide a standby credit facility at the time of financial closure. So when the financial closure is happening, lender provide a standby credit facility. So think of it as a financial cushion ready to step in when things goes beyond the budget. Then we have facility factored into credit assessment. So this standby facility is not just sitting idle, it is carefully factored into credit assessment. Lender consider this backup funding while evaluating the project financial health. And then we have financial ratios are maintained, you know, that thanks to this facility, the key financial ratio of the project, like, you know, DER, debt equity ratio, and you know, interest coverage ratio, ICR. So these are the key financial ratio. They stay stable even if the cost rise. It's like balancing on a tight rope with a safety net underneath. And finally, repayment terms align with the base loan. So the repayment terms of this standby credit facility align with the term of the base loan, keeping things simple and structured for the borrower. So you know, this process help project stay financially sound and attractive to investor even when the budget go off the track. So this is called cost overrun. Sometimes what happen that, you know, cost exceed. So what they do, so then a standby letter of credit, standby credit facility is provided. Right. Again, I am repeating the step. So to safeguard against unexpected cost overrun, lender provide a standby credit facility at the time of financial closure. Right. And you know, this standby facility is not sitting idle. Rather, they are carefully factored into credit assessment. And thanks to the facility of ratio maintaining, that the key financial ratio, basically this facility, what is the facility? A standby credit facility. Thanks to this standby credit facility, that the financial ratios are maintained as it is. They stay stable even if the cost rises. Right. And finally, the repayment term aligning with the base loan. So repayment term of the standby credit facility aligning with the term of the base loan, keeping things simple. And then the final thing which we have to study in this particular chapter is, now we have just I'm looking for presenting in front of you, DCCO, very very important. So friends, that let's talk about a crucial safeguard in project financing, which is called handling cost overrun. I just told you that how to handle the cost overrun, right? So sometimes project exceed their planned budget, but here is how bank step in smartly. So there is something called pre-approved standby facility. I just talked about it now. So if the standby facility was already pre-approved during financial closure, bank are ready to fund the cost overrun without any hurdle. It's like having a financial parachute packed in advance. No pre-approval is required, right? You can see, if not pre-approved, right, no worry. Even if there was not a standby facility pre-approved, bank can still finance overrun caused by DCCO extension. Try to understand. This question is most frequently asked. Right? Bank can still fund overrun caused by DCCO extension. You know what is the meaning of DCCO? Right? Basically, up to 2 years for infrastructure project and up to 1 year for non-infrastructure project. So because of this DCCO extension, what happened? Sometimes some extra cost is required and bank can finance. Even if no pre-approved, no standby facility is pre-approved, bank can still overrun, fund overruns, cost overrun, all without classifying the loan as restructured. Right? They have not to classify the loan as restructured, provided certain conditions are met. But there are conditions. What are the conditions? The condition, let's understand the condition. Condition is that bank must fund interest during construction. Bank must fund interest during construction, which is called IDC, right? That is called interest during construction. Second point, it can cover cost overrun up to 10% of the original project cost. Suppose original project cost was 1 crore. What is 10%? 10 lakh. So this is the maximum that the bank can finance. Cost overrun can happen, and they should maintain that original debt equity ratio. And they ensure that promoter bring their share first. Yes, this is very important. And finally and importantly, keep loan term unchanged or even more favorable to the bank. So the key takeaway is that this 10% overrun ceiling or overrun cap apply to everything, including cost hike from current fluctuation linked to DCCO extension. So friends, now you can see. So let's break down the loan document execution steps, execution process step by step. First of all, it all starts with the borrower, right? So basically, borrower who signed the essential loan document, this kick start the entire lending process. Next, the guarantor steps in. So basically, by signing the document, the guarantor agreed to share the liability, standing shoulder to shoulder with the borrower. Then once these signatures are in place, the charge is created over the primary security. As you can see, it means that this charge legally secures the lender interest in the borrower asset. Moving forward, the owner of the collateral. So owner of the collateral sign. So if it is someone other than the borrower, also sign all the relevant document to formalize the collateral agreement. Interestingly, if the collateral owner is not the borrower, they not become a guarantor. If the collateral owner is not a borrower, then they become a guarantor by default, adding an extra layer of assurance for the lender. Finally, everything is wrapped up by following a standard legal documentation. Right, a standard legal documentation, the usual set of paper which is used for most loan. So each step ensures that loan is legally sound, secure and ready to be disbursed. So that is the meaning of loan execution, loan document execution process. Now let's move to the next slide. Let's look at the credit document processing sequence. So friends, let's explore the credit document process sequence, a crucial path that ensures a smooth credit documentation. Step number 1, as you can see, is ensure proper stamping. So before everything else, verify that all documents are properly stamped. This is a legal must do before moving ahead with execution. So first of all, you do the stamping. After doing the stamping, then you do the execution. That is the first point. Now, with the step number 2 is to verify the authority to sign, which means check if the people signing the documents have the legal authority and the capacity to contract. This step safeguard against unauthorized commitment. And step number 3 is to complete document before signing. So before putting pen to the paper, make sure every section of the document is fully completed, no blank, no missing information. And then you have to register the charges with the ROC. That means ensure that all documents are registered with the sub-registrar within the legal prescribed time frame to make them enforceable. So this is the point. So ROC within 30 days. So register any necessary charge with ROC within 30 days. So remember this deadline, 30 days is very very important, and complete registration of the document with sub-registrar within the time frame. So each step matter. It's about making the document legally valid and protecting all the parties who are involved in this particular legal transaction. Now then we move forward to the next topic, which is the asset registration overview. So in this particular diagram you will be able to understand, basically we will able to clear look at the asset registration overview, a key step in securing asset legally. At the heart of this process we have various type of asset registration, each protecting a different category. So the first kind of charge you can see is called the mortgage charge. So basically mortgage charge need to be registered with CAIIB. I think you know CAIIB, that is the Central Registry of Securitization, Asset Reconstruction and Security Interest of India. So remember, mortgage charge has to be registered with CAIIB. Then we have something called security interest. So again, beyond mortgage, other security interests are also registered with CAIIB, ensuring transparency and legal enforcement. What about the vehicle charge? Try to understand. When it comes to vehicle, registration of the charge is done through the Vahan portal. So there is a site which we call Vahan. So this site registration of vehicle is done, which is an India National Vehicle Registry. Then what about aircraft? So aircraft, yes, even aircraft charges are registered, but this time with the DGCA, right? So the Directorate General of Civil Aviation. What about the ships? So friends, finally for the ship, these are the assets. So the asset for ships, registration happened with the Mercantile Marine Department, right, securing the lender interest in the maritime asset. So all the registration work like an umbrella, offering legal protection to lender and stakeholder across various industry. So I hope that makes sense. Different kinds of asset registration, I have made it clear to you. Please hit that like button if you really think that this concept is helpful to you. And friends, if you want such type of content for each and every unit, you can enroll in our CAIIB crash course program, which I have just launched, and this will help you cover the entire syllabus, all the important part of the syllabus in a very small amount of time, right? So to get more detail, you can WhatsApp me on this particular number, because the video you are seeing is just a part. The entire video is available in the crash course program. Now let's move to the next part. The next part that we have, let me show you. So this is the next part. Should personal guarantee be required for loan security? So this is the question. Now let's address a critical question in the world of lending. Should personal guarantee be required for loan security? On one hand, personal guarantee are often required for company where promoter, director or trustee have limited or no liability. Often what is happening, that on one hand personal guarantee are required. Yes, personal guarantees are required for those company where promoter, where director, where trustee have limited or no liability. In such cases, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible. It is a way to safeguard the bank interest when corporate liability is limited. So again I am repeating, yes, personal guarantee is required for loan security in those cases where promoter, director, and for those company or entity where promoter, director or trustee have limited or no liability, right? So in this case, bank insists on personal guarantee to make sure these individuals are held jointly and severely responsible, right? But on the other hand, personal guarantee may not be necessary in the case of sole proprietorship, partnership, right? Because owner already have unlimited liability, meaning their personal asset can be attached directly, right? So in this company cases, they were having limited liability, but in this case, they have unlimited liability, like proprietorship, partnership, personal guarantee of owner. So it's not necessary, because their unlimited liability allow attachment of the personal asset. So but wait, there is more to it. Let's dive deeper into when personal guarantee plays a key role in the credit delivery. So let's look at the next slide. Should a personal guarantee be required for credit delivery? So friends, see, there is a point. There is something called closely held company. Try to understand. Closely held company. Personal guarantee, it helps ensure continuity in management and act like a cushion to protect the bank interest. So for closely held company, yes, personal guarantee is required. For delays in asset charge. So what happens, sometimes asset charge may get delayed. Personal guarantee provide a temporary layer of security to the lender during this delay, because I told you now that asset has to be registered, has to be charge has to be created over asset, and to whom charge is to be created, I just told you. For mortgage there's a different, for CAIIB, right? For mortgage CAIIB is there. For different kinds of asset category, different charges have to be registered, right? But suppose delays happen, then what to do? Then this personal guarantee will help you, right? And then the public company with weak financial, right? This is the case. So when a company financial strength is questionable or cash flow is unstable, personal guarantee act like a critical risk mitigator, right? So there we have to do it. And finally we have subsidiary with weak financial. For subsidiary that are financially vulnerable, guarantee safeguard against unexpected default. So while personal guarantee are not always mandatory, they are a vital tool when risk factor arise. So that is the point which I have answered, which I have raised, explained through this particular diagram. Now let's shift to our focus to the next diagram, which is should exception to the prohibition or remuneration for guarantee be allowed. So let's try to uncover it. So friends, let's tackle a tricky question now. Should exception be allowed to rule that prohibit remuneration for guarantee? Should exception be allowed to that rule? There is a rule that prohibit remuneration for guarantee. Should exception be allowed to this rule? So it's like standing at a crossroad, two paths, two perspective. So the first says that allow exception. You can see on the left side it says that yes, allow exception. So in some cases, exceptions are permitted. Imagine a situation where the guarantor are no longer part of the management, yet their personal guarantee still protect the bank. In such scenario, allowing remuneration can make sense as it compensates for the ongoing risk they bear even without having active role. And second case, do not allow exception. On the flip side, many believe that we should stick strictly to the rule. Why? To avoid any potential misuse or ethical concern that could arise if exception become too common. So this strict approach ensures integrity of the prohibition is maintained. So what do you think? Should flexibility be allowed or should we stay firm on policy? So this is a classic debate between pragmatism and discipline, both having valid reasoning depending on the context. So on one side you say that yes, allow exception, right? Means rules that prohibit, there is a rule, right, that prohibit remuneration for guarantee. So but sometimes you can allow, right? For example, I have given you the situation, right? Suppose a situation where the guarantor are no longer part of the management, so yet their personal guarantee still protect the bank, right? So this situation I have told you, this is an exception which is allowed. Now let's shift our focus to our next slide, and in the next slide we are talking about managing working capital in sole banking arrangement. Very important discussion we are going to do. So friends, how working capital is managed under a sole banking arrangement. First of all, everything initiate sole banking arrangement. So this is the first point, initiate sole banking arrangement. Means the business manages working capital through a single cash credit account. So there is a single cash credit account through which the business manages working capital with one bank. So business has a cash credit account, or we call it CC account, with a bank, and through which this working capital is managed. Simple and centralized. Then route transaction through bank, which means not all your business transaction, inflow and outflow, are route. Next point is that all your business transactions, whether inflow, whether outflow, are routed exclusively through this bank. This gives the bank full visibility of your cash flow. Then open account with other bank. So, but wait, what if you need another account? You will need formal approval from your sole banker before opening account elsewhere. It keeps the bank in the loop. And then you have to obtain periodic statement. So then regular financial statement comes into play. So these report help the bank monitor your drawing power, right? So they can monitor your DP. DP is called drawing power, ensuring that your cash credit usage stay within the sanction limit. For every cash credit account there is a sanction limit, and to ensure that your utilization, your cash credit usage stay with that limit, DP is used. DP is called drawing power, and for that you have to give the periodic statement, right? So based on your periodic statement, your DP is decided. This is very important point. And regulate cash credit utilization. Basically it's all about discipline. Maintaining credit usage strictly within the approved limit is the key to maintaining a healthy financial profile. And finally, how do we derive the DP? I will tell you the formula to calculate DP. Just right now listen to me carefully. How is this DP calculated? So basically, bank assesses your current asset, current liability, using monthly stock statement. So you submit your monthly stock statement, then bank assesses what is your current asset, what is your current liability, right? Based on your monthly stock statement, based on your book debt, based on your sundry creditor. So applying margin to figure out your drawing power. So on all these things, your monthly statement, book debt, sundry creditor, some margin is applied, and then drawing power is derived. So at the end of this video, I will tell you a numerical based calculation based on the drawing power. So stay tuned till the end, and I will explain how to solve question based on drawing power. This is most frequently asked in numerical type. Now let's focus our attention to our next topic, that how should working capital be allocated to stabilize funding use. This is a very important discussion we are going to do. So let's explore two common approach. The first approach, we have the cash credit focus. On the left side we have the cash credit focus. So the question is how working capital be allocated to stabilize fund use. So this method offers flexibility. When I say cash credit focus, it offers flexibility. Borrower can dip in and out of fund as needed, but there is a catch. It may result in fluctuating utilization and unpredictable cost, right? So borrower can dip in and dip out fund as needed, right? They can withdraw and they can deposit the fund as and when required, but it may result in fluctuating utilization, right? It may result in fluctuating utilization, right? Of what? for fluctuating utilization and unpredictable cost. So during period of tight liquidity, borrower might max out their limit, causing bank to face high short-term borrowing cost. But during slack period, low utilization leave idle fund lying around, a double-edged sword. Right. So basically what is happening? So there are two periods, right? So there is a period called tight liquidity, right? So there is a period of tight. So depending on which kind of situation is it, let me explain. So depending on which kind of situation it is, so imagine a bank give loan to business through something called credit limit, like a credit card, but for company, right? So there is a period called tight liquidity period. Try to understand. This question was asked. So suppose there is a tight liquidity period. So tight liquidity period means money crunch time. When the market is short on money, that is called tight liquidity. Company will quickly use up all the money available to them under their limit to survive the crunch. Now the bank suddenly need more cash to meet this high withdrawal, so it may have to borrow extra money at higher interest rate, increasing their short-term borrowing cost, and this eats into bank profit. And sometimes there is a slack period. Slack period means what? Try to understand. Slack period means when the market is flush with the cash. This is called slack period. So company don't need to borrow much. So the bank fund are just sitting idle, earning little or no return, while the bank is still paying interest to depositor, or other obligation. So in tight time, higher cost due to borrowing. See what is happening in the tight liquidity time, higher cost because the bank has to borrow the money, right, at higher interest rate, and the slack time, the lower income because the money is idle, right? So the bank is stuck both the way. That is called double-edged sword. It struggle either with higher cost or with low return depending on the market condition. So that is the cash credit focus. That is the point of understanding the cash credit focus. I hope that makes sense to you, right? So that is the point of understanding cash credit focus. Now let's look at the other side. There is a fixed term loan allocation, right? So you can see, and then the point of cash credit focus, what we have learned, that during period of tight liquidity, borrower might max out their limit, causing bank to face higher short-term borrowing cost, and during slack period, low utilization leaves idle fund lying around, and double-edged sword, because fund is lying idle, and from where the fund are coming to bank? Obviously from the depositor, and bank is paying interest to the depositor. So this is called double-edged sword. This question was asked last time. Then there is something called fixed term loan allocation. So this strategy brings stability. Yes, it brings flexibility, right? This cash credit focus brings flexibility, but this fixed term loan allocation, it brings stability. Why it brings stability? Let's try to understand. Because by combining both fixed and flexible funding component, business can smooth out cash flow ups and down. The result is that lower idle fund reduce borrowing cost also reduce, and much and more predictable fund uses. So which part should you choose? The flexibility of cash credit or the stability of fixed term loan? Because whenever bank offer fixed term loan, then by combining both the fixed and flexibility, right, it combine both fixed and flexible component. That is the point, right? So this is the point which I want to raise through this particular. So the question was, how should working capital be allocated to stabilize fund uses? By using this fixed term loan allocation, right? Now the next question is how to structure working capital limit for borrower. So when it comes to managing borrower, a crucial question arises, that how do we structure working capital limit effectively? So let's break it down step by step. There is something called loan component. So remember, for large borrower with working capital limit of 150 crore and above, right, it is essential at least 60% of this limit is structured as loan, and yes, there is a flexibility to increase it further. Right, again I'm repeating. For large borrower means those who have working capital limits of 150 crore and more, right? These are called large borrower. So it is essential that at least 60% of this limit, suppose the limit is say 200 crore. What is 60%? 60% is 120 crore. At least 120 crore should be as loan, right? At least 120 crore should be as loan, right? So basically, and it can be extended further. It can be increased further. A second way to structure working capital limit for borrower is to include commercial paper. So if commercial paper are sanctioned, they must be counted as a part of loan component, right? They must be counted as part of loan component. It ensures proper integration within the borrower working capital, and you have to exclude certain credit. So, but don't forget, export credit and inland sales bill limit are excluded from the loan component calculation. So basically what we talk about the loan component calculation, the first thing that loan component should include for borrower having working capital limit of 150 crore and more, they should have 60%, at least 60% should be the loan component. Second point, any commercial paper should be part of the loan component, and we have to exclude some kind of credit like export credit, inland sales bill limit outside of the loan component. So that is the point which I have explained, how to structure the working capital limit for borrower. Now let's shift our focus. So friends, now let's walk through the loan structuring and management process step by step. So determine loan amount and tenor. So start with consultation, right? First start with the consultation, right? Finalize the loan amount and the tenor, which must be at least 7 days. So this should take at least 7 days. Loan amount and tenor, with you consult with the borrower to set loan parameter, loan amount and tenor. Then you structure the multiple loan, which means design loan with varying maturity to balance flexibility and repayment timeline. Now you ensure the RBI compliance. All consortium lenders. So basically this point is about the consortium. You know about this consortium thing, right? So how consortium works, that is the point I'm talking about. So basically all consortium lenders must stay in sync with RBI guideline. Then individual bank responsibility. Basically what happen whenever multiple bank arrangement is there, MBM is multiple bank arrangement. So whenever multiple bank arrangement is there, each bank within this MBA is responsible for managing it on compliance independently. Then you set the repayment terms, means fixed repayment schedule, whether it is via installment or bullet payment based on borrower need. You know what is the meaning of bullet payment? It means the entire payment will be paid at the end of the repayment terms. And finally apply rollover option. So consider rollover option, ensuring they comply with the IRAC norms. So income recognition and asset classification norms. So a systematic approach like this helps stabilize the borrower cash flow while keeping the lender risk in check, right? So that is the point. So this is how loan structuring and management process is done. Now let's look at the term loan disbursement process. So friends, let's explore the term loan disbursement process step by step. First of all, it all begins with the borrower contributing their share upfront, which is called margin, right? So borrower deposit margin, right? So this margin ensures the borrower has a skin in the game before the bank move forward. Then bank debit the loan amount. So it means once the margin is secured, the bank debit the full loan amount from its own account to get ready for the next action. Then bank remit payment to the seller. So next the bank take charges and directly transfer the fund to the seller on the behalf of the borrower, ensuring a smooth and secure transaction. Then there is a proof of partial payment, which means in certain cases if the borrower has already made partial payment to the seller, the bank will require proper documentation as proof before disbursing the remaining amount. And then you have direct credit for personal loan. So and if it is a personal loan, the process is simple. The sanctioned loan amount is directly credited to the borrower account. So whether it is a business transaction or a personal need, this process ensures that disbursement is secured, systematic and hassle-free for both borrower and the lender. So this is how the term loan disbursement is done. A step-by-step process I have told you. Now let's shift our focus to the next topic, which is the project loan disbursement. How project loan is disbursed. Let's look at it. So let's decode the project loan disbursement and equity infusion process. So it all kicks off with when the bank decide to disburse the project loan, right? Setting the wheels in motion for the funding the project. It's called initiation. Then we have step number 2, that is promoter equity infusion. What it means? So basically promoter now steps in and select an equity infusion strategy. So there are some methods. Either they can opt for full upfront contribution, or they can opt for partial initial contribution, or they can opt for proportional infusion alongside the loan, right? So what is the meaning of this full upfront, partial? Let's understand. So if it is full upfront contribution, it means promoter contribute the entire equity amount at the very start of the project. This shows a strong promoter commitment and boosts lender confidence, right? So basically promoter, in this case full upfront contribution, promoter contribute the entire equity amount at the start. And then if it is a partial initial contribution, so promoter contribute 40 to 50% of the equity initially upfront, with the balance infused as the project progress. So as the project progress, balance amount is infused. And if it is a promotional infusion, it means that this is a balanced approach where the promoter inject equity in phases. So this is called phase-wise injection of equity, right? So basically what happened in promoter proportional infusion, that it match with the bank financial throughout the process timeline. And there is something called debt equity ratio policy. Try to understand what is the meaning of this debt equity ratio policy. So friends, that bank apply a strict DER policy. This is called debt equity ratio policy, right? This policy is strictly applied especially in the project loan, ensuring the right balance between borrowed fund and the promoter equity, right? And it ensures compliance. So finally bank actively monitor and make sure that promoters contribution align within the agreed DER at every stage of the project. So this process ensures transparency, discipline and sound financial health for both the bank and the promoter, right? So that is the point which I make to understand using this particular diagram. Now let's shift our focus to the next diagram, that which banking arrangement should be chosen for financing. So confused about which banking arrangement to choose for financing? Let's simplify it for you with these 3 common approach. The first approach is called sole banking. So basically, if your funding need fall within the limit of a single bank, every bank has a limit on how much they can lend to a single corporate borrower. So if it fall between the single bank limit, then it is straightforward. Sole banking is the way to go. It is straightforward and ideal for a smaller project that don't require multiple lender. Second option you have is consortium banking. Basically, when the financial requirement is larger, you will need multiple bank to pitch in. Here one bank act like a lead bank. So basically this is the concept of lead bank, right? And they lead to coordinate the entire loan structure. This is called consortium banking, perfect for large scale project where teamwork among the bank is the key. And the last thing we have is multiple banking. So basically, if you want more freedom, multiple banking offer flexibility. No formal coordination between bank, but you can tap into several banks separately, managing each loan individually. So it all depends on your project size, risk appetite, and how much coordination you are ready to handle. The types of banking arrangement you have to choose, right? So sole banking, either you have consortium banking you have, or multiple banking you have. Now let's shift our focus to the next topic, which is loan syndication process. Very, very important topic. So ever wondered how loan syndication really work? Let me walk you through this step-by-step journey. So it all starts with the borrower select a trusted lead bank to arrange the loan. So there is a lead bank. Borrower trusts them to arrange the loan, right? So think of this as the bank as the captain of the ship. Now the lead bank reaches out to other bank to form a syndicate, right? This is the second step. Because big loan often need multiple player working together. Then what the bank do? Bank assess proposal, which means each bank in the syndicate review the loan proposal according to their own credit policy. Every bank has their own credit policy, it, right? And since bank has their own credit policy, so what happened? Each bank in the syndicate review the loan proposal. This is where they decide how much they are willing to contribute, and then lead bank coordinate the process. So basically, once commitment are in, the lead bank takes charge and manage the entire syndication process and negotiate terms with all the parties. And finally, meeting organized among banks. So the lead bank organize formal meeting with all participant bank to finalize agreement and iron on any detail. And finally, syndicate fee is charged. So for all this coordination, the lead bank charges syndication fee for its service. So it is all about collaboration, coordination, and confidence, right? So this is how it is done. So a step-by-step process I have told you: a lead bank, a syndicate bank, how it works, every aspect we have covered. Now there is something very, very important. So friends, with the rise of STP, what is the meaning of STP? STP is called straight through processing. Remember it. This is called straight through processing. So with the rise of STP, right, and CUE, that is called credit underwriting engine, the entire loan cycle from application to disbursement is now highly automated and cutting down manual work and boosting speed and efficiency. So how it works. So so basically, let me tell you what automation of the loan processing. In this slide you can understand it, right? How it get automated. First thing is that loan application is received, right? Which means this journey begins as soon as the loan application is received. Then automated processing initiated. No waiting around. The system automatically starts processing the application in real time. Then compliance check performed. So basically, automated tool jump in to conduct regulatory check, ensuring everything complies with the rule. Then decision making process. So basically, the system now evaluate the application, make decision based on the preset logic and credit rules, fast and objective. Then loan is sanctioned. Basically, once cleared, the loan gets sanctioned through automated approval workflow, and disbursement process begin. Funds are ready to flow. The system initiate the disbursement process efficiently, and minimum manual intervention. So the best part is that human involvement is very minimal. Only a few essential tasks are left for manual handling. So what is used to take days or weeks can now happen in hours thanks to automation. So you can see, using automation, the entire process of loan disbursement, loan sanctioning process, everything is getting automated, right? And this is thanks to STP, that is straight through processing, and CUE. This process has now is automated. Now, so friends, let's look at the credit risk mitigation process. So friends, that now that we have automated loan processing, so let's talk about something equally critical, which is mitigating credit risk. With loan expanding beyond personal finance into MSME, commercial sector, managing risk has become more sophisticated. Here is how banks are stepping up their game with technology. First thing they do is the data integration, which means that this comes with the power of first all borrower information is gathered and consolidated into one unified system, no more silos. Then we have AI analysis, which means this is the power of artificial intelligence. AI drive deep into borrower behavior, analyzing pattern that a human eye might miss. Then anomaly detection. So means automated tools detect any kind of irregularity in the data, like red flag, before they become real issue. Then we have risk assessment, with insight in hand, the system now evaluate potential risk linked to each loan, whether it is personal loan or a business facility. Every file is put under the risk radar. That is called risk assessment. And then step 5 is to inform decision making, which means finally bank based on all this data and analysis, bank can make a smart confident lending decision. So from data collection to risk informed approval, thus funnel ensure that lending is safer, faster and smarter. Right, so this is how. Now let me show you the next slide, and I will tell you how to calculate the drawing power. This is very, very important. Drawing power. Let's break down how bank calculate drawing power for a business under cash credit limit. So this is the topic from where numerical question is asked in every examination. So friends, imagine a business had been sanctioned a loan limit of 500 lakh. Suppose sanction limit is 500 lakh. Okay, but wait, the bank won't just hand over the full 500 lakh immediately. Bank first check two key things. The first thing that bank check is the stock the business has. What is the stock value of the business? In this case, it is worth 400 lakh. And also the bank checks the book debt. What is the meaning of book debt? You know the meaning of book debt. Book debt means the business unpaid customer invoice. So some invoices had not been paid by the customer. So this is called book debt. Business unpaid customer invoice. So which is left pending of the customer payment amount. So which is how much? 300 lakh, right? But there is a twist. Bank apply a margin, that is like a safety buffer, right? So on stock, the bank apply margin of 25%, and on the book debt, bank apply margin of 30%. So more margin on book debt because risk is higher there, right? So basically, first of all, step number 1. So such type of thing will be given into the question. You will be given sanction limit, you will be given stock value, you will be given book debt, right? And obviously margin on stock and margin on book debt, right? And the business has a stock worth 400 lakh, but it also owes rupees 100 lakh to creditor. Yes, it owes something 100 lakh to the creditor, means it has borrowed money from creditor and is not paid yet. It is still remaining to be paid, right, for this stock. So the paid stock, so how much he had paid? Tell me, out of the 400 lakh, how much he had paid? The 300 lakh he have paid, right? So it is clear. Let's try to understand. Let's see the next step. So total stock is how much? Total stock is 400 lakh. Creditor is how much? Creditor is how much? 100 lakh, right? So creditor means the amount which is still to be paid. So what is the paid stock? How much is the paid stock? It is nothing but the 300 lakh. Now you have to apply the 25% margin. I think why I have taken 25% margin, because margin on stock is 25%, right? So margin on the stock value. So I have subtracted 400 lakh minus 100 lakh, that is the paid value. On paid value only I am taking this 25%, right? Bank will not care about this creditor part, right? Bank will pay, margin will be taken only on the paid stock, that is 300 lakh. So what is the 25% of 300 lakh? So 1/4 of 300, which will give you 75 lakh. So this 75 lakh is the margin, which is the borrower contribution, right? And then remove it. So after removing this 75 lakh, bank will pay 225 lakh. This is the drawing power, right, from the stock. And now let's look at the book debt. I told you there is a two type of thing. One is the stock and other is the book debt, which means book debt means that this is still मतलब कि ये उधार लिया गया था, इसको वापस लेना है कंपनी को, right? Company has given some amount, some goods or some services to the customer on credit, and later they will accumulate, later they will collect payment from them, and it is still it has not been collected. How much amount has not been collected? So amount 300 lakh has not been collected, means 3 crore has not been collected, right? So basically the unpaid invoice, also you call it unpaid invoice, are 300 crore. And what is the margin on that? Margin on is 30%. So just calculate 30% of 300 lakh, which is how much? 90 lakh. So this is the borrower contribution. This bank will not give, borrower has to contribute it. So bank will subtract it, and the drawing power will be 210 lakh, which is 2.1 crore. So final drawing power is 225 lakh here and 210 lakh here, so which is nothing but 435 lakh. So although the bank sanctioned, how much the bank has sanctioned? See, the bank has sanctioned, bank has sanctioned 500 lakh. This is the sanction limit. Although the bank has sanctioned 500 lakh based on the business stock and receivable, the company can actually draw 4.35 crore at this point, right? It is how banks stay cautious and protect themselves while still helping business run smoothly. This is the how. This is done on every monthly basis. Whenever you submit the stock statement, banks see the stock, banks see their stock, banks see their book debt, and do this calculation and decide their drawing power, and they ensure that the maximum credit which is allowed to them stay within the drawing power. right? Now let us look at one more question. This will clear up your concept more. So let's look at this particular calculation. So friends, we are asked to find the drawing power. Some information given you: sanction limit is 20 lakh, security value is 30 lakh, margin is 25%, right? Margin is 25%. So basically when I say stock, what is stock basically? So stock is a kind of fixed asset, right? Stock is a kind of fixed asset. So based on which the bank give, this particular loan. This is called the security value. So its value is 30 lakh, margin is 25%. So the formula is quite simple. DP is how much? So DP is the security value minus margin, right? Like in the previous case, that is what we have done. So we have taken stock, we have taken book debt, and we have applied margin on them, and that is how we have calculated the drawing power, right? So this is all decided on basis of the security value. So security value here is how much? 30 lakh. And how much margin is there? 25%. So just what is 25% of 30 lakh? So this is 1/4 of 30 lakh. So 1/4 of 30 lakh, 7.50 lakh, 7.5 lakh. 7.5 lakh is your margin. Just subtract this from 30 lakh, you will get 22.5 lakh, right? Yes, but here is a twist. So DP we are getting how much? 22.5 lakh, and sanction limit is just 20 lakh. How can your DP greater than sanction limit? Your DP cannot exceed the sanction limit, which is 20 lakh. So even though we calculated 22.5 lakh, the bank will restrict DP to the sanction limit. So the final drawing power will be how much? 20 lakh. This is how bank protect their risk, by capping DP within their sanction limit, right? So I hope that makes sense to you. And this was same thing which I want to explain to you here. Just let me come back to this particular point where I told you, right, that we will discuss it later. Here you can see calculating drawing power from current asset and liability, right, and on monthly statement of the stock, book debt, and sundry creditor. And I just now I have seen how to apply this creditor. First of all, we subtracted the credited amount from the stock statement, right, because that is the paid amount, and on paid amount we apply the margin. Similarly on book debt we apply the margin, right, and then we calculated this particular DP, right, and margin are applied to this to determine DP, right? And I told you drawing power regulate cash credit utilization within the sanction limit. So drawing power should always be less than or equal to the sanction limit, right? You cannot utilize more cash credit than drawing power. Even though in this question what I see that the sanction limit was how much? Sanction limit was, it was 500 lakh, which was 5 crore, but still company can actually draw maximum 4.35 crore at this point. So when it comes to banking, monitoring credit risk is not just a routine task, it is a critical safeguard. So but the question is, how should bank monitor credit risk effectively? So let's break it down into 4 powerful strategy. The first strategy is to account conduct assessment. The first thing to do is to conduct account conduct assessment. By carefully analyzing how an account behave, like suppose you spot the frequent overdraft, or you spot the low turnover, right? By spotting the low turnover, by spotting the check return, bounce check, or delayed payment, right? So these are bank can detect early sign of financial stress. It's like reading the warning signal, right? So it's like reading the warning signal of that before the things goes out of control. So these are the warning signal: frequent overdrawing, check return, low turnover, delayed payment. So it indicates financial stress. So this is called conduct assessment. Second step is to conduct the legal recourse. What does it mean? So basically it is a process of monitoring credit risk effectively. So if a borrower submit incorrect certification, bank must act swiftly, either by withdrawing credit facility or by taking legal action. Sometimes what happen, borrower submit incorrect certification, right? So suppose he have to submit stock statement and he submit incorrect certification. So bank there can take legal action or withdraw facility, right? Being proactive here, protect the bank interest and send a clear message about accountability. And third point is that increase inspection, right? This is very important, that sometimes just surface level check are not enough. Banks should step up and conduct more in-depth inspection. This helps them uncover hidden risk and gain a deeper understanding of the borrower actual financial behavior. And lastly, shift to a stock pledging, which means switching to a stock pledging. So there is a term which we call stock pledging, right? So switching to a stock pledging, it allows bank to secure asset more effectively. It is a smart move to reduce unsecured exposure and safeguard the lending process. So to manage credit risk smartly, bank need a combination of data analysis, a strong enforcement, deeper inspection, and asset-backed lending. That is how you stay ahead and protect the financial ecosystem, right? So these are the 4 steps which you must keep in your mind, right? Question may be asked. Now let's move to the next question: financial discipline process. So friends, let's talk about something that is backbone of the healthy financial relationship, which we call financial discipline. So but what does the process looks like in action? So here is a step by step journey every borrower should follow to stay on the right financial track. First of all, to identify the need for periodic submission. Basically, the first move is recognizing the importance of regularly submitting financial update, like stock statement, like receivable data. Every data should be submitted periodically. Staying consistent with reporting build transparency and trust. Second thing is to submit a stock, receivable and statement. Now it's time to provide detailed report on your stock level and receivable. This help bank get a clear picture of your actual financial standing. You know what is the meaning of receivable? Receivable are basically the credit funding. Sometimes what happened, that particular business or company has given some goods and service on credit, and some amount is still it has not collected from them. So this is called receivable. So they have to submit the data, how much receivable they have, how much stock they have, inventory item. Every data has to be submitted periodically. The third step is to calculate the drawing power. How to calculate drawing power? I have already explained in the previous video, right? I have given you a numerical question where I have explained calculating drawing power. So then based on the data which is provided by the business, bank assess how much financial capacity you truly have, because it changes, it varies based on your stock statement, based on your book debt, right? So basically this is a critical in determining the limits of your borrowing power, right? And then after you scrutinize stock and receivable, which means bank then dive deeper, analyzing inventory, analyzing receivable for any discrepancy. Is there any discrepancy? Bank analyze that. So this step help spot risk before they escalate. Before the risk could escalate, this helps to spot the risk. And finally, to detect non-moving stock and old receivable. This is very important. So bank what do that attention shift to identifying items that are stagnant or outdated. Old stock and receivable can tie up cash flow and signal financial inefficiency. And step number 6 is to maintain the financial discipline. So goal is simple: stay disciplined by following financial best practice and being vigilant. Both borrower and bank can ensure a smoother, right? So both borrower and the bank can ensure a smoother operation and a strong partnership. So remember, financial discipline is not just a process, it is a habit, and in this habit that builds resilience and long-term success. So these are the steps. I hope that makes sense to you. I hope every step is clear, right? So remember this thing, what are the steps which are involved, how to bring financial discipline. Now let's look at the component of the stock. So friends, ever wondered what keep a lender confident about your credit worthiness? So it's all about credit control and monitoring, right? So lender is confident about your credit worthiness because it's all about credit control and monitoring. So it is a process that ensures that funds are safe and business stay financially sound. So the first thing they do is called a stock audit. You know what is the meaning of a stock audit? So for medium and large account, a stock audit is very crucial. It helps verify if the stock details shared by borrower are accurate. So it helps you identify whether the stock details shared by borrower, right? So a stock audit means what? Whether the stock detail, right? Whether the stock detail which is shared by borrower share the stock detail, right? So whether the stock detail is accurate. So basically it prevent inflated or misleading report. This is called a stock audit. So this is for medium and large account. Remember, this is conducted for medium and large account. Remember it, right? So it tells you whether the stock detail is accurate. If the stock details shared by borrower are accurate, so this is helpful. Then second thing is called receivable audit. What is the meaning of receivable audit? So basically receivable can make or break financial health. That is why bank ensure borrower statement are reliable by conducting receivable audit. It helps assess how much money is genuinely expected to come in. Then we have financial statement. So no credit control is complete without diving into financial statement. This gives banks a snapshot of your business financial health, income, expenses, profit, loss, everything on the table. Then we have the auditor's report. What it means? That an independent lens is a must. Auditor report gives a neutral third-party assessment of your financial status, adding credibility to the number that you present. And finally, we have working capital analysis. Means to keep the wheel turning, bank assess your working capital. This step is integral when it comes to renewing capital limit and ensuring your business can meet day-to-day expense. So together, these components form a robust system of check and balance, protecting both the lender and borrower and paving the way for sustainable credit management. Friends, if you are looking for any study material related to CAIIB, you can WhatsApp me on this particular number, right? Please save this number and you can WhatsApp me for a study material. We have app called JIB and CIB Made Simple. App link is provided in the description section, and also we have a Telegram channel for CIB in which I daily conduct free quizzes on daily basis, where you can check your progress on daily basis. So please join this Telegram channel. Link is provided in the description section of this particular video. You can also search CIB Made Simple on the Telegram. You will get the particular link of the group. Now let's look at how this process is done. So friends, now that we know the component of credit control, let's explore how credit control and monitoring process actually work step by step. So picture this process as climbing a staircase. Each step takes you closer to effective risk management and financial discipline. First thing is the periodic visit. Right. What is the meaning of periodic visit? That lender frequently assess operation on the ground, verifying asset, checking business activity level, and ensuring that what is on paper matches reality. Second thing is interaction with creditor and debtor. No business exists in a bubble. Bank interact with key financial stakeholder like creditor, like debtor, to get a broader picture of your business financial health and cash flow pattern. Then the scrutiny of the borrower account. Scrutiny of the borrower account means that they dive deeper into borrower account. Bank analyze your account activity, not just internally, but across multiple banks for a more holistic understanding of your financial habit. Right, that is called scrutiny of the borrower account. Right, then you have the market intelligence. What is the meaning of market intelligence? So bank also gather valuable insight from the market, like industry body, like association, agency, to help bank stay ahead of the trend. Then we have nominee director appointment. This is very, very important. So basically, in special or high risk cases, bank may go a step further by appointing a nominee director. This ensures direct oversight and tighter control over the borrower operation. Then we have credit audit. So bank check, no process is complete without a thorough credit audit. So in credit audit, bank checks for compliance with RBI guideline and review internal procedure, making sure everything run by the book. So whatever RBI has given the guideline, so it makes sure that its current policy align with that. And finally, we have customization of audit framework. So finally, one size does not fit all, right? So bank tailor the audit framework based on the unique risk profile of each borrower. So what bank does? Bank tailor the audit framework. So you know, this audit framework is tailored by bank based on unique risk profile of each borrower. Each borrower, you know, they have a unique risk profile, right? Each borrower risk profile is unique, and bank tailor the audit framework based on that. So there you have it. Step by step, bank ensure that credit stays safe, transparent, and well monitored. Right? Remember, these are the steps which you must keep in your mind. Now let's move forward and let's see the next part, which is regarding credit audit cycle. So friends, you know, let's now zoom into the credit audit cycle, the engine that keep credit risk management running smoothly. Think of it like a continuous loop of improvement and vigilance designed to protect financial institutions and sharpen their credit control system. So let's break it down step by step. The first step is, you know, is to review the sanction process. It's called reviewing the sanction process. It means, you know, it all begins with reviewing how credit is sanctioned. Is the loan approval process solid? Are policy being followed correctly? So this review set the foundation for the entire cycle. That is called review the sanction process. Right? So is the loan approval process solid or not? Then we have to assess the credit risk, which means, you know, that bank evaluate how risky the borrower is, looking at the financial, market condition, business performance to estimate the probability of default. So basically, they estimate something called PD. What is PD? Probability of default. Then to detect the EWS. You know what is the meaning of EWS? Early warning signal. So, but we don't stop there. Early warning signal like delayed payment, operational red flag are closely monitored to catch risk before they snowball into bigger issue. And then we have to recommend the corrective measure, which means if any gaps or risk are found, if any red flag is found, corrective measures are recommended. This could mean tightening the credit terms, restructuring the loans, or improving the borrowing monitoring. And then we have strengthened the administration. A stronger process means fewer mistakes. So bank focus on strengthening internal administration to enhance overall governance and risk control. And finally, to improve staff competency. So this is a key ingredient, which is people. Continuous staff training ensures that team is well equipped to spot risk, take decisive action, and maintain robust credit practice. And just like that, the credit audit cycle complete, only to begin again. Right? So this is how it works. So now let's look at the next slide, and everything in the slide is presented in the form of pictorial format so that you can easily retain it. Right? Let's look at the audit function overview. Now let's explore the core engine behind the robust governance, that is called the audit function. In every successful organization, the audit function a very pivotal role in ensuring transparency, compliance, and continuous improvement. Let's break it down. First of all, what they do, they process the audit report, which means, you know, it all starts here. The audit team diligently handle and organize vast amount of audit data. So they handle and organize vast amount of you know, audit data, right? So basically this information flows seamlessly into the inspection and audit department, ready for the action. Then we have following up with authority, which means, you know, the team work closely with the authority to close any gap and uphold the standard. Then we have addressing the audit responses. So it's not just about finding issues, it's about fixing them. Responding to audit feedback swiftly and effectively help build a culture of accountability. And then we have something called advising department. So basically they guide department, ensuring everyone aligning with the best practice and audit finding. And then we have updating management, which means management stay in the loop at every step. Regular update ensure that leadership is equipped to make informed decision based on audit insight. And finally we have to maintain the database. And of course every audit need a strong record. Maintaining a detailed and organized audit database safeguard institution memory and support future audit. So in short, audit function is not just about checking box, it's about driving excellence, compliance and trust across the organization. So this is called audit function overview, right? So these are the basic functions done in audit. Now let's look at the credit review frequency and compliance timeline. So friends, let's simplify something crucial, that is called credit review frequency. To safeguard financial health and ensure regulatory compliance, organization must conduct timely credit review based on the risk profile of account. So first thing is every 3 months. So every 3 months, which kind of account is done? So for high risk account, high risk account reviews are done quarterly, because these account demand extra attention to prevent potential default or compliance breaches. So constant vigilance help mitigate major risk before they escalate. And for every 6 months is for average risk account review. So these account may not ring alarm bell like high risk one, but they still require regular monitoring to maintain balance and stability. And finally for low risk account, annually it is done. So these account they get reviewed once a year. So these account carry minimal risk but still require a yearly checkup to stay aligned with compliance standard. So in short, frequency is tailored to risk. The higher the risk, the more frequent the review. This layered approach ensure proactive risk management and protect the financial system from surprises. Right, so that's it. Now let's look at the next point. The next point is legal audit process for large loan. Very, very important. So friends, that let's dive into the legal audit process for large loan, a critical safeguard in the banking system. So first of all, what you have to do, you have to identify the large value loan. You have to identify the large value of loan. So it all starts with spotting the big ticket item. Big ticket item is loan of 5 crore and above. Right. So these large exposure carry more risk and demand heightened security. Then we have to maintain the legal audit. So next the RBI steps in with a mandate. The legal audit of the title document become essential. So this is very, very important. Legal audit of the title document. This is called legal audit. Then why it is done? Because to ensure that security backing this loan is legally sound and enforceable. So every loan there is a security backing, and the security backing is legal and enforceable. So remember, for every loan of 5 crore and above, we have to identify such kind of loan. We have to mandate the legal audit, right, to ensure that security backing these loans are legally sound and enforceable. Right. And then we have periodic title deed verification, which means that the journey does not end there. Banks are required to periodically verify title deed all the way up to the final repayment. This is like keeping your seat belt fastened for the entire ride. And then you have to ensure the document authenticity. To avoid any surprise, concurrent auditor are tasked with cross-checking document authenticity. No room for forgery or tampering paper here. And then we have to submit quarterly review note. So banks submit quarterly report to the board or audit committee, presenting their finding and red flag if any. So this regular feedback loop ensure that transparency and keep everyone accountable. So in short, we can say that the topic which we are talking about, legal audit process, is a step-by-step process that fortifies system, making sure every large loan is backed by solid verifiable documentation. So for 5 crore and above loan, mandate legal audit, periodic title verification, ensure document authenticity, and submit quarterly review note. So bank report audit finding into the board and audit committee every quarterly. This is done. Now then we have comprehensive credit audit. So friends, let's now unlock the world of comprehensive credit audit, the key to maintaining a solid credit environment. At the heart of the audit lies the credit audit scope. So at the heart you can see it is nothing but the credit audit scope. So which revolve around 3 essential pillars. The first pillar is the portfolio review. So this portfolio review, the portfolio is thoroughly reviewed to evaluate not just its quality but also how well it aligns with the institutional credit policy. So basically quality is reviewed, right? Quality review is done. Not only quality review is done, but also how will this quality align with institutional credit policy, right? How will the quality align with the institutional credit policy? Is the portfolio balanced? Are the risks well diversified? So this step gives the answer. That is called portfolio review. Then we have sectoral exposure. So basically here we zoom into sectoral exposure to ensure they fully comply with the loan policy and RBI norm. So sectoral exposure, we zoom in into sectoral exposure to ensure that they fully comply with the loan policy they fully comply with the loan policy plus RBI norms. That is called sectoral exposure, right? So no sector should be overexposed, and this check ensure that we stay within the safe boundary. First of all, portfolio review is done. The portfolio is thoroughly reviewed to evaluate not just its quality but also how will it align with the institutional credit policy. And the third key is the compliance with the norms, which means every move is cross-checked with the RBI prudential norm and regulatory standards. It's all about playing by the rule and safeguarding the bank from compliance, right? So you can think of it like holding a bunch of keys, each unlocking a critical aspect of credit health. Together, they help bank ensure sound legal lending practice and regulatory compliance. Portfolio review, sectoral exposure, and compliance with the norms. So what is the meaning of sectoral exposure? Just now I told you that no sector should be overexposed. That is what we ensure by sectoral exposure. And the final thing is loan review process. How it is done? Let's see. So let's now take a journey through the loan review process. Each step on the road is crucial for maintaining a healthy credit portfolio. First of all, you have to identify which are the account which you have to review. Identify the account for review. Right. First of all, identify the account for review. It all begins with a carefully selecting account based on set criteria. Not every account makes it there. Only those flagged as important or high risk. Then you have to review the fresh proposal and renewal. We dive into fresh proposal and recently renewed note loans, which usually within 3 to 6 months of sanction. So suppose some loans have been renewed within 3 to 6 months of sanction. So that is what we do. So this ensures that no fresh sanctions slip through the crack without proper scrutiny. Then we have to review the existing account above, which means focus shift to big ticket loan, right? That is called high limit loan, big ticket loan. High limit loan need extra attention to ensure they continue performing well and remain within the acceptable risk parameter. That is called high limit loan. And then there is something called random sample review, which means but we don't just stop at the big account. A random 5 to 10% of the other account are reviewed as well. This keeps the review process fair and comprehensive across the board. And finally, we have to address the related group concern. So we zoom out and check for any group level concern. Are there interconnected account within the same corporate group that could trigger bigger risk? So this step makes sure that we catch them. So there you have it, our roadmap to solid loan review. It's systematic, thorough, and designed to keep the portfolio safe and sound. Right. So basically, what is the process? First of all, you carefully select account based on set criteria. You review. We dive into the phase proposal and recently reviewed loan, usually within 3 to 6 months of sanction. And then you have to review the existing account above the limit, which is called big ticket loan. Some random sample review is also done. 5 to 10% of other account is reviewed as well, and you have to address related group concern chapter. And obviously it is very short chapter, so we will go through the key points of this particular chapter. So let's get started with our first topic. First of all, let's talk about a key concept in banking and finance, right? So the first thing is the credit risk and your credit risk. So you can imagine this credit risk like a keychain holding several keys that unlock the reason behind potential financial trouble. So what is the meaning of credit risk? The meaning of credit risk? It simply means that possibility that a borrower may fail to meet their financial obligation. But what really drive this risk? First, we have something called external factor. So basically, forces from outside the bank control. External factor are those forces which are outside from the bank control, and these include some factors like economic shift, exchange rate, interest movement in the exchange rate, movement in the interest rate, political instability, right? So these are some of the reason behind this external factor. For example, if a government suddenly changes its policy or a major currency devalue, so borrower might struggle to repay loan, raising the credit risk, right? And the second factor is called internal risk. So these are within the bank control. So external risk means outside the bank control, which bank cannot control, right? Outside bank control. And if we talk about the internal factor which is within the bank control, right? Like example, poor credit appraisal, right? Suppose the bank has done poor loan structuring, inadequate credit appraisal, right? Excessive exposure to a specific industry, or a weak loan monitoring system, all highlighting the risk. So even lending too heavily to one sector or region without diversification can be dangerous. So mastering credit risk means understanding both the external storm and the internal crack. Only then a bank can safeguard itself and its client, right? So these are the two kinds of credit risk: external risk and internal risk. External factor, internal factor. Now let's let's see the classification of how this external environment and internal environment goes about. So friends, when we break down credit risk, it is split into two broad categories, like two distinct branches of the same tree. First form the external environment and the second form the internal environment. So external environment here is what we call portfolio risk. This is about the bigger picture, And two major type stands out here: concentration risk, which means when too much credit is concentrated in one particular sector or borrower, making the portfolio vulnerable; or industry risk. Suppose invent, which depends on how industry perform. If industry face a downturn, all loan linked to it might be at risk. On the other hand, there is something called internal environment, the bank on operation, right? And here we face the transaction risk. So this is more deal specific and includes several risks like default risk, which means when a borrower fail to repay; or spread risk, which means which relate to the change in the pricing of the loan; or downgrade risk, which means when the borrower credit rating fall. What is the meaning of downgrade? So suppose the borrower credit rating it falls, this is called downgrade risk. Obviously it increases the risk. And finally we have recovery risk. What is the meaning of recovery risk? So basically it is about how much can actually be recovered if things goes wrong. So while portfolio risk shape the broader credit landscape, transaction risk emerge right at the deal table. Both demand sharp attention to keep credit risk under control. So either it is portfolio risk or transaction risk, both demand sharp control, right? Close monitoring. Now let's switch our focus to our next topic, which is credit rating agencies and RBI regulation. So the peculiarity of this crash course is that in this crash course you get everything in pictorial format. So at the time of revising this particular chapter, you only go through this picture and everything is clear. No need to go through that book, because this is a kind of mind map. It remain in your mind for a longer time, and this is what we provide in this crash course. For more detail regarding the crash course, you can WhatsApp me on this particular number, right? So now let's discuss this RBI regulation on credit rating. So friends, let's dive into the world of credit rating agency and how the RBI keeps them in check. Credit rating is very vital in assessing the financial health of a borrower. But who gives this rating? So there is something called domestic agency. Last time question was asked, which of the following is not a domestic agency? So these domestic agency operate within India. So this includes CAIIB, CRISIL, Indian Rating, ICRA, Brickwork and Acute. They focus on evaluating Indian company and their creditworthiness. And then we have some global player, right? Like Fitch, Moody's, S&P, right? So these giant assess companies and sovereign worldwide. So all these agencies work under the umbrella of the RBI regulation on credit rating, right? So the RBI ensure that these agencies follow guidelines to maintain transparency and reliability, especially domestic agency we are talking about. And what about the banks? So they rely on these rating to estimate the probability of default, PED, right? The chance that a borrower might fail to repay. Additionally, under RBI, AIRB. What is AIRB? AIRB full form is Advanced Internal Rating Based Approach. I think you know about it. Operational risk measurement, there is an approach called Advanced Internal Rating Based Approach. So under RBI, AIRB, bank refine their risk model to make lending decision smarter and safer. So I hope that makes sense to you. What is credit rating agency and what is the RBI regulation? Now let's shift our focus to our next topic, which is none but overview of the CRILC. CRILC is a very important topic, and let me explain each and every part of it. So let's break down the CRILC reporting system, which is a very critical tool for managing large borrower risk. First of all, large borrower risk is involved. So first thing, what is CRILC? The full form is, let me write down the full form. It stands for Central Repository of Information on Large Credit. So it stands for Central Repository of Information on Large Credit. So, and its reporting system is mandated by RBI, right? So basically what happened, first thing is the reporting requirement. See, bank must report data for all borrower who have exposure, whether fund based or non-fund based, of 5 crore and above. So whoever has exposure of 5 crore and above, whether it is fund based or whether it is non-fund based, does not matter. Bank must report data for all borrower, right? So this include account classified under, because this include account classified under SMA. What is SMA? SMA means special mention account. But note, crop loan are excluded. Crop loan is not included, right? Although other agriculture loan still need to be reported, right? So what I am saying you, that bank must report data for all borrower who have exposure, whether fund based or non-fund based, of 5 crore and above. This include account classified as SMA. SMA is also included, a special mention account. But note, crop loan are not included, right? Although other agriculture loan still needs to be reported. So agriculture loan is also various type. So especially crop loan is excluding, and other reports, other loans should be including. Exemptions are there. What exemptions are there? So not everything goes into CRILC. Exposure to institute like NABARD, SIDBI, Exim Bank, NHB, these are exempted. Now there is something called PAN master record. Please try to understand what is the meaning of this PAN master record. So let me explain what it is saying, that here it is written that it says that even if there is no exposure, bank must still report outstanding current account balance of 1 crore and above based on the PAN master record. So you can say bank must report outstanding current account balance of 1 crore and above even if no exposure exists, right? So based on the PAN master record as per the RBI guideline rolled out in February and May 2024. So in short, you can think of the CRILC as an umbrella protecting the financial system by identifying early sign of stress among large borrower. So basically it deals with a large borrower because the full form itself says, right, what, okay, so what is the full form of CRILC? I already told you that basically it stands for Central Repository of Information on Large Credit. So LC means large credit, so that is why it deals with the large credit only. Now let's go through the history of this establishment and regulation of CICs in India. So friends, let's walk through the journey of how CIC, how credit information got organized and regulated in India. It all started back in 1999, right? So when RBI formed a working group, so there is a WG which is called working group which is formed by RBI. Why? So why this working group was formed? So this working group was formed to study the credit information system in India. So basically the main purpose was to study the credit information system in India, how it works. So this group does not stop at the research. They went ahead and recommended the creation of a formal credit bureau. They recommended the formation of a formal credit bureau to strengthen the financial transparency, right? Then comes civil, right? Then civil was established. You know what is the meaning of civil, right? So basically civil was the India's first credit bureau, which was set up by SBI and SDFC in 2001. But that was not the end. Soon after, India saw the creation of 3 more CIC. The first civil was established, remember, civil and as SBI and SDFC, and 3 additional CIC were established, right, to widen the credit information network. Fast forward to 2005, right, the RBI introduced a landmark regulation mandating that all financial institutions must be the member of at least one CIC under the Credit Information Companies Act. So basically there was an act which says that every financial institution should be a member of at least one CIC. Now RBI did not stop there. They also issued a directive asking bank and financial institutions to join all CIC to ensure seamless data sharing. To join all CIC further. Earlier they say only one CIC, later they say all CIC. Now lastly, speaking of membership, RBI put a cap on fee which is rupees 10,000 for joining and 5,000 annually for reporting, making it affordable and consistent. Lastly, bank and financial institutions were instructed to actively report defaulter with exposure of 25 lakh and above, right? So these are the points as per RBI directive. Now let's understand the credit default swap. So friends, let's decode the concept of CDS, which is called credit default swap. It's like an insurance policy for lender. First we have the protection buyer. The first we have is the PB. In short, we call it the protection buyer. Basically, this is typically a lender or an investor worried about a borrower defaulting on a loan. He is worried that a borrower will default on the loan, right? So this is an investor or a lender. So they seek protection against this risk. On the other hand, we have the protection seller. So basically, usually an insurance company or a financial institution that agree to provide coverage if the default happen. So this will provide the coverage. To whom? To the buyer if the default happen. So this brings us to the premium payment, right? A regular fee paid by the buyer to the seller, like just you pay premium on insurance policy. Now, question is who or what is this protection about? So what is this protection about? So that is where the reference entity comes in. It could be a company, it could be government whose bond or loan are at risk of default, right? It could be a company whose bond is at risk of default. It could be government whose bond is at the risk of default. So basically, if the reference entity default, the protection seller compensate the buyer, which means underlying asset which is under default condition, right? Who protect the buyer? Protection seller protect the buyer. And tying it all together are the ISDA terms, basically, which are a standardized rule and agreement that govern how this swap work, ensuring clarity and consistency globally. So you can think of this CDS as the key financial tool that unlock risk management option in the lending world. I hope that makes sense to you. Please hit that like button if you think that this information is really useful and it is presented in such a lucid way that you can easily revise at the time of examination. Now the next point we have is called CLN, credit link note. So let's take a walk through the fascinating world of the credit link note cycle, a powerful risk management tool in finance. First of all, it all begins with risk seller paying the premium. You see, risk seller paying the premium. So the entity exposed to the credit risk, right? Let's them call risk seller. He pay the premium to a special purpose vehicle or SPV, right? To transfer that risk. Then step number 2, SPV issues CLN. SPV, special purpose vehicle. So basically, credit linked notes are issued by SPV, and these notes are directly linked to the credit risk that the seller want to manage. So these notes are linked to the credit risk that the seller want to manage. And then what happened? Then step number 3 comes. Then comes the investor who purchased CLN, hoping for attractive return in exchange for taking on the credit risk. So these investors take the credit risk. In exchange for that credit risk, they hope the return. And then what happened? Step number 4, what SPV do with this money? SPV, so whatever investor have invested money, what SPV do with this money? So SPV invest proceed wisely, used usually in safe high quality security to balance the risk, right? So invest the proceed in a high quality security to balance the risk. But wait, if there is in trouble brewing, we check the default occur. So if yes, the next step is trigger. What is the next step? That in case of default, the SPV steps in to liquidate the security which is bought, right, from the payment is received from investor. SPV liquidate it, right, and then the fund from this liquidation are used to compensate the risk seller. But if all goes well and there is no default, SPV will simply return proceed to the investor, right? If all goes, because this investor take the risk, right? They take the credit risk, and if everything goes well, right, return proceed to the investor along with their return. So that is how it happened. And just like that, the CLN cycle is complete, a smart way to transfer and manage credit risk in the financial market. So depending on default happen or not, the next step is taken. So this is all you need to know about this credit risk policy, CLN, credit link note. Let's now dive into the credit risk management guideline, the backbone of sound lending practice in bank. So first of all, let's talk about infrastructure project analysis. Banks are advised to conduct thorough due diligence through, first thing, the method is called sensitivity analysis. You know what it is? Means it is used to assess how change in key variable affect the project. So there, a project depends on many various factors, and if you change each and every factor, how it affect overall project, this is called sensitivity analysis. Second is called scenario analysis. It helps us prepare for multiple possible outcome, right? There are multiple possible outcome. So multiple outcome, it helps us to prepare for multiple outcomes. Then we have the risk of delays and the cost overrun. Basically these two things, basically evaluating these two things, let's be honest, in infrastructure surprises are common. So risk of delays are there and cost overrun is also there. Cost overrun means what? That sometimes we expect only 10 crore and the actual cost become 11 crore. This is called cost overrun. Next we have independent credit appraisal. So RBI suggests avoiding external consultant and promoting objective in-house assessment. Why? Because independent eye ensure a sharper focus on the actual credit worthiness. And the third is promoter equity verification. Bank must verify the source of equity. RBI here is crystal clear. Watch out for disguised debt. Watch out for disguised debt. RBI is crystal clear here that watch out for disguised debt where parent company loan are camouflaged on equity in subsidiary or SPV. So basically no parent company is disguised as equity in the subsidiary or SPV, right? So that is the point. So this is called disguised debt where parent company loans are camouflaged as equity in the subsidiary or SPV. Now you may ask me, how should bank actually manage credit risk and monitor fund in real time? So how should bank actually manage the credit risk and monitor fund in real time? So that is where this point comes. DIN is used for identification. This help ensure director are properly identified, avoiding any wrongful credit denial. Then we have, you have to cross check the name, which means a bank should match director name against defaulter list to reduce the chance of risk exposure, and also to engage auditor directly, which means bringing in independent auditor allow bank to closely track how funds are used. And finally including covenant. What is covenant? Basically adding a smart clause in the loan agreement ensure tighter control over fund utilization. So in short, the RBI guideline help banks stay vigilant, make informed lending decision and protect themselves from the hidden risk. So that is the point all about it. Now let's talk about the last slide, that is the credit risk management cycle. So friends, let's explore the credit risk management cycle, a continuous loop that safeguard a bank's financial health and promote responsible lending. First thing is called strengthening risk management. So at the heart of it all, the bank must constantly refine and enhance their credit risk management framework and policy. A stronger system means fewer surprise down the line. Then the second thing is improve the asset quality, right? Which means next focus shift to building a portfolio of high quality asset. HQLA, high quality asset, right? HQA. So remember, healthy asset means healthy balance sheet. The next thing timely recognize stress. So here is the third point. that the timely recognized stress asset. So basically what happened when asset starts showing sign of stress, so bank must quickly identify and address stress asset to prevent deterioration. And then regular CAIILC reporting. I told you about this CAIILC, right? So basically transparency is the key. Bank are required to consistently report to central repository of information on large credit, keeping regulators in loop, right? And finally review borrower classification. So banks should regularly assess the classification of borrower. Are they performing? Are they slipping into default territory? Are they in SMA1? Are they in SMA2? Whatever it is, or who have the money still manage to escape payment. So let's break down the sequence of willful default, right? This is called willful default action that lead to massive financial loss. So step number 1 is the capacity to pay. The borrower has the capacity to pay, right? So what it means, that the borrower has enough money to repay but choose a different path. This is called intentional default. This is called intentional default. Means instead of fulfilling obligation, the borrower deliberately stop making payment. Why? Because they have other plan, or they can, this is called the misuse of fund. You know, the money meant for repayment is redirected to unauthorized purposes, maybe luxury, maybe risky investment. That is called misuse of fund. And the next is siphoning of fund, which means, you know, that now things get serious. Fund are moved away from their intended use. So basically, you know, there is something called intended use of the fund, like, you know, this is called hidden, or we call it transferred. So fund has, so when I say siphoning of fund, what it means, that fund are moved from their intended use. So you know, every fund has their intended use, but where it is used, somewhere else, right? Like hidden, transferred, or funneled somewhere. And step number 5 is the disposal of secured asset, which means the borrower sells secured asset. What is the meaning of secured asset? You know the meaning of secured asset? Secured asset means which were collateral for the loan. So secured asset just means the collateral for the loan, right? So borrower sells secured asset without even informing the lender, right? So this is called disposal of the secured assets. So borrower, once who had availed the loan, they sell secured asset without informing the lender. So he has total breach of trust. So these are the effect of this willful defaulting. So it may be intentional default, it may be the misuse of fund, it may be the siphoning of the fund, or it may be the disposal of the secured asset. And just like that, the bank suffer huge loss while the borrower walk away scot free. So friends, if you want to know how bank tackle and track this willful defaulter, right? So let's stay tuned. Let's move to the next slide. And in the next slide, we are just going to discuss the same. So there is something called financial management, diversion and siphoning of fund. So ever wondered how companies secretly misuse fund? So let's uncover the two biggest trick in financial mismanagement. The first is called diversion of fund. What is the meaning of diversion? See, money meant for one purpose is redirected elsewhere. How? So for example, using short-term capital, you are using short-term fund for long-term need. This is one way. You are using short-term fund for long-term need, or you are transferring money to a group company, or you are sending fund to unauthorized bank, or you are making investment without approval, and finally, and worst of all, failing to account for the money. So these are the different way of diversion of funds. So question may be asked, which of the following represent the diversion of fund? So you must know that these are the diversion of fund example. Like again I am repeating that you are using short term fund for long term need, or you are transferring money to group company, or you are unauthorized, or you are, so suppose you are sending fund to unauthorized bank, or you are investing without approval, and worst of all is failing to account for the money. So these are called diversion of fund. And the second part is the siphoning of fund. What it means? So this is where things get shady. So when I say siphoning of fund, this is where things get shady. So fund go into unauthorized activity, right? Fund goes into unauthorized activity. The company financial health takes a hit, and you know, even lender assessment get manipulated. Lender assessment get manipulated. This is called siphoning of fund. So siphoning of fund, under siphoning of fund, things get shady. Fund goes into unauthorized activity, right? The company financial health takes a hit. Even lender assessment get manipulated, and just like that, investor and bank suffer massive loss while the culprit walk away free. So understand the difference between diversion and siphoning, right? So friends, question may be asked that which of the following represent the siphoning of fund? So suppose fund goes into unauthorized activity, the company financial health takes a hit, lender assessment get manipulated. So these are the cases of siphoning of fund. I hope that makes sense to you. So how this diversion and siphoning works, so this can be clearly understood from this particular slide, and this is how we represent the data in our entire crash course, right? So if you want data, if you want to revise the content very shortly, very effectively, if you want to remove the scrap and only remember the important point, you can enroll in our CIB crash course program. For more detail, you can WhatsApp me on this particular number to get detail regarding this particular crash course program, right? So this is a sample PDF, just I am showing you. You will get PDF for every unit like this. Only important thing that matters from examination point of view has been represented in the pictorial format, so that you can cover, you can remember them for a longer amount of time. So now let's shift our focus to our next slide, and the next slide you can see is a very good important question. Let's answer this question. Imagine a borrower. So the question is, when is a borrower considered non-cooperative, right? Imagine a borrower deliberately blocking the recovery process. So should they be labeled non-cooperative? Let's find out. So first thing is that withholding information. Try to understand withholding information. What it means, that that some borrower refuse to share crucial financial data, making it harder for bank to recover dues. So no transparency, no trust. First point, the second point is denying the asset access. What is the meaning of denying asset access? So when lender try to recover financial asset, these borrower restrict access, so obstructing the process. And obviously, is this a red flag activity? Absolutely, this is a red flag activity. Means when lender try to recover finance asset, these borrower restrict the access, obstructing the process, and obviously this is a red flag activity. And the second thing is obstructing the security sale, which means the borrower goes a step further and block the sale of security, delaying financial recovery. But banks are prepared. If the total exposure exceeds 25 crore, you must note it down. If the total exposure exceeds 25 crore, right, the borrower and even promoter or key manager can be classified as non-cooperative, right? So these are the conditions under which a borrower can be called non-cooperative: if he is withholding information, if he is denying asset access, and if he is obstructing the security sale, right? So under this case, he can be called non-cooperative. And once that happens, strict action will follow, right? So bank must protect their fund. But what more they can do to prevent such cases? Let's find out, right? So friends, now let's move over to the not every borrower. So the question is, how is the borrower status evaluated? Not every borrower is the same, and bank follow a structured process to decide if a borrower should be classified as non-cooperative or given another chance. Let's break it down. First of all, they issue something we call show cause notice. So a formal notice is sent to the borrower, giving them a chance to explain why they defaulted. Right? So this is the chance, they give it a chance to explain why they defaulted. So a formal notice is sent to the borrower, giving them a chance to explain that why they defaulted. Then comes personal hearing, right? So if needed, the borrower can present their case to the authority. A fair chance is given before taking on any strict action. The next thing is the committee review. So a higher committee led by the chairman or CEO and 2 independent directors review the case and decide if the borrower should be classified as non-cooperative. And then reporting to CRILC. I think you are familiar with this CRILC. We have talked about it in the previous lecture. So what is reporting to CRILC means? So once a borrower is declared non-cooperative, bank must report them to CRILC. What is CRILC? CRILC stands for Central Repository of Information on Large Credit. What is the full form of CRILC? Central Repository of Information on Large Credit. So this is called CRILC, right? Central Repository of Information on Large Credit. So once a borrower is declared non-cooperative, bank must report them to CRILC within 21 days. How many time period is there? 21 days time period is there. So their status is reviewed every 6 months for possible declassification. A status is reviewed every 6 months for possible declassification. And the final step is a risk assessment, which means bank assess the risk involved and make necessary provision to protect their financial stability. So assessment of risk is done and provisioning is done. Means necessary provision is made to protect their financial stability. So a well-defined process ensures that genuine borrower get a fair chance while the willful defaulter face a strict action. Right. So the question is answered now. So what was the question? That how the borrower status evaluation process is done. So cause notice issued, personal hearing, committee review, report to CRILC, and risk assessment. Now let's switch gear and let's talk about bank account rectification. So now the topic name is restructuring, rectification and recovery. Now let's look at rectification. How rectification is done? So when borrower struggle with repayment, bank don't take immediate strict action. Instead, they follow a well-structured rectification process to help both party. The first thing is that bank identify the stressed account, which means bank first identify account that need rectification to prevent further financial distress. Then they persuade the borrower, which means rather than enforcing penalty right away, bank try to encourage borrower to clear their dues and regain financial stability, or transfer to other bank, which means if necessary bank facilitate account transfer to other financial institution that may offer better terms, or consortium lending action. In some cases multiple banks step in, one bank may take over the share of the loan, spreading the risk. Or in the next step there is something called sole banking challenge. What is the meaning of this so-called sole banking challenge? Sole banking challenge means exiting sole banking arrangement can be difficult, right? So adding complexity to the rectification process, or obviously withdraw concession. If no resolution is found, bank may remove financial benefit previously granted to the borrower, or enforcing covenant, which means at this stage strict financial agreement are implemented to ensure compliance and recovery. And finally is the reducing the limit. So bank may reduce the limit, right? So this is another step that is called reduction of limit, right? Restricting further borrowing until the borrower situation improve. So these are the steps that the bank can take, right? Reducing further limits. So this multi-step approach ensures that borrower get opportunity to rectify their financial position while bank protect their asset, a win-win strategy. This is called the rectification stage. So let me summarize the fact. The first is transfer to other bank or identify stress account, persuade borrower, consortium lending action, sole banking challenges. These are the main points which you have to go through. Now let's look at the restructuring. What are the steps to restructuring? So ever wondered how a struggling business get back on track? So financial restructuring is the answer. Let's explore its 6-step process that help business regain stability. First of all, you have to identify the viability. What is the meaning of viability? Means is to assess whether the business has the potential to bounce back. If it is viable, restructuring can begin. So first of all, you must check that yes, if it has potential to bounce back, then only you begin this restructuring process. If it is not, don't begin. Then you have to demonstrate the commitment, which means the borrower must show seriousness toward repaying the loan and cooperating with the restructuring process. Then extend repayment. So to ease the financial burden, bank increase the repayment period. What bank do? Bank increase the repayment period. So this is one way of restructuring, that you increase the repayment. So suppose repayment period initially was 20 year, they may increase to 25 or 30 year, right? To ease the financial burden, bank increase the repayment period, or to reduce the installment amount. So two things can be done, either increase repayment or to reduce the installment. So what is the meaning of reduction in installment? So lowering the amount in each installment to make repayment more manageable. So this make repayment manageable. And lower interest rate. Obviously interest rate is lowered, which means restructuring offer include reducing interest rate, making borrowing more affordable, and or to convert the dues. Means finally bank converts short-term debt into long-term loan, ensuring a smoother repayment and business continuity. So following this step-by-step process, business get a second chance and bank protect their asset, a well-structured win-win strategy. Right, so this is how restructuring is done, right? Let me again show you the step. Viability, commitment, extend repayment, reduce installment, lower interest rate, or to convert the dues. That means convert debt into long-term loan. These are the steps that the bank can take for restructuring. Now look at the loan recovery. So now let's shift our focus to the recovery part. So friends, ever wondered what happened when borrower failed to repay their loan? So bank and NBFC, non-banking financial company. So bank and NBFC, they have a structured legal recovery process. They have a structured legal recovery process to ensure that their dues are collected. So first step, is to initiate the legal proceeding. What it means that if a borrower does not clear their dues despite multiple chance, bank initiate legal recovery. What I am telling you, that suppose borrower does not clear their dues despite multiple chances. Right, multiple chance were given to the borrower, but they did not clear their dues. So bank initiate legal recovery. This is the first point. Second point, is to civil court suit for amount below 20 lakh. Which means for a smaller amount, bank filed suit in civil court to get the money back. Right, up to below 20 lakh. So if the amount is below 20 lakh, bank filed suit in the civil court. Now the third step is the preliminary decree and the repayment period, which means once the court acknowledges the case, borrower may get 6 months to repay before further action. So this is called preliminary decree. 6 month timing is given to the borrower for repayment after preliminary decree, right? So if it is below 20 crore, then 20 lakh, then only. Then we have final degree for execution. Final decree for execution, which means if the repayment does not happen, a final decree is issued allowing recovery within 12-year execution limit, right? And DRT process, if the repayment does not happen, and for larger amount above 20 lakh, below 20 lakh to the court, they can go to the civil court. But for larger loan cases are taken to a DRT for a faster resolution, which is called debt recovery tribunal. Even NBFC with asset over 100 crore, right, can approach DRT to recover their dues. So this legal framework help bank and NBFC recover loans systematically, ensuring financial stability. So these are called recovery process, right? Now let's look at the Lok Adalat. Lok Adalat is another way. Let me show you the importance of Lok Adalat here. So in this slide you will understand the overview of the Lok Adalat function. So friends, ever wondered if there is a faster, easier and cost effective way to resolve dispute without getting stuck in lengthy court cases? So well, Lok Adalat is a solution. So it is a unique dispute resolution mechanism under the LSAL, right? That is called Legal Service Authority Act 1987, right? Designed to settle the case amicably, right? It is designed to settle the case amicably. So it handle judiciary cases. It handle civil judiciary cases. So Lok Adalat can resolve civil case up to 20 lakh, right? Making justice accessible and efficient. And there is something called dispute resolution platform. So it provide an alternative to the traditional court where both parties reach a mutual agreement, avoiding expensive legal battles. DRT and DRAT cases. So for some cases there is no monetary limit. This means high value dispute can also be settled through this mechanism, right? So Lok Adalat promote speedy justice without the hassle of prolonged litigation, no court fee, no delay, just fair resolution, right? So this is the advantages of the Lok Adalat. Up to 20 lakh cases are handled in the Lok Adalat. Now the next point we have to discuss is the SARFAESI Act. Very very important. So ever wondered what happened when a borrower default on a loan? So bank don't always have to go to court. Thanks to the SARFAESI Act 2002, lender have a structured way to recover their dues efficiently. So first step is to lender identify the default, which means when a borrower fails to repay, lender makes the account as default. Then we have to enforce the security interest. Unlike regular legal battle, bank can seize asset without court intervention. This is called enforcing the security interest. Then they sell the asset to ARC, asset reconstruction company. So to recover their money, bank can sell their asset to ARC, which is a smart way to manage the bad loan. Or we can say the borrower appeal to DRT. What is the meaning of DRT? Debt Recovery Tribunal. So if the borrower disagree with the bank action, they can approach the DRT without needing to pay upfront fee. And the appeal process, this case must be resolved within 60 days, ensuring the speedy justice, right? So this case must be resolved within 60 days, ensuring the speedy justice. And then we have aggrieved party appeal to DRAT. If unsatisfied, the borrower can further appeal to DRAT, that is the Debt Recovery Appellate Tribunal, for another review, right? And finally, it is called magistrate assistance. So if required, bank can seek help from the chief or district magistrate to check position of the secured asset. So this entire process ensures bank can recover loan efficiently while borrower still have the right to appeal. A win-win for all, right? So this is how the SARFAESI Act works. I've just given you the preview of it. Very very important points. DRT, DRAT, how many days appeal process to take? 60 days. So remember these key points, right? So appeal process with case disposal within 16 days. Next 45 days it has to deposit half of the fine, right? Half of the asset. Okay, so that has to be deposited for DRAT, right? For appeal to the DRAT. Then we have the write-off process in banking. So have you ever wondered what happened when a bank failed to recover a loan? Does the bank just forget about it? Not really. This is where the write-off process comes into play. So let's break it down step by step. First of all, this is called initiate write-off, which means when recovery effort fail, the bank decide to write off the debt, right? So first of all, this recovery effort. So whenever this recovery effort fail, what happens? What the bank decide? So bank decide to write off. Bank decide to write off the debt. But wait, this does not mean that borrower is off the hook. So they use something called provision, right? The outstanding amount is offset against provision. And what is provision? Provision is like a financial buffer that bank maintain to cover the bad debt. This is called provision. Or they debit the profit and loss account. right? So when the recovery effort fail, then bank write off the asset, or they use provision, or they debit the profit and loss account. Any shortfall is recorded in the profit and loss account, impacting the bank financial. And borrower's liability remain even after the write off. The borrower is still liable for the debt, right? Bank can still take action to recover their money, or the claim future receivable, future recovery. So what it means, that the write off does not mean that bank give up. If the recovery become possible in the future, the bank can still claim it or clear NPA. This is very important, that a technical write-off help clear non-performing asset from the bank book, making financial report look healthier. And debit non-recoverable asset. In some cases, the debt is classified as non-recoverable and permanently debited. And sometimes preserve value. Timely write-off help bank preserve the value of money and keep their financial stable. So the next time you hear that bank has written off a loan, remember it is a financial adjustment, not a free pass for borrower, right? So this is what is done. It is recorded in the profit and loss. MSME are the backbone of our economy, but sometimes financial stress hits hard. So what happened when an MSME struggle to repay loan? So the banking system has a structured process to resolve such case. First of all, what they do, let me explain step by step. The first step is to form a committee, right? As you can see here. So a team of expert, including bank official, MSME representative, and government officer, is assembled to oversee the resolution process. So the regional or zonal head acts like convener. Then they have to refer the account. What is the meaning of referring account? Basically, if an MSME has loan above 10 lakh, right? Suppose MSME has loan above 10 lakh, the account is referred to the committee within 5 days for a resolution plan, that is called RP, right? So basically, first they form a committee, and if the MSME has loan above 10 lakh, then account is referred to the committee within 5 days. Within 5 days, they have to refer the committee to assess whether a resolution plan is needed. So the assessment is done that whether RP is needed or not. Then what they do, they approve the recovery process, right? Next step, as you can see, is the approving the recovery process. Means this committee, right? I told about the committee. So this committee evaluate different recovery and restructuring option and grant approval for the best possible solution. This is the third step. And step number 4, for large exposure, a techno-economic viability, that is called TEV. What is the meaning of TEV? TEV stands for techno-economic viability, right? So for large exposure, this techno-economic viability, it is conducted to check whether the MSME has the potential to recover and sustain. And finally, they approve the resolution plan. So the resolution plan is finalized and approved, including necessary provision to help the MSME get back on track. So why this process important? Because it ensures that MSME get a fair chance to revive, while the bank mitigate risk and recover their fund. So what do you think? Should more MSME be given a structured resolution plan? Drop your thought in the comment. Now let's look at the next point. So friends, when a bank restructure a large loan or changes ownership, an independent credit evaluation, that is called ICE, right? So whenever, two things I'm telling you, whenever whenever bank restructure a large loan, so either they are restructuring a large loan or they are changing the ownership, or they are changing ownership, an independent credit evaluation is mandatory. But how many ICE are actually needed? How many independent credit evaluator are actually needed? Let's simplify it. So question is, how many credit evaluation are needed for large loan restructuring? So again, I'm telling you, for large loan restructuring we are talking about. So suppose for the loan that is less than 100 crore, right, just one ICE rated RP4 or better is required. For loan of 100 crore or more, right, one ICE with at least require one ICE rated RP4 or better is mandatory, right? And for massive exposure of 500 crore or more, two ICE are needed and both are rated RP4 or better, right? So this is the point you must keep in mind, right? So basically, why this is important? Because these evaluation ensure that restructuring decisions are based on expert opinion, reducing risk for both the bank and the borrower. So ICE full form, independent credit evaluation. This is called ICE. So you must know how many ICE are required for the resolution process involving restructuring or ownership change with 100 crore or more. You must know it. Now let's talk about achieving restructuring plan implementation. So friends, a successful restructuring plan is not just about approval, it's about execution. Let's walk through the 5 crucial steps to ensure smooth implementation. So the first thing is that the borrower must not be in default with any lender by the 180th day after the review period. This is the first major checkpoint in the process. So there is something called review period. After review period, within the 180th day, borrower must not be in default with any lender. Second thing is to complete the documentation. Means all necessary document must be prepared, signed and recorded to reflect the restructuring term in both lender and borrower record. Third thing, is the security creation. Any collateral, any security requirement must be finalized as a part of restructuring process to ensure financial protection for lender. And finally, the loan term modification, which means all agreed change in the loan term, like interest rate, tenor, must be properly documented and accepted by all party. And finally, we have no default post implementation, which means even after restructuring is complete, the borrower must stay compliant with all lender to avoid falling back into financial trouble. So because proper restructuring can revive business, prevent bad loan, and ensure a win-win for both bank and borrower. So here is a question for you: should bank allow multiple restructuring for the same borrower, or should it be one-time chance? Please answer it. So this is how restructuring plan is implemented. Now let's switch our focus to lender provision timeline for a borrower default. So let's talk about it. So friends, when a borrower failed to implement a valuable resolution plan on time, so suppose a borrower is failed to implement viable RP on time, right? Lender must follow a strict provision timeline to safeguard their financial. First of all, the thing is review period end, which means the initial review of the borrower financial condition is implemented. If the issue remain unresolved, lender must set aside 20% of the total outstanding, which is the funded plus non-funded, right, as provision after the 180 day from the review period end. So suppose review period end in Jan end. So after 180 day means Feb, March and April. After April end, right? So after ending of April, so initial review of the borrower financial is completed. If the issue remain unresolved, lender must set aside 20% of the total outstanding as provision after 180 days from the review period. So if after the 180 day of the review period, if the issue remain unresolved, then this much provision is to be done. So lender must now assess the borrower financial situation and allocate provisioning accordingly. This is the first major financial buffer to avoid potential loss. Then we have 365 day provision deadline. If the default still persists, lender must increase their provision by another 15%. So earlier it was just 20% and now it has increased to 35%, right? So this step ensures that risk is properly accounted for in the bank's book. So lender calculate the necessary provision based on the outstanding amount. So it's all these are done on the basis of outstanding amount, right? The amount set aside is capped at 100% of the total outstanding, depending on the asset classification and existing provision. And then some additional provision apply. At this stage, all lender with exposure to the defaulted account must make an additional provision, reinforcing financial discipline and risk management. So this is called additional provision is applying. So basically this timeline ensures that bank remain financially stable despite borrower default. So here is a question for you: should lender have a strict timeline, or do borrower need more flexibility to avoid default? Please answer it. So these are the steps: review period ending, 180 day provision deadline, 365 day provision deadline, provision calculation. So how do you calculate the provision? So lender calculate the necessary provision based on outstanding amount, and the amount is capped at 100% of the total outstanding. Try to understand. These provisions are over and above the higher of the existing provision, and those required by the asset classification capped at maximum it can go to 100% of the total outstanding. That is the maximum provisioning can be done, right? 20% and 35% are the deadline. Now let's look at DCCO, very very important part. So friends, have you ever wondered what happened when the borrowing entity delay the commencement of operation? So bank follow a structured process for classifying such loan, ensuring financial discipline, right? So first of all, when operation begin, that is called DCCO start, right? DCCO start. So what is the meaning of DCCO? DCCO means date of commencement of commercial operation. Date of commencement of commercial operation. This is called DCCO. So the DCCO marks the official start. From here, interest capitalization stop. Interest capitalization stop. What it means? That interest capitalization stop and all expense start reflecting in the profit and loss account. All kind of expense are started reflecting in the profit and loss account, right? So this is the point. Interest capitalization, no more interest capitalization is there, and all the expense are recorded in the profit and loss account. Now the question is that is there any need to defer the DCCO? At this stage, bank assess whether the project need a DCCO deferment. If yes, If yes, then the loan undergo restructuring, means leading to asset downgrading or riskier classification. And if no, if deferment is not there, the bank check whether the revised DCCO still fall within the permissible limit. So the bank check whether the revised DCCO still fall within the permissible limit, and lender allow deferment within these limit up to 2 year for infrastructure project and up to 1 year for non-infrastructure project. This is the maximum deferment that the lender can allow. And if the revised DCCO remain within these limit, the loan is classified under a standard category, right? So if the deferment was no, yes, then restructuring is done. If it is no, then it is a standard category, right? And what if it exceed this limit? So if it exceed this limit, if the deferment exceed the permissible limit for 1 year for infrastructure project or 2 year for 2 year for infrastructure project and 1 year for non-infrastructure project, if it exceed it, then then further deferment lead to additional provisioning. Then further deferment is done and additional provisioning is there. And what if it exceed this limit? If the deferment exceed the permissible limit, further deferment lead to the additional provision. Because the process ensure that bank properly classify loan and account for risk, preventing financial instability. So should bank allow more flexibility in deferment, or would that increase financial risk? Please answer. Now this is a very important chart table from where you will understand this deferment. Very, very important. Case study is asked. So did you know that when a project face delay, bank don't just wait. They reclassify loan and adjust provisioning accordingly. Let's break down how deferment in DCCO work. So the step number 1, as you can see, is the first deferment. For first deferment. So if it's infrastructure project, 2 years is allowed. I told you early. And if it's non-infra project, then 1 year is allowed. And these loan remain classified as a standard asset, and 0.40% provisioning will be done. Step number 2, deferment due to reason beyond promoter control. And if the infrastructure project extra 1 year is added, right, extra 1 year is added, this means T plus 3 year. And if it is non-infra project, then 1 year is added, that is T plus 2. But here is the catch, the provisioning requirement jumps to 5%. Earlier it was just 0.40%, now it is 5%, right, applicable for 2 year or till revised DCCO, whichever is later. Step number 3, what if deferment due to arbitration in or court case? Suppose some court case is there, because of which deferment is happening. So if it is infra project, then additional 2 year, that means total T plus 4 year is allowed. And if it is non-infra project, it is limited to T plus 2 year only, like in this case as above. And if the deferment, if the promoter is changed, what will happen to the deferment? So it can go up to 6 year, and for non-infra project, it can deferment capped at 4 year. So bank carefully regulate project delay to balance financial stability and ensure loan don't turn into bad asset. That is why this deferment is done, right? So and that is how provisioning is done. Now let's look at the last topic of this particular chapter. So have you ever wondered what happened when the bank struggled with the bad loan? Well, RBI has a structured framework for selling financial asset, ensuring a balance between recovery and financial stability. First of all, you have to identify the financial asset. This is the first step. You have to identify the financial asset. Right. So this process begins when the bank evaluates their asset. Is the asset an NPA? If yes, then bank can sell to security company or reconstruction company. And if no, the bank check if the asset is under a standard asset under consortium. Right. Try to understand the step by step. Is it under NPA? Then you should either sell. If it is yes, right. So if it is the asset is an NPA, they can either sell to IC or if no, the bank check if the asset is under standard asset under consortium or not. Right. Now another critical check. Right. If the 75% of the asset value already classified as NPA, is the 75% value already an NPA? If it is, then then if yes, the bank can proceed with the sale to the SC and RC. And if no, then bank do not sell the asset. Now step number 4. What if the asset is not NPA? Right. What if the asset not NPA? So the asset is in SMA 2 category, which is called a special mention account 2 category. So it signals the potential stress. So the question is restructuring possible? So this is the question. Is restructuring part of the plan? Right. So friends, if yes, then additional financial finance is arranged to support revival. If no, the bank may reconsider a strategy. So this framework help bank make informed decision, either selling a stress asset or reviving them with additional support. So do you think that banks should have a stricter rule for asset sale, or should there be more flexibility? And the last slide here we have NPA sale and valuation process. So basically, ever wondered how bank get rid of their bad loan? Well, they don't just write them off. They follow a structured process to sell non-performing asset and recover when they can. So whenever a loan turn into NPA, the bank decide to sell it to recover some of its loss. So the buyer of the NPA must hold it for at least 12 months before taking further action. right? So the buyer retains asset for 12 months. Then there is something called public bid solicitation. To get the best price, bank invite public bid and conduct e-auction for competitive participation. And there is something called internal valuation policy. It means bank have internal system for asset valuation to ensure fair pricing before selling. And then there is external valuation for large exposure. Bankruptcy code. So friends, as we know, in our crash course, what we do, I provide you the video, which is the shortest form, which includes all the important points from a particular topic. No extra thing, which is not examined. All the important things from examination point of view are covered. And then you go out solving the quizzes, which I provide you daily in a separate folder. After quizzes, you see the score you obtain. If it is less than 60%, you reattempt the concept. You go through the concept once and reattempt the quiz. So this is how we are proceeding. It hardly takes 1 to 1.5 hours per day on daily basis to cover the unit which I am covering. Now let's get started with our topic. So when business face financial trouble, there is one team that steps in to bring order to the chaos. That is called insolvency professional. So this team, right, this is called insolvency professional. So let's break down their key role one by one. First of all, they are licensed by IBBI. Let's move from the bottom up, right? So let's move from the bottom up. They are licensed by the IBBI, right? What is IBBI? Insolvency and Bankruptcy Board of India. So every insolvency professional is registered and authorized by the Insolvency and Bankruptcy Board of India, ensuring they meet a strict regulatory standard. Then there is something called interim resolution loan. In the early stage of insolvency, they steps in as the interim resolution professional, which we call IRP, right? They steps in. Who steps in? We are just talking about, we are talking about the, as you can see. So basically they are licensed by IBBI and insolvency professional, IP. So IP acts like an IRP in the initial stage, right? In the initial stage, which means that they take charge and stabilize the situation. Then we have resolution role, which means then comes the critical job of facilitating negotiation and settlement between creditor and debtor, aiming to resolve the financial distress. Then comes liquidation role. If the resolution fail, the insolvency professional shift gear to oversee the distribution of assets to creditor under the liquidation process. And finally, their role as bankruptcy trustee role, which means finally in the bankruptcy case they act like a trustee. Who act like a trustee? IP means insolvency professional. They act like a trustee, managing proceeding and conducting meeting with creditor. So you can see the various role they perform. Bankruptcy trustee role, liquidation role. In liquidation, what they do? They oversee the distribution of asset to creditor under the liquidation process. Resolution role, that means the critical job of facilitating negotiation and settlement. Interim resolution role, for the time being, to manage the initial stage, IP plays a very important role. So you can see the various role performed by IP, that is called insolvency professional. Everything in this particular slide is in pictorial format so that you can easily understand. So, and remember, behind every struggling company turnaround, there is a sharp insolvency professional making it happen. Now friends, ever wondered who set the standards for Indian insolvency professional? Let's dive into the structure of insolvency professional agency. This is called IPA. So till now we have discussed IP. Now let's discuss insolvency professional agencies. So friends, at the core we have insolvency professional agencies. So let me show you the diagram. So this is the diagram, as you can see. So at its core you can see the core we have IPA, right? So these are the backbone institution that define and maintain the standards for all insolvency professional in the country. For all IP, they define the standards, what standards they should have to maintain, right? Now the purpose. What is the purpose of this IPA? So the purpose, to ensure quality, transparency and integrity by promoting professional standards across the insolvency system. Now, but here is the catch. The catch is that membership with an IPA is mandatory for anyone who wishes to be registered with IBBI. So for anyone who wishes to be registered with IBBI, membership with IPA is mandatory. This is very, very important, right? For IBBI registration, membership with IPA is necessary. And what is IBBI? Insolvency and Bankruptcy Board of India, right? License. I told you earlier that IPA are licensed by IBBI. Remember it. And existing IPA in India, there are 3 existing IPA. Let me zoom a little bit. So the first is ICSI, that is Institute of so who are these existing IPA? We have got 3 major ones. The first one is the Institute of Company Secretary of India. Second one is the Institute of Chartered Accountant of India, and the third one is Institute of Cost Accountant of India, ICMAI, right? So together these agencies act like a pillar shaping how insolvency professionals operate under the India's legal and regulatory framework. So the next time you hear about insolvency case, remember these IPA are silently ensuring everything run by the book. These are called IPA, insolvency professional agencies, right? Now let's look at the next point, existing component and function of information utilities. So what is information utilities? So friends, let's break down a crucial piece of insolvency puzzle, that is called information utility. At the heart of this system, at the heart of the system, you can see are the information utilities or IUs. Think of them as secure digital vault where crucial financial information is stored and verified. So first of all, let's talk about the mandatory requirement. What are these mandatory requirements? See, when a company faces insolvency, the application need an IU certificate of default. Try to understand. Whenever a company faces insolvency, the application need an IU that is called, what is IU? In short, this information, just now I have told you, information utilities. IU means information utility. So whenever a company faces insolvency, the application need information utility certificate of default. So this information utility issued a certificate of default. This step is very key to kick starting the process. Next come the data source. See, information utility pulls information from various channels like bank, FIs, NBFCs, asset recognition company, corporate firms and individuals. Then we have the data function. Data function, means IU handle everything from pulling, authenticating and certifying data to make sure it is credible and trustworthy. And finally we have the access mechanism. Thanks to the Central Application Program Interface, which we call CAIIB, Central Application Program Interface, this information is easily accessible to our shareholder. So that is the beauty of this crash course. In one single slide, you are able to understand 4 different things. If you go in the book, you will see number of lines which is written, and you have to filter out what is important for me and what is not important. And this crash course ensures that if you go through all the content which I am providing, this ensures that you can easily revise the main points, and this will help you in the examination to revise in the short time. So if you want to get avail of this crash course, you can enroll by getting more detail on this WhatsApp number, or in the description section of this video you will get the link to the crash course. So this is the beauty. In the short time, if you want to revise everything, this will help you. So you can see the mandatory requirement, data sources, data function, access mechanism, thanks to SAPI. CAIIB means Central Program Interface, Central Application Program Interface. Now let's look at the next slide. Remember this 4 point, very very important regarding the information utility. Now friends, but who takes decision once insolvency starts? That is where creditor and their committee, that is called COC, that is called creditor committee, committee of creditor, right, comes into play. Here is how voting works. So quorum, right, quorum needs 33% attendance. Routine matter needs a simple majority at 51%. Critical matter needs a strong 66% by backing. And for withdrawal under section 12A, a whooping 90% agreement. So the COC is formed by the interim resolution professional. Remember, COC is formed by IRP. And it is made up of entirely of financial creditor. Its member are FCs. It is made up of financial creditors, right? Well, okay, what about operational creditor? They don't vote, but they play an observer role. So this operational creditor, they don't vote, rather they play the role of observer. So together, information utility, and you can see the creditor, a financial creditor and operational creditor are there. So together, information utilities and COC ensure that insolvency proceedings stay fair, transparent and efficient. I hope that makes sense to you. Alright, let's now simplify how legal disputes are resolved in under insolvency laws in India. How legal disputes are resolved. So friends, this is where adjudicating authority and appellate body comes into the picture. Think of this as the 2 separate routes. One for corporate entity, as you can see, one for corporate entity, another for non-corporate entity. So corporate entity, like LLPs, like companies, these are called corporate entity, right? So their insolvency cases go straight to their insolvency case go straight to NCLT, that is called National Company Law Tribunal. And if any party is unhappy with NCLT decision, they can appeal to NCLAT, right, which is National Company Law Appellate Tribunal, simple and streamlined. And what about non-corporate entity? So when you talk about partnership, right, when we talk about proprietorship and individual, these are called non-corporate entity, right? So their case go to DRT, Debt Recovery Tribunal. If needed, appeal from DRT goes up to DRAT, right? So DRAT means Debt Recovery Appellate Tribunal. So friends, 2 parallel track, both designed to ensure speedy resolution and justice. Corporate matter to NCLT and NCLAT, and Appellate Tribunal is NCLAT, and non-corporate matter to DRT and DRAT. A well-organized system that keeps insolvency and debt recovery running, right? So this is all about adjudicating body. the corporate insolvency resolution process step by step. So first of all, you can see that it all start at the if a default of 1 crore or more, whether full or partial non-payment, this is a red flag. This is a red flag that kicks off the process. Then after step number 2, initiation by creditor. So who raised the hand? It could be financial creditor, it could be operational creditor, or it could be corporate debtor themselves. So all of them can raise the hand. Now step number 3 is the NCLT application. What it means? So friends, then they can file an application before the National Company Law Tribunal, the NCLT, to officially initiate the resolution journey. Then step number 4 is the IRP proposal. An interim resolution professional or IRP is proposed to steer the ship. For financial and corporate debtor, this is a must, and for OC it is optional. The IRP proposal is optional for OC. And then the next point is IRP appointment. The NCLT appoint the IRP to take charge of the resolution process and bring some order to the chaos. And the final step we have, as you can see, is the IRP takes over. Finally, the IRP assumes full control, replacing the power of the CEO and the board. The IRP ensure that corporate debtor continue as a going concern while the resolution unfold. Right. So there you have it. 6 clear steps that set the stage for saving or restructuring a struggling company. Want to know what happened next after IRP? Stay tuned for the next slide. So in the next slide you will see what happened next after IRP appointment. So what exactly happened after the initial step in the corporate insolvency resolution process? So let's take a ride along this resolution highway. So this is a resolution highway, right? First stop is the interim resolution professional or the IRP, right? So it is officially appointed. The IRP job is to take charge and manage the corporate debtor right from day one. Then moratorium is declared. So NCLT pulls the brake. A moratorium is declared, which means no fresh legal action or recovery against the debtor until this entire process is completed. A pause button for creditor. Then COC appoint RP, which means the committee of creditor. They now appoint a permanent resolution professional, also known as RP, who take over from IRP and drive the process forward. Now it's time to draw up a solid resolution plan. The plan will ensure CIRP costs are paid, and most importantly, operational creditor get at least the liquidation value. Right? Operational creditor get at least the liquidation value. Priority matters here. Finally, we have plan implementation. So we hit the execution phase. The plan is implemented and the IRP takes the wheel officially. Keep in mind, the corporate insolvency resolution process should wrap in 180 days, right? But maximum can be extended to 330 days under a specific condition. So from appointment to implementation, this roadmap help revive distressed company and protect creditor the interest. So I hope that makes sense. This was continuation of the previous slide which we have just gone through. Now let's come to the next slide and let's talk about the CIRP process and IRP appointment. Some more point. So let's climb step by step through the corporate insolvency resolution process and see how the interim resolution professional or IRP comes into play. So first of all, first step, as you can see at the bottom, is the applicant. I think it is at the top here. So first of all, CIRP applicant proposes IRP, which means the applicant, usually a financial creditor, proposes a name for IRP. This kick-start the process officially. Then NCLT appoint IRP, already told you. This NCLT give the green signal by appointing the IRP. Now, no ongoing investigation, but wait, it is mandatory that IRP has a clean record. No ongoing investigation or disciplinary action should be pending. Now, OC does not propose IRP. So suppose here is a key point that if the operational creditor does not propose any IRP, right, then in that case, right, if there is a confusion or there is a special circumstance, NCLT may consult with IBBI to appoint an IRP, that is insolvency resolution professional. Then NCLT appoint IRP within 14 days, right? So once appointed, the IRP steps in. The NCLT must appoint the IRP within 14 days of admitting the CIRP admission. And once appointed, the IRP steps in, right, and takes control of the asset of the corporate debtor. No exception here. And lastly, the board of directors of the debtor company is suspended immediately from the CIRP admission date. The IRP now run the show. This marks the beginning of a structured resolution process. Now let's move ahead. Public announcement process by IRP. So friends, alright, now that IRP is on the board, what is next? It's time to take this process public. First, the IRP is officially appointed to the case. Once in charge, they need to act quickly. Within just 3 days, you can see, within just 3 days, right, IRP must make a formal public announcement. That is called public announcement, right? Now, where no delays is allowed. Now, where does this announcement go first? It go first to the IBBI website. That is the official platform of the Insolvency and Bankruptcy Board of India. Then what happened? Corporate data website publication. That means this is the classic touch. The IRP must also get this announcement printed in 2 newspaper. And also, the same announcement is also published on the corporate data on website, which means transparency is the key. And now the IRP must also get announcement printed in 2 newspaper, one in English and other is the local language, original language. So the question is, what is the purpose of this announcement? The goal is simple: to invite creditor to step forward and submit their claim. The resolution process starts with knowing who or what. So this multi-channel approach ensures that no stakeholder is left in the dark. It's about fairness and openness. The next point, the next step we have, as you can see on your screen, is the PIRP. Very, very important thing. Every year question is asked based on it. There are many things in between, but we are skipping those part. We are just moving to the PIRP. So ever wondered how MSME or micro, small and medium enterprise can resolve financial distress faster and smoother? Let's dive into pre-packed insolvency resolution process, which is tailor-made for MSME. It's all start here. Recognizing MSME facing financial distress or those defaulting up to 1 crore, right? You should recognize such MSME. Step 1 is spotting the trouble early. Then to submit the RPs, you have to submit the resolution plan. So the MSME proactively submit a resolution plan, a strategy to fix the distress and get back on track. Then comes adjudicating authority approval. The plan is then sent to adjudicating authority. They will review it and give their official approval before moving forward. So this adjudicating authority review the resolution plan and give their final approval, right? Then then they apply the PIRP criteria, right? Then they apply something called PIRP criteria. But hold on, eligibility check matter. Does the MSME meet the PIRP criteria? So if the dues exceed 1 crore, right, then CIRP or other option might come into play instead. So remember, the deadline is, the limit is 1 crore only, right? If dues should be less than 1 crore. Now what happens then? Once cleared, the PIRP kicks off, or if PIRP is not suitable, then the process move to CIRP. Either way, action start here. And one important note is that there is a cooling off period, right? Which means PIRP or CIRP cannot be reinitiated within 3 years of completion of previous one. So until and unless the previous one has been completed for 3 years, these two cannot be initiated. This ensures stability and giving breathing space. So this process is designed to give MSME a fighting choice, right, helping them resolve issue quickly without losing business momentum. Now let's switch over and let's talk about the next slide. As you can see in the next slide, we will talk about which insolvency process should be pursued. So if PIRP is filed within 14 days of CIRP, it takes precedence, right? Or if PIRP is filed after 14 days, CIRP remains in control. So suppose initially what you filed is CIRP and just within 14 days you filed PIRP, then it takes precedence, PIRP takes precedence. And suppose you file CIRP and after 14 days you file PIRP, then CIRP remain in control. And PIRP model when debtor manage asset. So that is called debtor in possession, right? Now let's switch our focus to the next slide, which we have, as you can see, a step to initiate PIRP, right? So what are the steps to initiate PIRP? So basically, there are some steps. The first step is to get the creditor approval. Achieve 66% approval from financial creditor to initiate PIRP. How much? 66% approval. Once 75% shareholder approval, obtain this much through a special resolution, that is called shareholder approval. How much? 75% means 3/4. Then file the application with the adjudicating authority, and then court appoint an IRP, insolvency resolution professional, and then timeline completion. Complete the process within 120 days. So you can see in that case CIRP 180 days were there. Now it is just 120 days. Now let's look at the sequence. What happened in the sequence? So friends, let's break down the step-by-step journey of the insolvency resolution sequence under PIRP. It all begins with the commencement of pre-packed insolvency resolution process. This marks the formal start. Next up comes the BRP, which is called Base Resolution Plan Submission. This is the debtor initial solution, and this is a strict deadline to meet. Then from here the ball moves to the COC, Committee of Creditor, who have a 90-day window to review and approve the plan. They have 90-day deadline. Then comes termination. But if no plan get approved within this time frame, the process is terminated. No second chance. The clause enforce discipline and quick resolution. And section 29A apply. Let's not forget section 29A. This provision disqualify defaulting promoter and willful defaulter from participating in resolution process. Defaulting promoter and willful defaulter are disqualified from participating in resolution process. A strong safeguard to ensure only eligible players are at the table. This is how PIRP create a swift and structured pathway to recovery for the distressed company. Right? Remember the deadline, 90 days deadline for plan approval. If process terminate and section 29A apply. Now let's compare PIRP with CIRP in this particular slide. So first of all, eligibility. So PIRP is tailored made for MSME. Let me zoom a little bit. So no, you must know that this PIRP, is only tailored for MSME, right? MSME, micro, small and medium enterprise, right? With a default threshold capped at 1 crore, right? On the other hand, CIRP apply to all corporate debtor, but only kicks in when default exceed 1 crore. Remember it. Initiation. Who initiated? PIRP is driven by the corporate debtor itself. Post approval from the shareholder and unrelated financial creditor. I told you 75% approval of the from the shareholder and 66% from the corporate COC, committee of creditor. CIRP, however, can be initiated by anyone: financial creditor, operational creditor, corporate debtor. Anyone can initiate it. So timeline wise, PIRP offer a fast track, 90 days to submit RP with a maximum of 180 days overall. But in CIRP, in the contrast, can stretch up to 330 days with extension. Now, if you look at the management control, so control matters. Under PIRP, the data retained position, right? So if we talk about the control, right? So management control. So under PIRP, the data retained the position. So friends, what it means that under PIRP, the data retained position, right? The data retained position, but creditor are in control. Under PIRP, the data retained position, but creditor are in control behind the scene. And CIRP shift the control directly to the creditor, right? When it comes to the resolution plan, right? PIRP begins with the base resolution plan, right? Submitted by the debtor. However, CIRP invite EOI. CIRP invite EOI. EOI means expression of interest, right? CIRP invite EOI from all prospective applicant, opening up the floor to competition. Then section 29A. Both process enforce section 29A, disqualifying defaulting promoter and willful defaulter from bidding. But here is the catch. PIRP termination can either trigger liquidation or lead to full CIRP. Right? So if termination of PIRP, it can trigger liquidation or lead to full CIRP, while CIRP termination directly leans toward liquidation. Right? That is the point. Now moratorium. A moratorium in PIRP starts from date of commencement, right, from the very beginning. In CIRP, it activates upon filing. For termination, PIRP needs 66% COC approval, right, while CIRP follows section 12A with 90% vote to withdrawal. And lastly, PIRP have some extra layer that if promoter that no parallel running with CIRP, first point, a mandatory 3-year cool off period between PIRP or any other PIRP, and if promoter don't dilute equity as part of the resolution, the COC must record the reason for it. So whether it is speedy and flexibility under PIRP or the broader scope under CIRP, both routes are designed to tackle insolvency with precision. So that's all for this topic. Nothing extra to learn. If you cover this much, more than enough. So friends, let's take a fascinating journey into the evolution of wealth and organization dynamics. So this way, let's understand each and every fact. First, let's talk about the people management. So here you can see people management. So why do organizations exist? Because no one can do it alone. Organizations are built on interdependence, right? So there is something called interdependence, right? People coming together to meet individual needs while chasing shared goals and purposes. It is people who form the heart of every organization. Next come human capital. Yes, technology and tools have, but who make the real difference? It is you, the people. Human capital, your skill, your knowledge, your attitude is the game changer, right? These are the true driver of growth and transformation in any business. Finally, notice the shift in the wealth creation over the era. In agrarian era, wealth came from lands. So let me zoom a little bit so that the picture become very clear to you. So the first era was called agrarian era. So in agrarian area, what used to happen? That wealth come from the land, that is the field, that is the soil. But now today in the knowledge era, the rules have changed. Now it is human capital, right? Now it is human capital, right? That means what you know, how you think, how you innovate, that builds wealth. People are the powerhouse of modern success. So from land to people, soil to skill, this is how wealth and organization have evolved. Stay tuned as we dive deeper into how organizations thrive by unlocking human potential. So I hope this makes sense, whatever we have talked till now, evolution of wealth and organization dynamics. Now friends, Let's look at the next chart. So this is a single chart in which every information has been given. Let me zoom out a little bit. Every important information has been given that will help you understand the concept, right? So let's get started. So the concept is, let's dive into the world of organization structure, and let me write here informal structure. I think it is missing here, informal organization. So friends, to begin with, let's understand what an organization really is. What an organization really is. Let me zoom a little bit. So friends, according to the Edgar Skin, remember the name Edgar Skin in 1979, an organization is simply the rational coordination of activities of multiple people. Remember this definition, right? So they define organization as a rational coordination of activities of multiple people. So sounds simple, right? But this simple idea drives every successful venture. Every organization exists for a common purpose. There is a common purpose for which every organization exists, right? Whether it is building product, delivering services, or solving problem, there is always a shared mission behind it. That is a common purpose. And how does it operate? It operates through the division of labor, which means where work is broken down into a smaller tasks. Like we are covering this ABM chapter, this entire CAIIB. So we have converted into five subjects. In each subject we have different module. In each module we have different units, and we are covering one unit out of that. So this is how the division of labor is working, right? And the second thing is through hierarchy. So hierarchy is where clear level of authority ensure coordination and efficiency. So these two pillars, that is division of labor and hierarchy, help organization function like well-oiled machine. Now let's explore one of the key types of organization, that is the formal organization and informal organization. First of all, let's look at the formal structure. So here you can see, here it is formal structure, right? So it has a predefined goal. It has predefined goal structure, roles and relationship. Activities, process, responsibility are well documented. It ensures uniformity and consistency in decision making. So this is called formal organization. So these are the characteristics of formal organization. What about informal organization? So the second type is called informal organization. So unlike the formal structure, informal organization evolved naturally through human interaction. So informal organization evolved through human interaction. So here human interaction plays a role. They don't follow a predefined chart, but are built on relationship, trust and group dynamic. In short, while formal structure give order, informal network provide flexibility and adaptability. So they provide something we call flexibility. They provide something we called adaptability, right? Adaptability. While formal structure, formal structure provide order, provide discipline, right? So whether it is the official hierarchy or the informal bond among teams, both shape how organization breathe and grow. Stay with me as we unlock more layer of organization dynamic. So I hope this picture makes sense in every point which I have covered. We have gone through the organization structure and types. Friends, let's look at the third slide, and this is about informal organization. Now let's look at the next slide, that is productivity improvement. So friends, ever wondered how productivity became such a big buzzword in management and industry? Let's travel back in time and meet two pioneers who shaped this idea. Meet Robert Owen and you meet Charles Babbage. So friends, first meet Robert Owen, right? A visionary with a managerial focus. He was a visionary with a managerial focus. Owen saw workers as more than just laborer. To him, they are the vital machine. Remember, this is very important. His belief was that if you invest in the well-being of worker, you will naturally boost productivity. Better working condition, better education, better welfare, right? It means happier worker. And if happier worker are there, so what they say, if happier worker are there, it simply means better result. It simply means better result, right? Simple yet revolutionary for his time. On the other hand, we have Charles Babbage from 1792 to 1871. You can see Charles Babbage 1792 to 1871, right? Often called the father of computer. He is called the father of computer, right? So but also a key figure in productivity improvement. So Babbage also took scientific approach, applying logic and analysis to the workplace. He was a strong advocate of division of labor, right? And focused on optimizing work process using scientific principle. So it applied scientific principle to optimize work processes. So for Babbage, the goal was clear: efficiency and cost reduction. His goal was clear, that was efficiency and cost reduction, right? So what united them both? At the core, both Owen and Babbage emphasized productivity improvement, but with two different angles, right? In the case of Robert Owen, right, it was worker well-being. In the case of Robert Owen, it was just worker well-being, and in the case of Charles Babbage, it was efficiency. It was efficiency and cost control. Efficiency and cost control. Right. So whether you are about caring for the people like Owen or optimizing a system like Babbage, both parts leads to one destination, that is a more productive workspace, productivity improvement. Right. So again, I'm telling you, Charles, Robert Owen is called the father of, Charles Babbage is called father of computer. He took a scientific approach, applying logic and analysis to workplace. He was a strong advocate of division of labor. Right. He was a strong advocate of division of labor, and he focused on optimizing work process using scientific principle. Right. And while on the other hand, Robert Owen, we have just talked about, he called worker as a vital machine. Right. And Robert Owen, his belief was that if you invest in the well-being of worker, you would naturally boost productivity. Right. If you invest in the worker welfare, it will naturally boost productivity. So happier worker means better result. Right. So we can say that division of labor was about Charles Babbage. Right. So at its core, both Owen and Babbage emphasize productivity improvement, but with two distinct angles. Owen, worker well-being, and Charles Babbage, efficiency and cost control. So whether you are about caring for the people like Owen or optimizing the system like Babbage, both parts lead to one destination, and the destination is what we call more productive workplace. Let's rewind to the root of the modern management, the era where science meets business, giving birth to what we call as the scientific management approach. So let me zoom a little bit so that it become clearly visible to you. So now I hope it is visible, clearly text is visible. So friends, this approach was pioneered by none other than Frederick Taylor. Right. Frederick Taylor is pioneered this concept of scientific management approach. He is called the father of the scientific management, and Taylor believed that by scientifically studying work process, we could make them more efficient and predictable. Right. So how did he do this? So he introduced the division of labor. I think we have already discussed the division of labor, and also time motion study. So where every task was broken down into a smaller step, it is measured and optimized. Right. But the Taylor idea did not stop there. This was further developed by experts like Gantt and Gilworth, who added new dimensions like a scheduling technique and motion economy. At the heart of this approach were two major assumptions. What were the major assumptions under the scientific management approach? So it says that task breakdown. That means you break task into simple, repeatable steps and motivate worker using monetary incentive, leading to a stronger organization control. Right. But here is the twist. While Taylor's method was revolutionary, it was not flawless. Right. It faced sharp criticism for overlooking key human factor like fatigue, boredom, social interaction. So it treated worker as a replaceable part of the machine. Right. It treated worker like a replaceable part of the machine and focused heavily on control and prediction rather than on human behavior. So while scientific management saved industrial efficiency, it also sparked the need for more people-centered management approach later on. What do you think? Is the control more important than motivation today? What do you think? Is control more important than motivation? So basically this particular diagram clearly indicate every aspect of the scientific management theory. Right. So I hope the concept is clear, who introduced it and how it works, what are the advantages and disadvantages of it. Now let's switch our focus to next topic, that is consequence and rise of labor union. Ever wondered what triggered the powerful rise of labor union that reshaped workplace worldwide? Right. So here we are talking about that. So friends, so what happened that as industry grew more mechanized, worker began to feel like cogs in machine. Right. So let me zoom a little bit. So what happened as industry grew, as industry grew more mechanized, the industries began to feel like cogs in a machine, leading to labor unrest. Frustration boiled over as employees faced poor treatment and harsh working condition. Right, that is called labor unrest. Then comes, this is a sequence. Then comes economic depression. So an economic downturn that worsened thing, pushing more workers to seek solidarity and protection through union. This situation was further stirred by worker immigration. A steady influx of laborer added number and momentum to the union movement. That is called worker immigration. Then we have management anti-union stance. So basically it was not just worker reacting, management anti-union stance also play a key role. So here you can see aggressive opposition, right? Aggressive opposition from management only fueled the fire, right? Aggressive opposition from management, right? It fueled the fire, right? And strengthening the workers' resolve. So when union finally formed, collective bargaining became their weapon, often slowed down by tough and delayed negotiation. And overlaying these all were socio-political pressure. External force like politics and society heavily influenced corporate decision and labor policy. Finally, as the time passed, as all time passed and workplace evolved, modern management approach emerged. Modern management approach, it emerged. The old scientific management model could not survive today's fast-paced VUCA world. What is VUCA? You must understand. The full form of VUCA is very, very important. Volatility, uncertainty, complexity, and ambiguity. So the old scientific management model could not survive today's fast-paced VUCA world. Today, organizations are focusing on human-centric approach. So today, the main focus of organization is, human-centric approach, right? So prioritizing people over process, engagement over just efficiency. So do you think today's modern flexible management style are enough to keep labor union less confrontational to this era of change, right? So basically this is all about the discussion just now we have done regarding, this discussion is regarding consequence and rise of the labor union. So first of all, we talked about the labor unrest, economic depression, worker immigration, management anti-union stance, collective bargaining, right? What is the meaning of collective bargaining? Means when union finally formed, collective bargaining became their weapon, and overlying what this all were socio-political pressure. And finally we have modern management approach like VUCA, right? VUCA environment, volatility, uncertainty, complexity, and ambiguity. Now let's switch our attention to the evolution of the people management. So friends, have you ever felt like just a number at work? Well, that exactly how early worker felt in traditional factory. In the early days of industrial work, jobs were designed to be rigid and structured, right? You can see what were the issues. So this is an question and answer format. So the job was rigid and structured, stripping away meaning and pride. The result was that productivity decreased and workers felt disconnected from their task. But then come a powerful realization that that emotion matter at the work. Yes, emotion matter at the work. How people feel directly impact how well they perform. So this led to one of the most famous study in the management history, and that is called Hawthorne experiment. Remember this experiment, very, very important. So Hawthorne experiment, it was conducted by Alton Mayo and team at the Western Electric Company between 1924 to 1933, right? So what did they find? Something that changed management forever, right? What was the key finding? Let's discuss the key finding. So turns out it is not just wages and working conditions that drive productivity, rather human behavior, right? Human behavior, social interaction, right? And psychological factor are equally important. People thrive when they feel valued, heard, and connected. So today every modern manager are adapt to these insights. So ask yourself, is your workplace focusing enough on these human cell side of productivity, right? So the Hawthorne experiment key finding was that human behavior and interaction impact productivity, right? Now let's shift our focus to the next slide. As you can see on your screen, that have you ever wondered why some workplace feel more human and connected while others feel cold and mechanical? Let's uncover the shift that changed the world of management forever, right? So in this particular table I have condensed every information in just single table so that you can easily understand all the point, and this is the beauty of our crash course, right? Now friends, this shift is called human relation movement, and that is what we are talking about. We are talking about something called human relation movement, right? Hardly it will take 20 to 30 minutes to master this particular chapter, everything that matters for your exam. So this is a game changer that moved beyond treating employee as mere economic unit. At the heart of this movement were powerful concept from brilliant thinker like Chris Agrees, right? He emphasized growth and self-actualization at work, right? So helping employee reach their full potential, that is called growth and self-actualization. Then we have Abraham Maslow. So what about Abraham Maslow? Abraham Maslow introduced his famous hierarchy of need, right? He introduced famous hierarchy of need starting from Maslow theory, like psychological self-actualization, starting from basic survival need to achieving self-actualization. And then we have Douglas McGrath. He gives theory X and theory Y. We will cover it later, highlighting how management style, whether controlling or empowering, influence employee behavior. Then we have Frederick Herzberg. He developed the motivational hygiene theory, showing how both intrinsic and extrinsic factors drive motivation. But here is the twist. This movement replaced the old idea, right? So this particular movement, that human relation movement, it replaced the old idea. What was the old idea? The old idea was rational economic man. It replaced the rational economic man who only worked for money with the more human focused social man concept. Now things like workplace culture, right, team dynamic and personal fulfillment become just as important as paycheck, right? So people don't just work for money, then they seek meaning, purpose, connection at work. Modern management now blend both psychological and economic factor to boost performance. So that is the point. So what we learned from this discussion is that the key takeaway is that meaning, purpose, non-monetary motivation drive performance. Modern management integrate both psychological and economical aspect. So the next time you think about workplace motivation, remember it's all about the heart as much as the paycheck, right? So I hope that makes sense to you. Decode the backbone of every successful organization, the structure and function of human resource management and development. So basically, if we talk about the HRM or human resource management, right, it has evolved far beyond its traditional role. Initially it focused on basic people management, but over the time it has added layers and dimensions, right? It has added some layers, it has added some dimensions, right, stabilizing into a well structured and routine function. That is the evolution of HRM. This is the part. Now here is where the things get even more interesting, that HRM is process oriented, that means process driven. Every system from hiring to performance appraisal follow a defined process, right? And don't forget, educating line manager on HR principle is very vital to making sure this process flow smoothly. That means educating the line manager on HR principle is very, very important. But HRM don't work in isolation. It acts like an umbrella function, right? So it guides, it guides new system, it guides, subsystem, and cover every aspect of people management, right? Both old as well as the new. And last but not the least, here is a key role you may not have thought about, that is HRM is also a line and a staff function. This means it is not just HR team handling it. Every manager out there implement HR practices. Line manager in particular plays a crucial role in executing HR policy directly with their team, right? That is the role of line manager. So the next time you think HR is just hiring and firing, remember it's a dynamic collaborative engine driving organization success. So these are the various aspects of HRM which we have just gone through. Now let's look at the strategic HRM and HRD overview in this particular slide. So friends, ever wondered how companies stay competitive and resilient in today's fast changing world? The answer lies in power due, that is a strategic HRM and HRD. Let's start with the first pillar, that is called effective people management. The first pillar is effective people management. So by managing people well and adopting the best HR practices, organization gain a real competitive edge. So organization gain a real competitive edge, right? So it is no longer just about product or services, it's about how you manage your people. Next come talent acquisition. So the fuel for success, hiring the right people, training them, planning your workforce properly is a game changer. HRM is the engine that drives this, ensuring the right talent is in right place at the right time. That is called talent acquisition, right? So this is called fuel for success. Hiring the right people, training them, planning your workforce properly is a game changer. So HRM is an engine that drives this talent acquisition. But here is where HRD steps in as crucial subsystem of HRM. So this HRD is a crucial subsystem of HRM. HRD goes beyond just routine tasks. So it focuses on developing people. Let me zoom a little bit so that the picture is clear to you. So here you can see, let's look at HRD. So HRD is a crucial subsystem of HRM. Remember, this is very, very important. So you can remember it like this: D come before M. So D is a subsystem of M, right? So HRD goes beyond routine tasks. HRD focus on developing people, right? And enhancing performance, right? And using human potential to its fullest. This is where organizations shift from just managing people to truly growing them, right? Professional development is the next key element. Organizations that invest in continuous learning and development enjoy higher efficiency and adaptability, because when your people grow, your business grow. But not least, let's not forget the synergy between HRM and HRD. That's called complementary function. So what does it mean? See, these two work hand in hand without stepping on each other's toes. While HRM handle daily people process, HRD focus on bigger goal like shaping a positive culture, driving employee engagement, and managing changes. So the bottom line is that strategic HRM and HRD are not just support function; they are crucial for driving sustainability, growth, and long-term success. So I hope this slide is clear now, how HRD and HRM are related. And you must note that this is a question most frequently asked. HRD is a subsystem of HRM. Remember it. Very, very important. Now let's look at the critical attribute for HR role. So friends, did you know that? Do you know that what it really takes to be an outstanding HR professional? It is much more than just hiring and firing. Let's dive into the Parik and Rao. This question is asked. Parik and Rao framework, right? A blueprint for mastering the HR role. First, let's zoom out. So this is how I have represented it in. It is in form of flowchart. and let me explain step by step what is happening here. So remember, this is a very important thing we are going to discussing. According to the Parikh and Rao, the HR role demand a unique blend of 3 critical competence. And what are those 3 critical competence? The first is called technical, then we have managerial, and the last is called personality. Right. So these are called 3 critical competence: technical, managerial, and personality competence. Right. So friends, let's first talk about the technical competence. What is the meaning of this so-called technical competence? Let me explain. So friends, according to the Parikh and Rao, the HR demands a unique blend of 3 crucial competence. So technical competence are the nuts and bolts of HR. To be effective, an HR professional must master performance appraisal system, means they ensure fair and effective evaluation, behavioral test and measurement, using assessment to understand employee behavior trait, and training program design, means creating impactful learning experience to upskill the team. So these 3 things are under technical competence. There are many more, but these 3 are super important: performance appraisal, behavioral test and measurement, and training program design. If we talk about the managerial competence, so HR leader also needs sharp management skill like organizing ability, because chaos does not build great teams. System development skill means crafting process and framework that make organization run smoothly. That's the managerial competence. And finally, personality trait. This is where HR truly shines as people champion. So the right mindset include initiative, that means being proactive and a self-starter, positive attitude, because positivity fuel engagement, and teamwork ability, which means collaborating effectively to create a strong organization culture. So whether it is technical know-how, managerial sharpness, or winning attitude, the Parikh and Rao model, right, shows us that HR is both a science as well as an art. I hope that makes sense to you. Now let's look at enhancing HR professionalism and competence. So this flowchart sees every aspect of that. See, I have made this flowchart, right, and this will help you understand every competence. So this is the beauty of this crash course, right, because you need not remember anything. You just go through this chart. It will hardly take 1 minute to go through each and every part, and you will be able to understand. So at the time of revision, you just go through these key points, and this will help you remember the entire concept. Right. So let's get started. So friends, in this particular slide, what we are talking about, ever wondered what transform an ordinary HR professional into a true leader? Have you ever wondered what transform an HR professional into true leader? What transform? So friends, let's decode the secret to enhancing HR professionalism and competence. So building HR professionalism is like shaping a diamond. It needs multiple forces working together. So there are 4 key factors. The first is called individual growth. So it means continuous learning and self-improvement. Then we have organization role. So the influence and support you receive from your company. Then we have academic institutions, the knowledge and research backing your skill. And finally, we have the professional bodies, means the global HR communities that set the standard. So these are the 4, these are the 4 key factors. Now what make an HR leader truly stand out, right? So according to the SHRM competency model, there are 9 critical skills that every top HR leader must master, right? What are those 9 critical skills? Let's discuss. So let me show you. The first is called, leadership and navigation. So it means leading teams with purpose. It's ethical practice. Means, integrity is a non-negotiable. Business acumen, understanding business inside out. Relationship management, a strong connection, create a strong organization. Consultation, guiding team with expert advice. Critical evaluation, right? So if we talk about the critical evaluation, it means, making sharp data-driven decision. Global and cultural effectiveness, which means, thriving in diversity, communication, clear and impactful messaging, HR expertise, the foundation of every HR champion. So one more thing I want to tell you, these are the 9 critical aspects that is needed for SHRM, right? And there was a study, there was a Verma, Priksat and Sanjeev Kumar study also highlight the real world HR role you often see. What are the real world HR role? As per Verma, Priksat and Sanjeev Kumar, the first is functional HRM as a specialist. So it means the most common role. Then we have the strategic business partner. This is the second most impactful role. The third is the credible activist competency. HR as a trusted voice. And finally, we have workforce designer role, which means shaping the future of work. So remember, HR professionalism is not built overnight. It's about honing competency, embracing global standard, and always staying one step ahead. So that is how HR competency is built. Now let's look at strategic HR in bank, evolving roles and responsibility. So this slide clears everything about SHRM. So friend, did you know that how HR in bank has transformed from a traditional support function into true strategic powerhouse? So today strategic HRM in bank is no longer just about hiring and firing. It's about driving the business forward. So first let's talk about the shift. So in the past, HR was seen as a reactive function. Remember, in the past, HR was seen as a reactive function, but now it's primarily focused on compliance and protecting the employer's interest. That was called reactive function. But now, HR has evolved into a strategic business partner. So here you can see, shift from traditional HR to a strategic HR. But now HR is seen as a traditional strategy partner, fully aligned with the organization mission and goal. Earlier it was reactive, now it is a strategic business partner. Now if you look at the key responsibility, if you just look at the key responsibility of modern HR professional, so here you can see basically the first today HR professionals are no longer the sole executor, they are enabler also, which means creating system and empowering other. They delegate their more responsibility to the line manager, and focusing on value driven function that impact the entire organization. If you look at the evolving role of the line manager, that means they act like a local HR administrator. They take on crucial people management role, and they often serve as the last contact point for many HR related issues within the team. Now if you look at the new HR model in bank are now adopting a modern HR model. HR become a center of excellence, right? Focusing on core policy that apply organization wide. Their role is now about formulating universal HR policy, right? And most importantly, empowering line manager, right, to manage their team effectively, right? So HR in bank today is not just about administration task. It's about creating a culture of leadership, accountability, and business success. Now let's look at this particular slide. Very, very important. Question is asked every year. So friends, have you ever wondered who safeguard employees in India and ensure that workplaces are fair and just for everyone? Let's decode the key legislation shaping employment and employee welfare in India. At its core, we have employment and employee welfare legislation, which ensures that workers' rights are respected and promoted across the country. So it start with the equal employment opportunity. So Article 16 subsection 1 of the Indian Constitution guarantees equal employment opportunity. And then we have Employment Exchange Act 1959, making it mandatory for employee to notify job vacancy to Employment Exchange. Then we have Apprentice Act in 1961, promoting skill building and training program directly linked to future employment. So this ensures that job seekers are not just waiting but are being equipped and notified about opportunity. Then we have protective law for vulnerable worker. The system also safeguards the most vulnerable segment of our workforce, the Child Labor Act 1986. It protects children from being exploited at work. It protects children. Then we have Bonded Labor System Act 1976. So it abolishes bonded labor, ensuring no worker is forced to work under debt or coercion. And then we have Interstate Migrant Workmen Act. So it protects migrant workers who travel from far home in search of livelihood, right? So Child Labor Act, Bonded Labor System Act, and Interstate Migrant Workmen Act. Then we have government role in social welfare. The government plays a key role by framing welfare initiative under the directive principle of state policy. You know about DPSP. So there is something called directive principle of state policy, and enacting laws and aimed at preventing the exploitation of worker, and finally nurturing a positive organization perception of labor welfare. So these laws work together, create a safety net for workers across India, right? Now friends, let's shift our focus to the HRM approach. This is the last slide, right? This is the last slide which we will go through, right? So friends, let's talk about HRM approach. So friends, in today's fast changing world, human resource management is no longer just about hiring and firing. So HRM proactive approach. First thing you must note it down, that it is called proactive approach, which means a modern HRM is no longer reactive. It is futuristic and strategic. HR leader now align people management with business goal. So what they do, they align people management with what? With business goal, right? Creating synergy between human capital and organization success. So this HR, they function on employee welfare and growth. And here is the exciting part. Today HR professionals are ready to face challenge dynamically. Whether it is remote work, digital transformation, emerging workforce trend, HRM is constantly evolving. And let's rewind to 1980s. 1980s, the birth of formal HRD. HRD was formed, right? And while the Western world was shaping HRD as a concept, Indian academicians were developing their own HRD model. So two names stand out. You must have heard about Uday Parikh and T.V. Rao, right? So they pioneers who helped shape HRD in India. They did not just adopt Western idea, they customized HRD to India's unique business landscape, developing integrated system that blended beautifully with traditional HRM practice. And Indian government also played a vital role by encouraging employee participation in decision making and even promoting worker shareholding to deepen employee engagement. As India's economy grew and high-tech industry emerged, there was a massive surge in demand for a skilled professional. So our modern day knowledge worker, Today, HRD stands as a structured subsystem of HRM, right? Focusing on employee development, engagement, creative empowering for workforce attitude. So from being reactive to become proactive and dynamic, HRM and HRD in India have come a long way. Topic is Indian bank merger and privatization, and all the data have been condensed into one peak. I will try to cover everything that is given in your book in 2 to 3 pages in just one peak, right? This is the ultra condensed form of the notes. So let's get started. Welcome to this insightful session on the evolution of Indian bank merger and privatization. In the last few decades, India's banking sector has undergone significant transformation. So this is the entire peak in one, you can see snapshot of the peak. So friends, with the strategic merger, privatization, shaping the financial landscape. So the first thing is, as SBI Associate Bank merger, right? So SBI Associate Bank merger, one of the biggest consolidation in the India's banking history was that 5 associate banks merged with SBI, creating a financial powerhouse capable of competing on a global scale. Then we have Bank of Baroda merger, right? So the merger of Vijaya Bank and Dena Bank into Bank of Baroda aimed to create a stronger, more resilient financial institution. Then we have 2019 mega merger of public sector. So you can see that this landmark decision saw multiple public sector banks consolidated to create a stronger, more competitive entity. In December examination, question based on this was asked in the form of case study. So you must know which bank was merged with which bank and what it led to the creation of. Try to understand. First of all, Oriental Bank of Commerce merged with UBI, right? Then it comes from PNB, Punjab National Bank. Then Andhra Bank plus Corporation Bank, Union Bank of India. Syndicate Bank, right, merged into Canara Bank, and Allahabad Bank merged into Indian Bank. So these mergers were driven by the needs for financial stability and operational efficiency in an evolving economic landscape. If you look at the vision for Global India Bank, so you can see in the next part. So since 1990, India has been striving to create globally competitive bank that can stand fall on the international stage. So that is the point for vision for Global India Bank, right? So these merger align with that vision, ensuring Indian banks are equipped to handle global financial challenge. And now if we move toward privatization, so you can see privatization plays a very important role in banking reform. They are aiming to enhance the competitiveness, right? Reduce the government budgetary burden, improve overall performance. And then we have Narsimhan committee proposal. So basically a key recommendation in the India's banking reform, right? This was a key recommendation in the India's banking reform. This was a committee that suggested merging weaker banks to protect customer interest and build financially robust institution, right? So what was the rationale behind the merger? So the core reason driving this merger was the financial stability. This was the core reason. The first reason was financial stability. So basically strengthening balance sheet and capital basis. Second reason was was the efficiency, right? So optimizing resources and reducing redundancy. So with these strategic steps, India is building a stronger, more competitive banking sector that can efficiently serve its customer and boost economic growth. So what are your thoughts on this merger? Do you think that privatization will fully strengthen Indian bank? So basically this was a Narsimhan committee proposal, and based on it the same question was asked, that they suggested merger of bank to eliminate weaker bank, and it aimed at protecting customer interest. In December examination, this Narsimhan committee proposal was asked, right? And the rationale behind merger is to financial stability and increasing the efficiency. That is all you need to know about it. The next slide, let's move to the next slide. And friends, every successful organization rely on efficient HRM, which is built on 3 essential subsystems. So let's look at what are the 3 essential subsystems of HRM. The first is called administrative. Second is called developmental, right, which is the focus of this unit, and the third is called maintenance. So administrative means handling policies. So whenever I say administrative, it means handling policies, it means handling procedures, right, and or it means handling compliance, policies, procedures and compliance under administrative. If you look at the developmental, it means focusing on employee growth, right? A developmental focus on employee growth. This is an important aspect of HRM. And growth as well as training, employee growth as well as training. This is the focus of this particular unit. And the last is maintenance, which means ensuring a positive work environment. That means work environment should be positive. So these are the 3 HRM subsystem, right? So basically if you look at the developmental subsystem, basically that is our main focus here. So at the heart of HRM like work, right, the driving force behind individual growth and organization success. So basically job analysis plays a pivotal role. Question is why is job analysis so crucial? Let's break it down. The first reason, it provides you deep insight into the job roles and expectations. It helps you identify key activities and the most suitable candidate for each role. And the last but not the least, it lays the foundation for a strategic HR function like recruitment, training, and performance evaluation. So if you talk about the significance in HRM, that effective job analysis ensure that workforce efficiency, right? It ensures workforce efficiency and also organization success. And finally, a structured approach to HR strategy make role analysis a key pillar of HR management. So in short, we can say understanding HR subsystem and the role of job analysis can transform your workforce into well-oiled machine driving productivity and business growth, right? So now let's look at the next topic that we have, that is mastering job analysis framework, which is a key to effective HR management. So every job in an organization has unique demand, and to ensure the right people are placed in the right role, we rely on three critical components of job analysis. The first is called job specification. So this defines the qualification needed for a job, which means a knowledge, means theoretical and practical understanding of the role. Skills, which means technical and soft skill required to perform tasks efficiently. Abilities, means innate capabilities and competencies. Educations and work experience, means academic background and professional expertise. And finally managerial experience, means leadership and decision making skill for senior roles. Second thing, we have job description, which means this outline what the job entails, what the job includes. Why? Right, it includes job title, means a clear designation, job purpose, the core reason this job exists, duties and responsibility, means the key task and expectation, and finally the working condition. So you must know what are the things included under description. Specification, question may be asked that tell me knowledge exists under what. So you should know knowledge is a part of a specification. Working condition is a part of what, you should know it is a part of description. Job title is a part of description. Title, purpose, responsibilities, condition. So everything tells you that what the job consists of. And job specification is all about that the qualification needed for a job. What are the knowledge, what are the skill, what are the abilities which are needed for the job. And finally we have the job evaluation, which means here we assess the value of a job in the organization by looking at the job activities, which means that the main function performed in that job, relative importance, which means how crucial the rules is compared to the other. Qualifications means required certifications, training or license. Or finally the working condition, which means physical and mental demand of the role. So basically a well structured job analysis framework ensure better recruitment, better performance management and workforce planning, leading to organization success. So this is all about this job analysis, which is presented in just one peek. It will help you revise the concept in very short time just before the examination, right? Now let's look at the concept of learning, training and development. So friends, in today's fast-paced world, staying relevant require a deep understanding of these concepts. First of all, learning, you must know it, all these things. Basically learning is all about gaining knowledge, developing a skill and shaping attitude to enhance understanding, right? So whether it is formal education or experiential learning, experimental learning, this process is ongoing and crucial for success. The first aspect is the knowledge, which means expanding intellectual horizon. Second aspect is the skills. What is the meaning of skills? Which means practical application of learning. And finally we have attitude. Attitude means shaping perspective and behaviors. So skills, knowledge and attitude. Again I am repeating, knowledge means expanding your intellectual horizon, skills means practical application of learning, and attitude means shaping perspective and behavior, right? So practical application, whatever you have learned, whether you are practically able to apply it or not, that is the skill. Knowledge means just intellectual horizon expanding, and attitude it very well. Second part we have is called training. What is training? So training is job specific and focus on enhancing the current performance. So if you are enhancing the current performance, right, that is called training. So and you are preparing for the future role. It is a structured, it is structured and help professionals stay sharp in their field. What is the purpose? The purpose is to improve current job performance, current role performance, and to prepare for future job transition. The third is called development. What is development? Unlike training, development is continuous and voluntary process. You see, voluntary and continuous process, right? Because it involves deepening and broadening knowledge to prepare for bigger opportunity ahead. So core benefit is that it focuses on future career progression and also encourage continuous learning and adaptation. So this is learning, training, development, and the final thing we have is called education. You must know the difference between all these things. So education is broader than training and development. It fosters intellectual and professional growth. By providing a strong theoretical foundation. So intellectual growth means expanding thinking capability. Professional growth means strengthening expertise for career success. So a well balanced approach to learning, training, development, education, it ensures that, it ensures sustained career growth and success. So that is the concept of learning, training, development and education. I hope that makes sense to you, right? So friends, now let's look at the 4 level of training, training evaluation. So what are the 4 level of training evaluation? So that is we called Kirkpatrick model of training evaluation, right? So first of all, training is not just about teaching, it's about ensuring learning translate to performance and organization success. So if we talk about the training, training is not about teaching. It simply means that learning, that means learning whatever you learn, that translate to performance, and organization success. So that is the meaning of training. So there are different levels of training evaluation, right? So the first level we have is called level number 1, that is called reaction, that is called trainee perception. We can also call it trainee perception or reaction. So training starts with the first impression. How do trainee feel about their training? Was it engaging, relevant and useful? So here are some key focus area: the content, right? The training method, the training effectiveness, the training relevance and enjoyment. So why it matters? Because a positive perception encourages active participation and engagement. This is called reaction. There are 4 levels, and the first level of training is called reaction. Second level is called learning, which means knowledge and skill gain. So this level, it measures actual learning. What did the trainee absorb? Did they gain new knowledge, skill or attitude? So how it is measured? There is something called pre and post training assessment. So there is something called pre-training assessment and there is something called post-training assessment. So because there is something called practical test and quizzes which is conducted. So why it matters? Because if learning does not happen, training effort are wasted. This step ensure growth in expertise. So the second level we have is called learning. First level was reaction, second level was learning, third level is called behavior. Behavior means what? That is called application at work. So training is successful only if it is applied in real world situation, right? Training is successful only if it is applied in real world situation, right? So this level check whether employee use their new skill at work. How it is measured? How this behavior is measured? So it is measured observing the behavioral change, means how behavior is getting changed. Feedback from supervisor and colleague. You take feedback from supervisor, you take feedback from colleague. So because knowledge is one thing, but applying is where the true value is created. That is called behavior. Means whatever you have learned, whether you are applying that at work or not, that is called behavior, right? So knowledge is one thing, but applying is where true value is created. And the final level we have is called functioning, which is called the organizational impact. Basically, this is the ultimate goal. The ultimate goal is to measure how training impact business result, right? So how it is measured? We see the workplace productivity, we see the reduced error and increased efficiency, we see the improved customer satisfaction. So a training program is truly successful only when it improves the business performance, right? So this Kirkpatrick model ensures that training is not just an event but a transformation. What is your experience with the workforce training? Have you seen any impact? So friends, this way you can see this is the impact of our crash course program, that you are able to understand all these 4 levels in the simplest way possible. Level 1, again I am repeating, reaction, learning, behavior and functioning, right? Now let's shift our focus and look at that attitude. Attitude is the core of behavior, right? So attitude is the persistent tendency to feel and behave in a particular way. So you can see it is a persistent tendency to feel and behave in a particular way. It influences how we react to the situation, people and challenges. But the question is, what form the attitude? Let's dive into the 3 components. The first is called emotional component. So it means the power of feeling. This is how you feel toward an object, person or situation, right? How do you feel toward an object? How do you feel toward a situation, right? It can be positive, it can be negative or it can be neutral. So imagine working in a team. Your emotional response to your colleague affect productivity and collaboration. The second part is called informational component, which we call the knowledge is the key. So knowledge shapes perception. The more accurate and informed your belief, the stronger and more rational your attitude become. For example, if you believe in the benefits of a regular exercise, you are more likely to develop a positive attitude toward fitness, right? That is called the information component. Again I am repeating, emotional component means how you feel toward an object, person and situation. It can be positive, negative or it can be directly impact organization behavior. Second topic I talked about the information component, which means the component what you know and believe about an object or situation, right? So knowledge shapes perception. So if you believe the benefit of exercise, So the more likely you to develop a positive attitude toward fitness. So the last thing we have is the characteristics. So basically, attitude is not just momentary. They have a stability. The future of attitude define how strong, how consistent, how resistant to this change it is. So deep rooted attitude. So there is something called deep rooted attitude. So the deep rooted attitude last longer and influence major life decision, and surface level attitude may change quickly with new experience. So your attitude is your greatest asset. It determines how you approach challenges, interact with people, and seize opportunity. So the question is, what kind of attitude do you want to build? Please answer. Whether it is emotional component, which component is heavy in your attitude? That's the point. Now let's look at the function of attitude at work. So friends, ever wondered why attitude matter in the workplace? Well, they do much more than just shaping behavior. They serve key function that like driving the success, collaboration, and discipline. Let's explore them. So first of all, the topic is significance of attitude. So friends, if we talk about attitude, is not just an individual trial. It's a workplace game changer. It affects how employees interact, respond to challenges, and contribute to the organization culture. So there are 4 key functions of it, right? So attitude at work, let's break them one by one. So friends, if you are looking for any such kind of content where you can cover the videos, where we can cover the entire CIB content in very few hours, because time constraint everyone that face, and this crash course does the same. It saves your time. It provides you only that content that matters from your examination, nothing extra that have been asked in the last 3 to 4 years. I will provide that only content. Not only that, I will provide you quizzes for practice. I will provide you PDF for last minute revision purpose. All these things at just an affordable cost of rupees 800 only for all the 5 subjects. To get more detail regarding this crash course, you can WhatsApp me on this particular number. So friends, now let's shift our focus to our what we were discussing. The first function is called adjustment function. So this function help employee adapt to their workplace environment. Right? Adjustment means what? It help employee adjust to their workplace environment. Right? So positive treatment from management leads to higher motivation, higher engagement. Right? And when employees receive recognition and support, they develop a positive attitude toward the organization. Result, a happier, more productive workforce. Second is called ego defensive function, which means protecting self-image. That we all want to protect our self-esteem, right? But that is what this function does. It helps individuals justify their action and defend their self-worth. However, it can sometimes lead to negative attitude toward younger employee, creating workplace barrier instead of collaboration. So the moral of the story is that a healthy workplace mindset builds teamwork. The third function is called value expression function, which means living organization value. So this function helps in expressing deeply held value and reinforcing company culture. How? Because by enforcing a strict discipline, right? Means organization ensure professionalism and efficiency. It also reinforces organization value, making them a part of the daily life. That is called reinforcing the organization value. Organization thrive when employee align with the core value. And the last but not the least, we have the knowledge function, which means understanding the workplace. Ever wondered why people behave the way they do? This function supplies standards and reference points that help employee organize information and understand the world around them. Simply put, attitude helps us make sense of our work environment. So friends, the way you think, the way you feel, the way you behave at work impact your success, relationship, and growth. So the question is, what attitude will you bring to work tomorrow? Right? So that is the point. Now let's shift our focus to our next point that we have. Right? So let's see the next concept that we have is the Erik Erikson 4 stages of adulthood. Right? So friends, ever wondered why do we evolve emotionally and mentally as we age? Well, our journey through adulthood is not just about growing older. It's about shaping our identity, relationship, legacy, and self-reflection. So let's explore each and every stage of adulthood and how it impacts our career. So there are the 4 stages, and this was given by the Erik Erikson. Let's go through each and every stage. This is super important. So the first stage is called adolescence, which means ego identity formation. This means ego identity formation. It means who am I? So the foundation of adulthood begins right here. At this stage, individuals struggle with the self-identity, right? They struggle with the self-identity, right? So it means they reconcile their inner self-perception with how the world sees them, right? This is called self-identity. So why this is important? Because it shapes confidence, decision making, power, personal direction. Think back. Was there a time where you questioned who you are and where you belong? So that's a part of the stage. Sometimes you feel lonely and you feel that who am I, right? Where I do belong. That is called the adolescence stage. Second is called the young adulthood stage, which means relationship development, building bonds. As we step into adulthood, the focus shifts from self-identity to forming deep relationship, both personal and professional. This stage is all about trust, love, and meaningful connection. Success in this phase leads to a strong, lasting bond, while challenges can result in isolation and loneliness. The lesson is that the key to happiness is not just a career, it's the people we share our journey with. The third is called adulthood, which means guiding the next generation, leaving a legacy. As we move further in life, our focus shifts from personal growth to mentoring and guiding others. And the key aspect at this stage is sharing knowledge, right? Sharing wisdom, helping the next generation navigate challenges, contributing to the world in a meaningful way. Ever felt a sense of satisfaction from mentoring someone? That is this stage at work. True success is not just about what we achieve, it's about what we pass on. That is called adulthood stage. The next is called maturity stage. This is called ego integrity and reflection. That means finding the meaning, right? So this stage is all about looking back at life's journey and evaluating its purpose and fulfillment. Did we make the right choices? Have we found meaning in our career and relationship? So this phase determines our inner peace. Those who have lived with purpose and passion feel content, while others may struggle with regret. So lesson is that start making meaningful choices today so that you can look back with pride tomorrow. Then the final thing we have is a Levinson career transition theory. We will cover it in the next slide. So friends, I hope every stage of adulthood build upon the last, shaping who we are, who we become, embrace the journey, learn from the experience, and make every phase count. That is all our Eric Erikson 4 stages. I hope this explanation help you remember the concept ever long lasting. You will never forget it. Right. Now, the Dalton, Thompson and Price model have been simplified in a single diagram. If you go through the book, it will cover in one pages. And you don't know what to skip, what to cover. But I provide you with certain guidance. I provide you with a kind of that guarantee that if you go through this particular slide, nothing will be left out regarding this Dalton, Thompson and Price model. So friends, ever wondered why some people progress faster in their career while others struggle? It all comes down to the role we play at different stages of our professional life. According to the Dalton, Thompson and Price, there are 4 key career roles that define our growth. The first is called apprentice. Apprentice means learning and dependence. So everyone starts as an apprentice. The learning phase where we perform routine tasks under the supervision of mentor, right? So we rely heavily on our mentor for guidance. Our focus is on grasping the basics and building foundation session. The lesson is that never rush this stage. The stronger your foundation, the higher you will rise. The second stage is called the colleague, which means independence and contribution, which means stepping up. Once we gain confidence, we transition into the colleague role. Here we start making independent contribution while still operating in subordinate role. So the key aspect of this stage is that you start handling tasks without constant supervision, right? And you gain recognition for your contribution. Ever felt the satisfaction of completing a project on your own? That is the transition to this phase. The third phase is called mentoring. So as experience build up, we step into leadership and responsibility. This is the mentor stage where we manage teams and handle complex functions. So what changes in this role? You guide others, you just as someone guided you. You take on more strategic decision making responsibility. The lesson is that a true leader lifts others up. Your growth is not just about you, it's about helping others succeed. And the last stage is called a sponsor. A sponsor means a strategic leadership and influence. This is called the visionary role, right? This is called visionary role. So friends, at the peak of the career development, we reach the sponsor role. This is where true leaders shape the future of organization. You provide a strategic direction, you mentor future industry leader, you focus on long-term impact. Think about great leader. What set them apart? Their ability to inspire, influence and create lasting change. So friends, we all start as apprentice, but growth depends on how well we navigate each stage. The key to success: keep learning, take on responsibility and mentor others along the way. So which stage are you at in your career presently? Let me know in the comment, whether it is apprentice, colleague, mentor or sponsor, right? Please let me know which stage are you in currently, because this will help you check me whether you have understood this concept clearly or not, right? Please let me know in the comment. So every aspect we are covering in this crash course, nothing is left out. If you cover all this content smoothly, you will be able to grasp at least 50 marks is secured for you, right? So now friends, we are diving into a topic that shapes the corporate world, drive decision making and determine success. Ever wondered why some leaders inspire and others intimidate? Why do some managers earn respect while others rely on authority? The answer lies in different types of power they hold. Let's talk about the first is called reflected power. Some kinds of leaders don't rise by their own merits but because of their networks. This is the reflected power, right? It comes from connection and favoritism, so often seen in organization where matters more than what you know. Lesson is that networking is the key, but relying solely on connection won't build long-term credibility. Second is called charismatic power. So some leaders that does not need authority, they captivate and inspire. That is charismatic power. It is built on emotional appeal, extraordinary characteristics. So if you want to develop this, work on your confidence, storytelling, and personal magnetism. The third is called legitimate power. Ever followed orders just because someone is the boss? That is legitimate power. Come from job title, come from hierarchy, right? It is a formal authority, CEO, manager, team builder, right? But here is the catch: position alone won't earn respect. It must be backed by leadership skill. The fourth is called the reward power. Reward power is called the power of incentive, which who does not love promotion, bonuses, perks? That is the reward power. Leader who control reward and benefit hold this power. It is an effective motivator. Employees work harder when they say incentive. But beware, over reliance on reward can make motivation short term and transactional. Then we have something called knowledge power, which knowledge is the power. Literally, leaders who know their field inside out hold knowledge power. It comes from education, it comes from experience, right? So expert command respect because they offer valuable insight. Then we have something called emotional power. The next power we have is called the emotional power. So ever worked with a leader who makes you feel valued and understood? Have you ever worked with a leader who make you feel valued and understood? Right. So that is that is the emotional power. It is built on trust, empathy, relationship. Leader who connect emotionally create loyal and motivated team. Right. And then we have the expert power, the power of mastery. So it is different from knowledge power. Expert power come from deep specialization. So it come from deep specialization. So it is ability to solve problem other can't. Think of industry pioneers. Their expertise give them the authority. The lesson is that become so skilled that people seek your advice. Then we have the referent power. So some leader don't lead a title or reward. They command influence through respect and admiration. So it comes from a strong ethics, authenticity and character. People choose to follow them because they inspire trust. Want this power? Be genuine, be ethical and always lead by example. And last but not the least, we have the coercive power. Let me show you. We have the coercive power. So coercive power, some leaders use threat and punishment to enforce authority. This is the coercive power. It's all about control through fear and consequences. While it may get short-term results, it damages long-term morale. So great leaders don't rely on just one type of power. They balance influence, expertise, reward and respect to create a positive and high-performance environment. So that is all we have to know about this. In the next slide, let's look at the child ego stage. So friends, ever wondered why some people act playful in serious meeting or why some individuals seek constant approval? It all boils down to the ego states. So that is what we are going to discuss. Ego states, right? So and understanding them can revolutionize how we communicate, especially in the workplace. So the first question is, what is this child ego stage? The child ego stage is one of the 3 ego stages in transactional analysis, right? And the psychological framework that explain how we interact with others. It is driven by emotions, creativity, instinct. Right. So the first thing is called the adapted child. Right. The first thing is called the adapted child. Adapted child means what? The approval seeker. Which means some individual are rule follower. Some individual are there who are just a rule follower. Right. So they seek approval and comply with societal norms to fit in and avoid conflict. Some individual are just rule follower. For example, a team member who always agree with the boss even when they have a different opinion, right? Some individual are there, a team member who always agree with the boss even when they have a different opinion. The impact is that this can be helpful in maintaining harmony, but too much compliance may lead to lack of innovation. So a lesson is that a balance between compliance and independent thinking is the key, right? So this is called adapted child, the approval seeker. Second is called the natural child, who has the free spirit, which means ever meet someone who radiate pure joy and spontaneity? That is the natural child. That is called the ego state, right? This is called ego state. So basically they embrace creativity, curiosity and fun. They don't care about rules. They just express themselves freely. For example, the employee who bring energy to the workplace, cracking jokes in meeting, keeping things light-hearted. So impact is that while spontaneity foster innovation, it may needs to be channeled appropriately in professional setting. So let creativity flow, but be mindful of the content. And the next we have is the little professor, which means the creative thinker. So little professor is a mix of playfulness and intelligence. This child is not just curious but also a problem solver. They experiment, question and innovate. They look at problem differently and come up with unique solution. For example, a team member who finds unconventional solution to challenges, thinking out of the box. So this is the powerful asset in business, as creative problem solving leads to breakthrough. And then now let's shift our focus to the next topic we have. Let's move on to the transaction analysis. Now that we know the child ego state, let's connect it to transaction analysis, which is called TA. There are two types of transaction. The first is called complementary transaction. So basically, when communicate flow as smoothly, it's complementary transaction. It leads to clear understanding. It leads to productive discussion. Right? Example: a manager giving constructive feedback and the employee respond positively, resulting in growth and learning. The second part is called the cross transaction. This is the root of miscommunication. Miscommunication happen because of the cross transaction. So it happens when a response does not match expectation. For example, a boss give the feedback. Suppose the boss is there. Just wait a minute. Suppose boss is there. He give the feedback, but the employee start reacting defensively from a child ego state, leading to a communication breakdown. So if not managed well, conflict arise, affecting morale and teamwork. So understanding child ego state and transaction analysis help us to communicate more effectively. So I hope that makes sense to you. Effective communication happens in the case of complementary transaction. Cross transaction causes communication breakdown. Now let's shift our focus to our next topic. So friends, have you ever wondered why some people are incredibly self-aware while others struggle with feedback, or why personal growth seems effortless for some but challenging for others? So first of all, let's talk about the self-awareness. What is self-awareness? So self-awareness is the foundation of personal and professional success. It helps us understand strength and weakness. It allows us to improve relationship and decision making. So there is something called SWOT analysis, that is called strength, weakness, opportunity, threat. So as a strength for strength. A strength means what you are naturally good at. W means weakness, means where do you need improvement. Opportunity means what changes can you seize for growth. And threat means what obstacle might hold you back. For example, a professional might have a strong communication skill, that is a strength, but struggle with time management, that is the weakness. Right? So the self-reflection help you capitalize on your strength and work on your weak area. Second thing is Johari window mode, very very important. Right? Developed by Luft and Ingham, 1973, the Johari window reveals different aspects of your personality. The first is called arena. Arena means open self, known to you, known to both you and other. It builds transparency and trust. Second is called the blind spot, which means blind spot means they are known to other but not known to you, that you need feedback to improve. The third is called hidden or private self, which is known to you but not unknown to other. It requires self disclosure. And the finally we have the dark, which is called unknown self, unknown to both you and the other. This is your potential for discovery. For example, a person may not realize they have a great leadership potential, so that is called blind spot. He did not realize that they have a great leadership potential, right, while other point it out. So seeking feedback unlock hidden strength and improve self-awareness. Now let's look at the expanding the arena. So friends, to truly develop ourselves, we must expand our own open self. This happens through receiving feedback, self-disclosure, just sharing thought and feeling to build connection, and openness to ideas, welcoming new perspective and continuous learning. Right? Accept and constructive criticism with an open mind. For example, a manager who actively listen to feedback and share their own experience create a more transparent and productive workspace. So that is called the expanding the arena. You receive feedback, you go for self-disclosure, you get openness to the ideas. So by combining SWOT analysis, Johari window, and expanding the arena, you can become more self-aware, enhance your talent management dynamic. Imagine an organization as a target where success depends on hitting the bullseye, acquiring, managing, retaining top talent, right? But here is the challenge. The gap between demand and supply of skilled professionals is growing wider day by day. So talent management is no longer just about hiring. It's about strategically developing and keeping the right people to drive business. There are 3 C's. The first C is called competence. Competence means what? The mind that fill ability and expertise. Second is called commitment, means the hand and feet that takes action. And the last is contribution, which means the heart that ensures excellence in executions. Right? So basically, but there is a shift which is happening, that organization loyalty change. So employee expectations are evolving and companies must adapt to retain their best talent. But there is a challenge, right? Talent acquisition and retention have become critical concern for every business. The question is, how do we tackle them? Right? Now let's shift our focus to our next topic, That is what we have, evolution and the key aspect of talent management. Every aspect have been written in this particular slide. Talent management have evolved over the year, shaping how organization attract, develop and retain the top talent. But where did it all begin? So the origin is, the foundation of talent management was laid by McKinsey and Company 1997 and further refined by Chamber et al. 1998. They highlighted the war for talent, a battle that organizations still fight today. This is called the war for talent. So in today's competitive landscape, finding a skilled employee is not enough. Retaining them requires well-structured strategy. Companies that fail to adapt lose their best talent to competitor, right? So there is something called core activity. So there is the backbone of talent management lies in the core activity. First of all, succession planning, which means preparing future leaders. Second is called assessment development, which means assessment and development, which means investing, which means nurturing the potential. And the third is what we call high potential employee management, which means investing in top performer. So success in talent management depends on anticipating workforce need. First of all, you anticipate what will be the workforce needs, right? And then you do the strategic planning, right? You anticipate workforce need, you do some strategic planning, right? And organization must think ahead to ensure long-term success. It is not just about finding the right people, it's about keeping them engaged, motivated and aligned with business goal, right? Now friends, so this is all about how it originated, what is their core activities, what is the meaning of war for talent, and what should be the key focus. Now let's look at the strategic talent management. So friends, in today's fast-paced world, talent management is not just a function, it's a strategic necessity for organization for long-term success. So the key business benefit that they get from talent management is the revenue growth, right? A skilled employee drive profitability, customer satisfaction. So engaged teams delivers better services, quality and productivity. Higher efficiency leads to better output, cost efficiency and capitalization. So retaining talent reduces hiring cost. And if we talk about the purpose and importance, so why does it matter? Because talent management is not just about hiring, it's also about aligning talent with strategy and leveraging HR planning as a science to build sustainable business growth. So if we talk about the core of talent management, so defining talent need, why do we need talent need? What understanding the key success factor, understanding overcoming the real challenges and ensuring the employee retention. There are three pillars of talent management. The first is called acquiring talent, which means finding the right fit for the right role. Second is called developing talent, which means enhancing skill for future growth. And the last is retaining talent, which means keeping top performer engaged and motivated. So conclusion is that talent management is not just about people, it's about business success, it's about competitive advantage, it's about the long-term growth. So the question is your organization prepared to harness its full potential? Now let's look at the last topic of today's session, that is the talent management paradox and key element. So talent management is the backbone of every successful organization, but here is the catch, it is facing a paradox. See, the talent supply and demand paradox. What it means? On one hand, the supply of skilled talent is decreasing, while on the other hand, the demand for top professionals is skyrocketing. So this creates a major challenge for business worldwide. So how do organizations tackle this? So there is something called retention. So there are 5 key elements of, so basically there is something called retention strategies, which means keeping top performer engaged in no longer is choice, it is a necessity. Second point is the sustainable growth. Means business must create long-term strategy to balance demand with the available talent. But that is not all. Effective talent management requires a strong foundation that is built on these 5 key elements. First of all, attracting the right talent, which means the battle of top talent is fierce. Company must position themselves as a desirable employer. Second is called onboarding, which means a seamless integration process ensure new hires feel valued and engaged from day number 1. Third is called creating a talent pool, means organization must proactively build a pipeline of skilled professional for future need. The fourth is called designing career path, means employees stay where they see growth. A structured career planning is the key. And the fifth step is called retaining talent, which means retention is not about perks alone, it's about culture, leadership, opportunity. So remember these 5 key elements of talent management. This can be asked: attracting the right talent, onboarding, creating a talent pool, designing career path and retaining talent. So the talent wall is real. So question may be asked that which one of the following is not a key element of talent management? You should know the 5 key elements, right? How many elements are there? 5 elements are there. What are they? Just on your screen. So the talent war is real. Companies that master these elements, that attracting, onboarding, talent pool, designing career path, retaining talent. So companies that master these elements will thrive, innovate and stay ahead of the curve. So friend, that's all for this particular topic. Nothing to read extra. If you cover this much, that is enough. Somewhere question have been asked previously is being presented in the pictorial format in the form of flowchart. So let's get started with our first topic, that is based on personality. So have you ever wondered what truly shape our personality? It is just our thought and feeling or something deeper. So today let's unlock the mystery of personality and its fascinating theory. So according to the Salvatore Maddi, so you can see in this picture we are talking everything about personality. So according to Salvatore Maddi, he says that personality is built on a stable trait. It is built on a stable trait, right? It is built on a patterns of thought and feelings and actions that remain consistent over the time. So it is based on patterns of thoughts, feelings, action that remain consistent over the time. So while we all share certain commonality, what makes us unique is those traits, how those traits endure despite external pressure, right? So what I'm telling you, that while we all share certain commonalities are there with all, but what makes us unique is how these traits endure despite external pressure, right? So that is the definition by Salvatore Maddi. Now friends, but here is something interesting. Personality does not change overnight, right? It evolves gradually. You can see it evolves gradually. It is influenced by our values, our experience, our emotion. So this slow transformation shape who we become little by little. If you look at the practical insight, so just now I have told you that something interesting, that personality does not change overnight. It evolves gradually, influenced by our values, experience, emotions, right? And if you look at the practical insight of it, here you can see basically, and why does this matter? Because in the professional world, understanding personality is a game changer. Managers use this dimension to predict the behavior. Right? Forecast action and make better decision. So mastering the concept can give you an edge in leadership and self-growth. If you want to explore more about how personality influences success, stay tuned for the next slide, right? And let's move to the next slide that we have. So we know the personality. Now let's move to the theories explaining personality. Very, very important thing. So friends, have you ever wondered what makes you? Yes, is it your habit, is it your emotion, or is it something deeper? So today we will explore the fascinating world of personality and the theory that explain it. Everything has been presented in the form of this particular flow diagram, which help you recall the concept easily during the time of examination. And that is what we do in our crash course. For each and every unit, I have prepared PDF in such format so that you can easily retain it for the longer time. So friends, the question is, psychologists have long tried to decode personality, and two major theories stands out. First, we have something called, Raymond Cattell's trait theory, right? And it tells us that personality is a pattern of permanent trait. So the key word here is permanent. Traits are permanent, right? But these traits are like building blocks. That shape our behavior, making us who we are. But personality is not just about traits, right? Async theory of personality takes a different approach. He identified two primary dimensions. What are the two primary dimensions he identified? So he identified something called extraversion. You see, extraversion and neuroticism. What it means, try to understand. Extraversion means how outgoing, how reserved we are, right? How outgoing or how reserved we are. That is called extraversion, right? And neuroticism means what? How emotionally stable or anxious we tend to be, right? How emotionally anxious or anxious or stable we tend to be. And then come the classic debate, right? Type A and type B personality profile. So type A are restless and type A are impatient. They always chasing quick achievement, right? So they always chase quick achievement. So their perfectionist tendency push them to excel, but can also bring stress. But if you talk about the type B, they are on the other hand relaxed, easygoing, less concerned with time pressure. They take life at a steady pace, often leaning toward a more philosophical outlook. So understanding personality is not just theory, it is a tool. Whether you are a student, leader, entrepreneur, knowing this personality trait can help you work better with others, improve decision making, and even boost your personal growth. So for examination point of view, also remember this thing can be asked. And friends, if you want such kind of PDF for each and every subjects, proper explanation like this, you can enroll in our crash course. In crash course, first of all, we provide you videos through which you can understand the key points. After just attempting, going through the videos, you go to solve mock test, you go to solve the quizzes, right? You see whether you are able to attain at least 60% marks or not. If not, then you again read the theory and again attempt the quiz. This way we we do self-assessment on daily basis and we improve on daily basis. That is the main motive of crash course. We only covering only those things that matters to us. For more detail regarding this crash course, feel free to WhatsApp me on this particular number. In the description of this video you will see the link also. Now friends, let's move forward to the next concept that we have. So which personality type do you relate to more, type A or type B? Let me know in the comment. So I think the type A and type B is clear, concept is clear, extraversion neuroticism is clear, and Remel-Cattell's trait theory is also clear. Okay, now friends, let's move to the third page of this slide, third slide of this PDF, and we are discussing, have you ever wondered what truly drives human behavior? Have you ever wondered what drives human behavior? Why do we sometimes act on impulse while at the other time we hold ourselves back? The answer lies in psychoanalytical theory, and this is a very fascinating concept that not only explain human personality but also shape workplace dynamics. So friends, imagine your mind as a key ring where different keys represent different forces controlling your action. Let's unlock them one by one. First of all, we have ID. Alright, ID means what? The most primary force. This is the most primal force. We call it, we call it the most primal force. Right? So it is all about instant gratification. It's all about the pleasure. Think of a child who want candy now. Think of a child who want candy now. That is ID. Then comes ego. This is the mediator between the desire and the reality. Right? It's like, let me zoom a little bit so that the picture, the slide, the font is clear to you. Okay. I hope it is clear now. So if we talk about the ego, basically it's kind of mediator between the ID and reality. It ensures that we act in a socially acceptable way. Right, so the key point you must know, socially acceptable behavior. Like when you want to yell at your boss but choose to remain calm. Sometimes you want to yell at your boss, right, but you choose to remain calm. That is your ego. Then comes super ego. Super ego means your inner moral compass. It guides you to do the right thing even when no one is watching. That is called super ego. But here is a real challenge. Balancing these forces. If the ID overpower, we become reckless. If the superego dominate, we may suppress our need too much, and that is where interrelation comes in. That is where this interrelation comes in. Basically, maintaining equilibrium for a stable personality. We should maintain equilibrium between our ID, ego, and superego. But why does this matter at work? Because psychoanalytical theory, right, helps leaders and employees understand workplace behavior. It explains why some people are impulsive decision maker while others are cautious planner. It shed lights on conflict, motivations, and leadership style. And understanding these psychological forces can transform the way organization operate, helping team work more effectively. So what do you think? Which force influences you the most? ID, ego, or superego? Let me know in the comment. Friends, I hope that this concept is clear now. The main concept, if you go through the book, you will see multiples of lines written there, and most of them are not useful from examination point of view. Only thing that matters from examination point of view had been written here. No need to read extra thing. Just remember these things, that who gave this theory, right, and what this theory is all about. Then comes, the next theory we have is called trait theory. Very, very important, right? So friends, have you ever wondered why some people are natural leader while others prefer to stay in the background? Or why some are aggressive while others are calm? Well, the answer lies in the trait theory of personality. So you can think of personality as a key ring, right, where each key represents a trait that shape who we are. First of all, the core concept. Basically, our personality is not random, right? It is shaped by traits that we inherit from birth. Basically, the trait that we inherit from the birth, it shapes our personality. This is the key point, right? So that is why some characteristics seems to run in family. Now friends, let's talk about something called personality explanation. So no two people are exactly the same. No two people are exactly the same. While we all share some common trait, each of us has unique combination that makes us special. Let me give you some example of traits. Like, some people are naturally aggressive. Some people are loyal. Some people, have a great sense of humor, right? And that these traits define how we interact with the world. Now there is something called, behavioral interpretation. What is the meaning of this behavioral interpretation? See, but here is the real impact. Our trait determine how we behave. Whether someone is confident or submissive, outgoing or reserved, it all comes down to their dominant trait. So that is called behavioral interpretation. I am again repeating the point that, our trait determine how we behave, right? So this trait plays a very important role in our behavior. How we behave depends on our trait. Right, so whether someone is confident or submissive, outgoing or reserved, it all comes down to their dominant trait. So understanding trait theory help us, decode behavior at work. in relationship and even in leadership. If we recognize our strength and weakness, we can make conscious choice to improve and grow. So what is one trait that defines you the most? Are you a natural leader? Are you a thinker, or life of the party? Let me know in the comment. And don't forget to stay tuned for more insight on personality psychology. Right, that let's move forward. Now friends, we have another important theory, and let's make it clear, very very important friends. So friends, did you know that your brain has two sides and each side play a completely different role in shaping who you are? Let's dive into how the brain influences personality and behavior. So our brain is divided into left side and right hemisphere, right? Each controlling different aspect of our personality. So first of all, let's look at the left hemisphere. So left hemisphere, is called the logical side. L for left, L for logical. It's called the logical side. It is responsible for speech and verbal function, which means that is why we use it for talking and writing. Second thing, it handles the logical reasoning, which means it is perfect for solving math problem and making rational decision. The third point is sequential processing, means it loves order and step by step thinking. That is called sequential processing. If you go to the right hemisphere, right hemisphere, the creative side, we can call it the creative side in simple word. This one was logical, while the right is called creative side. So basically, it control our spatial ability. What it control? It control spatial ability, which means it help you recognize faces and navigate through places. Right. When I say spatial ability, it helps you recognize faces and it helps you navigate through places. It helps you navigate through places. Right. Second we have is called musical ability, which means if you love music, thank your right brain. It is emotional responses. So which means making you laugh, cry or feel empathy. But that is not all. The brain also plays a huge role in personality through biological influence. There are some biological influence also. So friends, what is the meaning of biological influence? You must have heard about ESB. What is ESB? Electrical stimulation of the brain. So scientists have discovered that stimulating different ideas of the brain can influence emotion, creativity and even reduce stress. Scientists have discovered that stimulating different areas of the brain can influence emotion, creativity and even reduce stress. So there is a psychology which we call split brain psychology. Let me explain that. So you will see here split brain psychology. Basically, split brain psychology is a studies on people with a split brain that reveal how the left and right brain function independently, making it one of the most fascinating discoveries in neuroscience. So friends, understanding how our brain works help us improve communication, decision making, creativity, plus knowing your dominant side can help you unlock your true potential. So are you more of a logical thinker or a creative genius? Let me know in the comment, and don't forget to like the video, because if it really adds values to you, if you think that this concept which I am presenting in this format, it really had value, it will surely help before the examination, revising the important points in a nutshell, and that gives you more time for practice. Our main motive of the crash course is that you should devote at least 80% of your time to MCQs practice and quizzes practice, and 20% to just theory. And this theory portion is taken care of by this kind of slides. Right, now let's look at the next part that we have. So the next table, which is taken from your Macmillan book, let's understand it, very very important. Question is, have you ever wondered why some people thrive in hand-on job while others excel in problem solving or social work? Well, it's all about matching personality with the right job. Let's explore. So this is called Holland typology of personality, right? And find out where you fit in. So according to the Holland's theory, different personality type are naturally suited for different career. So first of all, let's talk about the realistic. This is called the doers. So basically, they prefer physical activity requiring skill. So they prefer physical activity requiring skill, strength and coordination, right? So personality trait includes shy, persistent, stable, practical and conforming. And the best fit career for this is mechanic, drill press operator, farmer or assembly line worker, right? This is called realistic, means the doers. Shy, genuine, persistent, stable, conforming and practical. Then we have something called investigative type personality, which means the thinker. So we can call them the thinker, right? Basically, they love activities involving thinking, organizing, understanding. So such kind of personality to be analytical, original, curious and independent, right? So best fit career is biologist, economist, mathematician and news reporter. So they are thinker. The third kind of type is, let's move to the next slide. So the third kind of side is called social, which means the helper. So in simple word we can say social means the word helper. Basically, they enjoy helping other, they cooperating, understanding people. So they are sociable, friendly, cooperative, and understanding. And best fit career is social worker, teacher, counselor, clinical, psychologist. Then we have something called conventional. So conventional means what? So basically, if we talk about the conventional, which is the organizer, we can call them in single word, they are organizer. Which means, they enjoy structured rule-based tasks with clarity and order. So that is efficiency, conforming, practical, right, unimaginative, and bank teller, right. So best fit career is accountable, corporate manager. Then we have something called enterprising. Enterprising means the leaders. So in simple word, in one word we can say enterprising means what? Leaders. So basically leaders, leaders, they love verbal communication, they love influencing other to achieve goal, and the personality trait is self-confident, ambitious, energetic, and domineering. And the best fit career is lawyer, real estate agent, public relations specialist, and a small business manager. And then we have something called artistic. Artistic we call the creators. So they thrive in creative, unstructured environment that encourage expression. Personality trait, imaginative, idealistic, emotional, impractical. And the best fit career is painter, musician, writer, interior decorator. So choosing a career that aligns with your strength can make you work exciting and fulfilling. So which type are you? Drop your personality type in the comments. So I have talked you about almost 6 types. So drop which matches your personality. Now friends, let's move to the next slide. And in the next slide, what we are going to discuss, very important thing. Let's discuss it. Friends, workplace safety is not just a necessity, it's a fundamental right. But did you know that India has a strong legal framework to protect women from sexual harassment at the work? Let's break it down in simple and powerful way. The fight for, in this slide, everything will be clear. The fight for women's safety at the workplace has led to a structured legislative framework. First of all, let's talk about the Supreme Court directive. It defines sexual harassment clearly. Supreme Court defines sexual harassment clearly, right? It laid down guidelines for handling incident at workplace. So there is something called POSH Act, and question based on it asked most frequently, right? POSH, POSH Act, which means Prevention of Sexual Harassment Act, full form. So it is passed in Lok Sabha and Rajya Sabha before receiving the presidential assent, right? And the full title is the Sexual Harassment of Women at Workplace, that is called Prevention, Prohibition and Redressal Act 2013. When it was launched, 2013 it was launched, right? Remember the date, question is asked, what is the full form, right? POSH Act. Now the next point is very important, which I am going to talk now. There is section called section 34 IPC. So, and criminal law amendment, right? It strengthened legal provision for workplace safety. Punishment is for 1 to 3 years of imprisonment and fine. You can see punishment of 1 to 3 year imprisonment or fine. So with law in place, workplace must actively enforce them to ensure women feel safe, respected and empowered. So do you think that these laws are enough? Drop your thought in the comment. Now friends, let's move forward and let's look at the next point that we have to discuss, is the scientific management and its critics. So friends, have you ever wondered who engineered the way modern industry work? Meet F.W. Taylor, the father of scientific management. His groundbreaking ideas shaped efficiency and productivity, but not without criticism. Let's dive into. First thing, let's talk about the core principle of the scientific management. What is the core principle? So work should be studied scientifically for maximum efficiency. That is the meaning core principle. Work should be studied scientifically for maximum efficiency. And this efficiency prescription and differential piece rating, very important. Try to understand. Efficiency prescription we talk about, and something called differential piece rate system. Question is asked based on this. What is the meaning of differential piece rate system? See, it pay worker based on output to boost productivity. Means worker adhere to prescription if offered higher pay based on output. Means how much output they deliver, based on that they get payment. That is called differential piece rate system. This is the part and parcel of the scientific management. There is something called rational economic view, right? It focus on economic gains. You can see it focus on economic gains. Worker are motivated primarily by financial incentive. That is the motto of the rational economic view. Now friends, let's talk about the criticism also. Criticism, if we talk about, so remember F.W. Taylor, he is called the father of scientific management, efficiency method, motivation theory, right? Now if you look at the criticism, so first thing is that dehumanizing worker, which means treating them like a machine. Oversimplify human behavior, means it ignores creativity, it ignores emotion, it ignores social needs. That is called simplistic human behavior. And this Ravel hypothesis is most frequently asked question. Whatever we are covering in this slide are super important. Please don't overlook anything. Please don't underestimate the importance of these things, because they will be frequently asked. We have collected it for the last 5 years. We have seen the paper, at least the last 4 paper we have seen the paper. and based on that we are producing such kind of material before you, right? So now let's talk about the Ravel hypothesis. It assumes that workers are naturally inefficient and must be controlled, right? That is called money driven motivation ignores other need. That is called Ravel hypothesis. Means what? It assumes that workers are naturally inefficient and they must be controlled. So why it matter? Because Taylor's idea revolutionized industry, but the critics argue that they reduce worker to mere productivity tools. Is efficiency worth sacrificing human needs? Please let me know. What do you think? Should workplace prioritize efficiency or employee well-being? What do you think? Drop your thought in the comment. And this is all the scientific management is all about. Now let's shift our focus to our next topic that we have. Hertzberg two-factor job theory. So friends, ever wondered why some people love their job while others dreads Monday? The secret lie in Hertzberg two-factor theory, a game changer in workplace motivation. The two-factor theory that shape your workplace. The first factor is called hygiene factor. If you talk about the hygiene factor, it means job dissatisfaction factor. So those won't make you love your job, but their absence can make you hate it, right? So these factors won't let you love your job, but if they're not present, they will make you, they will make you hate the job. The first thing is company policy and supervision. So poor leadership, obviously it is frustrating. Then comes, salary and job security, right? We all need stability. Then we have personal life, working condition. So stress at work means stress at home. Simple. If you have a stress at work, obviously you will have a stress at home. Then next thing we have the interpersonal relation with supervisor. If it is toxic colleague, then means major turnoff will be there. So basically these are the factors which are covered under the hygiene factor. So fixing these issues only prevent dissatisfaction but does not guarantee motivation. If you fix these issues, if you fix stress, if you fix working condition, so this will only prevent dissatisfaction. It will not cause dissatisfaction, but it will not improve motivation. But on the other hand, we have some motivational factor, right? These make work exciting, fulfilling, and worth waking for. The first is recognition and achievement, means everyone love appreciation, right? Then comes advancement and responsibility, which means growth keep us engaged. Then there is the possibility of growth. No progress, no passion. Work itself, which means loving what you do is the ultimate motivator. So these factors drive employee to go above and beyond. So a perfect job is not just about a fat paycheck, it's about growth, recognition, meaningful work. So what is your top motivator at work? Let us know in the comment. So remember the difference. Question is asked, which of the following factor is a motivator factor? Which of the following factor is a hygiene factor? So you must know this factor, right? Friends, now let's shift our focus to the next slide that we have. And here we are talking about the ERG theory, ERG theory. Friends, ever feel stuck in life, unable to move forward? That because our need drive our action, right? And it was given by Clatter Elderford. Our need, they drive our action, right? So that is, let's break down the Clatter Elderford ERG theory, which simplify human motivation in 3 core needs. It simplifies human motivation in 3 core needs. Let's simplify it. First of all, ERG theory is a refined take on Maslow hierarchy. ERG stands for existence need, relatedness needs, and growth needs, right? What is the full form of ERG? E for existence, which means basic survival and security. R for relatedness. Relatedness means what? Relatedness means social relationship. It means social relationship, right? And what is the meaning of existence? So existence, I told you, basic survival. It is called basic survival, right? And security. And what about the growth? What is the meaning of growth? Growth means personal and professional development. But here is the twist. We don't follow these in a strict order. If one need is not met, we shift focus to another. That is where the frustration regression dimension comes in. Let's look at the first dimension. That is called, frustration regression dimension. So, when we struggle to fulfill a higher level need, growth is a higher level need. So when we struggle to fulfill the growth, we fall back to lower level need. What is the lower level need? Like security, like relationship. For example, a person feeling stuck in career growth may start seeking more social connection for fulfillment instead. So why this theory matter? Unlike Maslow rigid pyramid, ERG theory is flexible, ERG theory is realistic. It explains why people may switch priority in different life stages. So what is the driving your motivation? So existence means basic survival, relatedness means desire for social relationship, and the most important is the growth need, right? So that is the ERG theory. So Maslow pyramid is very rigid. We will talk about the Maslow pyramid in upcoming slide. Maslow pyramid is very rigid, but this ERG theory is flexible. Sometimes differentiation is asked, right? ERG theory explains why people may switch priority in the different life stage. So what is driving your motivation right now? Drop a comment below. Is it existence? Is it relatedness? Or is it growth? Please let me know in the comment. Friends, now let's switch our focus to the job design. In a single slide, I have explained everything. That's the beauty of this crash course, right? So friends, ever feel stuck in a monotonous job? The same routine, the same task day after day. Well, what if we told you that job can be redesigned to be more engaging, more challenging, more fulfilling? Let's explore job design strategy that break the cycle of boredom and boost productivity. So friends, first thing we have something called job enlargement. It means expanding job role to diversify skill and make tasks more varied. For example, instead of only handling customer query, an employee may also be involved in sales reporting, right? So employee is also involving in sales reporting. So when I say job enlargement means what? We are expanding our job role, right? And make task more varied. That is called job enlargement. For example, suppose instead of only handling customer query, an employee may also involve in sales reporting. This is called job enlargement. You are assigned another task. Then the second point we have is the job enrichment, which means adding depth to the job by increasing challenges, by increasing creativity to make more employee feel more responsible. Let me give you an example. Suppose giving an employee decision making authority. Suppose you give an employee decision making authority. What will happen? Rather than just executing the task, instead of just executing the task, you give the employee decision making authority. So what happened? Challenge get increased. It enhances the creativity. And third is called job rotation, which means shifting employee between different roles to prevent boredom and increasing flexibility. So for example, suppose there is an accountant. He might rotate between budgeting, auditing, financial analysis to build expertise. So the question is, why do we need to redesign the job? Because it make work more challenging, more creative. It increases responsibility and growth. It enhances job satisfaction. So sometimes question is asked, which of the following is an example of job enlargement? Which of the following is an example of job enrichment? You should know this thing, right? Now friends, let's look at this particular slide. So basically, have you ever felt overwhelmed, confused or frustrated in your job? Sometimes it's not just the workload, but the conflict within the role that make the work stressful. Let's uncover the different types of role set conflict. We are going to see what are the different types of role set conflict and how they impact workplace performance. So there are main 5 types which we must go through. We must understand the difference between them. So why, first of all, there's something called resources inadequacy. When you don't have enough tools, budget or to support your performance, you don't have budget, you don't have tools, you don't have support to perform effectively. Imagine being asked to build a house without bricks. Is it possible? Obviously not. Right. Now, second thing is called role ambiguity. When expectations are unclear, leaving employee uncertain about their responsibility. So lack of role expectation, it leads to uncertainty. Let me give you one example. Suppose, have you ever started a task without knowing what exactly was expected? That is called role ambiguity. Suppose you started a task. You don't know what was expected, what exactly was expected from you. So since you don't know what was expected, so it will cause role ambiguity. You just started the task, you don't know what was expected out of you, and this is called role ambiguity. The third kind we have is called, role expectation conflict. What's the meaning of this role expectation conflict? See, it means that, when different stakeholders having contradictory demand, it creates confusion. So different stakeholders are there, they have contradictory demand. For example, your manager wants speed, right? But your client demand perfection, right? So how do you balance them? This is called role expectation conflict. So whenever I say role expectation conflict, it means what? When different stakeholders have contradictory demand, creating confusion. Your manager wants speed, but your client demand perfection. How can you balance both of them? This is called, role expectation conflict. The fourth thing we have is called role overload. What is the meaning of role overload? This question was asked in the December examination. When excessive work pressure drain an individual time, energy. Work pressure is huge and it drain your time, it drain your energy. That is called role overload. You can think of an employee juggling too many tasks, leading to burnout. And finally, we have something called role erosion. Right after role overload, we have something called role erosion. So basically, when responsibility diminishes, making employee feel undervalued. So sometimes, responsibility decrease, it leads to undervaluation. So suppose if your key tasks are handled to someone else. Suppose you were performing the task of cash handling and the same task is given to some other person. This is called, role erosion. So how motivated would you feel? So basically, unresolved role conflict means lower productivity and job dissatisfaction. And if you address them, more engaged, more efficient and more happy workforce will become. right? I hope each and every role conflict is clear now. What are the different role conflict that we face? So that is the same. Now the last slide we have, let me move to the next slide. Yes, this is Maslow hierarchy theory, very very important. So basically, you know, this is called Maslow hierarchy. There are 5 steps in it. First is called self-actualization, which means a pursuit of personal growth and fulfillment. Second, we have the esteem need, which means recognition, self-respect, development. Then we have social need, which means desire. It means the desire for personal belonging and professional bonds. Then we have safety need, which means job security, protection from harm. And finally, we have the basic need, which means, you know, essential survival and working. So friends, that is all you need to know from this particular chapter. If you go through the book, there are many things given, but from examination point of view, whatever we have covered in this particular video is more than sufficient. Reward system. So friends, let's get started with our first topic, that is the climate survey. Have you ever wondered what truly shapes the work environment in an organization? Is it leadership? Is it teamwork? Or is it policy? The answer lies in combination of multiple factors, and that is exactly what a climate survey uncovers. So first of all, let's talk about the climate survey. So climate survey is more than just a questionnaire, right? If we talk about the climate survey, you know, it is more than just a questionnaire. So it is a powerful tool that help organization measure and improve their workplace culture, right? It is a powerful tool that help organization measure and improve their workplace culture, right? But what exactly does it cover? Let's dive into key focus area. The first thing is cover its support. What is the meaning of support? Basically, a positive work environment starts with a support. This includes how helpful managers are and how well colleagues support one another. A strong support system fosters collaboration and boosts the morale. Second thing is called standards. So every organization thrives on performance goal and quality expectation, right? So employee need clear benchmark to align their effort with the company's success. That is called performance goal. So basically every organization thrives on performance goal and quality expectation. Employee need clear benchmark to align their effort with the company's success. Third thing we have is called structure. So rules and regulations form the backbone of any organization. A well-defined decision-making hierarchy ensure a smooth operation and clarity in responsibility, right? So the structure means, you know, rules and regulation form the backbone of any organization, and a well-defined decision-making hierarchy ensure a smooth operation and clarity in responsibility. Next we have responsibility. So role clarity, accountability, very crucial for a productive workforce. When employees know their role, they perform better, they take ownership of their task. Next is the warmth. Warmth means, you know, a great workplace is not just about policy, it's about what? It's about people, right? So camaraderie and team bonding creates an environment where employees feel valued and motivated. It leads to constructive solution, not workplace conflict, right? So this is called the impact of having a proper conflict resolution. Then we have something called risk. Risk is also a part of this. So what is the meaning of risk? You know, so risk means innovation thrive on calculated risk. So here you can see the word written, calculated risk. Innovation always thrives on calculated risk, right? A balance between taking risk and maintaining safe preference ensure steady work without unnecessary setback. And finally we have reward. Reward means, you know, reward means recognition and fairness are key to employee satisfaction. When efforts are appreciated, motivation soars and productivity will follow. Then we have something called, you know, survey variability, which means organizations are dynamic and so is their climate. Difference in business nature, organization structure impact how employees experience their workplace. So a well-structured climate survey provides deep insight into this crucial aspect, helping business create a work culture that fosters growth, satisfaction and success, right? So that is about, you know, that is about this entire climate survey. Nothing extra you need to know about it. Friends, let's move to the next slide. That is the total reward framework strategy. Let's talk about it. What truly drives employee satisfaction and retention? Is it just the paycheck or is it there more to it? So the answer lies in total reward framework. The answer to this question lies in total reward framework. So right, it is a powerful strategy that combines both monetary as well as non-monetary investment, right, to create a thriving workforce. Let's break it down. So if you look at the total reward framework, it's not just about salary, right? It is a holistic approach that ensures employees feel valued, right? It is a holistic approach that ensures that employees feel valued, right, motivated and engaged, right? Employee feel valued, motivated and engaged. So let's explore its key elements. So there is, you know, a model called world at work model. So this model highlights the dynamic relationship between employer and employee. So there is a dynamic employer-employee relationship, right, which is influenced by some external factor and global business trend. It focuses on recognition for contribution, performance management, and talent development to nurture future leader. If you look at the component of this total reward framework, this question was asked: what is the world at work model? Two things remember: external factor, global business trend, and it emphasizes on dynamic employer-employee relationship. Now friends, what are the components of this total reward framework? One, total reward comes in various form. The three core components include foundation reward, which means basic salary, which means job security. This is called the foundation reward, basic salary and job security. Second is called performance based reward, so incentive tied to the achievement. This is called performance based reward. And the third is called career and environmental reward, which means growth opportunity and workplace culture. And if you look at the 5 pillars of this total reward, this is very important. Compensation, which is the first pillar, which means competitive salary and bonuses. Second pillar is called benefit, health insurance, retirement plan. These are the benefit. Flexibility means work-life balance and remote option. This is called flexibility. Performance recognition, which means acknowledging and rewarding effort. Career development, which means growth opportunity for employee. If you look at the primary category of this total reward framework, so all reward fall into 3 primary category. The first is called pay. Pay means direct financial compensation. Second is called benefit, which means additional perk beyond salary. And the third is called intangible reward, which means workplace culture, learning opportunity, work-life balance. So friends, when organizations implement a strong total reward strategy, they don't just attract top talent, they retain and empower them. Because at the end of the day, a happy and engaged workforce drive business success. So friends, if you are interested in such kind of videos where every concept is clear, right, using this kind of flow chart and mind map, you can enroll in our crash course program. Detail is provided in the description section. Friends, now we have understanding the compensation. Compensation is more than just a paycheck. It is a strategic tool that organizations use to attract, retain and motivate employees. But have you ever wondered how compensation is classified and structured? Let's break it down. So first of all, what is compensation? At its core, compensation refers to the monetary remuneration, right, an employee receive in exchange for their work performance. It is not just about salary, it is a well-structured system that reward employee fairly and equitably. So if you look at the job classification and compensation term, so different role come with different compensation structure. Here is how it works. So managerial role, top, middle, junior, right, level. So they receive remuneration. Managerial receive remuneration based on leadership responsibility. So they receive remuneration. If it is supervisory and clerical role, so they earn a salary for their structured job role. And if it is a clerical or administrative, so clerical and administrative means salary, right? And if it is skilled and unskilled labor, so they typically receive wage based on hourly or daily work. So they typically receive wage. So managerial remuneration, supervisory salary, clerical administrative salary, unskilled, semi-skilled, it's all about wages. If you look at the types of compensation, the first type we have is called wage or salary. Compensation is not just about a fixed salary. It includes multiple components like wages and salary. This means a regular pay based on job role. Second is the bonus, means performance based incentive, which is called PLI. And the last is benefit, means health insurance, retirement plan and perk beyond salary. Now compensation grouping by payment method. So organization classify compensation based on how it is structured. There is something called individual based compensation, which means personal pay, incentive or commission. Team or group based compensation, like reward share among team for collective success. That is called fixed compensation, a stable predictable salary structure. Or variable compensation, which means earning fluctuate based on performance. So a well designed compensation system is the foundation of a motivated workforce. Whether it is fixed, whether it is variable, individual or group based, the right compensation strategy can drive both employee satisfaction and business success. That is all you need to know about this compensation, nothing else. So these 3 dimensions of it we have just talked now. If you really think it was useful for you, please hit that like button. Now friends, let's look at the compensation theory and wage adequacy. So when we talk about wages, it is not just about number on a paycheck. It's about fairness, adequacy, right, and meeting the needs of employee. But how do organizations determine the right wage? Let's explore the theory of compensation and wage adequacy. So first of all, let's talk about the compensation theory. So this compensation theory is called the foundation of, this compensation theory is called foundation of wage decision. So every organization follow a structured approach, right, to wage determination, guided by conceptual and theoretical aspect of compensation. These theory provide the foundation for fair and right wage. So what are the factors affecting wage quality? Let's look at it. The first thing, there is a committee on fair wage. It has outlined key factors that influence wage adequacy, right? And these factors ensure that wage are aligned with economic condition, organization capacity, as well as social well-being. So let's look at the type of wage. The first wage is called minimum wage. Minimum wage is the most basic level of earning, ensuring that worker meets their basic sustenance level. Then second wage is called living wage. Living wage means beyond sustenance, these wages cover the social need and insurance, and it ensures a better quality of life for employee and their family. The third is called fair wage. Fair wage means the balance between minimum wage and organization capacity to pay, the balance between them. So these wages consider factors like productivity, market rate, economy condition. And finally we have the need based minimum wage, which means designed to satisfy minimum human need, ensuring worker can live with dignity and security. So wage adequacy is not just a business decision, it is a responsibility. By ensuring fair and sustainable wage, organization not only motivate employee but also build a most productive and lower workforce. Remember these five kind of wages: minimum wage, living wage, fair wage, need based minimum wage. Now friends, let's look at a very important ratio called compa ratio. How do company ensure fair salary? How do you know if you are being paid competitively? The answer lies in compa ratio. Let's break it down in the simplest way. What is the compa ratio? Basically, it is a central tool for salary evaluation. Remember, it is a central tool for salary evaluation, right? It helps the organization compare an employee salary with the midpoint of the pay range. So you can compare employee salary with the midpoint of the pay range, ensuring fairness and competitiveness in compensation. So what is the formula for it? In the numerator you write the actual salary. In the numerator you write the actual salary. In the denominator you write the midpoint of pay range. Multiply that by 100. Right, again I am repeating. So in the numerator you write the actual salary. In the denominator you write the midpoint of pay range and multiply that by 100. That will give you the compa ratio. So this percentage help HR professional determine what, when and where an employee stand in the salary structure, right? Actual salary upon midpoint of pay range multiplied by 100. So what is the objective of this compa ratio? As you can see the objective here. So objective is, the first objective, it plays a crucial role in the pay range, right? Promotion as well as the merit based pay adjustment. So what does this number tells us? Let's look at the what we can interpret from the number. Remember, so if it is 0 to 87%, it means new hires, inexperienced employee or underperformer. If it is 88 to 95%, it means learning phase, not yet fully competent. If it is 96 to 103%, it means fully competent performer, right, at performing at the market rate. And if it is 104 to 111%, it means employee consistently exceeding job expectation. So by using compa ratio analysis, employees are fairly compensated. So if it is 100%, it means employee at the midpoint means competent performer. Remember this benchmark. So by using the compa ratio, company can ensure that employees are fairly compensated and employee can understand their market worth. So where does your salary stand? Let's make pay fair and transparent, right? That is the role of compa ratio. Now let's look at this particular slide. Banking has come a long way from strict regulation to performance driven compensation system. But how did we get here? Let's look at the evolution of the banking autonomy and performance linked incentive. So friends, let's walk down the history lane. First of all, we know limited autonomy granted to the bank. You know what happened? Back in 2005, banks were given limited autonomy to manage performance linked play. This was a small step toward more flexible compensation structure, but there was still a long way to go. And if you look at the current banking landscape, fast forward to today, and the banking sector has seen a massive consolidation. With SBI, with several banks have merged and SBI become independent, making a shift in the financial ecosystem. Now the point is demand for compensation freedom. What does it mean? Basically, if you zoom a little bit, fast with competition growing, large banks are now demanding more freedom to offer performance based pay, right? So large banks are now demanding more freedom to offer performance based pay, right? So large banks seek more freedom in compensation based on performance, right? The idea is to reward high performing employee and boost productivity. But there are some challenges in implementation. What are the challenges? But change is not every time easy. Obviously, change is never easy. Resistance from various banking associations and has slowed down the adoption of performance-linked pay structure. Balancing employee concern with organization goal remain a challenge, right? And finally, the introduction of the PLI in the 9th bipartite settlement, which was a breakthrough came in 2020 when with the introduction of performance link incentive under the ninth bipartite settlement. This initiative was designed to align employee reward with bank performance. But how do PLI actually work? So the PLI metrics determine payout based on year-over-year growth in the operating performance, ensuring that better result leads to better reward. Right? This is called PLI metrics. We will talk in detail about it in the upcoming slide. So from limited autonomy to performance-driven incentive, the banking industry is evolving. PLI is a game changer that reward efficiency and motivate employee. So what do you think? Should performance-based pay become a norm in the banking? Please drop your response in the comment section. So this is how you should understand what is the PLI. Now let's talk in detail about this PLI. In this particular table, you will be able to understand everything. And please hit that like button if you really think that this video is worth watching. Now friends, let's look at this particular table. Ever wondered how bank employee benefit from their organization growth? So well, the performance link incentive, or we call PLI, right? This is called PLI. This PLI ensure that better performance leads to better reward. But how does it actually work? So the PLI payout is based on year-over-year growth. You see YOY. YOY means year-over-year growth. So this PLI payout is based on year-over-year growth in the bank operating profit. The more a bank perform, right, the greater the reward for the employee. Here it how it works. If year-over-year growth is less than 5%, means no growth is there, no incentive will be given. The bank needs to grow to be eligible. If year-over-year growth is 5 to 10%, then it means employee get 5 days of basic salary, 5 days of salary, and salaries include basic plus DA. And if the year-over-year growth is greater than 10 to 15%, more than 10 to 15% growth, then then they get 10 days of salary, right, which include basic plus DA. And if it is 15% or more, then 15 days of salary, right? But wait, there is a catch. The 10-day and 15-day slab are only payable if the bank has a net profit. Remember, if the bank has net profit, then only 10 and 15 days are payable. If the operating profit grow by 5% or more, but the bank has no net profit, then only 5 days slab will be applicable. So two things are there. If it has net profit, then only this 10-day and 15 days slab will be given. If just operating profit has grown by 5% and the net profit has not grown, then it will not be payable. So with this guideline, the PLI system came into effect from financial year 2020-2021, right, making bank compensation more performance driven and transparent. So with this structure, the banking structure is embracing a reward based culture, right, and and motivating employee to drive profitability and efficiency. So what is your take? Should more industry adopts this model? Share your thought in the comment section. Now friends, let's shift our focus to imagine working hard day and night only to be underpaid or denied wages. Sounds unfair, right? Well, that is exactly why wage protection law in India exists, to safeguard worker and ensure fair compensation. Let's explore this crucial law that protect employee right and prevent exploitation. And this question is asked every time. So at the heart of this law is the clear objective, that is to prevent low wages. What is the objective? That is to prevent the low wage, right? This is the objective, and ensure that every worker get their rightful earning. So here how different act plays a role in achieving this goal. The first is called the Payment of Wages Act. It ensures timely payment. 6. It ensures timely payment, right? So workers are not left waiting for their hard-earned money. It prevents unauthorized deduction, which means ensuring employees receive what they truly deserve. That is called Payment of Wage Act 1936. Minimum Wage Act 1948. It fixed the minimum wage to ensure no worker is exploited with unfairly low salary. Then there is a Payment of Bonus Act 1965. So basically, this mandate annual bonus payment as a reward for employee contribution to business success. And finally, the Equal Remuneration Act 1976. It ensures that equal pay for equal work, means eliminating wage discrimination based on gender. So friends, these laws protect millions of employees across India from wage exploitation, and they ensure hard work it values, fair pay is guaranteed, and workplace equality is upheld. So if you are an employer or employee, understanding these laws is very essential. Right now friends, let's look at the job evaluation technique. Very important thing. And if you really think that this concept is helping you, please hit that like button. I request you, so that this video can reach to many CIB aspirants and they can also take help of such kind of content. Friends, not all jobs are the same, right? Some require a specialized skill, while others demand leadership, creativity, technical expertise. But how do organizations determine the true worth of a job? So basically, that is where job evaluation techniques comes into play. Right, so let's explore the method used to assess and compare job effectively. On a broad level, we can categorize into two parts. The first is called non-quantitative method. Second is called quantitative method. So non-quantitative method is holistic method, right? But without number. They are holistic method, but without number, right? So this method evaluate job as a whole. This method evaluate job as a whole, right? Rather than assigning numerical value, they don't assign the numerical value. Rather, they evaluate job as a whole. So in this non-quantitative method, we have some method like ranking method. As you can see, ranking method is a part of it. What is the meaning of ranking method? So it means job are compared as a whole and ranked from simplest to the most complex, right? That is called ranking method. Which is the simplest job? Which is the most complex job? This how ranking is done. So basically the pro is that it is simple to understand, easy to understand, cost effective. But the cons is that highly subjective, making it unsuitable for large organization. And the second type of non-quantitative method of job evaluation we have is called job classification or grading method. You can see job classification or grading method. In this case, job are classified into predefined grades. As the name itself suggests, job are classified into predefined grades based on job description. So the pros is that it is less subjective than in the ranking method was very much subjective, but this is less subjective than ranking, widely accepted in organization. Cons is that job complexity may vary within the same grade, leading to inconsistency. So this is called qualitative method, right? Non-quantitative method, right? And if you look at quantitative method, so this method break down job into component and assign numerical value for a structured comparison. So what this quantitative method do? So this break down job into component. It break down job into different components, right? And assign numerical value for a structured comparison. So first of all, we have the factor comparison method. So it means jobs are analyzed based on key factor and numerical values are assigned to each component. There are some key factor and for each factor numerical value is assigned. This help create a fair and measurable evaluation system. So each job evaluation method has its own strength and limitation. Choosing the right method depends on the organization size, structure, level of precision required. So what do you think is the most effective job evaluation technique? Please let me know in the comment section. Friends, that is all you need to know from this unit number 13, I think. Yes, it was unit number 13. That is employee feedback and reward system based on performance management. Every aspect of this topic which we are going to discuss in the crash course. So let's get started. What performance management all about? In this upcoming flowchart, right, mind map, you will see every aspect related to the performance appraisal system in a single slide. You can see. So imagine running a company where employee put in their best effort, but there is no structured way to recognize or improve their performance. Sound chaotic, right? That is where performance appraisal steps in. First of all, why do we need them, right? So what is the necessity of this performance management? So organization can either create their own appraisal system or modify an existing one. So they can either create their own or modify an existing one. So the key is to align the system with the organization goal to ensure employees are motivated and growing in the right direction. So align with the organization goal. This is the best, right? So this is the necessity. So they can either create their own system or modify an existing one organization. And the key is to align the system with the organization goal. Then if you look at the types of appraisal system, the first one is called informal appraisal, which means it is based for a small organization. It is suitable for a small organization where contributions are directly visible, no complex record, just direct feedback, right? Second is called formal appraisal. As company grow, maintaining performance record become essential. This help in fair promotion, right? So this help in fair promotion. This help in we are talking about formal appraisal. So as company grow, maintaining performance record become essential. Fair promotion, salary hike and career growth, right? Fair promotion, salary hike and career growth. So this is called formal appraisal system. Now there is something called systematic appraisal. What is the meaning of systematic appraisal? So it is a well structured system, does not just track employee achievement, it support their growth, making them feel valued and encouraged to perform better. In short, a well-planned performance appraisal system is not just about evaluating employee, it is about driving success for both individual and the organization. So in this slide, we have talked the necessity of the performance appraisal. We have talked about the types of appraisal system, which includes informal as well as formal. So informal, we have just talked that it is based for a small organization, and formal we have talked as company grow, maintaining performance record become essential. This help in fair promotion, salary hike and career growth. So this is all about this performance appraisal system, necessity, types and systematic appraisal. Systematic appraisal, what it is? So systematic appraisal is a well structured system, does not just track the employee achievement, it support their growth, making them feel valued. That is called systematic appraisal system. Now let's take a comprehensive overview of the performance appraisal in this particular diagram. Every aspect have been covered here. Ever wondered why performance appraisal is such a crucial part of an organization? It is not just about evaluating employee, it's about growth, it's about fairness, so performance appraisal is about growth, it's about fairness, and it is about a better decision making. Let's break it down. First of all, what it does, that it enhances the supervision quality, which means when manager actively observe and guide employee, performance naturally improve. So basically proactive management, proactive supervision leads to more efficient workforce. Then we have it support the HR decision, which means promotion, salary hike, training program, all depends on performance data, right? Promotion, training data, training needs, salary hike, all depends on performance data. So a structured appraisal system help HR make fair and informed decision. The third important thing is the standardized employee rating, which means imagine a grading system that ensures fair comparison between employee. A uniform scale remove biases and make evaluation transparent. And finally, we have identify weakness and corrective actions. So no one is perfect. A well-structured appraisal system highlight improvement area and help employee work on their weakness. That is called identifying weakness and taking corrective action. And finally, it improves employer-supervisor relationship. A good appraisal system is not just about rating. It fosters trust. It opens communication between employer and their manager. So a strong performance appraisal system is not just a corporate requirement. It's a growth engine. So we can call it what? We can call it the growth engine, right? It is a growth engine that benefit employee, manager, and the entire organization. So the entire crash course is designed in such a way that you get such kind of slides which help you remember the things for a longer time, especially before your examination. When if you look at the ABM book itself, it is just 600 steps to 700 page book. It is impossible to revise the entire content in just one day. And what we do in crash course is that we just provide you what is essential from the examination point of view, nothing more than that. If you cover that much, especially such kind of slides, this will help you in quicker revision of the entire syllabus. And if you want to be a part of it, this particular crash course, what you need to do, you can WhatsApp me on this particular number. Now friends, let's look at the method of performance appraisal. So performance appraisal is not just about evaluating employee, it's about choosing the right method to assess their contribution effectively. So organization used both traditional method and modern method to ensure fair and accurate evaluation. Let's look at the traditional method. The old school way of evaluation that focus on ranking and rating. So basically it focus on something we call ranking plus rating, right? So friends, first method is called free from essay method, which means a detailed write-up about an employee performance. Second is called straight ranking method. We will talk in detail about it. So it is an employer ranked against each other. Then we have comparison method. So then we have graphic rating and grading scale method. So which means assigning grade on numerical rating. Forced choice description method means employer select predefined statement or distribute employee into performance category. Group appraisal method. So which means multiple evaluator discuss an employee performance. Now we have some modern method also. We will talk about it. Assessment center workshop. Basically employer tested through real world simulation. MBO, management by outcome, means performance is based on goal achievement. Human asset accounting model, right? Which means performance is employee value is assessed as an organization asset. Behavioral anchored rating scale, BARS. So a highly structured and behavior focused evaluation, and 360 degree and 720 degree evaluation. Means feedback is collected from peers, subordinate, supervisor, and even client. So which method is the best? It depends on the organization need. Traditional method work for a structured role, while modern method are ideal for dynamic work environment. So in today's world, a hybrid method is a hybrid approach that balance both is the key to fair, accurate, and growth oriented appraisal. Now let's look at traditional method. In a single slide, I will make you understand all the important appraisal. So this is the key of this, this is the beauty of this crash course PDF. Now friends, performance appraisal is crucial for recognizing employee contribution and making informed HR decision. So traditional method have been widely used for years, focusing on a structured evaluation. The first method is called graphic, or we call it linear rating method. So employee are rated based on characteristics like performance quality, teamwork, punctuality. So there are some characteristics like on basis of teamwork, on the basis of punctuality, on the basis of performance quality. So it is a quick and structured way to assess the employee. The second method we have is called free from essay method. What is the meaning of it? So it is a descriptive evaluation, it is a subjective evaluation when top management provides subjective feedback. So this method gives detailed insight but may lack a standardization, right? It gives you detailed insight, subjective evaluation. The employer gives a subjective evaluation about an employee, right? But it may lack a standardization. There is no standard method. The third method is called the grading method. So what is the meaning of grading method? Employees are graded based on the job knowledge, analytical ability, and skill. It ensures that objective performance review. It ensures an objective performance review, but require clear grading criteria. Then we have something called forced choice method. Here you can see forced choice and forced distribution method. So in this case, what happened? The evaluator must choose from preset statement. So there are some predetermined statement, preset statement. Evaluator must choose from them, and employees are distributed into performance category. So employees are distributed into performance category, right? So this remove bias but may not account for individual difference. Then a straight ranking method. Straight ranking method, what happened? Employees are ranked in the order of their performance. It is very simple but can create unhealthy competition. Then we have comparison method. In comparison method, what happened? It involves factor comparison and paired comparison. Two types of comparison are there. You can see factor comparison and paired comparison. You know what it means? See, so where employees are evaluated against each other based on a specific factor. So there are some factor based on which employees are compared among each other. So this work will for benchmarking but might not be fair in diverse role. And finally we have group appraisal method. So in multiple appraisers discuss an employee performance collectively. While this provide a well-rounded view, it can be time consuming and subjective. So friends, traditional appraisal method focus on structured and comparative assessment. While they help in ranking and categorizing employee, modern workplace often combine them with newer method to ensure fairness and employee growth. So this is the traditional method. Now let's look at the new method, modern method we call it. So in this case, we will talk about one modern method one by one. So first of all, we have something called assessment center workshop. Imagine a performance evaluation that goes beyond just annual review and rating. So if we talk about this assessment center workshop, these assessment center workshop are a modern dynamic way to assess employee using multiple evaluator. There are multiple assessor and multiple evaluator. So multiple evaluator, right, and diverse assessment tools are there. So let's break it down. So first of all, what is the meaning of this assessment center workshop? So they are structured program designed to evaluate employee based on real world simulation, real world test. So basically it is a structured program, right, designed to evaluate employee based on real world simulation, test and group exercise. So this method provides deep insight into individual potential. So what are the key skill measure? First thing is interpersonal skill, which means how well do they collaborate. Leadership quality, which means can they inspire and guide team. Organizing ability, which means do they manage tasks efficiently. Problem solving skill, how well do they tackle challenges. Stress tolerance, which means can they perform under pressure. Motivational orientation, which means what drives them. And finally we have the communication skill, means are they articulate and persuasive. So these are the key skill which is measured. Again I am repeating: interpersonal skill, leadership quality, organizing ability, performance problem solving skill, stress tolerance, motivational orientation and communication skill. So what is the purpose of the assessment center workshop? So basically they identify the managerial potential, which means that spot future leaders. They assess the training needs, means they recognize skill gaps. Campus recruitment means hire the top talent. And finally the future leaders means what? Develop future leader, which means build a strong pipeline. Now what are the drawbacks? So it is time consuming, which means it requires detailed assessment session. Yes, obviously it requires detailed assessment session. It is resistance from high performer, so some may feel uneasy being tested. And finally expertise required, need a skilled professional to evaluate candidate. So while time intensive, assessment center workshop offer one of the most accurate way to gauge employee true potential. In today's competitive world, company that invest in structured evaluation are building future leader leaders, future ready leaders to be more precise. So these are the key skills, success factor, right? Then purpose and drawback. All the 4 points we have covered in this in one particular mind map, as you can see. Now let's look at the 720-degree performance appraisal. These two are very most frequently asked. That's why we have chosen these two. Everything chosen in this crash course content have been asked in the previous year. Now friends, performance evaluation have been evolved significantly. But what if you could go beyond the traditional 360-degree feedback and ensure a more refined all-round appraisal system? That is exactly what 720-degree performance appraisal does. So it is an advanced performance appraisal system where employee receive feedback twice. So they receive feedback twice, right? That is why it is called 720 degree. They receive the feedback twice, once during the execution phase, right? Once they receive the feedback during the execution phase, right? So execution phase, and again after some time for course correction, and again they receive feedback for course correction, right? So friends, this ensures continuous growth and better leadership development. Let's look at the process flow. So first 360-degree appraisal is done, which means initial assessment from multiple stakeholders is conducted. Then we set the target, which means define a key goals and expectation. Then again we performance execute, means that employee work towards setting set target. So first of all 360-degree appraisal is done, then target is set, employee work towards set target, and then second 360-degree appraisal is done, which means a second of review after improvement effort, and then final feedback and correction is done, which means ensure growth and alignment. So what are the key features of this 720-degree appraisal? First of all, pre and post feedback round, which means it helps track progress over the time. Double check mechanism, which means it ensures accuracy in evaluation, how much accuracy is there in evaluation, and obviously continuous improvement. So it encourages long-term employee development and customer and investor perspective. So it integrates external feedback for a holistic view of the employee performance. So these are the key features of the 720-degree feedback. But what are the benefits of it? So it is intense and personalized. So if we talk about this 720-degree appraisal, that it is intense and personalized, means each employee get highly detailed feedback, timely correction, which means issues are addressed before they impact performance, and focus on leadership and growth. It helps employee evolve into a stronger leader. So if 360-degree appraisal was a game changer, 720-degree appraisal is the future. It takes feedback to the next level by adding a second layer of evaluation. So that is all you need to remember for this 720-degree feedback. If you really find this video helpful, please share this video with your other CIB aspirants so that they can also take help of this crash course. Now friends, let's shift our focus to the next point, that is competence versus competency. What is the difference? So many people confuse these two terms, but they are not the same. Let's break it down in the simplest way possible. So competence is about what you do, right? It is about what you do, and competency is about who you are. Competency is about who you are, right? Let's dive deeper. So competence focus on result and outcome. It focus on result and outcome, while competency focus on behavior and attitude, right? It is about the quality that make you good at the job. So competent describe the work and task. It describes the work and task, the task and job output. It describes the task and job output. But competency describes the trait and attribute of the person concerned. Competence, is skill specific, right? It is skill specific, which means you develop expertise for a particular job. And competency, it is transferable, which means it is about personal quality that apply to various roles. Then competence, if we talk about the competence, so competence is measured by job performance. Yes, using job performance you can measure the competence. But what about competency? Competency is a task oriented, right? Competency, it is task oriented. It focus on what you do. Competency is measured by behavior. Competence, it is measured by job performance. It is measured by job performance, and this competency is measured by behavior and attitude. It is measured by behavior and attitude. The next difference is that competence is task oriented. I already told you that competence it is task oriented, right? And competency is people oriented. It is always people oriented, remember it. Competence is task oriented and competency is people oriented, focusing on how you do it. So final thought is that if you want to excel in your career, you need both. Competence ensure you can do the job well, and competency ensure you bring the right attitude and mindset to do the job. So you need both of them. Competence competence ensure that you do the job well, because you have task. It is task oriented. It is measured using job performance. It describes the future of work. It focuses on result and outcome. And competency ensure you have the right behavior. You have the right attitude to do the job. So both are necessary. Now let's look at BEI, that is called behavioral event interview. Ever wondered how company assess a candidate beyond just qualification? So enter BEI, that is called behavioral event interview, a powerful technique to evaluate real world behavior and competency. This is a very. Have you ever wondered how company assess a candidate beyond just qualification? Enter the BEI, that is called behavioral event interview, a powerful technique to evaluate real world behavior and competence. So how does it work? So basically, it use open-ended question. It use open-ended question to encourage detailed response, and it is based on a STAR technique. Full form of STAR may be asked: situation, task, action, and result. Right. So let's look at the steps in BEI. So first of all, open-ended question and STAR technique. What are the steps? First of all, introduction, which means setting the stage for the interview. That is called introduction and explanation. That means it set the stage for the interview. Then we have something called job description, which means understanding the role expectation. So first of all, introduction means that you set the stage for interview. Second is the job description. Job description means understanding the role expectation. Then we have behavioral event, which means candidates share real experience, that is called behavioral event. Competency identification means assessing key skills, and finally conclusion and summary means wrapping it all up. So these are the steps in BEI. Again I am repeating: introduction, setting the stage for interview; job description, which means understanding the role expectation; behavioral event, which means candidates share real experience; competency identification means assessing the key skill, and finally conclusion and summary. So if you look at the types of BEI question, here you can see the first is the past situation based, which means tell me about a time where you handle a tough situation or when you handled a tough situation. This is called past situation based. Second we have is hypothetical scenario, like how do you react if faced with a challenging team conflict. This is called hypothetical scenario. These are the type of BEI question which is asked. Then what is the key purpose of this BEI? It assesses the actual behavior, which means it assesses actual behavior, not just theory, and it is focused on real life incident to evaluate problem solving. And finally it identifies the critical behavior attribute for job success. So these are the key purpose. If you look at the limitation of BEI, so it is memory bias, which means candidate may not recall exact details, that is called memory bias. And lack of knowledge validation, which means responses rely on self-reporting. So whatever response is given is rely on self-reporting. And interviewer dependency, this is one of the limitation, which means the success of BEI depends on the skill of the interviewer. So BEI is an excellent tool for hiring manager to dig beyond resume and uncover a candidate true potential. But like any method, it requires skill execution to avoid biases and get some reliable insight. Right. So that is its limitation also, and it's so friends, the next point we have, the next thing we have to study is is something called evaluation and structure of assessment center, which is very important. Assessment center. So friends, ever wondered how organizations select the best leader and manager? Have you ever wondered how organizations select the best leader and manager? So enter the world of, it is not just about interview, it's about assessment center. So basically, what is an assessment center? An advanced evaluation method that goes beyond writing test and interview. Right? It is an advanced, it is an advanced evaluation method. Right? It is an advanced evaluation method that goes beyond writing test, written test, and interview. Written test and interview is a big part, but it goes beyond that. Right? So what are the key process element of this assessment center? First is the multiple assessment technique, which means role play, case studies, group discussion, and more. Multiple assessors are there, means it ensures fair and well-rounded evaluation. Then pooling of information, which means insight from various exercises are combined for accuracy. Time of observation, which means candidates are assessed over an extended period. And finally, design of exercise, which means custom-made activity to evaluate real-world skill. So they are custom-made activity to evaluate some real-world skill. Right. So these are the key process element. Again, I am repeating. Again, first thing is multiple assessment technique. Basically, assessment center is an advanced evaluation method that goes beyond just written test and interview. It assesses competency, skill, and managerial potential using multiple technique. So there are some key process element like multiple assessment technique, like role play, a case study, group discussion. Some multiple assessors are there, ensuring fair and well-rounded evaluation. Pooling of information, insight from various exercises are combined for accuracy. Time of observation, which candidates are assessed over an extended period. Design of exercise, so custom made activity to evaluate real world skill, that is called the design of exercise. If you look at the origin and evaluation of this assessment center, so initially developed during World War II by the OSS for military application. Right, for military application it was originally developed by OSS, and it is used by the British War Office. And corporate adoption, it first started with AT&T in 1958, making it a research-backed hiring model. Now, if you look at the modern application of this assessment center, so it is widely used in public sector hiring for the government job, private sector hiring. It is adopted for leadership and talent management, and it is essential in competency assessment. So, company today need leader who can think critically, solve problem, and lead team efficiently. So, this assessment center, it help find those individuals through real-world testing rather than theoretical evaluation. So I hope that makes sense to you. This is called assessment center. Now friends, let's look forward and let's look at the performance appraisal. So basically performance appraisal is like mirror. So what are the merit, what are the demerit? So they are like mirror. They reflect an employee's strength, weakness, growth potential, but are they always effective? So first let's look at the merit of this performance appraisal. Right, the first merit is that it enhances the performance culture, which means it encourages a mindset of improvement and excellence. Constructive feedback, it helps employee identify area of growth and excel in their growth. Then it boosts motivation, which means recognize good performance, keep employee engaged and driven. But here is the catch. So the demerit, sometimes appraisal can be flawed due to unconscious biases. So there is something called halo effect. So these are the merit, the three merit we have just talked now: enhance performance culture, constructive feedback, boost motivation. And if you look at the demerit, right, so demerit, you can see halo effect. So a single trait dominates the entire evaluation, leading to unfair rating. A single trait dominates the entire evaluation, leading to unconscious, leading to unfair rating. Right. A single trait dominates the entire evaluation, leading to unfair rating. And sometimes lenient strictness bias is there. So sometimes some managers are too lenient or overly harsh, affecting fairness. And there is something called central tendency bias. So it rating all employees average, ignoring the real performance gap. This is another bias. And similarly we have similarity error, which means favoring employee who resemble the appraiser in background or behavior. So if we talk about the demerit, 4 demerit we have just talked now. First is the halo effect. Question is asked. Halo effect means single trait dominate the entire evaluation, leading to unfair rating. Lenience and strictness bias, which means some managers are too lenient or overly harsh. Central tendency bias is there. Right, rating all employees as average. Similarity error is there, means favoring employee who resemble the appraiser in background or behavior. So these are the kind of demerit that performance appraisal goes through. And if we talk about how to make it effective, so there are some methods. Objective and unbiased means that ensure fair assessment based on measurable result. Focus on skill development, which means use feedback to nurture talent and potential and make it fair and transparent. So a well-structured offense system build trust and credibility. So what is your take? Have you ever experienced an appraisal that feel unfair and highly motivating? Please let me know in the comment. Now we have MBO, very very important. So friends, in today's dynamic corporate world, setting clear achievable goals is the secret to success. But how do organizations ensure everyone is moving in the same direction? So MBO you can think of as the roadmap to the success, right? So basically what we do in MBO, we set the organization goal, which means define clear objective that align with company vision. There is something called joint goal setting, which means employee and manager work together to set meaningful target. Performance review meeting, regular checks in to track progress and ensure alignment. And then we have feedback and course correction, which means adjust a strategy when needed to stay on track. What are the advantages of this MBO? The first advantage is that MBO is not just about setting goal, it's about empowering employee. It encourages participation, which means employee take ownership of their goal. It enhances motivation, which means it achievable target keep employee engaged. It promotes healthy competition. Everyone strive for excellence, that is called healthy competition. And structured appraisal system, which means performance review become more objective, more fair. But beware, MBO has some challenges also, like it is focused on result only, which means it can ignore personal development and teamwork. And there is something called unhealthy competition, which means over emphasis on target may create stress. Sometimes conflict happen during goal setting. Different priority can lead to disagreement and soft target issue. Employee may set easy goal to appear successful. So what we learned from this discussion is that MBO is a powerful tool, but it must be implemented wisely. It works best when goals are realistic, when goals are well defined and balanced between results and development. So that is all you need to know about MBO, nothing extra. And friends, the next topic we have to study is to development of BARS, that is called Behavioral Anchor Rating Scale. See how this work. Ever wondered how organization can ensure fair and accurate performance assessment? So traditional rating system often rely on some vague criteria, right? So they often rely on some vague criteria. We are talking about traditional rating. But BARS changed the game by focusing on real behavior tied to the job performance. So the question is, how is this BARS developed? So step 1, you identify the key job behavior. We start by recognizing effective and ineffective action in the job role. What are the effective action? What are the ineffective action in a job role? Right? What make an employee excel? What behavior lead to poor performance? That is called identifying the key job behavior. Then we define performance dimension, which means job behavior are then converted into measurable category. So whatever job behavior you have identified, right, and that job behavior is converted into measurable category. That job behavior is converted into measurable category, helping create clear performance benchmark. It helps to create clear performance benchmark. Then step number 3 is the job expert evaluation. Means subject matter expert analyze behavior based on real job description. So again, I am telling you the step. First of all, we start by recognizing effective and ineffective action. Which action is effective, which action is ineffective in a job role, what make an employee excel, what behavior lead to poor performance. So that is called effective and ineffective action. Then we define performance dimension, means job behavior are then converted into measurable category, helping create clear performance benchmark, right? So how much is the expectation, that is called benchmark creation. The third step is job expert evaluation, which means subject matter expert analyze behavior based on real job description and critical work incident, right? This ensures practical job relevant evaluation. Then we have behavioral rating, which means expert rate behavior based on effectiveness. They rate the behavior of an employee based on effectiveness and performance dimension, ensuring that each performance level is well defined and fair. And finally, they create behavioral anchor. So expert, a subset of incident is selected as performance benchmark. This is called critical incident, right? So a subset of incident is selected as a performance benchmark. Employees are now rated based on observable action, not just subjective opinion. So this, because this BARS eliminate bias by focusing on real behavior, not vague trait. So that is one of the key feature of this BARS. कि टॉपिक है स्केल बेस्ड रेगुलेशन फॉर एनबीएफसी. तो एनबीएफसी का रूल क्या है? तो एनबीएफसी का रूल क्या है दोस्तों? एनबीएफसी क्या होता है? नॉन बैंकिंग फाइनेंशियल कंपनी बैंक को सपोर्ट करते हैं एक एक्स्ट्रा सोर्स बन के क्रेडिट यानी लोन प्रोवाइड करने में. ठीक है, लिखा है ना क्रेडिट इंटरमीडिएटरीज. तो एक तरह का सोर्स है, ये बैंक के जैसे ही हैं लेकिन कुछ यूनिक रोल और फंक्शन के साथ. अब यदि हम इसके रेगुलेशन का, इसका कंसेप्ट क्या है, ये जो स्केल बेस्ड रेगुलेशन इसका कंसेप्ट क्या है? तो एनबीएफसी का रेगुलेशन स्केल बेस्ड होता है, यानी इनका रेगुलेशन उनके साइज और रिस्क के हिसाब से प्रोपोर्शनेट है. वही मतलब हुआ स्केल बेस्ड का, मतलब हुआ कि इनका जो रेगुलेशन है उनका साइज और रिस्क के हिसाब से प्रोपोर्शनेट है. अगर एनबीएफसी का रिस्क ज़्यादा है तो उस पर स्ट्रिक्ट रूल लगते हैं, राइट? तो अब हम थोड़ा स्ट्रक्चर की बात कर लेते हैं. एनबीएफसी को स्ट्रक्चर के अकॉर्डिंग लेयर्स में डिवाइड किया गया है, जिसमें 4 लेयर आते हैं. पहला होता है हमारा बेस लेयर, राइट? तो सबसे पहला लेयर क्या होता है? हमारा बेस लेयर होता है. यह वो एनबीएफसी हैं जो डिपॉजिट एक्सेप्ट नहीं करते और जिनके एसेट 1000 करोड़ से कम है. मैं फिर से रिपीट कर दूं, बेस लेयर हमारा नॉन डिपॉजिट एनबीएफसीज होते हैं. तो यह वो एनबीएफसीज हैं जो डिपॉजिट एक्सेप्ट नहीं करते और जिनके एसेट 1000 करोड़ से कम है. प्लीज़ रिमेंबर इट, वेरी वेरी इंपॉर्टेंट फ्रॉम एग्जामिनेशन पॉइंट ऑफ व्यू, राइट? उसके बाद जो हमारा नेक्स्ट पॉइंट है वो ये है मिडिल लेयर. फिर आता है मिडिल लेयर, जिसमें इसमें ऐसे एनबीएफसी आती हैं जो डिपॉजिट एक्सेप्ट कर सकती हैं या उनके एसेट 1000 करोड़ से या उससे ज़्यादा होते हैं. फिर आता है हमारा अपर लेयर. अपर लेयर में वो एनबीएफसी हैं जो काफ़ी लार्ज हैं और उनके सिस्टम पे इम्पैक्ट हो सकता है, यानी ये सिस्टमेटिकली रिस्की हैं. ठीक है, सिस्टमिक रिस्क जिसको बोलते हैं, सिस्टमिकली रिस्की हैं. और सबसे ऊपर आता है टॉप लेयर. तो टॉप लेयर जो डिज़ाइन में खाली रखा गया है, लेकिन अगर कभी ज़्यादा रिस्क वाले एनबीएफसी आइडेंटिफाई होते हैं तो उन्हें यहाँ डाला जा सकता है. इसको हम लोग क्या बोलते हैं? टॉप लेयर बोलते हैं, राइट? उसके बाद दोस्तों हम बात करते हैं डिफरेंट एनबीएफसी एक्टिविटीज़ की. तो एनबीएफसी काफ़ी अलग अलग एक्टिविटीज़ में इन्वॉल्व होता है. जैसे आप यहाँ P2P देखेंगे जो कि पीयर टू पीयर होता है. AA का मतलब अकाउंट एग्रीगेटर होता है. NOFSC का मतलब होता है दोस्तों नॉन ऑपरेटिव फाइनेंशियल होल्डिंग कंपनी. और कई अलग तरह के होते हैं, SPD, IDF, CIC, HFC और IFC. चलिए अब थोड़ा सा मैं आपको एनबीएफसी को उनके लेयर और टाइप के हिसाब से कैटेगराइज भी किया जाता है. जैसे कि आपने बेस लेयर देखा, तो बेस लेयर में P2P आते हैं, AA आते हैं, NOFSC आता है और ऐसे एनबीएफसी हैं जो पब्लिक फंड को एक्सेस नहीं कर सकते विदाउट पब्लिक फंड. इसको बेस लेयर बोलते हैं. उसके बाद हमारा आता है मिडिल लेयर. तो मिडिल लेयर में क्या आता है? मिडिल लेयर में एनबीएफसी डी आता है. एनबीएफसी डी मतलब कि डिपॉजिट टेकिंग एनबीएफसी, डिपॉजिट एक्सेप्टिंग एनबीएफसी. फिर CIC आएगा. CIC क्या होता है? कोर इन्वेस्टमेंट कंपनी. और IFC आता है, यानी इंफ्रास्ट्रक्चर कंपनीज आती हैं, इंफ्रास्ट्रक्चर फाइनेंस कंपनी आती है. उसके ऊपर आता है हमारा अपर लेयर. अपर लेयर में क्या होता है कि टॉप 10 एनबीएफसी हैं जो एसेट साइज के हिसाब से टॉप पर हैं और कुछ स्पेसिफिक क्राइटेरिया के थ्रू सेलेक्ट किए गए हैं. जो टॉप 10 बाय एसेट हैं और कुछ स्पेसिफिक क्राइटेरियाज हैं. और सबसे ऊपर आता है हमारा टॉप लेयर. तो टॉप लेयर खाली रखा गया है, लेकिन अगर कोई एनबीएफसी ज़्यादा सिस्टमिक रिस्क क्रिएट करती है तो उन्हें यहाँ डायरेक्टली डाला जा सकता है. वैसे तो टॉप लेयर को एम्प्टी रखा गया है, लेकिन यदि कोई सिस्टमिक रिस्क प्रेजेंट करती है तो उनको यहाँ पे डाला जा सकता है. अब यदि हम थोड़ा सा एनबीएफसी के टाइप्स की बात कर लेते हैं दोस्तों, देखिए कुछ स्पेसिफिक टाइप्स भी होते हैं. जैसे कि आपका एनबीएफसी ICC होता है. ये ICC का फुल फॉर्म क्या बता दूं मैं? इन्वेस्टमेंट एंड क्रेडिट कंपनी. MFI यानी माइक्रो फाइनेंस इंस्टीट्यूशन. और जो फैक्टर्स हैं जो अपने स्किल के हिसाब से प्लेस किए गए हैं. कुछ हमारे गवर्नमेंट एनबीएफसीज होते हैं, सिर्फ बेस और मिडिल लेयर में ये लॉट है. याद रखिएगा, गवर्नमेंट एनबीएफसी बेस और मिडिल लेयर में ही ये लॉट होते हैं. दूसरी बात, यदि हम एनओएफ रिक्वायरमेंट की बात करें, नेट ऑन फंड बोला जाता है, तो एनबीएफसी आईसीसी, एनबीएफसी एमएफआई और फैक्टर जैसे एनबीएफसी के लिए 10 करोड़ का मिनिमम नेट ऑन फंड रिक्वायरमेंट है। ये 10 करोड़ याद रखिएगा, बहुत इंपॉर्टेंट है। कॉम्प्लायंस के लिए कुछ टाइम पीरियड भी दिया गया है। एक बार मैं आपको क्विकली रिकॉल करवा दूं सारा पॉइंट जो अभी हमने डिस्कशन किया, क्योंकि रिकॉल करना बहुत जरूरी है। मैंने आपको बताया कि एनबीएफसी बैंक को सपोर्ट करते हैं लोन प्रोवाइड करने में। इनका रेगुलेशन उनके साइज और रिस्क के अकॉर्डिंग एडजस्ट होता है, जिसे स्केल बेस्ड रेगुलेशन कहते हैं। एनबीएफसी को 4 लेयर में डिवाइड किया गया, बेस, मिडिल, अपर और टॉप। फिर अलग अलग एनबीएफसी एक्टिविटीज है, जैसे P2P लैंडिंग, अकाउंट एग्रीगेटर। अलग टाइप के एनबीएफसी जैसे एनबीएफसी आईसीसी और एनबीएफसी एमएफआई स्केल के हिसाब से प्लेस किए गए हैं, राइट। और एनओएफ रिक्वायरमेंट मैंने बोला आपको 10 करोड़ का होता है इन सभी केस में। चलिए, तो ये था कंटेंट एनबीएफसी रेगुलेशन पे। दोस्तों, यदि आपको इस तरह के पीडीएफ की रिक्वायरमेंट है जिसके माध्यम से आप क्विकली रिवाइज कर सकते हैं, तो हमारा एवीएम का कैप्सूल कोर्स है, जिसका लिंक आपको डिस्क्रिप्शन में मिल जाएगा। आप इस कोर्स में इनरोल हो सकते हैं। चलिए आगे हम लोग बात करते हैं रेगुलेटरी चेंजेस अंडर एसबीआर। आइए समझते हैं क्या कहा जा रहा है। तो देखिए, बात करने वाले हैं एनबीएफसी के रेगुलेटरी चेंजेस के बारे में, जो नई स्केल बेस्ड रेगुलेशन के तहत आई है। अभी एसबीआर होता क्या है? स्केल बेस्ड रेगुलेशन होता है, राइट। तो इन रेगुलेशन का पर्पज है एनबीएफसी को और भी स्ट्रांग और स्टेबल बनाना, स्पेशली जब वो बड़े हो गए हैं, राइट। तो अब आइए दोस्तों, हम लोग बात करते हैं कॉम्प्लायंस टाइमलाइन फॉर न्यू रूल। इसका मतलब क्या होता है? लेट्स ट्राई टू अंडरस्टैंड। सबसे पहले जो नए प्रोविजनिंग और कैपिटल रिलेटेड रूल आए हैं, उनको एनबीएफसी को पूरा करने के लिए 4 साल का टाइम दिया गया है। ओके, यानी एनबीएफसी के पास अब सफिशिएंट टाइम है अपने कैपिटल और प्रोविजनिंग को नए स्टैंडर्ड के अकॉर्डिंगली एडजस्ट करने का। बिल्कुल सही बात है। फिर हम लोग डायरेक्टर के एक्सपीरियंस की रिक्वायरमेंट की बात कर लेते हैं। अब एनबीएफसी को अपनी बोर्ड में मिनिमम एक डायरेक्टर रखना होगा जिसके पास बैंकिंग या एनबीएफसी फील्ड में एक्सपीरियंस हो। मैं फिर से रिपीट कर रहा हूँ, मिनिमम 1 विद बैंकिंग और एनबीएफसी एक्सपीरियंस। इसका पर्पस यह है कि एनबीएफसी के टॉप मैनेजमेंट में एक्सपर्ट लोग हों जिनका ग्रोथ और रिस्क मैनेज करने में मदद कर सकें। देखिए, मैं क्या बोल रहा हूँ कि एनबीएफसी को अपने बोर्ड में मिनिमम एक डायरेक्टर रखना होगा जिसके पास बैंकिंग या एनबीएफसी फील्ड में एक्सपीरियंस हो। पर्पस क्या है? एनबीएफसी की टॉप मैनेजमेंट में एक्सपर्ट लोग हों, राइट। फिर हम थोड़ा सा आईपीओ फाइनेंसिंग के बारे में बात कर देते हैं। आईपीओ फाइनेंसिंग पर भी एक नया रूल आया है। एक बोरोवर को 1 करोड़ से ज़्यादा का आईपीओ लोन नहीं दिया जा सकता। कितना का है? 1 करोड़ का, और यह मैक्सिमम लिमिट है। और एनबीएफसी अपने इंटरनल गाइडलाइन के थ्रू इसे और स्ट्रिक्ट भी कर सकती है। फिर हम बात करें इंटरनल कैपिटल असेसमेंट की, तो एनबीएफसी को रिस्क असेसमेंट अब बैंक के तरह करना पड़ेगा। ठीक है, क्या मतलब हुआ? जैसे क्रेडिट रिस्क हुआ, मार्केट रिस्क हुआ, ऑपरेशनल रिस्क हुआ, यह उनके इंटरनल कैपिटल एडिक्वेसी असेसमेंट प्रोसेस ICAAP के तहत आता है। उनके साइज और कॉम्प्लेक्सिटी के अकॉर्डिंगली टेलर किया गया है। जैसे एग्जांपल के तौर पर, जैसे एक छोटी एनबीएफसी के पास कॉम्प्लेक्स रिस्क कम होते हैं तो उसका ICAAP सिंपल होगा, वही बड़ी एनबीएफसी को डिटेल रिस्क एनालिसिस करना पड़ेगा। समझ में आया दोस्तों? अब प्रूडेंशियल गाइडलाइन बात करते हैं। तो जो हमारा अपर लेयर होता है जिसको एनबीएफसी यूएल कहते हैं, तो अपर लेयर एनबीएफसी के लिए कुछ स्पेसिफिक प्रूडेंशियल गाइडलाइंस आई हैं, जैसे कि इनको अपने रिस्क वेट एसेट पर कम से कम 9% CET1 कैपिटल रखना पड़ेगा। लिखा गया ना, CET1 मिनिमम 9% कम से कम। फिर इसका मतलब जो एसेट का रिस्क ज़्यादा है उन पर हायर कैपिटल मेंटेन करना होगा। फिर एक है हमारा लीवरेज लिमिट। इसका मतलब ये हुआ कि जो हमारे अपर लेयर एनबीएफसी हैं इनके लिए लीवरेज लिमिट भी डिसाइड की गई है, जिससे ये इंश्योर हो कि इनका ग्रोथ उनके अवेलेबल कैपिटल के साथ बैलेंस में हो, इनका ग्रोथ जो है उनके कैपिटल के साथ बैलेंस में हो। तो यानी ये एनबीएफसी बहुत ज़्यादा लोन नहीं दे सकते बिना अपने कैपिटल को सपोर्ट किए। अब थोड़ा सा हम बात कर लेते हैं प्रोविजनिंग रिक्वायरमेंट बाय एसेट क्लास। थोड़ा देखिए, मतलब क्या हुआ कि एनबीएफसी में प्रोविजनिंग अलग अलग एसेट क्लास के हिसाब से वेरी करती है। इसका मतलब कि हाई रिस्क एसेट के लिए ज़्यादा प्रोविजनिंग रखनी पड़ती है। यदि हम बात करें क्रेडिट कंसंट्रेशन की, तो क्रेडिट कंसंट्रेशन को कंट्रोल में रखने के लिए कुछ लिमिट्स भी इंप्लीमेंट किए गए हैं। जैसे आप यहाँ देख सकते हैं, यदि सिंगल एक्सपोजर है, एक सिंगल बोरोवर के लिए मैक्सिमम एक्सपोजर एनबीएफसी के Tier 1 कैपिटल का 25% तक हो सकता है। और यदि हमारा ग्रुप बोरोवर है तो ग्रुप बोरोवर के लिए मैक्सिमम एक्सपोजर Tier 1 कैपिटल का 40% तक हो सकता है। ठीक है, जैसे अगर एक एनबीएफसी का Tier 1 कैपिटल मान लीजिए 100 करोड़ है, ठीक है, तो वो किसी एक बोरोवर को मैक्सिमम 25 करोड़ और किसी एक ग्रुप को मैक्सिमम 40 करोड़ ही दे सकती है। ये आपको समझ में आया? ठीक है, अब एक बार हम लोग समराइज कर लें, क्विक रिकैप में समझ लेते हैं। मैंने क्या बताया आपको कि जो हमारे नए प्रोविजनिंग और कैपिटल रूल्स को इंप्लीमेंट करने के लिए एनबीएफसी को 4 साल का समय दिया गया है। ठीक है, ये सब चीज़ याद रखिए। फिर मैक्सिमम एक डायरेक्टर होना चाहिए जो एनबीएफसी या बैंकिंग का एक्सपीरियंस रखता हो। आईपीओ फाइनेंसिंग पर बोरोवर की लिमिट 1 करोड़ है। एनबीएफसी को बैंक की तरह अपना कैपिटल रिस्क के हिसाब से एडजस्ट करना पड़ता है। और अपर लेयर एनबीएफसी को CET1 कैपिटल मिनिमम 9% मेंटेन करना है और उनके सिंगल और ग्रुप एक्सपोजर पर लिमिट भी है। जो मैंने आपको 25% और 40% बताया। चलिए अब थोड़ा सा रेगुलेटरी गाइडलाइंस के बारे में बात कर लेते हैं। आप यहाँ देख सकते हैं SBR की बात की जा रही है, जिसको हम लोग बोलते हैं सुपरविजन बेस्ड ऑन लेयर्स। देखिए एनबीएफसी को अब उनके लेयर के हिसाब से मॉनिटर किया जा रहा है, जैसे कि बेस लेयर, मिडिल लेयर, अपर लेयर। मिडिल और अपर लेयर वाले एनबीएफसी पर थोड़ा ज़्यादा स्ट्रिक्ट सुपरविजन होगा, क्योंकि ये लेयर ज़्यादा रिस्क पोज करते हैं। किसके लिए? मिडिल और अपर लेयर के लिए। यदि हम आरएमसी की बात करते हैं, आरएमसी क्या होता है? रिस्क मैनेजमेंट कमेटी होता है। देखिए एनबीएफसी को अपना रिस्क मैनेज करने के लिए एक आरएमसी बनाया गया है। आरएमसी को अपने रिस्क और फाइनेंशियल हेल्थ के बारे में ज़्यादा ट्रांसपेरेंट रहना होगा और डिस्क्लोजर में इन्हांस किया गया है। जैसे मैं एग्जांपल बताता हूँ, जैसे मान लीजिए कि अगर किसी एनबीएफसी में रिस्क बढ़ने के चांसेस हैं, मान लीजिए कोई एनबीएफसी है उसमें रिस्क बढ़ने वाला है, तो आरएमसी का काम है टाइमली डिस्क्लोज करना और नेसेसरी एक्शन लेना। ठीक है, तो टाइमली डिस्क्लोज करना होगा, नेसेसरी एक्शन लेना होगा। फिर एक आता है लार्ज एक्सपोजर फ्रेमवर्क फॉर अपर लेयर, यानी LEF जिसको बोलते हैं, लार्ज एक्सपोजर फ्रेमवर्क। देखिए अपर लेयर वाला एनबीएफसी के लिए सेक्टर एक्सपोजर को लिमिट किया गया है, यानी एक ही सेक्टर में ज़्यादा पैसा इन्वेस्ट करने का लिमिट है, जो रिस्क को कंट्रोल में रखने में हेल्प करेगा। मैं फिर से रिपीट करता हूँ, जिसको LEF कहा जाता है, लार्ज एक्सपोजर फ्रेमवर्क कहा जाता है अपर लेयर के लिए, यानी अपर लेयर वाले एनबीएफसी के लिए सेक्टर एक्सपोजर को लिमिट किया गया है, एक ही सेक्टर में ज़्यादा पैसा इन्वेस्ट करने का लिमिट है। राइट, यही बताया जा रहा है। अब थोड़ा बात कर लेते हैं मैनेजरियल रिस्ट्रिक्शन की, जिसमें डुअल ऑफिस रोल आता है। देखिए अब एनबीएफसी में की स्टाफ डुअल रोल में काम नहीं कर सकते, यानी एक ही पर्सन मल्टीपल पोजीशन होल्ड नहीं कर सकता, और इस रूल को फॉलो करने के लिए एनबीएफसी के पास 2 साल का कॉम्प्लायंस पीरियड है। यदि डिस्क्लोजर की बात करें तो एनबीएफसी को अपने एनुअल रिपोर्ट में गवर्नेंस और ऑडिटर के ओपिनियन भी डिस्क्लोज करने होंगे, ताकि शेयर होल्डर और पब्लिक को यह पता चले कि एनबीएफसी अपने गवर्नेंस में कितनी ट्रांसपेरेंट है। फिर हम बात करते हैं, यहाँ पे आप देख सकते हैं बताया जा रहा है न्यू गाइडलाइंस आरबीआई गाइडलाइन फॉर एनबीएफसी। नए आरबीआई गाइडलाइन के तहत एनबीएफसी को एक्सेप्शनल आइटम, ब्रीचेज, डिफॉल्ट, एसेट डाइवर्जेंस, ये सभी को टाइमली रिपोर्ट करना होगा। यह इन्फॉर्मेशन एनबीएफसी के फाइनेंशियल हेल्थ और रिस्क को क्लियरली दिखाता है। यदि हम सीसीओ के रोल की बात करें, जिसको हम लोग चीफ कंप्लायंस ऑफिसर बोलते हैं, तो एनबीएफसी में एक चीफ कंप्लायंस ऑफिसर होता है। इसका रोल भी बहुत जरूरी है। यह सीसीओ बोर्ड को रिपोर्ट करेगा और पॉलिसी इंप्लीमेंट करने का जिम्मेदारी लेता है। फिर आता है बात कॉम्पेंसेशन एंड रिमनरेशन कमेटी का। तो कॉम्पेंसेशन या सैलरीज को बोर्ड अप्रूव करेगा और इसके लिए एक रिमनरेशन कमेटी होगी। यहाँ देखिए लिखा जा रहा है, मैलस और क्लॉबैक प्रोविजन भी है। ठीक है, आप देख सकते हैं दोस्तों, आपके सामने जो मैं नोट्स प्रस्तुत कर रहा हूँ ना, एकदम टू द पॉइंट है। देखिए बुक में पढ़ने जाइए, आपको ये पेज, यही चीज़ आपको 30 से 40 पेज में मिलेगा, जिसमें आपको ये बताना मुश्किल होगा क्या छोड़े और क्या पढ़ें। और आपके सामने मैं की पॉइंट्स डाल रहा हूँ, जिसको मैं आप सीधे सुन लेते हैं तो आपके दिमाग में वो बैठ जाएगा और उसको आप सुन के ही चीज़ों को समझ सकते हैं। यदि हम मैलेस और क्लैबैक प्रोविजन भी है, जो कि एक एनबीएफसी में अकाउंटेबिलिटी को इंश्योर करता है। राइट, मैलेस और क्लैबैक का मतलब है कि अगर कोई स्टाफ मेंबर गलत काम करता है तो उसका कुछ कॉम्पेंसेशन वापस लिया जा सकता है। अब आपको पूछ देगा एग्जाम में, व्हाट इज मैलेस प्रोविजन इन एनबीएफसी, तो मैंने बताया ना कि कोई भी कुछ गलत करेगा तो उसका प्रोविजन वापस ले लिया जाएगा। सिंपल भाषा है। ठीक है, अब हम थोड़ा बात कर लेते हैं बोर्ड के रोल्स और गवर्नेंस स्टैंडर्ड की। बोर्ड के रोल और रिस्पॉन्सिबिलिटी को डिफाइन किया गया है। बोर्ड रेगुलर बेसिस पर एनबीएफसी के पॉलिसीज का रिव्यू करेगा और विसल ब्लोअर पॉलिसी को सपोर्ट करेगा। राइट, अगर कोई एम्प्लॉय इशू रिपोर्ट करना चाहे तो वो सेफ रहे। मैंने यहाँ बताया था कॉन्फिडेंशियलिटी रखी जाती है। एनबीएफसी के सब्सिडरीज में भी सेम गवर्नेंस स्टैंडर्ड फॉलो किए जाएंगे। एक बार हम लोग क्विकली रिकैप कर लें। मैंने क्या बताया आपको कि एनबीएफसी को लेयर के हिसाब से सुपरवाइज किया जा रहा है। मिडिल और अपर लेयर पर ज़्यादा स्ट्रिक्ट सुपरविजन है। राइट, उसके बाद मैंने क्या बताया कि रिस्क मैनेजमेंट के लिए आरएमसी जरूरी है, रिस्क मैनेजमेंट कमेटी जरूरी है, और डिस्क्लोजर और भी ट्रांसपेरेंट हो गए हैं। फिर मैंने आपको बताया कि जो अपर लेयर है, अपर लेयर एनबीएफसी को एक ही सेक्टर में लिमिटेड एक्सपोजर रखना होगा। फिर कह रहा है कि की स्टाफ के लिए डुअल रोल पर रिस्ट्रिक्शन है और एनुअल रिपोर्ट में ज़्यादा इन्फॉर्मेशन डिस्क्लोज करनी होगी। और फिर फाइनली है कि सीसीओ और रिमनरेशन कमेटी का रोल भी ऐड किए गए हैं, ताकि एनबीएफसी और अकाउंटेबल और ट्रांसपेरेंट हो। राइट, चलिए दोस्तों, यदि आपको चीज़ें क्लियर हो रही हो तो प्लीज़ लाइक बटन हिट करने में हिचकिचाइएगा मत, ये बहुत ही इंपॉर्टेंट है ताकि ये वीडियो और भी लोगों तक पहुँच सके। चलिए अब हम लोग बात करेंगे जो नए रेगुलेशन के तहत आते हैं कुछ इंपॉर्टेंट गवर्नेंस के बारे में। सबसे पहला आता है कोर बैंकिंग। देखिए अगर किसी एनबीएफसी के पास 10 या उससे ज़्यादा ब्रांचेज हैं तो उसको नेक्स्ट 3 ईयर में कोर बैंकिंग सिस्टम अडॉप्ट करना पड़ेगा। ठीक है, कोर बैंकिंग सिस्टम से फ़ायदा यह है कि सारी ब्रांचेज एक ही सिस्टम पर काम करती है, जो ट्रांजैक्शन को और ट्रांसपेरेंट और इजीली ट्रैकेबल बनाता है। जैसे बैंक में आप किसी भी ब्रांच में जाते हैं, राइट, तो राइट जैसे मान लीजिए कि आप बैंक में किसी ब्रांच में जाते हैं तो वहाँ पे क्या होता है कि वहाँ जाकर ट्रांजैक्शन कर सकते हैं, वैसे ही एनबीएफसी का यही फीचर प्रोवाइड होता है। अब दोस्तों हम बात करते हैं बोर्ड मेंबर की क्वालिफिकेशन की, यहाँ समझने का प्रयास कीजिए। देखिए एनबीएफसी के बोर्ड मेंबर के लिए अब रिलेवेंट क्वालिफिकेशन होना जरूरी है, यानी उनके पास फाइनेंस या एनबीएफसी इंडस्ट्री का प्रॉपर एक्सपीरियंस होना चाहिए ताकि वो एनबीएफसी को अच्छे से गाइड और मैनेज कर सकें। उसके बाद हम थोड़ा सा ट्रांजिशन पाथ की बात कर लेते हैं। देखिए एनबीएफसी को अपने शेयर को, अच्छा एक चीज़ समझिए, सुनिए ध्यान से, मैं जो बता रहा हूँ आपको, यहाँ पे लिस्टिंग की बात की जा रही है। देखिए एनबीएफसी को अपने शेयर को 3 सालों में स्टॉक एक्सचेंज पर लिस्ट करना पड़ेगा, ठीक है। इस लिस्टिंग से एनबीएफसी की फाइनेंशियल हेल्थ और परफॉर्मेंस पब्लिक के सामने आएगी, यहाँ वही चीज़ बताया जा रहा है। और दूसरी बात, एक और चीज़ याद रखिए कि टॉप लेयर वाले एनबीएफसी को हाई कैपिटल चार्ज और इंटेंसिव सुपरविजन फेस करना पड़ेगा, मैं पहले भी बता चुका हूँ। तो टॉप लेयर में वो एनबीएफसी आते हैं जो सिस्टमेटिकली इंपॉर्टेंट है, तो उनको और भी क्लोज मॉनिटर किया जाएगा। फिर यदि हम अपर लेयर की बात करें तो एनबीएफसी अपर लेयर में क्लासिफाइड होते हैं, उनको आरबीआई की तरफ से 24 महीना मिलता है, 24 महीना मिलता है कंप्लायंस के लिए, यहाँ लिखा गया ना 24 मंथ टू कंप्लाई। और उनके पास एक बोर्ड अप्रूव्ड पॉलिसी भी होनी चाहिए जो 3 महीने में बन जानी चाहिए, यहाँ लिखा गया ना बोर्ड अप्रूव्ड पॉलिसी नीडेड इन 3 मंथ। अच्छा अब यदि हम बात करें ड्यूरेशन रिक्वायरमेंट की, समझने का प्रयास कीजिए। एनबीएफसी को मिनिमम 5 साल तक इन्हांस रेगुलेशन के अंदर रहना पड़ेगा, जो इन्हांस रेगुलेशन है। और इसके अंदर अगर उनका परफॉर्मेंस और रिस्क प्रोफाइल सही हो तो बोर्ड अप्रूवल के साथ वो इस रेगुलेशन से जल्दी एग्जिट भी कर सकते हैं, ठीक है। अच्छा परफॉर्मेंस रहेगा तो एग्जिट कर सकते हैं। फिर क्राइटेरिया प्रॉक्सिमिटी नोटिफिकेशन, मतलब क्या हुआ समझिए, आरबीआई एनबीएफसी को नोटिफाई करता रहेगा अगर वो अपर लेयर स्टेटस के करीब रहे, और पीरियोडिक रिव्यू के थ्रू उनका असेसमेंट चेक भी करता रहेगा। कौन करेगा? आरबीआई करेगा। अब थोड़ा सा हम गवर्नमेंट एनबीएफसी के लिए जो एग्जाम्पशन है उसकी बात कर लेते हैं। गवर्नमेंट एनबीएफसी को अपर लेयर कॉम्प्लायंस से एग्जाम्प्ट रखा गया है जब तक वह स्पेसिफिक क्राइटेरिया फुलफिल नहीं करे। अब देखिए उसके बाद हम सीसीओ के रोल की बात कर लेते हैं। तो चीफ कंप्लायंस का रोल एनबीएफसी में बहुत इंपॉर्टेंट है, स्पेशली गवर्नेंस, इंटरनल कंट्रोल और रिस्क मैनेजमेंट में। जैसे आप यहाँ देख सकते हैं फ्यूचर रेगुलेशन, मतलब आने वाले टाइम में जो एनबीएफसी पब्लिक फंड या इंटरफेस के बिना काम करती है उसके लिए भी कंप्लायंस गाइडलाइन आ सकती है, ठीक है। उसके बाद कंप्लायंस की बात करें तो सीसीओ का रोल है कि वो इंश्योर करे कि एनबीएफसी सारे रूल और इंटरनल पॉलिसी को फॉलो करें और किसी भी कंप्लायंस इशू को जल्द से जल्द रिजॉल्व करें। तो एक बार मैं आपको क्विकली रिकैप करवा देता हूँ इंपॉर्टेंट फैक्ट। तो हमने ये देखा, तो दोस्तों क्विक रिकैप में ये पॉइंट्स हैं कि एनबीएफसी जिनके 10 से ज़्यादा ब्रांचेज हैं उनको कोर बैंकिंग सिस्टम 3 सालों में अडॉप्ट करना है, ये रट लीजिए, 10 से ज़्यादा ब्रांच 3 साल, ये सब की पॉइंट्स हैं। उसके बाद बोर्ड मेंबर को रेलेवेंट क्वालिफिकेशन होना जरूरी है और एनबीएफसी को 3 सालों में लिस्ट होना पड़ेगा, यहाँ देखिए लिखा गया है लिस्ट होना पड़ेगा 3 सालों में, यहाँ देखिए। फिर कहा जा रहा है कि टॉप लेयर एनबीएफसी पर हायर कैपिटल चार्ज और स्ट्रिक्ट सुपरविजन होगा, राइट। और अपर लेयर एनबीएफसी के पास कॉम्प्लायंस के लिए 24 महीने हैं और उनको मिनिमम 5 ईयर तक इन्हांस रेगुलेशन में रहना होगा, 24 मंथ एंड 5 ईयर, ये याद रहना होगा आपको। अपर लेयर की बात की जा रही है। और गवर्नमेंट एनबीएफसी अपर लेयर कॉम्प्लायंस से एग्जेम्प्टेड है और कॉम्प्लायंस और सीसीओ रोल गवर्नेंस और रिस्क मैनेजमेंट के लिए क्रिटिकल है। चलिए यहाँ तक तो हमने देख लिया। अब थोड़ा सा हम लोग कॉम्प्लायंस डिपार्टमेंट की बात कर लेते हैं, अगले स्लाइड में चलते हैं। तो दोस्तों अब आइए हम लोग कॉम्प्लायंस डिपार्टमेंट के स्ट्रक्चर और लीडरशिप की बात करते हैं। लेट्स मूव टू द नेक्स्ट स्लाइड, या हियर इट इज। सो सी देखिए कॉम्प्लायंस डिपार्टमेंट को सीसीओ यानी चीफ कंप्लायंस ऑफिसर लीड करते हैं और यह डिपार्टमेंट काफ़ी इंडिपेंडेंट होता है, राइट। तो सीसीओ इसको लीड करते हैं और ये काफ़ी ज़्यादा, जस्ट वेट अ मिनट, या करेक्ट। तो कंप्लायंस डिपार्टमेंट की हम लोग बात कर रहे हैं, आई थिंक जस्ट वेट अ मिनट, ओके। अभी मैं जो स्किप कर रहा हूँ उसको मैं बाद में आपको डिस्कस करता हूँ, पहले मैं ये पॉइंट आपको समझा दूँ। देखिए कौन लीड करता है, तो सीसीओ लीड करता है और यह डिपार्टमेंट काफ़ी इंडिपेंडेंट होता है, यानी दूसरे डिपार्टमेंट से अलग अलग काम करता है। इसमें एक पॉइंट आप देखिएगा, एनुअल रिस्क असेसमेंट, मतलब हर साल एनबीएफसी को अपने कॉम्प्लायंस रिस्क का असेसमेंट करना पड़ता है। इसका मतलब उनको देखना पड़ता है कि कहाँ कहाँ कॉम्प्लायंस रिस्क में आ सकता है और उसको सॉल्यूशन प्लान करना पड़ता है। यदि सीनियर मैनेजमेंट की बात करें तो सीनियर मैनेजमेंट का काम है कॉम्प्लायंस फेलियर और गाइडलाइन का रिव्यू करना, अगर कहीं कुछ इशू है तो उसको रेक्टिफाई यानी करेक्ट करना। फिर अथॉरिटी की बात करें तो कंप्लायंस टीम को अथॉरिटी दी गई है कि वो अपने रिकॉर्ड को एक्सेस कर सकती है और एनबीएफसी में फ्रीली कम्युनिकेट कर सकती है। एक होता है हमारा डुअल हैटिंग रिस्ट्रिक्शन, ये क्या होता है कि सीसीओ को डुअल हैटिंग से बचना होता है, मतलब ये ऐसे कमिटी में नहीं रह सकते जहां उनका रोल कॉन्फ्लिक्ट हो। क्वालिफिकेशन, तो कंप्लायंस टीम में काम करने वाले लोगों का बैकग्राउंड काफ़ी डाइवर्स होना चाहिए, जैसे कि बिजनेस, ऑडिट, लॉ, रिस्क, आईटी, ताकि वो हर एंगल से कंप्लायंस को मैनेज कर सकें। साथ ही एक सक्सेशन प्लान भी होना चाहिए ताकि सीसीओ के बाद कौन आएगा ये क्लियर हो। फिर एक हम बात करें इंटरनल ऑडिट की, तो कंप्लायंस रिस्क एनबीएफसी के इंटरनल ऑडिट फ्रेमवर्क में भी शामिल है। रेगुलर ऑडिट होते हैं और जो फाइंडिंग है वो सीसीओ को बताई जाती है ताकि वो टाइमली एक्शन ले सके। फिर हम लोग आरबीआई के सुपरविजन की बात करें तो आरबीआई ने एनबीएफसी के रिस्क असेसमेंट में कंप्लायंस रिगर को भी शामिल किया है। इसका मतलब कि आरबीआई भी कॉम्प्लाइंस की स्ट्रेंथ को ध्यान में रखते हुए एनबीएफसी को मॉनिटर करता है। सीसीओ का टेनर क्या होता है, तो सीसीओ की मिनिमम 3 साल की फिक्स टर्म होती है और उनके पास इंडस्ट्री और रेगुलेटर का नॉलेज होना जरूरी है। फिर हम बात करें इंडिपेंडेंस की, तो सीसीओ को इंडिपेंडेंस मेंटेन करना होता है ताकि वो अपने जजमेंट इंडिपेंडेंट तरीके से ले सकें। साथ ही उनका सिलेक्शन बोर्ड या बोर्ड कमेटी करती है एक डिफाइंड प्रोसेस के हिसाब से। अब आरबीआई नोटिफिकेशन फॉर सीसीओ अपॉइंटमेंट, इसको समझिए। देखिए एनबीएफसी को आरबीआई को इन्फॉर्म करना होता है कि अगर सीसीओ अपॉइंट, ट्रांसफर, रिजाइन या रिमूव हो रहे हैं तो ये आपको इन्फॉर्म करना पड़ेगा, राइट। एनबीएफसी को आरबीआई को इन्फॉर्म करना पड़ेगा। और सीसीओ का प्रोफाइल क्या होना चाहिए, फिट और प्रॉपर होना चाहिए, आपको यहाँ लिखा जा रहा है। अब देखिए एक पॉइंट लिखा जा रहा है जो कि रिपोर्टिंग लाइन से रिलेटेड है। देखिए सीसीओ डायरेक्टली एमडी एंड सीईओ या बोर्ड को रिपोर्ट करते हैं, और अगर एमडी और सीईओ को रिपोर्ट कर रहे हैं तो बोर्ड के साथ उनके क्वार्टरली मीटिंग भी होते हैं। यहाँ लिखा है ना क्वार्टरली मीटिंग, ठीक है। सीसीओ का बिजनेस यूनिट के साथ डायरेक्ट टाइज नहीं होना चाहिए और उनके अप्रेजल का रिव्यू बोर्ड या कमिटी करती है, कोई बिजनेस टाई नहीं होना चाहिए, राइट। एक बार क्विकली रिकैप कर लें, मैंने क्या बताया आपको कि कॉम्प्लायंस डिपार्टमेंट को सीसीओ लीड करता है, मैंने भी बताया, और जो इंडिपेंडेंट होता है और उनके पास एनुअल रिस्क असेसमेंट और रिकॉर्ड एक्सेस की अथॉरिटी होती है। सीनियर मैनेजमेंट कॉम्प्लायंस फेलियर और गाइडलाइंस को मॉनिटर करता है। सीसीओ के पास रेलेवेंट एक्सपीरियंस और टेनर फिक्स होता है, कितना टेनर होता है, 3 से ज़्यादा साल का होता है। और सीसीओ का एमडी या सीईओ या बोर्ड के साथ डायरेक्ट रिपोर्टिंग होता है और उनके पर शुरुआत करते हैं हम लोग अपने पहले कंसेप्ट के साथ। देखिए कॉम्प्लायंस कल्चर का पहले मीनिंग समझते हैं। देखिए कॉम्प्लायंस कल्चर का मतलब है अपनी ऑर्गेनाइजेशन में एथिकल और लॉफुल बिहेवियर को प्रमोट करना, राइट। तो यह सिर्फ रूल्स फॉलो करना नहीं बल्कि ग्रोथ, यहाँ देखिए ग्रोथ, प्रॉफिटेबिलिटी और ऑर्गेनाइजेशन की रेपुटेशन को प्रोटेक्ट करना भी है। तो इसमें सीनियर मैनेजमेंट का रोल काफ़ी इम्पॉर्टेंट है और वो कॉम्प्लायंस को सपोर्ट करते हैं, राइट। उसके बाद कॉम्प्लायंस को हायरिंग, ट्रेनिंग, रिवार्ड्स में इंटीग्रेट करना ज़रूरी है ताकि हर लेवल पर इसका इम्पैक्ट दिखे। कॉम्प्लायंस का मेन गोल है फेयरनेस, यहाँ पे आप देख सकते हैं कॉम्प्लायंस का मेन गोल क्या है दोस्तों, फेयरनेस, इथिकल वैल्यू, लॉफुल बिहेवियर। तो कॉम्प्लायंस का मेन गोल है फेयरनेस। फिर उसके बाद है कॉन्फ्लिक्ट को हैंडल करना, कॉन्फ्लिक्ट मैनेजमेंट, और कस्टमर राइट को रेस्पेक्ट करना। इसके मैट्रिक्स भी ट्रैक करते हैं ताकि पता चल सके कि हम कितना इम्प्रूव हो रहे हैं, राइट। तो इसके इंपॉर्टेंट मैट्रिक्स भी होते हैं, जैसे कि ये मैट्रिक्स जो है कॉम्प्लायंस प्रोग्रेस को ट्रैक करते हैं, इफेक्टिवनेस को ट्रैक करते हैं, ये बताते हैं कि हम कितना इम्प्रूव हो रहे हैं, राइट। अब देखिए बैंक्स के लिए इसका काफ़ी बेनिफिट्स है। यदि हम बैंक्स के पर्सपेक्टिव में बात करें तो इसका काफ़ी बेनिफिट है, जैसे कि रिस्क रिड्यूस होता है। यहाँ देखिए इस स्लाइड में हम लोग डिस्कस करने वाले हैं, ठीक है। और जैसे क्या क्या बेनिफिट है, जैसे कि रिस्क कम होता है इससे, और एम्प्लॉय का कॉन्फिडेंस और ट्रांसपेरेंसी इंप्रूव होता है। एम्प्लॉय कॉन्फिडेंस एंड ट्रांसपेरेंसी, रिस्क कम होना, और रेगुलेटर्स और इन्वेस्टर के साथ रिलेशन और स्ट्रॉन्ग होते हैं, ये सबसे बड़ा फ़ायदा है। तो ये कॉम्प्लायंस कल्चर कैपिटल प्लानिंग और स्ट्रेस टेस्ट में भी सपोर्ट करता है। ये चीज़ आपको समझ में आया। तो बेसिकली हमने क्या देखा कि इस स्लाइड के माध्यम से हमने देखा कि कॉम्प्लायंस कल्चर होता क्या है, इसकी एसेंस क्या है, और फिर उसके बाद इसके मैट्रिक्स कैसे होते हैं, इसका मीनिंग क्या है, इसका गोल क्या है, और बैंक के पर्सपेक्टिव में कैसे ये बेनिफिशियल है ये कल्चर। चलिए अब हम लोग अगली स्लाइड में आते हैं और हम लोग देखेंगे पुअर कॉम्प्लायंस कल्चर का मतलब क्या है। देखिए पुअर कॉम्प्लायंस कल्चर का मतलब है जब ऑर्गेनाइजेशन शॉर्ट टर्म गेन पे फोकस करती है और लॉन्ग टर्म स्टेबिलिटी को इग्नोर करती है, ठीक है। ऐसे कल्चर में डोमिनेंट लोग कंट्रोल में होते हैं लेकिन ओवरसाइट वीक होता है, डोमिनेंट इंडिविजुअल, वीक ओवरसाइट, ठीक है। ऐसे कल्चर में मैंने आपको बता दिया डोमिनेंट लोग कंट्रोल में होते हैं। रेगुलेशन को सिर्फ टिक बॉक्स के लिए फॉलो किया जाता है, राइट, और इंटरनल कंट्रोल को शॉर्ट टर्म बेनिफिट के लिए कॉम्प्रोमाइज़ किया जाता है, राइट। यहाँ लिखा गया है टिक बॉक्स अप्रोच टू रेगुलेशन, और इंटरनल कंट्रोल में ब्रीचेज रहते हैं इमीडिएट बेनिफिट के लिए। दोस्तों आप यदि बुक में पढ़ेंगे इस टॉपिक को तो लगभग आपको 30 से 40 पेज में कंटेंट मिलेगा, और हमारे इस वीडियोस के माध्यम से मात्र 10 मिनट में इंपॉर्टेंट पॉइंट्स को आप कवर कर सकते हैं। और ये जो कंटेंट है हमारे कैप्सूल कोर्स का पार्ट है, एवीएम का कैप्सूल कोर्स में आप इनरोल हो सकते हैं। डिटेल में डिस्क्रिप्शन में उसका लिंक अवेलेबल है, यार मुझे इस नंबर पर व्हाट्सएप भी कर सकते हैं। कैप्सूल कोर्स में आपको हर एक यूनिट के इस प्रकार के 10 मिनट मिरेकल PDF मिलते हैं, जिसके माध्यम से आपका रिविजन बहुत ही फास्ट हो सकता है। चलिए आगे बढ़ते हैं। हम लोग बात करते हैं कि यहाँ रिस्क मैनेजमेंट के लिए इंसेंटिव नहीं होते, लैक ऑफ इंसेंटिव फॉर रिस्क मैनेजमेंट, और इशूज़ को छुपाया जाता है, कंसीलिंग इशूज़, किसी को ओपनली बात करने से डिस्करेज किया जाता है, राइट। और यह सब रिस्क ब्लाइंड स्पॉट क्रिएट करते हैं। यही सब ऑब्वियसली हम लोग बात किसकी कर रहे हैं, हम लोग पुअर कॉम्प्लायंस कल्चर की बात कर रहे हैं। तो यह सब रिस्क ब्लाइंड स्पॉट क्रिएट करते हैं जिससे दूसरे लोगों की पर्सपेक्टिव को इग्नोर हो जाती है। अब इसका कॉस्ट क्या होता है, तो प्योर कॉम्प्लायंस के काफ़ी कॉस्ट होते हैं, जैसे कि सैंक्शन, फाइनेंशियल लॉस, रेपुटेशन डैमेज। एग्जांपल के लिए ग्लोबली 400 बिलियन से ज़्यादा पेनल्टीज लग चुकी हैं 2008 से। इंडिया में आरबीआई ने 2020-21 में 34 एंटिटीज़ पर टोटल 90.51 करोड़ का फाइन लगाया है। तो अब आपके बुक में बहुत सारे बैंक का एग्जांपल दिया है, वो हमारे लिए रेलेवेंट नहीं है एग्जामिनेशन पॉइंट ऑफ व्यू से। तो इसको इम्प्रूव करने के लिए ऑर्गेनाइजेशन को क्लियर डूज ऑन डोंट्स डिफाइन करना चाहिए सब एम्प्लॉय के लिए। ये आपका डू है और ये आपका डोंट है। और फिर जो हमारे मिसकंडक्ट केसेस हैं उसको एक लर्निंग अपॉर्चुनिटी की तरह यूज़ करना चाहिए ताकि आगे ऐसे मिस्टेक अवॉइड हो सकें, राइट। चलिए आगे बढ़ते हैं। आइए समझते हैं कि अगले पॉइंट में हम लोग डिस्कस करेंगे कि आरबीआई ने कुछ कॉमन पेनल्टी ट्रिगर और कंप्लायंस प्रोग्राम के बारे में आइए डिस्कस करते हैं। तो आरबीआई पेनल्टी लगाता है अगर बैंक मिस सेलिंग करे। यहाँ देखिए मिस सेलिंग डेरिवेटिव, तो अगर बैंक मिस सेलिंग करे तो आरबीआई उस पर पेनल्टी लगाता है, जैसे डेरिवेटिव प्रोडक्ट गलत सेल करना या केवाईसी एएमएल नॉर्म्स का नॉन कॉम्प्लायंस, रेगुलेटरी या इंटरनल रूल ब्रेक होना जैसे ड्यू डिलीजेंस का लैप्स होना या फिक्स डिपॉजिट का मिसयूज होना। यह सभी बड़े ये सब के सब ट्रिगर्स कहलाते हैं और ये सेक्शन 46 सब सेक्शन 4 और 53(1) में लिखा गया है। कॉम्प्लायंस का मेन पर्पज़ क्या है कि यह बैंक अपने ट्रस्ट और रेपुटेशन को बनाए रखें और मिसकंडक्ट से सीखने के लिए केस स्टडी का यूज़ करना ज़रूरी है। जैसे कि आप रिसेंट केस में एयरटेल पेमेंट बैंक का केवाईसी इशू आया, इक्विटास स्मॉल फाइनेंशियल बैंक का लाइसेंसिंग इशू आया, ये सब रिसेंट केसेस हैं, ठीक है। तो यहाँ पे वही बात की जा रही है कि कॉम्प्लायंस का मेन पर्पज़ यही है कि बैंक अपने ट्रस्ट और रेपुटेशन को बनाए रखें, मिसकंडक्ट से सीखने के लिए केस स्टडी होना बहुत ज़रूरी है, राइट। अब देखिए इंडिया में आरबीआई ने क्या किया है, आरबीआई ने लैंडिंग, राइट, फाइनेंस और स्टैट्यूटरी रूल्स लैप्स के लिए भी पेनल्टी लगाई है। देखिए लैंडिंग, फाइनेंस एंड स्टैट्यूटरी रूल पर लैप्स आएंगे तो आरबीआई पेनल्टी लगाएगी। कॉम्प्लायंस को डेली ऑपरेशन में इंटीग्रेट करना चाहिए, लिखा गया है ना, इंटीग्रेट कॉम्प्लायंस इन डेली ऑपरेशन, क्योंकि यह कल्चर का कोड है। कॉम्प्लायंस को डेली ऑपरेशन में इंटीग्रेट करना चाहिए क्योंकि यह कल्चर का कोड माना जाता है, राइट। यू कैन सी कल्चर इट इज़ कोर फॉर ट्रस्ट, इंटीग्रिटी एंड लॉफुल कंडक्ट। कॉम्प्लायंस रूल्स तो 1992 से ही है, लेकिन क्राइसिस के बाद इस पर और इम्फेसिस दिया गया ताकि फ्रॉड कम से कम हो, राइट। और एक स्ट्रॉन्ग कॉम्प्लायंस प्रोग्राम बनाने के लिए यह स्टेप फॉलो करने चाहिए। आइए देखते हैं कौन कौन से स्टेप है। पहला है कि रिटर्न पॉलिसी बनाएं, उसके बाद एक कॉम्प्लायंस ऑफिसर और कमेटी को अपॉइंट करें, उसके बाद रेगुलर ट्रेनिंग दें, इनकरेज करें, ओपन कम्युनिकेशन को इनकरेज करें, इंटरनल मॉनिटरिंग और ऑडिट रखें और स्टैंडर्ड इन्फोर्स करें और करेक्टिव एक्शन लें। तो ये सभी है हमारा। अब आगे हम लोग बात करते हैं कॉम्प्लायंस कल्चर और इन्हांसमेंट, राइट। सो कॉम्प्लायंस कल्चर और इन्हांसमेंट के बारे में बात करते हैं कि कॉम्प्लायंस कल्चर को स्ट्रॉन्ग बनाने के लिए कुछ की एट्रीब्यूट्स होने चाहिए। तो सबसे पहले क्या है कि लीडरशिप का सपोर्ट होना चाहिए, राइट, जिसे हम टोन एट द टॉप भी कहते हैं। इसको क्या कहा जाता है, टोन एट द टॉप, जिसको क्या कहा जाता है, लीडरशिप सपोर्ट, टोन एट द टॉप। ये कल्चर पूरी ऑर्गेनाइजेशन में इंटीग्रेट होना चाहिए और कंप्लायंस स्टाफ का रोल विजिबल और इंडिपेंडेंट होना चाहिए। पॉलिसी सब पर यूनिफॉर्मली अप्लाई होनी चाहिए और रिवार्ड्स रिस्क के बेसिस पर होना चाहिए। और दूसरी बात यह है कि सिर्फ प्रॉफिट पर नहीं, मतलब रिवार्ड जो है रिस्क के बेसिस पर होना चाहिए, सिर्फ प्रॉफिट पर नहीं होना चाहिए। दूसरी बात है कि एक स्ट्रक्चर्ड कॉम्प्लायंस प्रोग्राम के लिए फंडिंग और टारगेटेड ट्रेनिंग ज़रूरी है। कॉम्प्लायंस में इन्वेस्टमेंट करना भी इम्पॉर्टेंट है जिससे फाइनेंशियल और रेपुटेशनल लॉस प्रिवेंट किया जा सके। यहाँ देखिए लिखा जा रहा है कॉम्प्लायंस इन्वेस्टमेंट, ओके। बैंक अपने कॉम्प्लायंस इन्हांस कर सकते हैं ऑटोमेशन और टेक के थ्रू। आइए देखते हैं कैसे हम लोग इन्हांस कर सकते हैं टेक्नोलॉजी के माध्यम से। तो ऑटोमेशन और टेक से क्या होगा कि आपका एरर कम होता है और रिकॉर्ड मेंटेन करके कॉम्प्लायंस कमिटमेंट भी दिखाया जा सकता है। जहाँ तक बात है बोर्ड और मैनेजमेंट की, तो बोर्ड और मैनेजमेंट के रोल इंपॉर्टेंट होते हैं। बोर्ड इंटीग्रिटी प्रमोट करता है और मैनेजमेंट कॉम्प्लायंस को इन्फोर्स करता है। कॉम्प्लायंस के लिए क्लियर और कंटिन्यूस कम्युनिकेशन और कॉम्प्लायंस कल्चर को इनकरेज करने के लिए इंसेंटिव भी ज़रूरी है। लिखा गया है ना, क्लियर कम्युनिकेशन, इंसेंटिव, ये सभी ज़रूरी हैं। प्रिवेंटिव कॉम्प्लायंस से फ्यूचर में ब्रीचेस को अवॉइड किया जा सकता है, क्योंकि प्रिवेंटिव का नाम ही रखा है ना कि जो फ्यूचर में ब्रीचेस आएंगे उसको हम लोग अवॉइड कर सकते हैं। चलिए अब हम बात करते हैं कि कॉम्प्लायंस ऑर्गेनाइजेशन एंड जीआरसी सॉल्यूशन। तो देखिए दोस्तों, कॉम्प्लायंस ऑर्गेनाइजेशन को स्ट्रॉन्ग बनाने के लिए रिस्क मैनेजमेंट के साथ अलाइनमेंट और ऑपरेशनल रिस्क के साथ कोलैबोरेशन इंपॉर्टेंट है। मैं फिर से रिपीट कर दूं कि कॉम्प्लायंस ऑर्गेनाइजेशन को स्ट्रॉन्ग बनाने के लिए रिस्क मैनेजमेंट के साथ अलाइनमेंट, किसके साथ अलाइनमेंट, रिस्क मैनेजमेंट के साथ अलाइनमेंट, और दूसरी बात कि कोलैबोरेशन दोनों इंपॉर्टेंट है। तो इसमें एक की पॉइंट है कि कंप्लायंस टीम को अथॉरिटी, इंडिपेंडेंस, रिसोर्सेज और बोर्ड का एक्सेस मिलना चाहिए। किसको मिलना चाहिए? कंप्लायंस को, कंप्लायंस टीम को। अथॉरिटी होना चाहिए, इंडिपेंडेंट होना चाहिए, रिसोर्सेज और बोर्ड का एक्सेस मिलना चाहिए। इंटरनल ऑडिट का काम है इंडिपेंडेंट रिव्यू देना, ऑब्वियस सी बात है। और जो हमारे चीफ कंप्लायंस ऑफिसर होते हैं, CCO जिनको कहा जाता है, राइट, तो चीफ कंप्लायंस ऑफिसर कंप्लायंस कल्चर, कंप्लायंस पॉलिसी और अवेयरनेस डेवलप करता है। यदि हम बात करें रिस्क आइडेंटिफिकेशन की, तो दोस्तों कंप्लायंस कल्चर का मेन फोकस है रिस्क को प्रोएक्टिवली आइडेंटिफाई करना, रिस्क को प्रोएक्टिवली आइडेंटिफाई करना बिजनेस एरिया में। अब थोड़ा हम GRC की बात करते हैं, जिसका फुल फॉर्म होता है गवर्नेंस, रिस्क एंड कंप्लायंस, यानी GRC सॉल्यूशन। GRC सॉल्यूशन के थ्रू ये और भी स्ट्रांग होता है। गवर्नेंस के अंदर कंट्रोल, पॉलिसीज, रिस्क और कंप्लायंस को इंटीग्रेट किया जाता है, जो कि स्कोर कार्ड और डैशबोर्ड के साथ मॉनिटर होता है। रिस्क मैनेजमेंट स्ट्रक्चर्ड रिस्क असेसमेंट और मॉनिटरिंग के थ्रू इंश्योर होते हैं। और कंप्लायंस को सस्टेनेबल बनाया जाता है रिपीटेबल प्रोसेस के साथ। देखिए लिखा जा रहा है, राइट, रिपीटेबल प्रोसेस फॉर सस्टेनेबल कंप्लायंस एट ऑल लेवल, राइट। तो कंप्लायंस को रिपीटेबल प्रोसेस के साथ सस्टेनेबल बनाया जाता है। यदि हम बात करें इंटीग्रेटेड प्लेटफॉर्म की, आजकल वेब बेस्ड GRC ऐप भी हैं जो यूज़र फ्रेंडली मॉड्यूल्स ऑफर करते हैं। यहाँ देखिए वेब बेस्ड GRC ऐप है जो यूज़र फ्रेंडली मॉड्यूल ऑफर करते हैं, जैसे इंसिडेंट मैनेजमेंट, जैसे RCS, फुल फॉर्म पूछा जा सकता है, रिस्क कंट्रोल सेल्फ असेसमेंट, जैसे KRI, की रिस्क इंडिकेटर। चलिए यहाँ तक क्लियर है आपको। अब जरा बात करते हैं कि इंटीग्रेटेड GRC के कुछ इंपॉर्टेंट बेनिफिट्स हैं। यह रिडंडेंसी को एलिमिनेट करता है, यानी डुप्लीकेट एफर्ट को अवॉइड करके स्ट्रीमलाइन करता है। यह कॉस्ट एफिशिएंसी भी लाता है, क्योंकि यूनिफाइड रिसोर्सेज का यहाँ पे यूज होता है। रिस्क और कंप्लायंस प्रोसेस क्लियर और कंसिस्टेंट होते हैं, राइट। और एक सेंट्रलाइज प्लेटफॉर्म प्रोवाइड करता है जिसमें सारी कंप्लायंस और रिस्क इन्फॉर्मेशन अवेलेबल होती हैं। ओके, अब विसल ब्लोअर पॉलिसी की बात करते हैं। देखिए इसमें क्या बताया जा रहा है कि ये अनइथिकल एक्शन को सेफ तरीके से रिपोर्ट करने का मौका देती है बिना किसी रिटेलिएशन के। मैं फिर से रिपीट कर रहा हूँ कि जो अनइथिकल रिएक्शन है उसको सेफ तरीके से रिपोर्ट करने का मौका देती है बिना किसी रिटेलिएशन के। तो विसल ब्लोअर की आइडेंटिटी प्रोटेक्ट होती है और डिस्क्रिमिनेशन नहीं होता। फिर यह पॉलिसी उन लोगों को भी प्रोटेक्ट करती है जो रिपोर्टिंग प्रोसेस में सपोर्ट करते हैं, राइट। उसके बाद गुड फेथ रिपोर्ट को जो जेन्युइनली किया गया है उन्हें प्रोटेक्शन मिलता है, लेकिन मैलिशियस यानी कि गलत नीयत से किया गया रिपोर्ट प्रोटेक्टेड नहीं है। और अगर इशू पब्लिक मैटर से रिलेटेड है तो CEO की अप्रूवल ज़रूरत है, CEO के अप्रूवल की आवश्यकता है यदि पब्लिक मैटर से रिलेटेड कोई मैटर है तो। ये बातें क्लियर हो रही हैं। एक एक चीज़ को मैं सिंपल भाषा में समझा रहा हूँ ताकि इससे रिलेटेड कोई भी सवाल आपसे पूछे आप जवाब दे पाएँ। वीडियो को लाइक करना मत भूलिएगा यदि चीज़ें आपको क्लियर लग रही हैं तो। विसल ब्लोअर कंप्लेंट प्रोसेस काफ़ी सिंपल और ट्रांसपेरेंट होता है। जब कोई वायलेशन या अनइथिकल एक्शन दिखे तो वो अपने कंसर्न को ओम्बड्स पर्सन या CBO को रिपोर्ट कर सकते हैं, ओम्बड्स पर्सन या CBO को रिपोर्ट कर सकते हैं। और अगर किसी ने रिटेलिएशन बिहेवियर दिखाया तो उसके अगेंस्ट डिसिप्लिनरी एक्शन लिया जाता है। विसल ब्लोअर पॉलिसी में कवरेज है हर टाइप की वायलेशन को इंक्लूड करता है, जिसमें से हैरेसमेंट, फ्रॉड, इलीगल एक्ट, अनफेयर प्रैक्टिस और कॉन्फ्लिक्ट, ये सब के सब हैं। अब देखिए रिपोर्टिंग का स्टेप क्या है। पहले अपने कंसर्न को लिखित या वर्बल फॉर्म में ओम्बड्समैन या CBO को रेज करें। उसके बाद रिव्यू के लिए ओम्बड्समैन या CBO या ऑडिट कमेटी चेक करती है कि कोई कोड ब्रीच तो नहीं हुआ है। फिर कॉन्फिडेंशियलिटी का ध्यान रखा जाता है, आइडेंटिटी प्रोटेक्ट होती है जब तक डिस्क्लोजर इन्वेस्टिगेशन में मदद न करे, और फॉल्स क्लेम पर पेनल्टी लगती है। और फाइनली इन्वेस्टिगेशन के दौरान, अगले स्लाइड में चलते हैं दोस्तों, फाइनली क्या होता है, इन्वेस्टिगेशन के दौरान ऑडिट कमेटी इन्वॉल्व पार्टी को इंटरव्यू भी करता है। अगर फाइंडिंग बोर्ड को रिपोर्ट करनी है तो ओम्बड्समैन या CBO डिटेल रिपोर्ट बोर्ड को सबमिट करते हैं। एम्प्लॉय अपने कंसर्न HR हेड, डिपार्टमेंटल हेड, लीगल कॉम्प्लाइंस हेड, CEO या मैनेजमेंट कमेटी को भी रिपोर्ट कर सकता है। अब देखिए विसल ब्लोअर प्रोटेक्शन एक्ट 2011 अभी इनैक्टमेंट के लिए पेंडिंग है, और लेकिन सुप्रीम कोर्ट ने एंटरिम मेजर के रूप में IDP रिजोल्यूशन 2004 को इफेक्टिव कर दिया। मतलब अभी तक इसको इनैक्टमेंट किया नहीं गया है 2011 का जो ये एक्ट है, लेकिन सुप्रीम कोर्ट ने IDP रिजोल्यूशन 2004 को इनैक्ट कर दिया है, राइट। अब यदि हम बात करें एजेंसी की, तो विसल ब्लोअर कंप्लेंट को हैंडल करने के लिए सेंट्रल विजिलेंस कमीशन होता है, CVC जिसको बोलते हैं। जो गवर्नमेंट मिसकंडक्ट से रिलेटेड कंप्लेंट को इन्वेस्टिगेट करता है, जो भी मिसकंडक्ट है उस कंप्लेंट को इन्वेस्टिगेट करता है। यह कंप्लेंट पब्लिक सर्वेंट और एनजीओ के लिए एक्सेप्ट होती है, लेकिन आर्टिकल 33 है, ये ध्यान से सुनिएगा, यह जो कंप्लेन है पब्लिक सर्वेंट और एनजीओ के लिए एक्सेप्ट होती है, लेकिन आर्टिकल 33 ए से लेकर 33 डी के अंदर जो लोग एक्सक्लूडेड हैं उनकी कंप्लेंट नहीं ली जाती। ठीक है, तो इसके लिए मैं क्या बता रहा हूँ कि जो विसल ब्लोअर कंप्लेंट को हैंडल करने के लिए काम सीबीसी का होता है, जो गवर्नमेंट मिसकंडक्ट से रिलेटेड कंप्लेंट को इन्वेस्टिगेट करती है। यह कंप्लेंट पब्लिक सर्वेंट और एनजीओ के लिए एक्सेप्टेबल होती है। आर्टिकल 33 ए से लेकर 30 में जो लोग भी हैं उन्हें एक्सक्लूडेड हैं। एनोनिमस कंप्लेन को एक्सेप्ट नहीं किया जाता। विसल ब्लोअर की आइडेंटिटी प्रोटेक्टेड होती है, लेकिन अगर डिस्क्लोजर इन्वेस्टिगेशन में मदद करता हो तो आइडेंटिटी डिस्क्लोज की जा सकती है। हेड को इंश्योर करना पड़ता है कि कॉन्फिडेंशियलिटी मेंटेन रखे। अब देखिए, इन्वेस्टिगेशन के दौरान सीबीसी, सीबीआई या पुलिस को भी इन्वॉल्व कर सकता है। विसल ब्लोअर प्रोटेक्शन में एक डेजिग्नेटेड एजेंसी होती है, यहाँ देखिए लिखा जा रहा है, विसल ब्लोअर में एक्ट में एक डेजिग्नेटेड एजेंसी होती है जो कि मिसयूज को इन्वेस्टिगेट करती है और एक्शन रिकमेंड करती है। अगर इन्फॉर्मेंट को विक्टिमाइज किया गया हो तो वो प्रोटेक्शन ऑर्डर के लिए रिक्वेस्ट कर सकता है। जिसने इन्फॉर्मेशन दिया उसको यदि विक्टिमाइज किया जा रहा हो तो वो प्रोटेक्शन ऑर्डर के लिए रिक्वेस्ट कर सकता है। दूसरी बात यह है कि अनऑथराइज आइडेंटिटी लीक पर पेनल्टी लगती है। यदि हम सीबीओ की बात करें, जो हमारे चीफ विजिलेंस ऑफिसर होते हैं, वो मिनिस्ट्री में कंप्लेंट एक्सेप्ट कर सकते हैं और सीबीसी पीआई डीपीआई के अंदर कंप्लेंट को मॉनिटर करता है और प्रोटेक्शन इंश्योर करता है। ये पीआई डीपीआई एक्ट है जिसको मैंने बोला था 2004 में लॉ आया था। अब हम आगे बात करते हैं दोस्तों कि विसल ब्लोअर कंप्लेंट को हैंडल करने का काम सीबीसी का होता है। बार बार मैं ये बोल रहा हूँ, सीबीसी जो गवर्नमेंट मिसकंडक्ट के केस को इन्वेस्टिगेट करता है, लिखा है ना, गवर्नमेंट मिसकंडक्ट को इन्वेस्टिगेट करता है। यह कंप्लेंट पब्लिक सर्वेंट और एनजीओ की ली जाती है। अभी ये सब चीज़ मैंने आपको बताया है यहाँ पे, किससे ली जाती है, एनजीओ से, पब्लिक सर्वेंट से ली जाती है, जो कि और आर्टिकल 33 ए से लेकर डी के अंदर जो एक्सक्लूडेड है। एनोनिमस कंप्लेंट को एक्सेप्ट नहीं किया जाता। विसल ब्लोअर की आइडेंटिटी को प्रोटेक्ट किया जाता है, लेकिन अगर डिस्क्लोजर इन्वेस्टिगेशन में मदद करे तो आइडेंटिटी डिस्क्लोज भी किया जाता है। अगर इन्वेस्टिगेशन की जरूरत हो तो सीबीसी, सीबीआई का, पुलिस का हेल्प ले सकती है। अच्छा, विसल ब्लोअर पॉलिसी में एक डेजिग्नेटेड एजेंसी होती है, मैंने बताया आपको, जो कि मिसयूज को इन्वेस्टिगेट करती है और एक्शन रिकमेंड करती है। अगर विसल ब्लोअर को विक्टिमाइज किया जाए तो वो प्रोटेक्शन ऑर्डर रिक्वेस्ट कर सकता है। अभी मैंने आपको बताया कि जो सीवीओ होते हैं वो मिनिस्ट्रीज़ में कंप्लेंट को एक्सेप्ट कर सकते हैं और सीबीसी पीडीपीआईपी के अंदर कंप्लेंट को मॉनिटर करके प्रोटेक्शन प्रोवाइड करती है। अब थोड़ा हम बात कर लेते हैं सेबी रिक्वायरमेंट एंड रिपोर्टिंग का। तो सेबी के अंदर लिस्टेड कंपनी जो है कॉर्पोरेट गवर्नेंस को इनेबल करेंगे रिपोर्टिंग चैनल के साथ अनएथिकल एक्शन के लिए, और इनका जो मैकेनिज्म होगा वो उनके जो ऑडिट कमेटी है उनको डायरेक्ट एक्सेस मिलेगा फॉर केसेस इन्वॉल्विंग सीनियर मैनेजमेंट के जो केसेस हैं वो किनको मिलेगा, ऑडिट कमेटी को मिलेगा। और इससे क्या होगा कि एम्प्लॉय को सेफगार्ड जरूरी है ताकि एम्प्लॉय को रिटेलिएशन से बचाया जा सके, और पॉलिसी को ऑडिट कमेटी के द्वारा रिव्यू किया जाएगा टाइम टू टाइम। इससे क्या होता है, पॉलिसी का मेन पर्पस ये होता है कि जो एथिकल और जो लीगल ब्रीचेज हैं उसको रिपोर्ट करना, ट्रांसपेरेंसी प्रमोट करना। स्ट्रक्चर, द बोर्ड ऑफ डायरेक्टर एंड द ऑडिट कमेटी आर लाइक सुपरवाइजर, दे मेक श्योर एवरीवन फॉलोज द रूल। The CCO, Chief Compliance Officer, leads compliance and report to the MD and CEO or board or ACB. Compliance is not just at the top. It is everywhere. It is at corporate office, it is at regional office, it is at branches. The CCO's performance is regularly reviewed by the board and the audit committee. Now, let's talk about the role of board and senior management. It all starts from the top. The board and senior management lead by example. They create a compliance policy and the CCO reports to them. They make sure there is no conflict of interest and fix any compliance problem quickly. The board does regular review quarterly and annually to keep everything in check. Senior management role. Senior management, the CCO is chosen by a senior committee. CCO is chosen by a senior committee while the board having the final say. Before the CCO is appointed, they notify the RBI and certify that the CCO is fit and proper. They also make sure the board stay updated with all the regulatory changes and the standards. Now, next point we will discuss that let's talk about the key responsibility of compliance and how things work at the corporate level in simple terms. Let's talk about the key compliance responsibility, testing and reporting. Bank run tests to check if they are following all the rules and report all the results to the board, ACB, audit committee, MD and CEO. Sustaining compliance. Compliance is not just one time thing, it is a part of yearly review process. Plus, they ensure everything aligns with the RBI guideline. Risk management. Every year, the bank check for compliance risk and create a plan to handle them. Compliance structure at the corporate office. Departmental setup. The compliance department is based on central or head office. CCO role. CCO, that is Chief Compliance Officer, is a senior person like a general manager, making sure every compliance risk are managed and teams stay on track. Compliance basis. They follow rules from RBI, laws and internal policy. Risk assessment. This is done by looking at factors like past mistake, the nature of bank activities and how exposed they are to regulatory risk. Independence. The compliance team must focus on compliance, not audit, to avoid any conflict of interest. Coordination and staffing. Teamwork and staffing. The CCO work with all departments and is supported by experts in field like law, accounting, IT and business. And that's it. Compliance is all about making sure rules are followed and risks are managed effectively. Now, let's talk about how bank handle regulatory compliance and how compliance department work at the head office. So friends, see, regulatory compliance officer. Bank have separate compliance officer for different regulators like IRDA, SEBI, etc. And they work stay separate. Any concern raised by these regulators are reported to the RBI via chief compliance officers. Right. So regulators means RDI, IRDA, SEBI, these are the regulators, and any concern they are reported to RBI via CCO. So CCO report all these concern to RBI. Now compliance department at head office. So the bank identify which business function must follow regulatory rules. For each product or process, they assess the compliance risk for each product and for each process. Right, they assess the compliance risk to ensure everything is on track. They make sure guidelines and quarterly compliance report are shared on time with the audit committee. Communication system. They also set a communication system to make sure that compliance information flow smoothly between branches and departments. Now, let's talk about each department get a specific compliance requirement and return to submit to authority. Breach circulation. If there is any compliance breach, it is reported to the department along with way to prevent it. CCO. The CCO also play a key role in monitoring new product or services for 6 months to manage any compliance risk. Remember this 6 month term very important. Let's talk about the coordination and compliance. Business operation and compliance team work closely together to keep everything aligned. A compliance checklist is given to auditor to verify branches. The compliance department review any inspection or audit finding related to the compliance, and that's wrap it up. Compliance is all about staying on the top of regulation and making sure that bank run smoothly. Now let's talk about some important responsibility of bank compliance team. So what are the important responsibility of bank compliance? As you can see, compliance testing, right? So let's dive into we break down some important responsibility of bank compliance team, what they do and why does it matter. First we have compliance testing, as you can see it here. See, this is when the bank check its branch to make sure they are following all the rules and guidelines set by the regulators. Think of it as a way to keep everyone in line. Then next we have RBS, that is risk based supervision, or RBS. The bank work closely with the RBI special team to assess risk in different areas. This help the bank stay safe and prepared. Then we have RBI coordination. Speaking of the RBI, the bank also need to respond to RBI queries and submit all necessary report quickly. This is what we call RBI coordination. Then we have cross-border business. For any international banking services, the bank has to make sure it follow all legal rules. This is known as cross-border compliance. Then we have reporting. Branches have to send report every month or quarter, and these are consolidated to give the bigger picture to the board. And then we have overseas. Now for the overseas branch, what is the rule? Overseas branch need to keep their KYC and anti-money laundering policies up to date, and they also need to send periodic certification back to the head office to ensure everything is running smoothly. Then we have testing, as you can see, testing. So just like in local branch, overseas branch must conduct their own compliance test and report their finding. And finally they need to report their submit report to the regulators in their country, especially if there is an issue. Now let's then after you can see written here monthly, quarterly MIS reporting. So see, try to understand. Back to the main office, that is compliance department reporting. Back to the main office. See, the compliance department send regular report to the bank board of director. So every month they report key issues to the board, and every quarter they report key issues to the board. And every quarter they send update about communication with RBI and other regulators. So every month they report to the board via ED CMD on key role, and every quarter report to ACB on compliance function and RBI MOF Ministry of Finance communication status, right? And any department that receive a communication from RBI or other regulatory body must respond within 7 days. So this 7-day feedback is must, right? Like RBI, MOF, IBA, FIDI, FIMDA, any etc. Once a year, the compliance team assess how well the bank is managing its risk and report it to the board. Now there is something called exceptional reporting. What it means? See, if something seriously something goes wrong, like a major regulatory failure, that get reported too. And that's a quick breakdown of the bank compliance responsibility. It's all about staying on the top of regulation to avoid risk. Now let's talk about the CCO participation in committee. See, first let's talk about the chief compliance officer. This is called CCO. So, and the committee they can join. The CCO has a key responsibility to ensure that bank follow all the rules. So CCO can't be part of any committee where there might be conflict of interest, right? So however, they can still provide advice to those committee. The CCO can officially join certain committee like audit committee of board, like asset and liability committee, that is called ACE, that is CRMC, credit risk management committee, that is CORM, operational risk management committee, and product group committee, that is called PCE. So if the CCO needs to be part of any other committee, that is decided by the MD, CD or CEO. MD, CEO or ED decide. Now let's look at what each department does to make sure that they are following all the rules. So first is called compliance responsibility. Every department has to follow the law and the internal guideline. If something goes wrong or a rule is broken, they must report it to the compliance department. Now let's talk about the compliance officer role. So every department assigns a senior officer called compliance officer to take care of this. They are like the go-to person for all compliance related tasks. So what does the compliance officer do? Well, their main tasks include identifying risk and in their area and coming up with plan to reduce them, monitoring compliance and making sure everything runs smoothly, submitting report on time to the regulators and the boards, and finally, and of course, they clarify any question about compliance with the compliance department. They also participate in training session and stay updated on the latest rule and turn those guidelines into easy to follow instruction for the staff. Plus they set up a framework. You can see they set up a framework to keep track of how well the department is following the rule. Finally, when the RBI or any other regulators send a communication, department need to respond fast, and they send this feedback to the compliance department, and that's how the CCO and the other department work together to make sure the bank is always following the rule. Now let's talk about different departments and branches in bank that make sure they are following all the rules. This is the key part of creating a strong compliance culture. Let's break it down, right? So first thing first is role of functional department. First let's look at functional department and what they do for compliance. See, building compliance culture. This functional department help build a strong compliance culture by making sure all the information they submit to the RBI is accurate and up to date. Next we have these are responsible for monitoring compliance within their area and reporting any issues to the bank management, while the compliance department keeps an eye on things. Next we have regulatory communication. When the bank get any communication from RBI or other regulatory body, the compliance department forward it to the right team for confirmation. Sorry friends. Then we have update rules and manuals. They also regulatory update rules, manuals and standards and make sure these new guidelines reach everyone in the bank. Then we have key compliance area, that is the strategic compliance area. So each department is responsible for managing important area like KYC, AML, BCSBI, FEMA. They also make sure that important circular are displayed in all branches. Compliance certificates. At the branch level, they submit quarterly compliance certificate to the compliance department to show everything in order. Now let's talk about what happened at the branch level. See, in each branch, the branch manager plays a key role as the compliance officer. They make sure their branch is following the rules while balancing business goal. Now we have field level compliance officer. At the zonal and regional level, field level compliance officer are appointed. They report directly to the chief compliance officer to make sure everything is running smoothly. Remember, the field level compliance officer report, they are designated at FGMO, zonal regional office, and they report to CCO. Now if something goes wrong, these officers report breaches to their head so that corrective action can be taken immediately. Now let's move up to the regional and zonal office. So you can see they make sure that the compliance function at RO, ZO, FGMO. So they make sure that all the branches under them follow the rules and regulation and submit quarterly report to the central office. Just like in branch, if there is a breach in compliance, they report and take corrective action. Also, the internal control coordination. The inspection department also plays a role by checking compliance during inspection at their regional level. Lastly, the zonal and regional offices provide support to the branch, helping them to stay compliant. And that's how the bank department branches work together to maintain compliance at all level. Now let's talk about how bank manage compliance at their overseas center. So each overseas branch has its own compliance department, which is led by a local compliance officer. They make sure that the branch follow all local rules and regulation. The compliance officer is supported by an officer from India or local staff, depending on host country regulation. Let's talk about what does the compliance officer does. So they need to have a good understanding of all the statutory, regulatory and internal guideline. They report directly to the bank chief compliance officer, that is CCO, and monitor how well the branches are following the rules. They also conduct compliance tests to ensure to regularly and report the result to the CCO. The chief executive, you can see written here, the chief executive, which is called CEO, he is responsible for making sure all the compliance guidelines are followed, and HR department provide the right staff. Right, obviously HR department provide the right staff. Now next we have the learning and development team arrange regular training sessions to the compliance staff to keep them updated. Now let's talk about what happened when there is a compliance failure, that is called material compliance failure. See, compliance means following rules and requests set by both external body like regulator and internal guideline. Non-compliance can happen in different way, like through mistake in business operation, audit finding, or during regulatory inspection. So these are the source of failure. Now independent assessment body. Independent agencies assess compliance to make sure the bank maintains its integrity and trust, and that's how compliance is managed at overseas branch. Now let's talk about the basis of internal control in branch. Right, that is called material compliance. Compliance with following, obviously we have talked about this. Now material, let's talk about this compliance testing. Internal control is all about you can see internal control is all about making sure a bank run efficiently, follow the rules and reduces the risk. It helps keep the, you can see internal control, it helps keep the bank measure performance, make good decision, catches mistake or fraud before they become big problem. It is important that all staff understand the control and apply them consistently. Now control system management. Let's talk about this control system elements. What are the elements? So let's look at the key part of internal control system. This includes the commitment from the boards and management, a solid structure, ethics and employee competence. Then we have risk assessment. So that the bank need to identify and analyze risk to put the right control in place. Risk assessment means figuring out what could go wrong both inside and outside the bank. Once those risks are known, control like performance review or asset protection are put in place. Control and procedures, you can see written here, control and procedures. So the bank also has to keep clear written procedure that all staff follow. These procedure along with accounting and information system make sure decisions are based on timely and accurate information. Lastly, the bank need a strong control culture. So this means having a qualified staff, clear roles, and have accurate information flow, ongoing monitoring and self-assessment help keep the system in check. Now let's talk about the essential part of banking, that is information system audit and compliance. First up, let's talk about information system. Bank need a strong control to ensure integrity, security and privacy. It is also super important to have a tested backup failure in case the system fail. Next we have audit and record keeping. You can see, so the bank need an independent audit program that check everything on an annual basis and follow up on any issues. On the top of that, record keeping must follow proper accounting principle to reflect the bank true financial status. For physical asset, bank limit access, control cash, and ensure security with policies for tailored operation. Well trained staff are crucial for to keep thing running smoothly, and with India's banking becoming more digital, new regulatory challenges are emerging that bank need to stay on top of. Lastly, let's talk about compliance. It's more than just following the law, Bhansang. So it is an independent part of the bank that keeps an eye on the compliance risk, right? In simple terms, it helps the bank follow laws, rules, regulations, policies, right? And to avoid fines, to avoid fines and losses or damage its reputation, right? Laws, regulation, policies and codes. So to avoid fines and to avoid damaging its reputation, this compliance risk is very important. Now the next question is, what is its importance, why it is so important? So why every bank has a compliance policy, as you know? So compliance makes sure that the bank treat customer fairly, right? So for fair practices, this is very important, and gives good financial advice, right? So that's why it is quite important. Now it also helps the bank maintain trust by promoting ethical practices. You can see, build trust by ethical practices that go beyond just following the law. Now the next thing is, what are the challenges? What are the challenges? So as bank use more technology and grow financially, it become harder to keep up with regulation, making compliance even more critical. So this is one of the major challenges which the bank face. As I told you that the major challenge is that take financial integration increases regulatory challenges. Already we have discussed, right? Now compliance risk, let's talk about this compliance risk. See, when a bank does not follow the rules, it will face legal penalties, right? So if suppose a bank does not follow the rule, so it will face something called legal penalties, and also financial losses. Okay, it will also exposed to financial losses and reputational damage. That's why having a strong compliance policy is essential to avoid this risk. So in short, we can say that compliance help bank stay on track, build trust and operate smoothly, stick around for more. Okay, now let's come to the next part, that is compliance risk versus other risk. See, regulatory risk, the first risk you can see is regulatory risk. Not following rules can harm the bank reputation, customer and lead to penalty. So if you are not following the rule, it will harm the bank reputation, that is called reputational risk. And operational risk means what? This comes from bad processes within the bank, and compliance risk is a part of this operational risk process. The next is legal risk. So legal risk, if the bank break the law, it can face legal trouble and financial loss. Next come reputational risk. So when reputation takes a hit, the bank may lose customer and business. And the last is, so these are type of financial risk, and last is annihilation risk. So in extreme cases, regulator could shut the bank down, that is called annihilation risk. Next is non-financial risk. The first is business risk. Problem inside or outside the bank can affect how it operate and its profit. So some problem, some internal or external factor which affecting operation and profitability. Next is called strategic risk. If the bank strategies fail, right, it could hurt earning and capital in the future. So suppose bank strategies fail, so it could hurt earning and capital in the future. Now let's talk about compliance risk in the cyber security. Why it matter? In today tech driven banking, cyber security is crucial to keep data safe and operation smooth. Now cyber resilience, bank need a strong cyber defense to protect information and manage risk. Compliance function, the compliance team help identify and reduce cyber security risk. So this is what the role of compliance function. Now let's talk about RBI guidelines for bank compliance. You can see written here RBI guidelines. So bank must have a compliance policy within 6 months reviewed. It should be reviewed annually. Every year. Next thing is, this policy cover risk identification, risk monitoring and risk management. Annual reviews are required. Already I have told you that it is to be reviewed annually. Annual reviews are required. to ensure everything is running smoothly, that reports to RBI is accurate, right? So annual reporting. So basically what we have seen, that compliance is about more than following rule. It protects the bank from risk, especially in today's digital world, right? So you can see control and processes, compliance policy, and it covers compliance objective, scope, role of CCO. Everything we will cover in the upcoming slides. So friends, if you want PDF of such type of content, you can enroll in our ABM PDF plan. I am providing you concise notes, ultra micro notes, and also concise notes also. So you can take help of both of them. Now let's continue our discussion on compliance principle, process, and procedures. See how compliance work in bank. That is what we are going to discuss. See, the head office identify risk and give instruction to manage them, ensuring that the bank follow the rule. Now feedback come from audits and inspection to improve processes. For new products, the chief compliance officer, that is called CCO, clear them and monitor them for 6 months to ensure that they comply with regulation. The next is compliance manual. See, bank create compliance manual to guide staff on following rule. See, there is a regular interaction between compliance, legal, risk, audit, and taxation teams to stay aligned on the issue. Now let's talk about what is the role of CCO. See, CCO has full access to information. He can investigate any issue and participate in RBI discussion and to stay updated. The compliance function also include monitoring and reporting result to the management and to the board. So whatever result you have, whatever outcome you have got, you have to communicate those outcome to your board and management. If there are failure, they are disclosed in the bank annual report. The next thing is code of conduct. Bank have a code of conduct to ensure fair dealing with customer and regulatory compliance. So whatever key point we have covered, let's recap all those key point here. You can see, first thing we have seen that compliance function is independent. See, this is a unique feature of our PDF that I am again revising you all the key points which we have covered just now. See, the compliance function is independent. It ensuring that the bank follow laws, regulation, and ethical practices. The goal is to avoid legal trouble, financial loss, and reputational damage by following proper procedure. As bank become more tech driven, more tech focused, managing compliance become more challenging. So this compliance is a crucial part of keeping a bank secure and trustworthy. Now let's talk about compliance crucial. So let's talk about some more topic about compliance. So why is compliance important? Compliance ensure bank follow fair practices, conflict management, handle conflict well, and treat customer with integrity, right, and transparency. It help building trust. And now we have already discussed what is compliance risk. It happens when a bank does not follow rule, and we have discussed this type of risk: regulatory risk, operational risk, legal risk, reputational risk, annihilation risk, business strategic. Already we have covered all this. So let's jump over to the next topic. Okay, so we have seen the compliance policy, right? Cyber security and compliance, how it is related, how cyber resilience help mitigate the cyber security risk, we have discussed. Now let's talk about compliance policy and procedure. Yes, this is very important. See, so what does it mean to say that compliance policy is a part of bank governance program, right? It aligns with the RBI guidelines to manage risk and protect the bank reputation. So this policy includes objective, it includes scope and the role of the CCO, that is Chief Compliance Officer. What are the key elements of policy? The key elements of policy: risk management and internal control to ensure everything runs smoothly. And bank need to create a compliance policy within 6 months and renew it every year. This policy should cover the bank philosophy on the compliance and a strong and focus on managing risk. It should be tailored to the size and risk profile of the bank and must include a quality assurance program, right, with accurate reporting to the RBI. Now if we talk about the compliance principle and compliance procedure, the first come head office. So head office identify the risk, right? The head office identify the risk and give instruction on how to mitigate them. Next come is CCO. CCO is Chief Compliance Officer. It ensures that new products are monitored for 6 months to ensure compliance with regulation. Next come compliance manual. So what is compliance manual? Compliance manual are created for staff to follow, and there is a regular interaction between the compliance department and other teams. Now if we talk about the role of CCO, The CCO plays a key role in participating in RBI discussion and internal bank committee. Now they have the authority, the CCO have the authority to conduct investigation and can even bring in external expert if needed. The CCO regularly report any irregularity to the management and present its annual report on compliance failure to the board. Already we have discussed the code of conduct. Every bank has a code of conduct that emphasizes fair customer treatment and strict regulatory compliance. Right. Now let's discuss the compliance function and overview, compliance program and overview. Right. So it is what is a compliance program? So see, what is compliance program? It is a risk based program led by the head of the compliance and involve planned activity to ensure that bank follow all rules and regulation. And every year the bank does a compliance review to check for any failure, making sure they follow regulatory guidelines. The key activities in compliance program are: first thing is the bank conduct an annual risk assessment to figure out what the major risks are and how to handle them. Next is it also create a strategy for the upcoming year, right, and make sure there is a plan to mitigate risk effectively. And finally there comes compliance report are sent monthly to the senior management. Remember it is reporting, this is very important. So it is sent monthly to the senior management and the CEO, and quarterly to the board. If there are major failure, the board is informed immediately. Now if we talk about audit, the compliance function is reviewed every year by the internal audit to ensure everything is running smoothly. And then comes the role of compliance in bank. So the compliance function is independent. Already I have told you, it reported directly to the senior management and the board. It is responsible for identifying, assessing, monitoring and reporting compliance risk. To be effective, the compliance team must have enough resources, expertise and authority, and they also provide guidance and training to the bank staff. That is called multi-jurisdictional bank. Now if we talk about bank compliance scope and CCO rule, very very important. So what does a bank compliance cover? First thing is market conduct, ensuring fair practices in the market. Next is conflict management, that means handling conflict within the bank. Next is tax and advice, ensuring compliance with tax law and providing proper advice to the customer. Next is fair treatment, and the last comes statutory compliance. So statutory compliance means following important law like Banking Regulation Act, RBI Act and more. This comes under statutory compliance. Now if you talk about regulatory compliance, this means which are adhering to the guidelines set by RBI, SEBI and IRDAI, which are regulatory authority. Code of conduct means bank must follow ethical standards set by the boards like BC, SBI and IBA. Next comes accounting standards, so compliance with ICAI and SEBI for listed bank. Next come internal policy. So internal policy means ensuring that all the internal process and policy are followed. Now the next question is, who is responsible? Who is responsible for all this? So bank must set quarterly compliance. Already I have told you that reporting quarterly compliance report to the board and CCO, and director and chairman ensure that the corrective action are taken when needed. And if we talk about the role and responsibility of CCO, CCO is a key player in maintaining compliance. The CCO must serve for at least 3 years. They are appointed by ACB, that is audit committee of board or CEO, and an early removal must be approved by the board. Eligibility we talk about must be a senior executive, GM, general manager like or equivalent, must have 15 years of experience in banking or finance with at least 5 years in audit, finance, compliance or risk role, should have a strong understanding of industry regulation and risk management. And the final case is must have a clean record with no adverse observation from RBI. So the CCO plays a crucial role, as you all know, in keeping bank on track with compliance, from managing risk to ensuring bank follow all the necessary law. The CCO ensure smooth and ethical operation. Now already we have discussed CCO selection and appointment. See, let's dive into one more time. So senior executive committee recommend candidate for the CCO position. The board make the final decision. If we talk about RBI notification, so before appointing, transferring or removing CCO, notification to the RBI is required, and then comes supervisory approval. The selected CCO must have their profile and certification from approved by the managing director and CEO. Now direct reporting means the CCO report directly to the MD, CEO or ACB, annual committee, right, audit committee of board. Then there is quarterly meeting. So CCO meet with ACB quarterly without senior management present, ensuring open dialogue. And the next is authority. The CCO has access to all bank record and does not report to business verticals or pursue business target. Performance review. That means board and ACB are responsible for reviewing the CCO performance. Now CCO compliance responsibility. First thing, the CCO keep the board and senior management updated on regulatory rules and compliance and changes. Next thing is clarifying issue. They can clarify any compliance related issue. Assessing risk. It means an annual assessment of the compliance risk is conducted. Then the next comes is reporting. Major compliance risk are compliance risk or changes are reported to the board, ACB, MD, CEO. Conducting testing. The CCO conduct compliance testing. Sustaining compliance means they must ensure the compliance with RBI and other supervisory observations. Now let's talk about the last topic, that is dual hatting. See, the CCO cannot conflict business role, but cannot hold conflicting business role, but must take on non-conflicting roles as AML officer. Right, example, AML officer. Advisory role. They can serve on committee that do not create a conflict of interest, such as those involving purchases or sanction. Responsibilities. Designing and maintaining the compliance framework. Providing traveling on regulatory risk. So responsibility we have seen designing and maintaining the compliance framework, providing training, and communicate compliance as expectation clearly. If we talk about board oversight, so board ensure that CCO independence while being managed by MD and CEO. So the role of CCO is crucial for maintenance of compliance. Now let's see the key CCO observation. Key CCO responsibilities. The first responsibility is risk-based supervision and inspection of the supervisory evaluation ISE. So CCO coordinate with RBI supervisory strategy team for a Spark inspection. And next is they gather necessary data from the head office to prepare for inspection of the supervisory. Remember this full form. ISE means inspection for supervisory evaluation. Next is exit meeting. The CCO arranges exit meeting with top executive and the SSM team to finalize the RAR. RAR means risk assessment report. Supervisory meeting. Phase coordination of the meeting with RBI and senior executive is crucial. In this meeting, CCO present RAR, risk mitigation plan and supervisory rating. Next come action plan and compliance. The CCO submit a time-bound action plan to address any compliance-related issue and ensuring adherence to RAR and RMP. They report the compliance status and any emerging issue to the top management and audit committee of the board, ACB. Next is formulation of the compliance rule, that is CR. So the CCO ensure that a compliance rule, that is CR, are formulated and updated for all bank. Now let's do some MCQs. So the first question in the front of your screen, whatever we have discussed just now. If you really feel that this effort is useful to you, please hit the like button. Now the question is, which of the following best describe the compliance function of the bank? Option A says that the compliance function is dependent entirely within the bank. Compliance function is a dependent entity within bank responsible for minimizing only financial loss. This is incorrect because compliance function operate independently, not dependently, and also it address not only financial losses but also reputational, legal, regulatory and reputation. So this is wrong. Option B says that the compliance function focuses on adherence to internal policy only with no impact on reputational risk. This is incorrect because the compliance function is not limited to internal policy. It encompasses adherence to law, regulations and external standards. So this is wrong. Option C says that the compliance function is an independent function responsible for identifying, assessing. Yes, this is correct. Option D says that compliance function exclusively monitor compliance with market convention and legislation. So this is incorrect because the compliance function scope extend beyond just monitoring market convention and legislation. It also includes critical area like market conduct, conflict of interest and everything. Now let's move on to question number 2. So option number C is correct in this particular question. Question number 2 says that which of the following correctly explain the relationship between the compliance risk and other financial risk in the bank? So what is the relation? Option A says that compliance risk is type of legal risk exclusively concerning litigation and unmet legal obligation. This is incorrect because compliance risk encompasses a broader scope than just legal risk. It includes regulatory, operational and reputational risk. All of these are included. So it is wrong. First option is wrong. Option B says that compliance risk is a subtype of operational risk with implication for reputational, regulatory action and potential business course. So option B is correct because as it identifies compliance risk as a subtype of operational risk which can be lead to regulatory sanction and then reputational issue, etc. Option C said that compliance risk focuses solely on cyber security. This is incorrect because cyber security is a vital part of compliance risk. The compliance risk cover a wider range of issues, including market conduct, adherence to legal and regulatory adaptation. And what about option D? Option D says that the compliance risk has no impact on businesses or strategic risk as these are related to the external market factor. So see, this is incorrect because the compliance risk directly affect So option D is incorrect. As you know, compliance risk has no impact on business risk. This is wrong. Compliance risk can directly affect business risk and strategic risk. Non-compliance can lead to penalties that impact profitability. Next question is which of the following is true regarding the compliance function in bank as outlined by the compliance principle, process and procedures. First option say that the compliance function is primarily responsible for mitigating operational risk with no direct involvement in the new product clearance or annual reporting. So what about the first question? See, this is incorrect because the compliance function is directly involved in new product clearance. It is saying that it is not involved. No. New product clearance compliance function is involved, which involve monitoring for a specific period. It also plays a significant role in annual reporting to the management. The CCO plays a limited role in interdepartmental communication. This is incorrect because CCO has a broad and active role in interdepartmental communication, engaging with both internal department and external department, right? Option C says that the chief compliance officer is responsible for identifying compliance risk, overseeing new product clearance and ensuring regular interaction. Correct. Option D says that the compliance function is only accountable for internal audit and does not report any failure to the board. This is incorrect because compliance function is responsible for reporting compliance failure to the board of or audit committee of board. So they either they report to the board or audit committee of board, that is called ACB, and this failure must also be disclosed on annual report. Next question is which of the following statement accurately distinguishes compliance risk from other risks faced by the bank. So what are the options? First option says that compliance risk is primarily concerned with operational failure. See, so this is incorrect because while compliance is may relate to operational aspect, but it includes more than just operational failure. Legal risk, it includes potential legal consequence, right? Option A is wrong. Option B said the compliance risk is subtype of operational risk. So this is correct as it appropriately categorized the compliance risk as subtype of operational risk. It also emphasized the compliance risk can lead to reputational damage. Correct. Option B is correct. Option C says that the compliance risk deals with only cyber security concern and does not intersect with a strategic or business risk. See, this is incorrect because compliance risk is not limited to cyber security. It involves wide range of factors. Option D said that compliance risk is completely dependent on legal and reputational risk, which only occur from external factors like market condition and consumer trend. This is incorrect because compliance risk is not independent of legal and reputational risk. They are dependent, right? Last question: which of the following accurately describe the roles and responsibility of the CCO? Option A: the CCO has the sole authority to approve new product and does not need to monitor compliance once product is approved. This is wrong. See, once the product has been approved, it has the responsibility to so option A is incorrect because CCO is involved in approval of new product. Ongoing monitoring of the compliance is required for a specific period, typically 6 months. Option B says that compliance manual are created primarily for board of director and not intended to use by the general bank staff. So this is incorrect because compliance manual are designed to use by all bank staff. Option C says that compliance officers are empowered to investigate compliance issue, engage external expert and reporting irregularity to the senior management and the board ACB. So option C is correct as it accurately describes the authority of compliance officer to conduct investigation, engage external expert where necessary and report compliance to senior management. Option D says the compliance function the compliance person operate independently from interdepartmental interaction. This is incorrect because effective compliance require regular interaction with other department. It's not that so something in isolated cannot happen, right? So this is very important. The next question is which of the following statement accurately describe the role of CCO and the compliance person in the bank. So first option say that the CCO must have at least 10 years of experience in the banking and finance industry, and tenure is set at 5 years to ensure long-term stability. This is wrong because CCO must have 15-year experience in banking. Right. Option B says that the internal audit review the compliance function. The internal audit review the compliance person effectiveness, and the compliance person is responsible for providing guidance and training to both management and staff on compliance standard. Yes, it is correct. Next option C, for multi-jurisdictional bank, compliance is managed centrally by head of compliance with no delegation to individual with local knowledge. This is wrong. So as you can see, it written here that first off, bank need to keep a close eye on their financial health. Right, and things like how much money they have and how well they are doing, their ability to pay debt, right? So their ability to pay debt, how well they are doing, and the risk they face, right? So these things are included in the financial health. That's why financial statement are so important. You can see these financial statement are so important, right? They give us a clear view of what is happening behind the scene. It gives a clear view of what is happening behind the scene. Now, in the banking world, transparency is a key, right? Especially in listed bank. need accurate and timely information to make informed decision. This is where various rules comes into picture. And bank follow regulation under the Banking Regulation Act, governed by the Banking Regulation Act, Companies Act, as well as guidelines from Reserve Bank of India and Basel III standard to make sure everything is in order. RBI requires bank to provide consistent information, right? To provide consistent information, banks should provide consistent information through a specific format like a Schedule 17 and a Schedule 18. Now, if we talk about RBI, risk management and audit, to stay safe, bank perform internal audit. These audit help prevent problem, like which type of problem is prevent, like fraud, right? You can see written like fraud, like and ensure that bank follow RBI guidelines. They also align risk management with the bank risk appetite. So risk management is aligned to the bank risk appetite, meaning the bank makes sure it does not take on more risk than it can handle. Now, if anything goes wrong, it is reported immediately to the compliance and risk management team. Anything goes wrong, it is immediately reported to the risk management team. Now, let's talk about the importance of internal audit. See, the term internal audit term has a big job. They provide independent check. You can see it written. They provide independent check on how well the bank is managing the risk and control. They report directly to the audit committee of board, that is called ACB. Right, so this internal audit team directly report to the ACB, that is audit committee of board, who are held accountable for bank overall performance and governance. So who is held accountable? That is ACB. ACB means what? Audit committee and board. You can see written reporting compliance and risk issue reported to the board and ACB, and this board is responsible for audit independence. This board will be held accountable for bank overall performance and governance. So in the short, we can say the role of internal audit is to keep the bank running smoothly, prevent issue before they become big problem, and protect the bank reputation, right? So that's a quick look as how bank manage their finance and risk. Now let's discuss quality assurance. Let's start from here. Let's discuss quality assurance. See, in this slide we will continue our exploring our how bank ensure their audit and risk control are up to the mark. We will also look at the key responsibility of the board and audit member. First, bank need a quality improvement program, right, for their internal audit. This is the part of quality assurance process. This is a part of QAP, quality assurance process, which help them stay efficient and secure. Fraud prevention is another major priority. Bank have control in place to detect and prevent fraud, right? And the internal audit team checks whether this control are working properly. Audit also include fraud risk assessment. You can see written here. Audit include fraud risk assessment to spot any early sign of trouble. Is there any early sign of trouble? This is done by fraud risk assessment. Now, if we talk about the audit committee, audit reporting and board responsibility. Now, if any compliance or risk issue comes up, they report directly to the bank board or audit committee of the board. There are two things. Either you call it ACB, that is audit committee of the board, or you can call it bank board. You can see written that any compliance and risk issue is reported to the board and ACB. The board itself plays a big role in making sure the audit is independent. You can see it board responsibility ensure audit independence with enough staffing and resources. Now, if we talk about the audit committee responsibility, audit committee is a team in charge of overseeing audit, monitoring audit. It is led by an independent expert. They do a lot of critical tasks. Let's move to the next slide and see what are their responsibility. Like you can see, they set up internal audit and financial reporting policy. Second thing they do is they recommend and manage external auditor. Third thing they do, they approve the audit scope, timing and method used in auditing. Also, they make sure any issues found during audit are fixed and keep an eye on the risk management and internal control. And finally, they review the bank financial statement each year. Now, if we talk about the committee oversight and transparency, so this audit committee, let's talk about this audit committee. The audit committee also keep track of the fraud cases, cash shortages, investment and regulatory compliance. They make sure everything is in line with the regulation and report any finding to the board. If needed, they can start inquiries into the specific matter. And they meet at least 4 times a year. Remember it quarterly, right? They can initiate inquiry and they meet at least 4 times a year. So this is about the audit committee. Remember this thing, very very important. Now if we talk about the oversight, also include checking on the quality of audit quality, and reviewing any report from a statutory audit or RBI inspection. Now transparency is a big deal here also. The committee review internal control and policy to make sure everything is clear and open. So that's how bank maintain a strong audit and fraud prevention system. I hope this simplified explanation help you understand the key responsibility of the board and the audit committee. Now let's see some more duties of the audit committee. Let's dive into the responsibility of the audit committee and how Reserve Bank guides bank on internal audit. We will also talk about importance of independence in audit and how breaches are reported. See, the audit committee plays a key role in keeping the bank safe, as I have already told you. They monitor risk management, statutory compliance and internal control to make sure everything is running smoothly. If they find issue, they have an authority to investigate or even bring in external expert for advice. According to the RBI guideline, audit must have the power, resources and authority to be effective. Right, this is as per the RBI guideline. The head of the internal audit, that is called HIA. What is HIA? HIA is called head of the internal audit. So the HIA is a senior executive who has access to all the bank's record. He is a senior executive with access to all record, right? And this person is highly skilled, especially in area like banking, IT, forensic audit. They report directly to the audit committee or the managing director and CEO. This HIA report directly to the audit committee of the board and managing director and CEO. Now if we talk about audit improvement, if we talk about the audit enhancement or audit improvement, audit are also evolving. Bank now use off-site audit, which monitor transaction remotely. They have something called information system audit to focus on IT system, and concurrent audit, so that continuously oversees process to ensure things are done correctly in real time. If we talk about the resilience and supervision, so to build resilience, banks are improving the rule of internal audit in high risk area and regularly testing risk rating. They are also integrating IT more into their audit, focusing on fraud prevention and validating their internal audit framework with external check. Now it is crucial that internal audit remain independent, like you can see in the next slide, independency. It is crucial that internal audit remain independent following RBI guideline to help strengthen the bank overall system. If we talk about the compliance reporting, so proper reporting structure are necessary to show how effective internal audit are. Bank must follow uniform reporting structure, uniform reporting standards for compliance and report any breaches to the right department. So whether it is within the branch, regional office or even overseas location, the process remains the same. If there is a breach, it get reported to the compliance. So that's a look at how bank manages their audit and compliance, ensuring resilience and transparency. Now let's discuss, we are going to break down some important bank disclosure requirement, accounting standards and how bank manages. Already I have told you that ROZO official audit team report breaches during the visit, right? Functional department report to compliance. Now overseas branches also follow the same system. If we talk about the bank disclosure requirement, so bank have to follow certain rules set by the RBI to ensure transparency. These rules help promote market discipline. So key point is market discipline, right? By making sure banks share important information about their capital risk and key business activity. All bank except RRB, that is regional rural bank, must prepare CFS. CFS means consolidated financial statement. These statements shows the overall financial position of the bank and its subsidiary. Friend, if you want PDF of such type of notes, micro notes, you can enroll in our AVM PDF plan. Detail is provided in the description section and you can get the PDF. So now all bank except RRB must prepare CFS. These statements show the overall financial position of the bank and its subsidiary according to the accounting standards. Now for RRB, they are treated as associate in the sponsor bank CFS. Now there are some specific rule bank follow for their account. For example, any entry that is older than 5 years in the block account need approval from the two official to move forward. And for nostro account, means account held in the foreign currency, if credit entry has been unreconciled for over 3 years, it is moved to the bank liability. And for debit entry outstanding for more than 2 years, banks say retired 100% provision. These two things you have to remember. Now banks are also required to transfer at least 25% of their net profit to a statutory reserve. and they need RBI approval to use that reserve. Additionally, if the bank raise money by issuing share, they can use the share premium to cover the cost of issuing those share. In the case of fraud, provision can be spread over 4 quarter instead of handling them all at once. You can see for fraud, provision is spread over 4 quarter. Now bank follow specific accounting standards like AS5. Bank must disclose any impact from prior period. Next is AS9, that revenue recognition can be postponed and this must be disclosed. Next is AS15, that is employee benefit follow ICAI guideline. AS17, bank must report by business and geography. AS18, that means related party transaction must be disclosed. AS21, that means bank must recognize tax effect and focus on capital adequacy. AS23, it means investment in associate must be accounted for. AS25, bank must provide half yearly financial disclosure in a uniform manner. So finally, any floating provision, right, extra reserves set aside for uncertain future loss, so this is called floating provision, so must be disclosed in the notes to the financial statement. That's a quick look at how bank manage their financial reporting and reserve while following important disclosure. Now let's talk about the additional disclosure. So with some important additional disclosure bank need to make and how SEBI regulation play a role. Bank are required to disclose a range of important information such as how they use their reserve, right, how they use the reserve, customer complaint, ombudsman award, letter of comfort, provision for credit risk, in short it's called PCR, fees, right. They also need to provide detail on the concentration of deposit, NPA, recoveries, and even the remuneration, that is the remuneration of executive, especially for private and foreign bank. Now if we talk about SEBI listing regulation, so Security and Exchange Board of India have listing regulation that came into effect from September 2015. Companies that are listed on the stock exchange must sign an agreement with those exchange. Now they also need to follow a specific accounting standard, have their financial audited annually by the independent auditor, and ensure they communicate early and equally to all investors. Additionally, listed company must adhere to both SEBI and stock exchange law. If we talk about the disclosure obligation, so to protect a stakeholder, company have to file periodic report, right, periodic report that can help track their performance. They need to provide timely update on general meeting and any change to the capital structure, share right. For any major event like financial report, buyback, or the case of fraud, the companies must notify the exchange. They also have to disclose detail of the analyst meeting resolution and meeting minutes. Now SEBI regulation 30, under the regulation 30 there are two types of mandatory disclosure. Let's come to the next slide. The first is called part A, right. So SEBI disclosure of para A means sub event must be disclosed without needing a materiality test. No materiality test is required. This means they are so important that they must always be reported. And para B say that for event that could impact operation, business changes, legal issues or contract, a materiality test is applied to decide if the disclosure is needed. Now website disclosure, which is under regulation 46. All this important information must be updated on the company website within 2 days of any changes. This include business detail, terms for independent director, and the composition of board committee. Now that wraps up our look at the additional disclosure requirement for bank and the key SEBI regulation that ensure transparency for investor. Now let's come to some MCQs. As I already told you, we will do some MCQs. So let's see the first question. The first question is, which of the following statement best describe the critical component and requirement necessary for effective internal auditing in the banking sector as outlined in the financial regulatory framework, right? So let's see the option. Option A says that user need encompasses into bank financial position, performance, liquidity and solvency, while market discipline highlight the need for timely and reliable info critical for the banking sector. Yes, option A accurately describe the key element of effective internal auditing, including the need for timely and reliable information, right, and the importance of market discipline. So option A is correct. Option B says that internal auditing should focus solely on compliance with the RBI guideline, ignoring fraud, risk control and the importance of governance. This is wrong, because they misrepresent the scope of internal auditing. And the C option says that audit committee is responsible for overseeing audit, ensuring independence and competency, and is chaired by board member without a specific expertise in auditing. So see, audit committee responsibility already we have seen that it is chaired by a board member which have a specific, it is not without, that's why this is wrong. And what about option D? Let's see. Option D says that quality assurance in bank emphasizes fraud risk control, but board responsibility does not require active participation in ensuring audit response. See, option D is incorrect as they misrepresent the role of quality assurance, right? So option A is the correct answer. Now let's come to the next question. Which of the following statement accurately reflect the responsibility and function of the audit committee and the internal audit guideline in the banking sector? So we have to see the function of audit committee. So first option says that audit committee is responsible for framing internal audit policy, reviewing annual financial statement, and ensuring the effectiveness of internal control while meeting quarterly. So option A is partially correct, but here something is not mentioned. What is that? Investigative power. The RBI, that means RBI internal guidelines require that audit have no authority, limited resource, and the head HIA operate without access to record or reporting to senior management. This is completely wrong, right? Because they misrepresent the audit guideline. This is completely wrong. Option B is wrong. Option A is wrong. Option C says that audit enhancements such as off-site audit and concurrent audit are unnecessary as they do not contribute to improving risk management. Oh, this is wrong. This is completely wrong. It misrepresents the importance of audit enhancement. Option D says that audit committee has authority to initiate inquiry into the fraud, cash shortage, and regulatory compliance, and he must monitor management, statutory compliance, and internal control. This is correct. This correctly reflects the audit committee roles in overseeing internal control. Which of the following statement best encapsulate the compliance reporting and disclosure requirement in the banking sector as per the RBI norms? So first option says that compliance reporting involves demonstrating internal audit effectiveness with a uniform reporting structure where breaches are reported to relevant department and overseas branches follow a different system. So this is incorrect because it incorrectly states that overseas branches follow a different system. This is wrong. Overseas branches also follow the same system. Option B says that the bank disclosure requirement mandate that all banks must prepare and disclose CFS with RRB treated as associate while ensuring proper accounting provision for block and nostro account. Correct. Absolutely correct. Now option C says that the profit and reserve management require bank to transfer 50% of the net profit to the statutory reserve. So this percentage is wrong. This is not 50%. And option D says that reporting breach state that official audit team and functional department report breaches during his visit and ensuring that there is a proper approval process. So option D is covered breaches report but does not fully explain the accounting provision. That's why option D is wrong. Correct answer is option B. Next question is which of the following statement accurately describe the accounting standards and the additional disclosure requirement for bank as per regulatory guideline? So option A says that accounting standard for bank AS5 mandate the disclosure of prior period impact, AS9 immediate revenue recognition disclosure, AS15 bank to disregard ICA guideline for employee benefit. See, this is wrong because AS9 or AS15 wrongly reported here. AS5 is correct. Additional disclosure for bank must include reserve drawdown, customer complaint, Ombudsman award, detail about consultation or deposit accurate. SEBI listing regulation effective from 2 September 2015 requires companies to follow accounting standard but do not maintain annual audit. This is wrong. It mandates annual audit. Option D says that the accounting standard like AS18 and AS25. AS18 require bank to disclose related party transaction and AS25 necessitate uniform quarterly disclosure. See, option D is partly correct but incorrectly describe AS25 as requiring quarterly disclosure instead of half yearly disclosure. You can see written here AS25 यूनिफॉर्म क्वार्टर, इट इज़ हाफ ईयरली. तो इंडियन कॉन्ट्रैक्ट एक्ट और कंपनीज एक्ट में फ्रॉड को अलग अलग तरीक़ों से डिफाइन किया गया है, जैसे कि झूठी प्रॉमिस, चीज़ें छुपाना या कुछ गलत इन्फॉर्मेशन देना. यहाँ देखिए वही लिखा गया है. फिर उसके बाद दोस्तों अगला पॉइंट है कि फॉर्जरी पे आते हैं, राइट. तो एक चीज़ आप यहाँ देख सकते हैं कि कंपनीज एक्ट में फ्रॉड को कहा गया है एक्ट ऑमिशन टू डिसीव हार्म कंपनीज ऑफ स्टेक होल्डर, और जो हमारा रॉन्गफुल गेन है या लॉफुल गेन है, लॉस ऑफ प्रॉपर्टी है, वो भी आता है. इंडियन पिनल कोड यानी आईपीसी जो है फ्रॉड को डिफाइन करता है इंटेंट टू डिसीव, और आरबीआई का कोई डायरेक्ट डेफिनेशन नहीं है. इसने मिस एप्रोप्रिएशन, ब्रीच ऑफ ट्रस्ट, इन सबको फ्रॉड के रूप में कहा है. और यदि कैश शॉर्टेज 10,000 से ऊपर हो तो फ्रॉड के रूप में ट्रीट होगा यदि सस्पिशियस हो तो, बैंक के पर्सपेक्टिव में. यदि हम फॉर्जरी की बात करें तो यह किसी डॉक्यूमेंट को बदल के नया बनाने के लोगों को धोखा दे, मतलब आपके पास डॉक्यूमेंट है उसको बदल दिया गया और नया बना के लोगों को धोखा देना होता है. और हमारा इंडियन पैनल कोड के अंदर अगर आपने किसी और के नाम से डॉक्यूमेंट बनाए या फेक क्लेम किए तो वो फॉर्जरी के अंदर आता है. तो डिसीव है आईपीसी सेक्शन 463 के अंदर, और फॉल्स डॉक्यूमेंट हमारा सेक्शन 464 के अंदर आता है। और दोस्तों बैंकिंग फ्रॉड भी काफ़ी कॉमन है, जिसमें एम्प्लॉय, बोरोवर और थर्ड पार्टी जैसे बिल्डर भी इन्वॉल्व हो सकते हैं, जैसे कि फेक एफडी बनवाना, फिक्सिशियस नेम का यूज़ करना, राइट, फेक एफडी बनवाना। फिर यहाँ देख सकते हैं कि स्टॉक की वैल्यू बढ़ा के दिखाना, जिसको इन्फ्लेटेड स्टॉक बोलते हैं, ये एम्प्लॉयर के लिए फेक आईडी, फेक एफडी। फिर बोरोवर के लिए इन्फ्लेटेड स्टॉक या आइडेंटिटी थेफ्ट, और थर्ड पार्टी के लिए क्या है, थर्ड पार्टी के लिए बिल्डर्स, वेयर हाउस एंड डॉक्यूमेंट फ्रॉड, ये सभी फ्रॉड के डिफरेंट टाइप्स होते हैं, राइट। तो चलिए अब हम लोग आगे बढ़ते हैं और बैंकिंग और साइबर फ्रॉड को डिस्कस करते हैं। तो दोस्तों यहाँ पे आप देख सकते हैं कि साइबर फ्रॉड और साइबर सिक्योरिटी थ्रेट के बारे में डिस्कस करते हैं। यह वो टेक्निक है जो क्रिमिनल यूज़ करते हैं लोगों को धोखा देने और सेंसिटिव डेटा चुराने के लिए। कौन यूज़ करता है? क्रिमिनल यूज़ करता है, ठीक है। कॉमन साइबर फ्रॉड की बात की जा रही है। तो पहले कुछ कॉमन साइबर फ्रॉड को देखते हैं, जैसे कि फेक प्रोफाइल बनाना, सिम को क्लोन करना, वॉलेट से पैसा डिडक्ट करना, कार्ड स्कीमिंग, यूपीआई स्कैम, राइट। तो ये सभी कुछ इंपॉर्टेंट हमारे साइबर फ्रॉड हैं। तो अब देखिए यहाँ पे कुछ इंपॉर्टेंट पॉइंट है, जैसे आप यहाँ एनीडेक्स दे सकते हैं, टीम व्यूअर, यहाँ पे आप देखिए नाम लिखा गया है एनीडेक्स और टीम व्यूअर। तो एनीडेक्स और टीम व्यूअर से भी लोगों को ट्रैप किया जा सकता है। आइडेंटिटी थेफ्ट और रिमोट एक्सेस ऐप, जैसे ये सब क्या ऐप हैं? आइडेंटिटी थेफ्ट ऐप है, रिमोट एक्सेस मालवेयर ऐप है, जैसे कि एनीडेक्स और टीम व्यूअर, राइट। तो ये भी इससे भी लोगों को ट्रैप किया जाता है। अब देखिए साइबर क्राइम पोस्ट डिमोनेटाइजेशन के बाद और भी बढ़ गया है, लिखा है ना, इंक्रीज डिजिटल फ्रॉड पोस्ट डिमोनेटाइजेशन। और क्योंकि लोगों की पर्सनल इन्फॉर्मेशन वनरेबल है और क्रिमिनल ग्रीड और फ्रीबीज के चक्कर में यूज़र को फंसा लेते हैं। देखिए फ्रीबीज देने के चक्कर में यूज़र को फंसा लेते हैं, ग्रीड के चक्कर में यूज़र को फंसा लेते हैं। फिर दोस्तों साइबर सिक्योरिटी थ्रेट भी अलग अलग लेवल का होता है, राइट। जैसे कि आप यहाँ देख सकते हैं DDoS अटैक। तो DDoS अटैक जो सिस्टम को ओवरलोड कर देते हैं, लिखा है ना। उसके बाद आप देख सकते हैं MITM अटैक। और सोशल इंजीनियरिंग क्या होता है कि यूज़र को ट्रिक कर देता है कि इन्फॉर्मेशन रिवील करने में। MITM अटैक क्या होता है? MITM अटैक जिसमें हैकर कम्युनिकेशन को इंटरसेप्ट कर लेता है। फिर उसके बाद मालवेयर और स्पाईवेयर है, ठीक है। तो कुछ डेंजरस टेक्निक है जैसे स्पूफिंग, फिशिंग, राइट। यहाँ देख सकते हैं स्पूफिंग, फिशिंग, जिसमें लोगों को गलत लिंक पर क्लिक करवा के उनकी इन्फॉर्मेशन चुराई जाती है। यहाँ लिखा है ना, नेटवर्क डेटा इंटरसेप्शन, डिसेप्टिव मैसेज फॉर डेटा थेफ्ट। रैम स्क्रैपिंग क्या होता है कि POS मालवेयर कैप्चर सेंसिटिव डेटा। ये सब आपको पता होना चाहिए कि मालवेयर क्या है, स्पाईवेयर क्या है। मालवेयर के बारे में देखिए क्या लिखा गया है, मॉनिटर डिवाइस सेंड डेटा टू अटैकर, मतलब डिवाइस को ही मॉनिटर करने लगता है और फिर वो डेटा अटैकर को भेज देता है। और फिर रैम स्क्रैपिंग में दे सकते हैं कि POS मालवेयर कैप्चर सेंसिटिव, यानी पॉइंट ऑफ सेल मालवेयर की बात हो रही है। और स्नाइफिंग और स्नूपिंग आप जानते ही हैं, ठीक है। आप डिसेप्टिव मैसेज भेजते हैं डेटा थेफ्ट के लिए। उसके अलावा जो हमारा और कुछ डेंजरस टेक्निक है जैसे कि स्पूफिंग, फिशिंग, जिसमें लोगों को गलत लिंक पर क्लिक करवाया जाता है। और मोबाइल से भी रिस्क होता है, जो हमेशा ऑटो लॉक और पिन यूज़ करते हैं, ठीक है। तो मोबाइल से होता है IMEI नंबर। यहाँ पे एक चीज़ और देखिए आप लिखा जा रहा है IMEI नंबर सेव रखें और डिवाइस खो जाए तो रिपोर्ट ज़रूर करें। लिखा है ना कि ऑटो लॉक जरूर रखें, मोबाइल की सिक्योरिटी बताई जा रही है। एनीडेक्स में रिस्क होता है रिमोट अनऑथराइज एक्सेस का। जूस जैकिंग, यानी कि आप चार्जिंग पोर्ट के माध्यम से मालवेयर डालना, देख रहे हैं, चार्जिंग पोर्ट के माध्यम से ही मालवेयर आता है, उसको जूस जैकिंग कहते हैं। 0 डे, आप मान लीजिए कि कुछ अनडिटेक्टेड सॉफ्टवेयर फ्लॉ है, उसको 0 डे कहा जाता है। फार्मिंग, आप फेक साइट पे रिडायरेक्ट हो रहे हैं, उसको फार्मिंग कहा जाता है। स्मिशिंग फिशिंग, यानी SMS और कॉल से आप फिशिंग कर रहे हैं, इसे स्मिशिंग कहा जाता है। स्पीयर फिशिंग, यानी ऑर्गेनाइजेशन को टारगेट कर रहे हैं या टॉप मैनेजमेंट को टारगेट कर रहे हैं। अब हम लोग बात करते हैं मोबाइल सिक्योरिटी, ऑनलाइन सेफ्टी एंड फॉल्स फ्रॉड रिपोर्टिंग के बारे में। सबसे पहले मोबाइल सिक्योरिटी के लिए कुछ बेसिक टिप्स हैं। हमेशा स्ट्रॉन्ग पासवर्ड या बायोमेट्रिक लॉक यूज़ करें और SMS पिन जरूर सेट करें, स्पेशली अगर आप एनीडेक्स जैसे रिमोट एक्सेस ऐप यूज़ कर रहे हैं तो, राइट। तो ये बहुत इंपॉर्टेंट है यदि आप उसके बाद दोस्तों जो नेक्स्ट पार्ट है वो है कि वेबसाइट पर भी सिक्योर ब्राउजिंग का ध्यान रखें। HTTPS चेक करें, साइट्स को वेरीफाई करें और कभी भी सस्पिशियस लिंक पर क्लिक मत करें। फिर अपडेटेड रहें, सिक्योरिटी के लिए अपना ऑपरेटिंग सिस्टम अपडेट रखें और स्ट्रॉन्ग पासवर्ड सेट करें। प्राइवेसी भी बहुत इंपॉर्टेंट है, मतलब कि अपनी पब्लिक इन्फो लिमिट रखें और अगर कोई अनऑथराइज ट्रांजैक्शन दिखे तो तुरंत रिपोर्ट करें। फ्रॉड रिपोर्टिंग की बात करें तो अगर आप फ्रॉड रिपोर्टिंग के प्रोसेस पर आते हैं तो अगर फ्रॉड हो जाए तो बैंक को RBI को 7 दिन के अंदर रिपोर्ट करना पड़ता है। लिखा है ना, बैंक रिपोर्ट फ्रॉड टू RBI विद इन 7 डेज। और मंथली रिपोर्ट भी सबमिट करने होते हैं अगर फ्रॉड जो है 50 लाख के ज़्यादा हो तो, ठीक है। देखिए FMR सबमिशन टू CFMC SSM बाय मंथ एंड 50 लाख से ऊपर के लिए आपको मंथली रिपोर्ट भी सबमिट करना पड़ेगा। और अगर सिर्फ फ्रॉड अटैम्प्ट हो तो उसका भी रिपोर्ट 10 लाख से ज़्यादा होने पर दिया जाता है। लिखा है 50 मिलियन से ऊपर है तो 50 लाख के ऊपर है तो सबमिट विद इन अ वीक। और उसके बाद दोस्तों यह टाइमली रिपोर्टिंग और मॉनिटरिंग स्टाफ की अकाउंटेबिलिटी के लिए बहुत ज़रूरी होता है। अब थोड़ा सा हम लोग फ्रॉड रिपोर्टिंग और मॉनिटरिंग पे बात करते हैं। तो जब भी 1 लाख से ज़्यादा का फ्रॉड होता है ना, तो यहाँ देखिए लिखा गया है, पहले मैंने बताया कि सबमिट के FMR टू RBI CFMC SSM विद 7 डे मंथ एंड। और यदि 1 लाख के ऊपर का आपका फ्रॉड है तो उसकी रिपोर्टिंग बोर्ड को की जाती है, और अगर स्टाफ इन्वॉल्व हो तो उनके ऊपर भी एक्शन लिए जाते हैं। देखिए यहाँ लिखा हुआ है, यहाँ देखिए 0.1 मिलियन है तो 1 लाख के ऊपर फ्रॉड, बोर्ड को रिपोर्टिंग किया जाएगी, एक्शन लिया जाएगा स्टाफ पे, राइट। और एक चीज़ यहाँ देखिए फ्लैश रिपोर्ट कहा जाता है 50 मिलियन के ऊपर के फ्रॉड के लिए सबमिट विद इन अ वीक, ठीक है। और फिर अटेम्प्टेड फ्रॉड के लिए यदि 10 मिलियन के ऊपर का अटेम्प्ट है तो ACB को एनुअल ऑडिट कमेटी बोर्ड को किए, RBI को करने की आवश्यकता नहीं है। FIR प्रोसेस क्या होता है कि ब्रांच सिक्योर करेगा डॉक्यूमेंट को। अच्छा एक और चीज़, तो एक मैंने क्या बोला कि 1 लाख के ऊपर है फ्रॉड तो उसको बोर्ड को रिपोर्ट करना होगा, और यदि स्टाफ है तो उस पर एक्शन लेना पड़ेगा। अच्छा यदि मान लीजिए कि आपका 1 करोड़ के ऊपर है तो यहाँ देखिए 10 मिलियन मतलब 1 करोड़ होता है, 1 करोड़ से ज़्यादा केस है तो उसके लिए एक स्पेशल कमेटी बनती है जो बोर्ड लेवल पर काम करती है, इसको बोर्ड लेवल कमेटी बोलते हैं। यह कमेटी मेजर केसेस को रिव्यू करती है, और अगर रिपोर्टिंग में डिलेज हो तो फिर अकाउंटेबिलिटी भी इशू करती है। यहाँ लिखा है ना एनफोर्स अकाउंटेबिलिटी। बैंक अपनी फ्रॉड रिस्क पॉलिसी को RBI के रूल के हिसाब से अपडेट करते हैं, और अगर रिपोर्टिंग में डिले या इनएक्शन होता है तो बैंकिंग रेगुलेशन एक्ट के सेक्शन 47A के तहत पेनल्टीज भी लगा सकती है। उसके बाद दोस्तों यह प्रोसीड्यूर फ्रॉड को मैनेज और मॉनिटर करने में हेल्प करते हैं, तो ये सब हमें याद रखने हैं, ये सब पॉइंट हमें ध्यान रखने हैं। उसके बाद एक आप यहाँ देख सकते हैं कि कमेटी का रिव्यू क्वार्टरली होगा, एनुअल फ्रॉड रिव्यू होगा, और फ्लैश रिपोर्ट 50 मिलियन के ऊपर के फ्रॉड के लिए 1 वीक के अंदर सबमिट करना है। अटेम्प्टेड फ्रॉड में जो आपका 10 मिलियन के ऊपर है उसको एनुअल कमेटी और ऑडिट कमेटी बोर्ड को आपको सबमिट करना है, ठीक है। RBI की आवश्यकता नहीं है। अच्छा अब थोड़ा CTS के बारे में बात करते हैं, चेक हैंडलिंग के बारे में। देखिए बैंक को इंश्योर करना होता है कि सिर्फ CTS 2010 स्टैंडर्ड चेक ही यूज हो ताकि सिक्योरिटी हाई रहे। और दूसरी बात कि अगर 2 लाख के ऊपर का, यहाँ देखिए यदि 2 लाख के ऊपर का चेक है तो उस पर UV वेरिफिकेशन होता है, और अगर 5 लाख से ज़्यादा का चेक है तो मल्टीपल लेवल चेक की जाती हैं, ठीक है। ये 2 चीज़ ध्यान रखिएगा। नए अकाउंट को भी क्लोजली मॉनिटर किया जाता है। सेफ्टी के लिए SMS अलर्ट भी इंपॉर्टेंट है, जैसे चेक क्लियर होने पर पेयर और ड्रॉअर को नोटिफिकेशन मिलता है। अगर 1 करोड़ से ज़्यादा का फ्रॉड हो या पब्लिक ऑफिसर इन्वॉल्व हो तो उन्हें पुलिस या CBI को रिपोर्ट किया जाता है। लिखा है ना कि आप यदि 1 करोड़ से ऊपर का फ्रॉड हो रहा है तो पुलिस या CBI को रिपोर्ट किया जाएगा, सेंट्रल ब्यूरो ऑफ इन्वेस्टिगेशन, ठीक है। अगर कुछ और फ्रॉड प्रिवेंशन मेजर में आता है पॉजिटिव पे सिस्टम, इसको PPS बोलते हैं। क्या बोलते हैं? यहाँ देखिए पॉजिटिव पे कहा है ना PPS, तो ये 50,000 के ऊपर के चेक होते हैं उनके लिए कस्टमर को बैंक को पहले ही चेक की डिटेल देनी होती है, राइट, इसको PPS बोलते हैं। फिर दोस्तों फॉर्जरी या चेक फ्रॉड के केस की बात करें तो फॉर्जरी या चेक फ्रॉड के केस में अलग अलग रिपोर्टिंग प्रोटोकॉल है। जैसे पेइंग बैंक को फ्रॉड चेक का रिपोर्ट करना होता है, और अगर इंटर ब्रांच फ्रॉड हो तो हेड ऑफिस RBI और पुलिस तक नोटिफाई किया जाता है। यानी जो पेइंग बैंक है वो फ्रॉड चेक का रिपोर्ट तुरंत देगा, और इन 2 ब्रांचों के बीच में फ्रॉड हो तो आप क्या करेंगे, ब्रांच रिपोर्ट को फेक चेक फ्रॉड को हेड ऑफिस RBI और पुलिस तक पहुंचाएंगे, ठीक है। और उसके बाद कलेक्शन फ्रॉड हो तो कलेक्टिंग बैंक रिपोर्ट करेगा फ्रॉडलेंट कलेक्शन को RBI को, और लॉ इन्फोर्समेंट करवाएगा। ये सब पॉइंट हमें ध्यान रखने हैं। पॉजिटिव पे सिस्टम, SMS अलर्ट, चेक वेरिफिकेशन। फिर एक आता है लोन फ्रॉड डिटेक्शन और रेड फ्लैग अकाउंट, जिसको हम लोग बोलते हैं RFA, रेड फ्लैग अकाउंट को। तो पहले समझते हैं कि RFA होता क्या है। जब किसी लोन अकाउंट में फ्रॉड के साइन दिखते हैं तो हम अर्ली वार्निंग सिग्नल या EWS से डिटेक्ट करते हैं। तो मान लीजिए कि कोई लोन अकाउंट है, ठीक है, और उसमें हमको फ्रॉड के साइन दिख रहे हैं, तो फ्रॉड के साइन वहाँ विजिबल हैं लोन अकाउंट में, तो हम EWS का यूज़ करते हैं। EWS क्या होता है? अर्ली वार्निंग सिग्नल से डिटेक्ट करते हैं, तो उस अकाउंट को रेड फ्लैग अकाउंट यानी RFA मार्क कर दिया जाता है। अब EWS मॉनिटरिंग का क्या प्रोसेस है वो ज़रा देखिए, ठीक है। तो बैंक को हमेशा EWS का ध्यान रखना होता है। अगर किसी अकाउंट में 50 करोड़ से ज़्यादा का एक्सपोजर है और EWS डिटेक्ट हो जाए, देखा है ना 500 मिलियन मतलब 50 करोड़ होता है, 50 करोड़ का एक्सपोजर से ज़्यादा है और EWS और वहाँ पे आपका EWS डिटेक्ट हो जाए तो उस अकाउंट को RBI क्या करता है, फ्रॉड मार्क करके CRILC पर रिपोर्ट करता है, ये ध्यान रखिएगा। उसके बाद दोस्तों अगर लोन फ्रॉड 50 करोड़ से कम का है, 50 करोड़ से ज़्यादा का है तो CRILC को रिपोर्ट किया जाएगा RFA मार्क करके। और यदि 50 करोड़ से कम का लोन है, लोन फ्रॉड है, तो बैंक अपने प्रैक्टिस के हिसाब से मॉनिटरिंग कर सकते हैं और आइडेंटिफाइड फ्रॉड को RBI और CFMC को रिपोर्ट कर सकते हैं। लिखा गया है इसके लिए लोन ऑफिसर को स्पेशली ट्रेन किया जाता है ताकि वो EWS को पहचान कर टाइमली रिपोर्ट कर सके, यही कह रहा है यहाँ पे। अब देखिए, हर महीने फाइनेंशियल मॉनिटरिंग ग्रुप या FMG एक RFA रिपोर्ट प्रिपेयर करता है। इसको FMG का फुल फॉर्म होता है फाइनेंशियल मॉनिटरिंग ग्रुप। तो एक RFA रिपोर्ट CMD या CEO को सबमिट करती है ताकि टाइमली एक्शन ले सकें। तो ये था कुछ लोन फ्रॉड डिटेक्शन और RFA रिपोर्टिंग के लिए स्टेप्स। ठीक है, याद रखिएगा 50 करोड़ के ऊपर और 50 करोड़ के नीचे हमारा अलग अलग केसेस होते हैं। उसके बाद हम थोड़ा EWS सिग्नल के बारे में बात करते हैं अगले स्लाइड में। तो सबसे पहले देखिए, जो हमारे फाइनेंशियल इरेगुलरिटीज़ होते हैं ना, तो उनको देखते हैं। अगर हाई वैल्यू चेक बाउंस हो रहा है, स्टैट्यूटरी ड्यू अनपेड है या पेमेंट डिले में है, तो यह रेड फ्लैग हो सकता है। क्या क्या बोला मैंने? हाई वैल्यू चेक बाउंस, स्टैट्यूटरी ड्यू अनपेड है और डिलेड पेमेंट हो रहा है, तो ये सब हमारे रेड फ्लैग अकाउंट के चांसेस हो सकते हैं। ऑपरेशनल रेड फ्लैग में कुछ साइन है, जैसे कि स्टॉक या इंश्योरेंस डॉक्यूमेंट को सबमिट नहीं करना, प्रोजेक्ट में बार बार चेंजेस लाना, ओल्ड फॉरेन बिल लाना, ये इंडिकेटर बता सकते हैं कि कुछ गड़बड़ तो हो सकती है। फिर दोस्तों, फंड का मिसयूज, तो फंड मिसयूज भी एक मेजर वार्निंग है, जैसे लोन फंड का मिसयूज या इंस्पेक्शन में डिले, डॉक्यूमेंटेशन और कोलेट्रल इशू भी होते हैं, जिसमें कोलेट्रल का टाइटल डिस्प्यूट में हो या मल्टीपल लैंडर इन्वॉल्व हो सकते हैं। देखिए ना, कोलेट्रल का टाइटल डिस्प्यूट में हो, मल्टीपल लैंडर हो, ये सब के सब डॉक्यूमेंटेशन इशूज होते हैं। सस्पिशियस ट्रांजेक्शन भी अलर्ट करते हैं। अगर लोन रिपेमेंट दूसरे बैंक से हो रहा है, फंड किसी रिलेटेड फर्म में इन्वेस्ट हो रही है या ओवरड्यू बिल का ट्रेंड है, तो ये सब फ्रॉड के सिग्नल हैं। लिखा गया है ना, लोन रिपेमेंट फ्रॉम अदर बैंक, फिर फंड इन्वेस्टेड इन रिलेटेड फर्म। फिर हम बात करते हैं स्टॉक ऑडिट और रिपोर्ट की पॉइंट्स, इसके रिलेटेड पॉइंट को समझिए। स्टॉक ऑडिट रिपोर्ट के कुछ की पॉइंट देखते हैं। लायबिलिटी जो एनुअल रिपोर्ट में नहीं दिखती लेकिन ROC में डिस्क्लोज है, देखिए यहाँ लिखा जा रहा है। लायबिलिटी मतलब कि जो हमारे एनुअल रिपोर्ट में नहीं दिखती है लेकिन ROC में डिस्क्लोज होता है। फिर RTGS, उसके बाद क्या कर रहा है कि फ्रिक्वेंट लोन रिक्वेस्ट, ठीक है, ये केसेस होता है। रूटिंग की बात करें तो RTGS के बड़े पेमेंट या हैवी कैश विड्रॉल इन लोन अकाउंट, राइट। फिर उसके बाद इन्वेंट्री और रिसेबल का टर्नओवर के साथ मैच ना करना, यहाँ देखिए लिखा जा रहा है कि जो हमारा इन्वेंट्री है, जो रिसेबल है, वो टर्नओवर से मैच नहीं कर रहा है। बिल वेरिफिकेशन, लैक ऑफ ओरिजिनल बिल, कैश विड्रॉल में मान लीजिए हैवी विड्रॉल हो रहा है, सब केसेस को हम डिस्कस कर रहे हैं, राइट। करंट एसेट की बात करें तो ये सब के सब जो केसेस आपके सामने है ना, ऑल दीज आर रिलेटेड टू आवर स्टॉक ऑडिट रिपोर्ट। अब देखिए, उसके बाद एक है कि आपका RTGS ट्रांसफर लार्ज पेमेंट होगा, करंट एसेट सिग्निफिकेंट फ्लक्चुएशंस हो कर है करंट एसेट में, वर्किंग कैपिटल जो है टर्नओवर के रेस्पेक्ट में हाई बोरोइंग हमने ले रखा है, फिक्स एसेट में बढ़ रहा है बिना लॉन्ग टर्म फंड के। मतलब अब फिक्स एसेट लेने का तरीका है लॉन्ग टर्म फंड से या शॉर्ट टर्म फंड से मान लीजिए डाइवर्ट कर रहे हैं, ठीक है। तो ये सभी चीज़ें हैं। अब थोड़ा सा एक पॉइंट बताया जा रहा है अनबिल्ड रेवेन्यू, मतलब सबसे पहले कुछ की इंडिकेटर्स है, जैसे कि एनुअल रिपोर्ट में अब देखिए यहाँ पे अनबिल्ड रेवेन्यू जैसे ईयर ओवर ईयर इंक्रीज हो रहा है, इंटर कंपनी डील्स, लास्ट ट्रांजैक्शन एंड आउटस्टैंडिंग अमाउंट, ये सब के सब सिग्नल्स हैं फ्रॉड के। अब देखिए एक है हमारा एनुअल रिपोर्ट डिस्क्रिपेंसी बताया जा रहा है कि कुछ की इंडिकेटर्स हैं बैंक में की विजिलेंस फंक्शन और रेड फ्लैग के बारे में आइए बात करते हैं। तो देखिए जैसे एनुअल रिपोर्ट में मटेरियल डिस्क्रिपेंसी या डिस्क्लोजर पुअर हो, टैक्स रिलेटेड रेड हो, प्रमोटर का स्टेक कम हो या मैनेजमेंट में फ्रीक्वेंट चेंजेस हो, ये सब के सब मटेरियल इनकन्सिस्टेंसी, पुअर डिस्क्लोजर, टैक्स रेट, प्रमोटर डायरेक्टर स्टेक। अगर 5 करोड़ से ज़्यादा का एक्सपोजर है तो बैंक लीगल ऑडिट और क्वार्टरली रिव्यू भी करता है ताकि रिस्क का टाइमली असेसमेंट हो सके। लिखा है ना, लीगल ऑडिट फॉर एक्सपोजर 5 करोड़ प्लस, क्वार्टरली रिव्यू। अब बात करते हैं विजिलेंस के टाइप पे। देखिए 3 मेन टाइप होते हैं विजिलेंस के, एक होता है प्रिवेंटिव, डिटेक्टिव और प्यूनिटिव। प्रिवेंटिव में प्रिवेंटिव विजिलेंस सिस्टम फ्रॉड और मिसकंडक्ट को रोकने के लिए डिज़ाइन किया गया है। डिटेक्टिव वाला जो है वो विजिलेंस कंप्लेंट और ऑडिट के थ्रू फ्रॉड डिटेक्ट करता है, ठीक है। और तीसरा है हमारा प्यूनिटिव। तो प्यूनिटिव विजिलेंस में ऑफेंडर को पेनलाइज किया जाता है। फिर से रिपीट कर रहा हूँ, प्रिवेंटिव में सिस्टम फ्रॉड और मिसकंडक्ट को रोकने के लिए डिज़ाइन किया गया है। डिटेक्टिव विजिलेंट कंपनी विजिलेंस कंप्लेन और ऑडिट के थ्रू फ्रॉड डिटेक्शन करता है। और प्यूनिटिव विजिलेंस में जो ऑफेंडर है उसको पेनलाइज करता है। RBI के जो सेंट्रल विजिलेंस सेल हैं यानी CBC जिसको बोलते हैं, सेंट्रल विजिलेंस सेल, और CBI के साथ काम करता है ताकि ट्रांसपेरेंसी और अकाउंटेबिलिटी इंश्योर हो। तो प्रिवेंटिव, डिटेक्टिव, प्यूनिटिव आपको याद रहेगा ना। प्यूनिटिव के बारे में बता सकते हैं क्या होता है? तो प्यूनिटिव विजिलेंस में ऑफेंडर को पेनलाइज किया जाता है, लिखा गया है पेनलाइज। और डिटेक्टिव में क्या होता है कि विजिलेंस कंपनी और ऑडिट के थ्रू फ्रॉड डिटेक्ट करता है। फिर हम बात करें इसके प्रिवेंटिव विजिलेंस में कुछ की मेजर्स होते हैं, जैसे आप यहाँ देख सकते हैं जैसे कि रेगुलर ऑडिट, रिस्क एरिया को आइडेंटिफाई करना, सरप्राइज इंस्पेक्शन और जॉब रोटेशन, ये सब के सब हमारे प्रिवेंटिव ऑडिट के पार्ट हैं, प्रिवेंटिव विजिलेंस के पार्ट हैं। मतलब रोकना है ना, ऐसा सिचुएशन होने से रोकना। और इलेक्ट्रॉनिक विजिलेंस जो है इसके अंदर फिशिंग और फ्रॉड के अगेंस्ट प्रोटेक्शन के लिए 2 फैक्टर ऑथेंटिकेशन, स्ट्रॉन्ग पासवर्ड पॉलिसी और एम्प्लॉय अवेयरनेस प्रोग्राम बहुत इंपॉर्टेंट है। थोड़ा सा हम फिशिंग की बात करते हैं। तो अच्छा, तो फिशिंग में क्या होता है कि सोशल इंजीनियरिंग भाया फेक मेल, मैंने बताया था डेटा चुराने के लिए फेक मेल भेजे जाते हैं फिशिंग के अंदर। अब एक होता है पार्टिसिपेटिव विजिलेंस में एम्प्लॉय एक्टिवली पार्टिसिपेट करते हैं ताकि इंटरनल कंट्रोल और करप्शन के अगेंस्ट विजिलेंस स्ट्रांग हो। और यह CBC के स्टैंडर्ड्स को फॉलो करता है जो कि 1964 में इस्टेब्लिश हुई थी और 1998 में स्टेटरी एसेट में और स्टेटरी स्टेटस मिला था। चलिए, ये सभी पॉइंट्स हमें ध्यान रखने हैं। अब हम लोग अगली स्लाइड की ओर बढ़ते हैं और हम लोग डिस्कस करेंगे CBO के रोल के बारे में। तो CBO के रोल को समझते हैं। CBO पब्लिक सेक्टर बैंक में स्केल 5 और ऊपर के ऑफिसर के केसेस में विजिलेंस मैनेज करते हैं, ठीक है। स्केल 5 ऑफिसर होते हैं और ये ऑटोनोमस हैं और डायरेक्टली सीनियर एग्जीक्यूटिव को रिपोर्ट करते हैं ताकि इम्पार्शियल इन्वेस्टिगेशन हो। देखिए, विजिलेंस केस में क्या होता है कि कुछ कॉमन टाइप में ब्राइवरी, इलीगल गेन, डिसप्रपोर्शनेट एसेट, फॉर्जरी और नेग्लिजेंस जैसी एक्टिविटी आती है। अगर यह केसेस कंप्लेन करप्शन रिलेटेड हो तो जो मिसकंडक्ट के बेसिस पर उठाए जाते हैं। जूनियर ऑफिसर भी करप्शन रिपोर्ट कर सकते हैं और उनकी आइडेंटिटी प्रोटेक्ट की जाएगी। अब यहाँ पे देखिए विजिलेंस का क्या प्रोसीड्यूर होता है। तो पब्लिक नोटिस लगाई जाती है जो ब्राइवरी और करप्शन डिस्करेज करता है। कंप्लेन को ट्रैक करने के लिए एक रजिस्टर मेंटेन करना होता है जिसमें कंप्लेन का स्टेटस अपडेट होता है, जैसे नो एक्शन, वेरीफाइड, फॉरवर्डेड या इन्वेस्टिगेटेड। फिर CBO का रोल प्रिवेंटिव और डिटेक्टिव दोनों है, याद रखिएगा, प्रिवेंटिव भी डिटेक्टिव भी है। प्रिवेंटिव में बैंक सिस्टम को एग्जामिन किया जाता है ताकि करप्शन रिस्क आइडेंटिफाई हो सके, और डिटेक्टिव रोल में CBO सर्वेलेंस, कंप्लेंट मैनेजमेंट और इन्वेस्टिगेशन हैंडल करता है। इन्वेस्टिगेशन और रिपोर्टिंग हैंडल करने के लिए यहाँ पे देखिए बताया जा रहा है कि रिपोर्टिंग प्रोसेस में प्रिलिमिनरी इंक्वायरी काफ़ी इंपॉर्टेंट है और प्रॉम्प्टली की जाती है। अब देखिए, एक हमारा डिसिप्लिनरी अथॉरिटी होता है, इसको DA बोलते हैं। तो DA को डिसीजन में हेल्प करती है। अगर 2 ऑडिट या 4 साल में कुछ प्रूव नहीं होता है तो एक्शन ड्रॉप हो जाता है, राइट। अब थोड़ा सा हम लोग DA की बात कर लेते हैं, डिसिप्लिनरी अथॉरिटी की बात कर लेते हैं। सबसे पहले डिसिप्लिनरी अथॉरिटी का रोल समझते हैं। DA डिसीजन लेता है बेस्ड ऑन प्रोपोंडरेंस ऑफ प्रोबेबिलिटी। यहाँ देखिए लिखा जा रहा है DA डिसीजन लेता है प्रोपोंडरेंस ऑफ प्रोबेबिलिटी, मतलब अगर ज़्यादा चांसेस हैं ना कि मिसकंडक्ट हुआ है तो एक्शन लिया जाता है। यह एब्सोल्यूट प्रूफ पे नहीं बल्कि प्रोबेबिलिटी पर डिपेंड करती है, इसीलिए नाम ही रखा गया है। इन्वेस्टिगेशन रिपोर्ट को कॉम्प्रिहेंसिव होना चाहिए, लिखा है ना, कॉम्प्रिहेंसिव रिपोर्ट होना चाहिए। और जो DA है यानी डिसिप्लिनरी अथॉरिटी है, ठीक है, ताकि DA को प्रॉपर डिसीजन लेने में मदद मिल सके। और अगर किसी मिसकंडक्ट के डिटेक्शन को 2 ऑडिट या 4 ईयर के अंदर नहीं हो पाता, मान लीजिए कि कोई मिसकंडक्ट का डिटेक्शन जो है 2 ऑडिट या 4 ईयर के अंदर नहीं हो पाता तो उस केस पे एक्शन नहीं लिया जाता। वही क्या जा रहा है, टाइम लिमिट फॉर एक्शन, तो कोई एक्शन नहीं लिया जाएगा यदि अनडिटेक्टेड रहे 2 ऑडिट में या 4 साल में। फिर विजिलेंस डिपार्टमेंट DA को सपोर्ट करता है इन्वेस्टिगेशन और पेनल्टी रिकमेंडेशन में। एक्यूज को अपना साइड रखने की राइट मिलती है, मतलब वो एविडेंस को कंटेस्ट कर सकता है। दूसरी बात है, पेनल्टीज़ भी अलग अलग होते हैं। जैसे यहाँ देख सकते हैं, यदि मेजर है तो अगर मेजर मिसकंडक्ट हो तो पे कट, डिमोशन, फोर्स रिटायरमेंट या डिसमिसल हो सकता है। और माइनर पेनल्टी जैसे वार्निंग या लेसर एक्शन भी लिया जा सकता है। टाइमली डिस्पोजल ऑफ केसेस काफ़ी ज़रूरी है ताकि स्टाफ मोराले डाउन ना हो। यह प्रोसेस गवर्नमेंट और CBC के मॉनिटरिंग में होती है। टाइमली डिस्पोजल यहाँ देखिए बताया जा रहा है टाइमली डिस्पोजल के बारे में। ये देखिए, उसके बाद दोस्तों टाइमली डिस्पोजल के बाद अब प्राइवेट और फॉरेन बैंक में विजिलेंस गाइडलाइन को समझते हैं। RBI गाइडलाइन के मुताबिक प्राइवेट और फॉरेन बैंक को एंटी करप्शन मेजर इंप्लीमेंट करने पड़ते हैं। अब एक होता है CIB क्या होता है, चीफ ऑफ इंटरनल विजिलेंस, इसको CIB बोलते हैं। तो ये जो चीफ ऑफ इंटरनल विजिलेंस होते हैं, इनका रोल होता है करप्शन को इन्वेस्टिगेट करना, इंटेलिजेंस गैदर करना और CEO को रिपोर्ट करना। CIB पेंडिंग इन्वेस्टिगेशन का मंथली रिव्यू करता है और बोर्ड को रिपोर्ट करता है। तो की प्रैक्टिसेस में सेंसिटिव रोल को आइडेंटिफाई करना और स्टाफ रोटेशन और मैंडेटरी लीव पॉलिसी को इन्फोर्स करना शामिल है। फिर कह रहा है कि कंप्लेन चाहे एनोनिमस हो या नहीं इन्वेस्टिगेशन की जाती है, अगर वो मेरिट पे होती है तो। फिर इन्वेस्टिगेशन प्रोसेस में डिसाइड किया जाता है कि इंटरनल इंक्वायरी होगी या पुलिस को इन्वॉल्व किया जाएगा। स्पेशल केसेस में पुलिस या SFIO के साथ कोलैबोरेशन होती है, ठीक है। तो ये सब डिसिप्लिनरी प्रोसीडिंग के रिगार्डिंग कुछ पॉइंट है जो कि ध्यान रखने हमें। तो फ्रेंड्स, ये था हमारा कंप्लीट लेक्चर। आपको यदि इसकी PDF की रिक्वायरमेंट है तो हमारे कैप्सूल कोर्स में आप इन्वॉल्व हो सकते हैं। इस नंबर पे मुझे व्हाट्सअप करें या डिस्क्रिप्शन सेक्शन में जाइए, वहाँ पे मैंने लिंक दे